Yeah, and he said, "Well, let's buy some of this stock." I think it was $4 a share, and I had maybe $500 saved up from various odd jobs, caddying and that sort of newspaper routes, that sort of thing. And he said, "Well, buy 1,000 shares. You put up your $500. If you lose, you lose the $500, but you make money." So I didn't realize at the time, but he was essentially giving me 8-to-1 leverage on this trade. Fortunately, it worked out, and it went to $10 a share about 6 months later. And, for no other reason than, hey, it's $10 a share, I said, let's sell this. And so I made a profit of $6,000. And from there, I was pretty much instantly hooked and thought, this is great. Why would anyone ever have to work for a living when you can just do the, trade like this? And obviously, it's not that simple. I had some very good beginner luck, and it worked well, though. But that's what really piqued my curiosity.
Yeah, that definitely is some very nice beginner's luck right there. So, what was your sort of motivation to buy that? Like, where did the idea come from to actually put your money into that company when you could have invested in any company that's listed on the market?
Yeah, I had seen on television a local news broadcast saying how that this technology was reluctant to be brought on at first because the state police in Massachusetts didn't want to pay for the transponders to track the stolen vehicles down. So the company said, we're going to donate them to the state police department. And the state police were real excited about it. And I remember hearing one of the cops on television say, hey, I think this is great. I even bought stock in it. Found out later that the trooper, basically had inside information when he bought it and had to give his profits back on that. But it didn't prevent me from, coming up with the idea. And I was, probably just a young, impressionable kid who wanted to bond with his dad and thought that this was a great idea and knew that, he was in the market, and we'd been watching Wall Street Week, like I said, and I figured, hey, let's put some of this to work. What do you think, Dad? And he took the initiative to say, okay, let's do it.
Okay, excellent. And just quickly, how active was your dad in the markets? Was he an active trader?
No, my dad, he's retired now, but he's a physician, and he would, he was pretty active, but not by any measure compared to, like what I do today or where my trading has evolved to. He's been more of a buy and hold for, 6 to 12 month type of investments.
Okay, sure. Cool. All right. Well, so from college, moving forward a couple years, you landed a job as a stockbroker. How did that come about, and what sort of tasks were you doing in your role as a stockbroker on sort of a day-to-day basis?
Well, the interesting thing was that I really didn't know what a stockbroker did. And maybe that's naive, but I think it's good too, because I probably wouldn't have gotten into it if I realized what a broker's job was. So, after college, I didn't really know exactly what I wanted to do. I knew I liked the market, and happened to find a brokerage firm that was willing to sponsor me for the Series 7 license. Once that occurred, I went in to the office, and they basically gave us a script and said, start calling off these lists, find phone books, alumni directories, and that sort of thing. And it was after I passed my Series 7 license and was making the calls for a while, I realized that the business was really a glorified telemarketing position, not the trading that I was interested in. So again, probably a little bit naive, but it's it got me in the door. I went to a more established firm, which was Lehman Brothers, and really learned how to sell there more than anything, which was great training. And then just kind of transitioned to trading from there after moving to a couple different brokerage firms.
Okay, so you were mostly on the phones there, trying to convince people to buy stock. Is that correct?
Yeah, yeah, and it's I like to kid around about it and say that it was a great experience because I got to practice with other people's money, and I wasn't cavalier with anyone's money that they entrusted me to, but I did learn a lot of good lessons by not having my money in the market and learning how the market worked a little bit. So I was instantly attracted to technical analysis. It made a lot of sense to me. One of the early influences there, I guess, was there was a newsletter called the Cabot Market Letter, and they had written about, they were interested in buying this stock if it got above a certain level. And I thought, well, isn't that strange? Why would somebody want to buy it at a higher price? That seems kind of counterintuitive. So I looked into it, and I saw the chart, and it instantly made sense that if it got above that level of resistance, I didn't even know that's what it was called at the time, but if it got above there, that it looked like it was clear sailing from there. So I ended up getting involved in that stock, made money, and just started to devour everything I could find about technical analysis.
Okay, sure. So you went to the stockbroking firm, and then you went to Lehman Brothers. From there, I believe you ended up trading with a prop firm. What was your experience like trading with a firm, and what was the attraction to actually get into a firm instead of trading your own money just as a retail guy?
Yeah, I think I was 22 or 23 years old when I did that, and it was basically I had saved up some money in the market, and I had seen in the back of Investors Business Daily there was every single week a advertisement for trade with our capital, or earn 20 to use 20 to 1 leverage is what it was. So I was intrigued with that because I figured that I didn't have enough money to really get involved in the market with the amount of capital that I had. So I was still a broker. I answered this ad, went to New York, and met with these guys. And I signed up as a remote trader, and this was 24K modem. And I remember being all excited with a 48K modem, sitting there in my basement trading. And they didn't give a lot of training. That was the thing that they basically said, okay, we'll give you a shot. You get to keep X percentage of your profits. And I had, I basically borrowed some money to put down for that initial $25,000 deposit. And so therefore I was extremely risk averse. And that really helped me. I mean, they say don't trade with scared money. And I don't think it was necessarily scared money, but I was being smart and really people say they don't like to lose, and I say in the market you have to hate to lose. You really have to. When you start feeling something moving against you and you get uncomfortable, you just have to get the heck out of it. So I was fortunate in a way that I wasn't scared money, that I had the opportunity to see how stocks traded, technically through my experiences as a retail broker. So that was great experience for me. And from there, then I helped them, that is the New York firm that I was with, I helped them open an office in Denver and started branching out that way a little bit.
Okay, sure. And did you mention in there that you were working, or you were trading, remotely from the firm? Yes, it was, so they were out of New York and they didn't have any local offices. So they were sponsoring people to, trade with their leverage basically. And, they got a piece of the commission and they marked up the commissions a little bit, so that plus the additional profit that they made, that it was a good business model for them, and it was a great opportunity for myself. Okay, sure. And are there many prop firms that still kind of operate that way today?
Yeah, there are. Yeah, there's still. I mean, if you dig around, you can find them, and they are. A lot of times people are attracted to them. I can't criticize the firms or the people who are attracted to them, because what they typically attract are people with less capital and maybe not a whole lot of education either, but they're willing to give them a shot basically in the market. And I would say that, knowing what I know about the markets today, that I took a huge risk that I would not recommend anyone else do when I did do that account with the prop firm, but it worked for me. So I think that everyone, has the right to make that decision for themselves.
Yeah, absolutely. So you mentioned right there that you took on a huge amount of risk to do this. Did you ever have a backup plan in case this trading thing never took off for you?
Great question. And I can't really say that I had a defined backup plan. It was more, I'm going to make this work one way or another. And I suppose that if it didn't work out, I would have returned to the brokerage business and started, building a book of business that way again.
Okay, sure. So during this time, up until sort of where we are right now in your journey, what would you say was the biggest challenge, within these sort of first 5 years, the biggest challenge or some of the hurdles that you had to overcome that were essentially affecting your P&L in a negative way?
Well, I think it's true for almost anyone that we are our own worst enemies. And, I'm not sure if that's the answer you're looking for, if you're thinking, maybe some external factor. But realistically, I think that we are all our own worst enemy in the market. That even today, I'm still astounded some days about some of the decisions I make during the day, and think, well, I knew better than that. What was I thinking? And to control our impulses and to be more disciplined, to cut losers quickly and to hold winners, real basic stuff. Those are the things that trip pretty much everyone up and continue to plague anyone involved in the market who's honest. We are human. We do get emotionally involved, even though we try not to. And the thing that I've gotten a lot better at is recognizing those times when I'm making poor decisions and saying, enough, just stop, liquidate the position. This is not smart. So it's a matter of probably trading more specifically, maybe I started trading too big and too concentrated in certain positions. But at the same time, right before I learned a great lesson right before I started with that prop firm, because I was trading a company called Chantel Pharmaceuticals, and they weren't a pharmaceutical; they were a complete fraud. Actually, they had a miracle skin cream that eliminated wrinkles, and this stock was going. It started out at maybe $6 a share, and I was on it because it had big volume. It was breaking out, and I was trading it up to about 23, 24. I held some over the weekend. One weekend, maybe 1,000 shares at $21 a share, and I remember that Monday morning seeing that the stock was halted. And it was, Barron's did a hit piece on it, and the stock went. It was basically cut in half, and I lost maybe $8,000 to $12,000. I don't remember the numbers overnight. Right before I was just getting my money together to go trade. So the lesson there was not to have such concentrated positions, especially in little story stocks. And there's so many lessons you learn along the way. But that was one that really stood out for me, that almost eliminated me from ever getting involved with that prop firm.
Okay, sure. So I really like that answer, and that's an excellent example too. While that was probably quite a painful point in your sort of development stage, were there any points where you felt like maybe you weren't just cut out to be a trader and you actually came close to giving up?
Yeah, actually, it was probably I'm just going to say It was maybe 2000, 2001. At that point, the market was getting crushed, and I had not learned at that point yet that you can't just keep buying stuff that goes down. And I was actually had a prop trading firm of, I can't really call it a prop trading firm, more of a people would come in and trade with their own money, and we would help them with getting extra capital. But the market was getting crushed, and I was losing money pretty consistently at that time, just buying stuff in downtrends and expecting that they would bounce, and they weren't bouncing. And I nearly dissolved the account. I was super close. I took a couple weeks and did some reflecting, came back and talked to the partner that I had at that time and said, listen, here's what I need to do. Fortunately, we had a business, and the business was profitable. So I just slowed things way down, and started trading. Maybe, I don't even remember, but half of or a third of my normal size, and just started grinding it back and getting back into it in a more disciplined way, and reevaluating and learning. So I was real close, though, to throwing it away. And if I did not have a backup plan, backup business where I was able to pay bills, then there's no doubt in my mind that I would have been out of the business and no idea what I would be doing today. I was very fortunate, I think.
Okay, right. Yeah, that's really interesting. So let me ask, from when you left the stockbroking firm job to at what point, how long did it take you until you reached a level of consistent profitability? Like, when did things really start to click for you?
Well, I remember my first 6 or 7 months, I was profitable every month, and I was being super disciplined and cutting losses. Then I started to get a little bit of that ego involved, where I thought I knew everything. And then I started to go through a down stage. Fortunately, I kept it limited, and it was really just an evolution, really. The whole thing, obviously, trading in general is an evolution, and you come back to the basic principles. So I kind of got lost on that question there for a moment, but the thing that I would say is that my lessons learned are that the basic things that I still preach to this day: only price pays, follow the trend. I repeat those things a lot of times to remind myself, because that's really the principles of how you make good money in the market. And I believe you get exactly what you deserve in the market, that you can't make excuses that if I lose, it's because I did something stupid, and I hold myself accountable. I can't complain about Greece or China or whatever the news of the day is. I have to recognize the environment we're in and adapt to it, or stand on the sidelines and wait till things make sense.
Yeah, totally. So let's get into that a little bit deeper. So describe to us, if you could, your actual trading style and your methodology for how you approach the markets these days.
Well, my main approach, sometimes I will do counter trend trades on an intraday basis, but the main approach is that I'm a trend trader, and I'm looking for stocks, for instance, in an uptrend, and using multiple time frames. So as I describe it, it's not really quite this simple, but identify a stock on a longer term time frame. So when I'm looking at a swing trade setup, and that's my preferred time frame, is that I want to look for stocks that will last a few days in terms of the trend, if the market warrants it. And obviously there's certain conditions where we've got a choppy market and it's just not feasible. But I'll look for the bigger trend on a daily time frame, and a real very, very simple thing that I look at is what's the direction of the 50-day moving average. Now that will just tell me, okay, if it's rising, well then we're in an uptrend, and I look at that stock and say, okay, that's not a stock I want to short. If the stock has a declining 50-day moving average, I say that's not a stock I want to buy because it's in a downtrend. So I'll look at it and see, has it had a period of volatility contraction, and that is, has it pulled back? And so the uptrending stock, if it's pulled back to a prior level of resistance that looks like it might be support, or a key moving average, or a retracement level, or just something significant technically, then I will say, okay, now on that daily chart, I've identified a possible trade candidate. Then I will go down to a 30-minute chart. So each candle representing 30 minutes for the last 20 to 40 days, whatever I need to kind of see what's relevant, basically. So on that 30-minute time frame, and it's not just a 30-minute time frame, you have to be aware of all the time frames really, but this is again simplifying it. Then I'll look at it and say, okay, on this 30-minute time frame, where has the stock come from? So if it's run 10% in the last 3 days, it tells me the risk reward isn't good there. But if instead we've got a stock in a strong uptrend that's pulled back on diminished volume, and it's starting to undergo a little bit of accumulation on that 30-minute time frame, then I'll start to look a little bit more carefully. And one of the guidelines I use on an intraday, intermediate term time frame, such as a 30-minute chart that goes back 20 to 40 days, is a 5-day moving average. And I generally want to buy the stock when it makes a higher high above a flat to rising 5-day moving average. And that tells me the intermediate term trend is now turning back up, and I have a logical place to set my stop, which would be, as I like to say, underneath the most recent and relevant higher low. So that if I see that the entry relative to the initial protective stop is small enough to justify a position, and that the trend on the longer term time frame looks like it should be able to continue in the direction, in this case in an uptrend, then I'll look to say, where's the potential for resistance, or where would it likely slow down? And based on that perceived amount of potential reward, then I come up with a risk reward and say, okay, this is a stock that makes sense. So I use that 30-minute time frame to come up with the risk reward and to plan the trade. And then I'll go down to like a 10-minute chart, each candle representing 10 minutes over the last 10 days or so. And I'll start to anticipate the trade now more. I'll start to stalk it, set alerts. If I think it's going to break out beyond 25.50, I'll set an alert, let's say at $25.40. And then when that alert triggers, I'll start to look at the stock a little bit more carefully. I'll see, what's the overall market doing? Is there, if the market's down and the advanced decline line is let's say 2-to-1 negative, I might, I'd say, well, I still want to look at this stock, but maybe I'll trade smaller share size. And so I start stalking it. I'll reset my alert to 25.45 or 25.48, or I'll start to watch it on a shorter term time frame. And then I want to make my decision based on price only. I don't want to look at it and say, well, the volume's not there yet, because a lot of times people will wait for volume, but the volume will come a day and a half later when the stock has already moved 5 or 6%. So to trust price action, going back to your question of, what lessons have I learned? I think that trusting price action, if you have a good plan and you have a backup plan for it, that really you're going to get into a lot more trades and not talk yourself out of them because the volume's not there yet, or there was a divergence with the MACD, or, well, I don't like what the NASDAQ is doing, or something like that. So to take each trade based on the merits of that trade individually, And if there are macro concerns about the market or some kind of event coming, to use that for the money management aspect and to reduce my position size to compensate for that higher volatility or perception that we might not be able to follow through as strong as if the entire market was in a better trending condition. So it's a long-winded answer, sorry.
No, that's excellent. That's really good. So,
are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, just so we're clear, like you spoke there a lot about price action and focusing on the price itself. How do you treat fundamentals and news? I think you might have briefly touched on that there, but just so we're clear, do the fundamentals and news have any impact on your decisions to get into a trade?
I try to not let them. I am generally aware, so I want to know what are the potential catalysts for a stock. So if for instance, I'm looking at this stock and I think it's a buy, but then I see they're due to report earnings after the close, then I'm not going to trade the stock because I don't want to gamble on earnings. That's a lesson I've learned in the past as well. Gambling on earnings, it's gambling. There's no edge there. So I will be aware of what the catalysts are potentially. I'll be aware of the news headlines at least to try to determine what are the catalysts, what's shaping the psychology in the market today. But I try not to read into it too much and have an opinion of the news itself, because the news is often, I don't want to say made up, but coincident to the price action. Not leading, or it's, we can't always trust accountants. We can't trust CEOs that the news is actually what's happening. And that's why I adamantly say over and over again, only price pays, that you can be aware of the headlines and that sort of thing. But market doesn't care what I think about a stock, about what its value is or what it should do based on an earnings report or something. The only thing that's going to pay or hurt is price action. So I would rather lose my opinion than lose my money and move to the sidelines quickly, because you can always reassess the trade and determine to get back in. But there's a tendency to that when we look at the news, we get our egos and our opinions, and we think the need to be right becomes stronger and really clouds our judgment.
Yeah, okay. No, that's excellent to hear about. Um, Now, this is something you often talk about, and that is focusing on the psychology of patterns and less about the actual pattern itself, like whether it's a cup and handle or a double bottom or whatever it might be. So, could you explain perhaps your reasoning for looking at patterns from this angle?
Well, there's nothing wrong with recognizing a pattern, and I often talk about candles, for instance, as well. Some people will be looking at a candle and they'll say, "Hey, that's a doji," and on the daily time frame. And I'm more interested in what happened underneath the surface. How did that doji come about that it sold off strong in the morning and might have chopped sideways for a little bit, but then the buyers regain control, and I can see it much better on a shorter term time frame. That is, I can understand the psychology of what's shaping it. And back to the cup and handle, nothing wrong with recognizing these classic technical patterns. And I started like that as well. Looking at recognizing technical patterns, but I saw a lot of them fail. And what is it behind there that makes the sense? So a cup and handle, you could train a monkey to recognize cups and handles. You can program a computer to do it. But there's the art of the science rather of technical analysis versus the art of trading and understanding, hey, things can and often do go wrong. That is, they don't work out as anticipated the way a technical analysis book will tell you it should. So I want to see that, so a cup and handle, a stock comes up to a certain level of at $80 a share. It runs up to that. It pulls back down to 70 and it runs up to 80 again, but there's still supply there that's unable to be taken out at that point. So the stock backs off again, but instead of backing off down to $70 a share, it finds buyers at $76 a share. It finds support and starts rallying up towards that $80 level again. And then it might even dip down to 78 and then hit the 80 and then break out. So the point is, though, that these higher lows that are being established tell me that the buyers are gaining control price-wise. They're not waiting for the pullback to 70. Instead, they take control at 75. Then they take control at 78. So they're getting more aggressive price-wise. And the time distance between those tests of resistance might be, from the first test of 80, it might have been, to the second test, it might have been a month and a half. And then 4 weeks later, we test that 80 level again, and it pulls back to 78. Then 2 weeks later, it comes back up again. So they're getting more aggressive, not only price-wise with the higher bids where they're taking control, but time-wise that they're coming back more often to test and work through that supply being offered at the $80 level. So so you can understand what's happening rather than just saying, hey, that's a cup and handle. I read about those. Those are bullish. I'm going to buy it. It just gives you that better understanding of what the forces are underneath the market. So you want to look at the market and say you can have one of three positions. You could be long, you could be short, or you could be in cash. How do the longs feel? How would you feel if you were long? And where would you be getting more aggressive? How would you feel if you're the seller at that $80 level and your supply gets worked through? Or if you're a short seller and you're trying to hold it back at that $80 level? And if you have the ability to be objective and on the sidelines in cash, where do you get involved at the best risk reward standpoint? So it's not really super complicated to try to put yourself, how would I feel if I was long there, if I was short on that stock, or if I'm in cash, should I just ignore this stock, or is there the potential for opportunity in it?
Yeah, you mentioned a lot of great points in that answer, so thanks a lot for sharing that, Brian.
Sure.
Now, I've noticed in your analysis of reading charts that you pay close attention to two indicators. There might be others, but I noticed that you pay extra close attention to these two. So the first would be moving averages. and the other would be VWAP, volume weighted average price. So, or I'm not sure what it is, but have you noticed this? And why do you think this sort of there's, I don't know if a stereotype's the right word, but there's kind of like a stereotype around moving averages as though they're ineffective?
Yeah, I think that a lot of people do misunderstand and misuse moving averages. I look at them as a mathematical trend line, a constant to compare price to over a certain period of time, whether it be 20 days or 50 days or 200. The time is the constant, in other words, in a moving average. And just like we were talking about the psychology of a pattern, I think it's even more important to realize with a moving average, we're all taught that a 50-day moving average is support. I say it tends to act as support. So a stock in a strong uptrend pulls back to a 50-day moving average. People will say that's a buy signal. And to me, it's not a buy signal, but it's a reason to look more carefully at the stock on a shorter term time frame, to look under the surface and see what's actually happening there. Because I can show you thousands of examples where a stock pulls back to the 50-day moving average and just keeps going. That is, it just keeps dropping. So it's the psychology behind that 50-day moving average. If you're a long holder and you bought the stock, let's think of a mutual fund or someone, and they've got millions of shares of this stock, and they bought it at 20, and it runs to 28. And it's 4 points above its 50-day moving average. They might say, hey, it's getting a little extended. Let's start paring our position back. Let's sell some while we can. So they sell a couple 100,000 shares. It pulls back down to the 50-day moving average, and they say, all right, let's not sell anymore because the 50-day moving average often acts as support. So what they're doing is they're removing supply from the market at that area only because they've observed, they've learned that the 50-day moving average often acts as support. Let's think about a short seller in the same situation who thought, hey, this stock has gotten overheated. Let's sell short some stock. We'll cover it down near the 50-day moving average. So they put the supply on the stock to bring it down to the 50-day moving average. They start to stick in their bids for the stock, and they not only remove one of the sources of supply that helped get it to that 50-day moving average, but then they're also starting to add some demand in there by putting in bids. So the bids are starting to show up, and the stock is losing supply, and we're starting to see that gradual shift. So I want to look underneath the surface and say, is there actual evidence? Let's go back to that 30-minute time frame. Is there actual evidence on the 30-minute time frame that the stock is starting to at least turn sideways, that the pattern we've seen over the last 2 weeks during this pullback of lower highs and lower lows is starting to show more neutral market? So we see less supply. We're starting to see a little bit of demand. And then think about the people, the big mutual fund might say, okay, we sold 200,000 shares between 25 and 28. Here it's at the 50-day moving average. Let's bid for another 100,000 shares. We'll replace part of our position in there and provide support for the stock as well. So they're putting in bids. That's the source of demand. And then you've got your all of the people who look at moving averages and say, hey, the 50-day moving average usually acts as support, so I'm going to stick in a bid there. I want to get involved in this hot stock because it's pulled back to the 50-day moving average. So we start to see that it becomes a self-fulfilling prophecy, this 50-day moving average or a 10-day moving average or whatever the dominant moving average is for that stock on whatever time frame it is, a 200-day moving average, let's say. So there's the psychology behind why do people look at that level. Now let's take it one step further and say, since that stock rallied from 20 to 28 and it's pulling back to 24, we might have another group of people who trade based on Fibonacci. And they're saying, well, it's pulled back to a 50% retracement. 50% has been a good level to buy this stock. So they kind of go through the same process of let's put in our bids here, let's remove supply. And then let's say there's another factor such as the volume-weighted moving average price since that event is in that area. So there's the psychology behind all of these oscillators and indicators that are much more important than just looking at little squiggly lines and saying, okay, that's a buy signal, okay, that's a sell signal.
Okay, excellent. So let's talk about the VWAP. I mean, what is it you like about this indicator, and what separates VWAP from other indicators?
The volume-weighted average price, what it does is it takes, so whereas a regular, simple price-based moving average is based on of the average price for whatever period of time you're looking at, it doesn't consider the volume that traded there. So if we have a stock that traded, let's just say, keep it real simple, if you had a stock that traded 100 shares at $20 a share and 10,000 shares at $19 a share, you can't really assign the same value on a moving average to say the average is 19 and a half. The average is really closer to 1901 based on volume. So we're looking at it from the supply and demand in terms of the actual dollar amount assigned to a certain price level. And what I like to look at is, for instance, the volume weighted average price since an event. One thing that's been really helpful is, since when a stock breaks out from 20 to 28 and then it begins to pull back, oftentimes you will see that buyers congregate, or support is found near the volume weighted average price since that breakout event. Or more recently, I've been tweeting about, for instance, in Alibaba and in GoPro, the volume weighted average price levels since these companies actually became public, and they've both, within the last couple months, shown that, the stocks had some nice bounces and they rallied almost precisely to the level, the volume weighted average price, since the stock came public. So there's a lot of psychology assigned to that level. It's the average price. It says above this level, the average participant is making money. Below it, the average participant is losing money. And we can start to, delve into the psychology of the buyers and sellers and see how much they have at stake at certain, they tend to be inflection points. So at those levels, how much do they have at stake, and who's, gaining or losing control there?
All right, cool. So still on the subject of VWAP, do you find that it's more popular within the professional space? And if you do, why do you think that VWAP is maybe underutilized by retail traders?
Well, one of the original uses of the volume-weighted average price is for, let's say you work at Fidelity and you want to buy 2 million shares of Alibaba. So you tell your broker, hey, I want to buy 2 million shares over the next 2 weeks, and what I want you to do is to do a good job for me. The way I'm going to measure that is over the next 2 weeks, we're going to see what the volume weighted average price was during that time. If you do better than the volume weighted average price during that time, I'll give you more business. If you do worse than that, I'm going to go to a different brokerage firm and have their traders execute the trade for me. So it's a value comparison for a lot of institutions in that regard. I think, though, that over the last I've been looking at the VWAP for about 12, 13 years, and I actually stumbled upon it. I think that everyone looks at every oscillator and indicator when they first start out looking for that holy grail. And the VWAP just seemed, it just kind of spoke to me that it acted as support and resistance. So it is becoming more widely used by retail. Fortunately, not overused. That it's still effective for looking at even intraday in the markets. I'll look at it often on a 1 minute chart and look for who's in control. And if it's got a declining volume weighted average price, generally I don't want to buy it. If it's got an advancing volume weighted average price, that is, the average price has been increasing throughout the day, the transaction level has been increasing throughout the day, then I generally don't want to short that stock. So it's becoming more widely utilized. I like to think I have something to do with that. I've been tweeting about the VWAP and wrote about it in my book in 08. So I've been tweeting about it and talking about it and writing about it since then. And it is becoming a lot more prevalent with more retail type people.
Okay, sure. No, that's really well said. Now, you spoke a little bit earlier about your time frame analysis, and I've just got a few more questions around that. But before we get into it, I think it would be beneficial if you could maybe run us through the 4 phases of market cycles as you see them. I believe you cover this in your book, but if you could just give us sort of a brief overview of the 4 different phases of a market cycle.
Sure. Actually, you know what I would like to do, Aaron, is to send you a copy of the infographic I had made up for that, because it really explains it a lot more in detail, what I'm going to be able to say, and perhaps you can put a link up to it with this podcast. But essentially, it's as I mentioned, when I first started trading, I wanted to I got my hands on as much technical analysis information as I could. And what's always been attractive to me is the simpler analysis. And Stan Weinstein's book from 1986, I believe, or something like that, Secrets for Profiting in Bull and Bear Markets. If any of your readers have or listeners have read that, they'll see it's been a huge influence on my career. I in fact sent a copy of my book to Stan Weinstein, and he praised me for it, and saw that I said, "Hey Stan, this is I've been hugely influenced by your work. I learned this from you, and I want to give you credit." And anyways, the 4 stages, it's goes back to the business cycle. The business cycle being, we have periods of expansion, then we have a peak, then we have a decline and a trough. So we have these 4 stages. And in the market, it's been described as stage 1 is accumulation. Accumulation occurs after a decline. So after a long decline, it doesn't even have to be a long decline. Let's say we're talking about a daily chart, and the stock has experienced a significant pullback. As I like to say, if they don't scare you out, they'll wear you out. So during the stage 4 decline that precedes stage 1 accumulation, what you see is that you've got stubborn holders who hold the stock on the way down. They're not being disciplined. They're not cutting losses. They're still believing the press and the hype around a stock. But in that stage 1 accumulation, what's happening is the stock starts to become indecisive as the supply and demand starts to reach a little bit more of an equilibrium, that you don't see there are these fearful sellers anymore. It starts to turn a little bit more neutral. So that accumulation phase, what we see in there is that it can last a long time, and one of the hallmarks of a accumulation is that we see moving averages crossing back and forth above and below each other. So moving average crossovers represent indecision. A lot of people use them as a timing tool, and I think that's incorrect, because moving average crossovers mean there's a conflict in terms of trend So a 20-day moving average crossing up and down, up through and then down below a 50-day moving average says, the intermediate and longer term trends are in conflict here. There's no real trend revealing itself. So it's a good avoid. So during that stage one accumulation, it's a good stock to avoid. As those longer term moving averages flatten out and begin to, start to turn higher, then you see that the buyers are slowly gaining control. And in that late stage one accumulation, that's where you anticipate the breakouts. So as the stock makes a higher high above the flat to advancing longer term moving averages, that's when you want to participate in the stock. So you anticipate in stage one, you participate in stage two, and as it makes the higher highs and higher lows, you manage risk and hold on as long as the stock tells you to, based on whatever time frame you're engaged on. So in other words, as long as it makes higher highs and higher lows, you stick with it. And then as it undergoes distribution, we see the opposite of now we see that the stock is not going higher anymore. It's being met with more supply. The moving averages cross back and forth, representing indecision, and it's either digesting those gains through time before a breakout, or if it breaks down, then we look at it and say, okay, now the moving averages are heading lower. This is a stage 4 decline. That stock is an avoid if you're just a long trader, or it's a short sale candidate. So those 4 stages allow you to just kind of very simply look at the market or an individual stock and say who's in control, buyers or sellers, or is it unclear? And if it's unclear, the beauty of that is that's just an avoid. There's no reason to go near that stock and give it some time, keep it on your watch list, come back to it, but there's no reason to be involved in a stock that's just going sideways.
Yeah, well, there's always plenty of others to choose from, isn't there?
Exactly.
If you can send through that infographic, I'll post it with the show notes underneath this episode.
Yeah, of course.
At Chat with Traders on the site. So I have a question in regards to time frames, and how did you discover the time frame which was the best fit for your personality to trade? Like past guests on the show have mentioned quite a few times that many traders often spend a long time working with a time frame that isn't necessarily the best fit for them. So how did you discover a time frame that worked well for you?
Well, and that's a great point. And going back to your, what lessons have been important, understanding your time frame is hugely important. And, if you have the patience of someone like Warren Buffett, then you've got no business looking at an intraday, chart for what happened for one day. But if you're maybe a little bit more, I think a lot of traders tend to be a little bit ADD and hop around a little bit from stock to stock looking for the action, then you shouldn't be looking at what pays the best dividend. So it comes with, like a lot of success in the market, with understanding yourself personally and what works best for you. How much time do you have to commit to the market? Can you sit down in front of the market each day and be on task and pay attention to the micro movements and be patient enough to not just get emotionally involved because you're bored and I'm a trader, so I should be trading type mentality. So how much time do you have? How much capital do you have? How much experience do you have? No one should start out with day trading. Day trading is something you evolve, or some people might say devolve to. But because there's, the more often that you're confronted with having to make a decision in the market, the more often it is, the more likely it is that your emotions are going to creep into the decision-making process, and you're not going to be able to control yourself as well. So everyone should start out with a longer-term horizon, whether it's a couple months, or swing trading is really an ideal type of time frame because it gives you the opportunity to get feedback on your trades within a couple weeks, generally, and you can learn and hone in on things a little bit better. You don't have to be watching tick by tick. But if you are the type of person who, can sit in front of the machine and pay attention, control your impulses, and you've been successful on the couple month horizon, then down to a successful swing trader, if you can do that successfully, then you start to experiment with day trading. It's a great skill to have. It's not appropriate all the times when you've got a choppy market environment. It's a great skill to have because it allows you to put some money in your account without exposing yourself to overnight risk where we might have a market that's gapping on a frequent basis. So it's a great tool. It's a skill. It's certainly not appropriate for everyone. And to start out just trying to day trade is something I would tell anyone that you're a fool if you try to just start by day trading.
Yeah, okay. So I think a lot of people who are probably quite new to trading are often attracted to the idea of day trading with the mindset that you're taking more trades, you can make more money than whether if you're swing trading, you might only take a few trades a week. Do you believe that you can make just as much money as a swing trader as someone who's a day trader? Like, is there any time frame that makes more money?
I think swing traders make more money than strictly day trades. All of the trades that I look for, I'm looking for a swing trade opportunity. I would ideally like to hold all of my stocks on for a few days to weeks. However, the market gives me new information throughout the day, and I have an opportunity to maybe lock in some profits or avoid a loss. So I will, the market will tell me basically it's not appropriate for me to hold. So I will day trade it instead. And I will say that I also tend to have a personality that lends myself to probably a little bit more day trading than I should be doing. But it's also kind of kept me in the business at the same time that I'm not willing to sit with a loser long enough to cause damage or to hit a stop that's 5% away when I can cut my loss at 1% because I see the handwriting on the wall. And that's just something that comes with experience.
Okay, no, that's a great answer. So, all right, Brian, well, this has been really, really good, but we should probably start to wrap things up. So let me just ask you one last question. And in your opinion, what is the reason for why the majority of traders lose money and never reach a high level of success? Why is there such a high turnover in this business?
Well, it's an extremely difficult business. Anyone that tells you that it's easy is lying, being misleading. It's a difficult business. You have to have capital to start, but there's no barrier to getting involved, let's say, as a day trader when from day one when you shouldn't. I think that people get impatient with the market. They don't find out who they are and what their personality and their appropriate time frame is in the market until after they've made too many big mistakes, so that they want to get involved in the market and they see it as the opportunity for a way to make easy money, when in fact it's extremely difficult. And it comes first with mastering yourself, or no one masters their self, but having a much better understanding of yourself. So I think it's impatience and then ego that when they get into a trade and they see that it starts going against them, they start pulling up news, they start looking for other opinions. Their ego doesn't allow them to take that quick loser when they when they meant to, when they went in with a plan and said, I'm going to cut my loss here, but then their ego gets in the way and says, no, just buy a little bit more. It's definitely going to bounce, and they compound their problems. So not understanding their time frame and being impatient and not learning the mechanics of how the market actually trades, and understanding the psychology of the flows of money without before they start sizing up their positions and getting involved with too big a share size, or just saying, hey, I like Apple, so I'm going to buy Apple. Well, Apple's not always a buy. All stocks go through that cyclical phase where they go through a stage 4 decline.
Yeah, what a great answer. Okay, Brian, well, we've hit on a ton of great points during this interview. And again, thanks so much for coming on and sharing a whole lot of knowledge with us. This has been really good. Before you go, can you share with listeners where they can go to find out more about you?
Yeah, alphatrends.net, and StockTwits, it's at alphatrends. So you can find my book also on Amazon or technicalanalysisbook.com. And I'm pretty easy to find on the web.
Okay, great. And your book title is Technical Analysis Using Multiple Time Frames. So we'll put a link to that in the show notes at chatwithtraders.com/29. This will be episode 29. And you're also
congrats on that too.
Thank you.
On 29 episodes, yeah. Nicely done.
Yeah, one a week. We're not slowing down. So you're also on Twitter as well, aren't you?
Yes, at Alpha Trends.
Okay.
ALPHATRENDS.
Great. All right. Well, all those links, of course, will be in the show notes at chatwithtraders.com/29. So you can go there to, get a recap on this episode and all the links mentioned to find out more about Brian. All right, Brian. Well, again, thanks so much for doing this, man. Take care, and let's talk soon.
Excellent. Thanks again, Aaron.
Is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now a new era has begun. Meet Trade the Pool limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey guys, what's up? Welcome back to another episode of the Chat with Traders podcast. This is episode number 30, and thank you so much for taking the time to tune into another episode of the podcast. It's awesome to have you listening. Now, this week, we're taking things up a level. I had the honor of interviewing the legendary market wizard Tom Baso, president of former money management firm Trendstat. Tom started his working life as a chemical engineer, often discussing stocks and investing with colleagues. As he started to experiment with trading from a $2,000 account, there was no beginner's luck in sight. Tom consecutively lost money for the first few years before things started to turn around. With a series of events that followed, Tom went from trading his own money to forming Trendstat and managing other people's money. At the peak of his career, Trendstat managed $600 million of capital. And while Tom's now retired, he still actively studies and continues to trade. This week's interview covers many topics that range from trend following and systematic trading to psychology and why you must never forget to enjoy the ride, which is most important of all. Just before we roll into it, I'd like to highlight there were a number of challenges recording this interview. Firstly, this was recorded a few weeks ago when I was fighting through a cold, and we had some challenges with the audio equipment. And we also had to record this interview in two parts. Then just to top it off, there was a thunderstorm that rolled through midway. But I'm hoping you can look past this because the knowledge and experiences that Tom shares over the next hour or so is invaluable. All right, guys, I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Tom Baso. Hey, Tom, how are you?
I'm doing fine, Aaron.
Excellent. Great to hear. I mean, it's awesome to be speaking with you, and I must say before I go any further, thanks so much for being open to an interview and making the time to come on. It's really a true honor to be speaking with you.
It's totally my pleasure.
Yeah, so I mean, like, earlier this week I was going through, I reread your Market Wizards interview and I listened to a bunch of your interviews on Michael Coville's podcast, and they're all really insightful, and so I'm excited to hear what you're about to share with us today. And I mean, there's no doubt that listeners are going to take away a lot of valuable wisdom from this discussion. So just before we get into it too much further, for those who may not already be familiar with you, they might just be getting into trading or just starting to get into the world of finance, would you like to give us just a quick 30-second snapshot of who you are and kind of what you're most well known for? And then I've got a bunch of questions about where it all began for you.
Sure. I'm, of course, the former creator and president of Trendstat Capital Management. We had about a 28-year run or so. I started out as a chemical engineer and got into trading, and one thing led to another. First, I was trading stocks, and I got into bonds a little bit and traded a few options, and got into futures trading, expanded that to about 80 different markets in futures, and eventually got into currency trading, which is the bulk of our money at the end. But we still traded mutual funds and futures, and at our peak, we handled about $600 million of other people's monies. We were registered commodity trading advisors in the U.S. and registered investment advisors as well in the U.S. Shut that down in 2003 and enjoying retirement the last 12 years or so.
Okay, that's excellent. I mean, that's a really impressive way to kick this off. So I'm keen to hear how you very first got into trading and what was it that initially attracted you to the financial markets?
Well, what happened is, as a chemical engineer, I realized that there was sort of boom and bust in the United States in the economy. And every time there was a boom, they'd hire engineers, and every time there was a bust, they'd lay them off. And not wanting to get laid off and at least wanting to have a backup plan, I decided I'd better save some money as I was earning it. And as that got to be a little bit of a larger quantity of money, I decided I should do something with it rather than sticking it in the bank. And some friends of mine that were also chemical engineers at lunch would talk about the stock market, so that intrigued me, and we started a stock portfolio, and so I could participate in the conversations as well, and that led to an investment club where we ended up eventually running the club, and that ended up into a small investment advisory business, and teamed up with another couple fellas and got that going. That grew into a substantial size, and I eventually sold my share of that company and formed TrendStat. And TrendStat then was my way of trying to not only manage my own money, but manage my client monies as well. And we just kept growing that over time and evolving in complexity, number of markets, and so on until we became the success that we became.
Okay, excellent. So let me just take it back to when you mentioned there that you sort of started out as a chemical engineer. Were there any skill sets that you learnt as an engineer which you applied to trading or had some sort of relevance when you sort of brought it over to the markets?
Yeah, the most obvious one that I have noticed over the years, and it certainly applied throughout my TrendStat years in the company, was something called process engineering. And what I refer to that as is one of the first lessons you learn as a chemical engineer is the old pipeline comes into a tank, the tank is full of water, and there's a pipeline going out of the tank. And you learn how different flows coming into the tank will fill the tank over certain amounts of time, and you'll learn that flows going out take water out over time. And when you have them coming in and going out at different rates, then you need to be able to calculate how much water is going to go up or down in the tank. And so process engineering in my mind always becomes stuff coming in, stuff being processed, and stuff shipping out. And TrendStat Capital Management was a perfect example of that. We had all sorts of downlinks and internet connections and everything, bringing in data continuously, in some cases tick by tick. Then we were an operation that did nothing but process that information. So we had 40 computers and 10 people at our max that were just doing nothing but crunching a lot of data. And then there's the flow out, the orders, the communiques, the updates to websites, and all that. So to me, that was just process engineering. Bring in the information, process the information, ship information out. And the faster and better and more efficient you can do that, the better off you're going to be.
Yeah, okay, that's really interesting. So just still sort of sticking with that journey as you were starting out, if we were to zoom in on your first few years, what do you recall your experience being like?
Well, the first thing that comes to mind brings a smile, because the first few years, I would say, were pretty much losses and me making mistakes and just sort of wandering and trying to find my way. I looked at things like fundamentals, and I took several newsletters, and I read opinion after opinion to the point where I was totally confused. And I realized that sooner or later, a trader has to take individual responsibility for what he or she is going to do. And the only way you're going to do that is to simplify everything down so that you can say, this is how I'm going to trade. I'm going to take this data, I'm going to examine it or process it, and there's going to be a flow of orders that goes away from me. And when I do that efficiently and religiously and in terms of disciplined, that's where I'm going to be able to analyze whether that approach is working or not working, modify it if it's not working, improve it, and keep getting better and better as a trader. And so the first couple of years were actually losing years, and it required a tremendous amount of foresight, strategic knowledge, and patience on my part to just keep doing it, because it's kind of like, how many times do you want to beat your head against the wall before you stop? And there was certainly plenty of that in the first few years.
Okay, that's great, Tom. So I think it's fair to say most of us will probably never forget our very first trade. So tell us, do you remember your first trade, and how did that turn out for you?
I don't remember the specific trade, but I would remember that it was a stock that I bought, and I think I bought it based on somebody having a hot tip. I want to say it was Alcan aluminum, somehow way back when. And I realized well into the trade that I had no idea how this particular tip that I was given had anything to do with the financial well-being of Alcan aluminum, and that I had no idea how to get out of the thing once I got into it. I didn't even have the ability to chart it or do anything. So I just really felt like completely a fish out of water. I had no idea what I was doing. I realized it fairly quickly, and thankfully did not lose too much money on that one. I did lose, I believe, but I thought it was an interesting educational experience.
Okay, sure. And I mean, you touched on this sort of a little bit earlier, and I think I read this in your Market Wizards interview, but is it true that when you very first started, you actually lost money for 5 years consecutively, sort of one after another?
That would be referring, Aaron, to my commodities trading. I took about, I think it was the fourth year, perhaps, where I at least broke even. So I traded for, first year lost money, next year lost less money, next year lost less money, finally broke even, and it probably took me to about 4 or 5 years roughly to where I was actually producing a reasonable profit.
Okay, so I think there's a couple really valuable sort of notes we can touch on there. The first one would be, how were you able to lose money for 4 or 5 years, yet continue trading? And secondly, what was it that motivated you to keep pushing on and not to give up?
Okay, the first question is, in terms of how was I able to keep doing it, is I was a chemical engineer. I was actually had a day job. I was making good money. We were in great demand back in the oil embargo days in the 70s and 80s. And I ended up with a nice job, lots of promotions. I was highly ranked in my daytime job. I always got the best raise, the best promotion, and eventually had moved over into the business side of the chemical industry, and was still trying to advance down that road while I was trying to become a better trader at the same time. And because of that, I had cash flow, and because I always kept my trading very small, and as I was trading and losing small amounts of money, I was easily able to not only replace the losses, but to increase the size of my account, to improve diversification, to improve the numbers of volatility and risk controls and things that I was learning how to do at the early stages. Some of that just requires more capital, and I just worked real hard and tried to save as much as I could and keep adding to the account. And why I was able to keep going was that I saw that every year, when I looked back at the year and tried to decide what was going to, which direction am I taking in the future for the coming year, I could always see that I had made progress, that I had made less mistakes, that I lost less money, that I had captured more of the types of moves that I was trying to capture. And it kept me thinking that I'm on the right path, and I just need to keep refining it and getting better and getting more diversified and keep my costs down. And little by little, I finally got there. It took a long time.
Okay, good one. And just looking back on that time, of course, with the power of hindsight, is there any way that you feel as though you could have potentially shortened that learning curve from the point of first starting out to where you've reached a level of profitability?
Well, yeah, in today's world, I probably could a little bit, in that there's all sorts of, some of the brokers will give you free practice trading types of softwares and on the websites and things that would allow you to run tests that for very little or no money as an inducement to get you to trade your account through them. Interactive Brokers comes to mind, interactivebrokers.com, and but there's others too. And there's lots of software that you can either buy or use in various levels of sophistication that would allow you to test certain ideas out and cover a variety of data. In my days, I literally had Wall Street journals. I saved every one religiously. When I did a study, it would be pulling out the Wall Street Journal day after day after day after day and sticking it on a piece of paper, because mini computers or microcomputers hadn't even been invented yet. So I'm doing this all by hand. I'm using chart paper to chart the things, and I'm running a study over a course of a couple years of data. It would take me an entire weekend to just try to run some idea on one particular market for maybe a few years of data by the time I was all done. And it just cumbersome and tediously boring and tediously slow to get it done. But I knew that once I had certain things done, that I could use that and understand what I was going to get on the good side and what I was going to get on the bad side. It also forced me as a trader to live in the moment of those trades day by day, in the data, in the historical data. So many times I think today traders have such fancy, sophisticated software that you could run 20 years of data against 60 different markets and you get some number at the end that says you made 12%. And there's no understanding of how that 12% was made in the detail. It's just the final page of the study that comes out and it gives you all these fancy statistics. You say, oh, I like that, I'll do that. But you don't live with the trades day by day and realize the types of things that could have happened intra-trade that you have to be able to psychologically live with. Well, because I was doing everything by hand, I guess good or bad, it was good that I ended up being able to really understand how a trade evolved day by day, because I was doing it all by hand. There wasn't any computer program back in those days.
Sure, that's really interesting. And like you mentioned, the Wall Street Journal there, was there anything else you were doing to sort of educate yourself on the subject of trading?
Read a lot of books, and we had our lunchtime crowd that would exchange ideas. Those were the two ways I kept expanding my brains.
And during sort of this period up to your first maybe 10 years in the markets, were there any points that forever changed the way you approached trading, like any aha moments, realizations, or sort of hard lessons that will forever stick with you?
There was one that I talked to Jack Schwager about in New Market Wizards that is etched on my memory, and it involved the Hunt corner on silver way back when. I can't even remember the year anymore. I'm going to say it was in the 80s. And I was long silver, as I was supposed to be. And I had about, I think at that time my futures account might have been, I'm guessing between 70 to 100,000, right in there. It'd gotten to be a decent size account now, but it was relatively small. And all of a sudden, silver starts screaming upward, and I've got, I forget how many, like 4 or 5 contracts of this stuff. And I'm looking at my equity in my account, and today it's 125,000. The next one it's 150,000. It's 175,000. It's 200,000. It got all the way up to 500,000 on this one trade, and my account was going up and down 25 to 50,000 a day. As they got near the top, it got very frothy. And darn it, I'm a good trend follower at that point. I'm going to stay with this trade and let the trade run, let the winner run, cut the losses short. That's the rules. You got to do it. And I was just so disciplined about it. And by the time it got back to my stop loss point, which I had moved up and followed the trend, I ended up netting out about a $250,000 account out of it, and which on the surface of everything would seem to be, what's wrong with that, right? I mean, we started with 50 or 75 and we ended up with 250. That's a good trade. And it certainly was very profitable. But when I sat back at the end of it and I thought of the nerves that I had to put up with to live through that trade, I thought, wait a second. should I have really had 5 contracts or whatever it was throughout this entire trade, or would it have made more sense to have a proper exposure and to stay with the trade during the entire trade all the way to the end, but when the markets got insane, to hold less of that position so that as a portfolio, all of my instruments in the portfolio would have a somewhat equivalent ability to produce profit or to create loss, and they would be able to diversify each other a little bit. In this one case, the silver so dominated my portfolio that I might as well not even been trading anything else. And I thought that didn't seem right to me, so I started doing a lot of research on volatility as a percent of equity in my portfolio, and started from that point on creating the early stages of what Trendstat eventually very successfully used over the years, which was our volatility controls. And along with that, the risk controls evolved, and we used those at Trendstat as well, which was limiting the risk of the particular market to my portfolio and limiting the volatility that it contributes to the portfolio, both as a percent of equity. I think once I had those two things in place, performance got a little more predictable, got a little bit more consistent. Profitability got, I think, strangely a little better. I guess it allowed me to put the proper number of contracts on so that one market didn't dominate the losses too much. But that led to, I ended up ultimately, even with margin, as a percent of equity controls in a couple of instances in Trendstat, and we had the ability then to put together real portfolios that had real diversification, that had real abilities to have all the markets help contribute to the profits or losses. And that was a real aha moment to me because living through that silver trade, wow, there pretty much is a way to keep yourself up at night.
Something I just want to touch on that you mentioned there, and that was about volatility control as a percentage of equity. Can you just elaborate on sort of what you really mean by that, and maybe how this is something that other traders could adapt to better sort of manage their capital?
Sure, it's easy to do, and I'll give you the exact formula. It's take a market and figure out for one contract of a futures market, figure out how much the highest high of the day and the lowest low of the day is worth, is a range in dollars or whatever currency you're living with, in our case, US dollars. And you'll come up with that number, and that's its volatility of one contract for that market for that day. I would average, I use an exponential average, but you can use whatever you want. It all works similarly. I'd use a 20-day average of that daily volatility. So that gives me sort of the last 20 days of how much is this thing moving up and down. Is it moving up and down per contract $1,000? Is it moving up and down $200? Is it moving up $500? Whatever it is, it's just telling you that this is how much this thing has speed to it. It is going to dominate, it's going to contribute when it's going your direction that much per day, and it's going to potentially hurt you that much a day if you're in the wrong way. Once you have that number, then I just divided it by the dollars of equity in my account. So let's say you're trading $100,000 and that particular market was moving highest high to lowest low, it would be maybe $1,000 in any one day. Well, that one contract would then have a 1% volatility to equity. 1,000 divided by 100,000. Now, what I used to do, and I can't even remember the numbers now, it's been so long, but we used to set at Trendstat for some 80 different markets we ultimately traded. Each market would have a very specific, by how we were trading it, level of volatility that it would be capped at, and we would never let it get above that. So every day, the computers would take in the data, recrunch the 20-day moving average of the volatility, recrunched the equity that we now have because we either made money or lost money today, so the equity's changed. Come up with a new percent equity for percent volatility to equity of every single of the 80 markets. It would compare them to the allowed limit of each of those markets, and it would give us a set of orders to peel off markets if we ever had any that got over the volatility level. And we would just sell them off at market the next day.
Okay, excellent. Thanks for sharing that with us, Tom. That's really good.
Mm-hmm.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Something I'm keen to ask you about, and that's kind of your mindset and where you were at sort of in your head during your sort of 20s when you were getting into trading there during those early years. Did you always envision yourself as reaching the high levels of success that you were able to achieve? I'm always interested to know if you like had that long-term vision and a long-term goal that you were sort of working towards. You knew where you wanted to get it. You knew where you wanted to get. It was just a matter of how you were going to get there. Like, did you always picture you would reach the massive success that you reached later in life?
I didn't even picture that I would be a professional money manager when I started out. I was a chemical engineer. I was simply looking for a way of trying to manage some money on the side, and I assumed that if I was successful at running my own portfolio, I perhaps could retire a few years early from being a chemical engineer. But I was happy at the early stages of being a chemical engineer. I was paid very well for it. Chemical engineers, when they came out my year in '74, were one of the highest paid engineering disciplines because of the oil embargoes and everything. So life was pretty good for a young single 20-something that's making more money than he's spending, and it's piling up in his account, and he is learning how to trade, and I just assumed it would be a side portfolio and that I would somehow be able to increase my net worth, and I'd have the backup in case I was ever laid off, and life was good. Little by little, what happened was, as people found out I was having some success with my own portfolio, the investment club evolved into sort of, hey, why don't you do what you're doing for yourself with some of our money? That led to a certain limit on the number of people I could do that for before all of a sudden now you've got it registered as an investment advisor, and then running into two other friends that ended up getting into the investment advisory business with me, and little by little things just, I still figured we'd just do this on the side and do it part-time at night or on weekends, and it'd be a second source of potential income. But it was still just a way to manage the money and defray the expenses of taking all these services, and the cost of registration in the U.S. is, there's some money involved in that. And what ended up happening, much to my amazement, is on a part-time basis, we ended up making enough money off of our business to where we could pay one salary full-time. So I said to my two partners, I said, you guys have kids and all that, and you can't really travel. You're tied down a bit more. I'm still, I don't have any children. I got a lot of flexibility. How about if the company pays me my salary that I'm making now at the chemical company, and allow me to leave and open up the offices, and let's take this serious and make it a full-time, successful business. They agreed. I left, started everything, started traveling and meeting clients and putting business on the books and creating computer systems and hiring secretaries and signing office leases and doing all the things that you have to do. And one thing led to another, and pretty soon I got the second partner out, and before long the third partner joins us. We add more staff. The whole thing becomes a wild success.
That's excellent. So let's get into that a little bit deeper about once TrendStat was formed, and talk to us about how you were trading at TrendStat. I believe that it was a totally systematic sort of operation. So can you just sort of shed some light on that topic?
Yeah, TrendStat really, the name of the company was coined by myself, and it's just the trend following statistics. Abbreviated to TrendStat. STAT is statistics, and trend is the trend following or trend of the markets. And I felt like if you could just take and collect lots of data on lots of different markets, determine the trend, and then always position the portfolios in line with whatever that trend was, that over time there were going to be large movements, large trends that ended up paying your way for the most part. A good statistic that I would cite was in the first year at TrendStat, I did an analysis of where we made money and where we lost money, and I actually ranked the trades from the most profitable trade during the year to all the way down to the largest loser of the year. And we were running about 30-something% reliable in terms of our trading. That is to say, 30% of our trades would be profitable and 70% of them would be losers. But it turns out that one year, 2 trades that were so largely profitable that if you had not gotten those 2 trades in your portfolio, you would have broken even for the year. That's how lopsided it was to the 2 trades that ended up being so blockbuster and so unbelievable that you had to have them in your portfolio. If you didn't, you were just going to break even that year. That got me thinking, I've got to make sure, with no excuses, that I always get every one of those 2 or 3 large trades every year that are going to be there for the most part over time. And those are going to be what's going to pay the way. And the rest of it is a whole bunch of hard work to get nowhere. And that was really what led me to the kind of just expanding the number of markets that I traded, because it put bets, if you will, in more markets, giving you that many more opportunities to catch that 1 or 2 in those particular markets. And I never knew which market ahead of time or which trade I was making was going to be that big winner, but I wanted to make sure that I had as many chances of catching them as possible. And so I just kept buying more and more computers, and we had at the peak, including myself as an engineer, we had 3 full-time computer experts that were doing everything from programming to hardware to keeping the networks running to backing things up to backup facilities off-site, all sorts of things. And it just became a data processing facility, really. A lot of people used to think of me, and still do, as a trader, and yet a lot of times when I was in the middle of Trendstat, I was thinking of myself as the president of this data processing company more than I was a trader. I realized, looking back at it, I definitely was a trader. I had to create all these programs. I had to tell my programming people what I was trying to go for, and that was being a trader. But if you woke up and followed me around all day, you'd kind of be wondering how would anybody think that I was a trader.
Yeah, I think that's really interesting, actually, how you sort of mentioned that, and you sort of almost called yourself or the company just the data processing hub, pretty much, instead of a sort of what you typically think of when you think of a trader. I think that's quite funny. So generally speaking, was there any human interaction with the trading systems during a typical trading day at Trendstat there?
No, there was zero. What we did was we built lots and lots of computer programs that we would take data in. We would run the programs once a day against that data, and then decisions would be made by the algorithms that we had built into the computers, and prints would come off, and the human beings would just scan it to look for any kind of computer malfunctions or data malfunctions or anything that looked strange to anybody. Because that would be the last chance we would have to catch an error that maybe of our computers through our poor programming perhaps might have created. But once we knew that everything looked normal, the data looked normal, the data passed all the data checks that we did, the orders were created, hit the button, and out they go. And all of that was automated. The only thing the human beings would have to do was start the process to run the orders, visually scan them to see if anything looked strange, and hit a button to transmit them all. That was the only thing the humans did.
Okay, sure. So Trendstat was sort of in full effect during, I think it was sort of the 90s, is that correct?
Yes, in various stages.
Okay, so during that time period, was this approach common amongst money management firms, or was this quite sort of new to the space of money management, this sort of systematic and automated approach? Was the technology that you were using reasonably cutting edge for the time?
I would put it this way. I would say that cutting edge would mean very different things to different people, I think. If it was at all cutting edge, it would be sort of us trying to take a longer-term trading strategy across a lot of markets and automate that process. I do believe that during the 90s there were automated traders out there, but they were probably doing more intraday trading and what would you call straddle trading, pairs trading, those types of things. It seemed like a lot of the automation was concentrating more on the very short term, and we were just the opposite, concentrating on fairly long term, but doing it in a systematic way. So we were probably unusual in that regard.
Okay, sure. And I mean, I probably should have asked this a little bit earlier, but what was the initial appeal that attracted you to a systematic approach?
That's a good question. I would call it laziness, human being laziness. When I was doing my initial work and I had to have my chart paper out and burn my eyes up every night trying to go through all what the markets did and put in my new data and figure out where my orders were and then create some kind of a fax and then ship that to the trading desk and have them put my orders in for the next day. It was a lot of work. And I realized when personal computers came out, and I was an engineer by background and I knew how to program, I thought, well, why don't I get me one of these things? And I'm just going to program the ability to put the data in and pull it down from someplace and program the computer to do what I do every day. And then it'll generate a set of orders, and then maybe I could print them out and put them in the fax machine. And later on figured out that there's these things called fax cards that I can, take the print and take it right to the fax machine and out to the order desk. And little by little, I kept eliminating my jobs. And I developed this philosophy of a human being can do something every day. There's two forms of human endeavor, so to speak. There's the artistic, creative side, which I think everybody loves to do, the artsy side, the inventive side. And then there's a lot of things we do as human beings that are just stuff that a machine can do. And it's just very repetitive and doesn't require any unbelievable brain behind it, in that if you can put down in a rule-based way exactly how you're doing what you're doing, then you can have a machine do the same rules. You just have to program it into the machine. And so what I try to do at Trendstead is keep everybody as much as possible working on the creative and inventing side of things, and let our computers free us of the drudgery of every day. That was the philosophy.
Okay, sure. No, that's excellent. So, I mean, kind of, you've talked about your systematic approach, but your actual trading method was, from what I believe, was very much based on a trend following kind of strategy.
Yes.
So, I mean, what was it about the trend following approach that you adapted that just meshed with your personality so well? Like, what are some of the key benefits to this approach that you saw?
Well, one of them was that a lot of the major mutual funds and brokerage firms constantly kept saying it can't possibly work. And yet I'd seen people of notoriety that had successfully traded along those lines. In addition, it was mathematical. In addition to that, it fit me because it was more long-term in nature, as opposed to trying to worry about what happened the last hour in the market. And I was a busy guy. I didn't have the time to mess with what happened in the last hour. I was, in the early stages, I was still working as an engineer, trying to do stuff on a part-time basis, trying to get an MBA, trying to build a house out in the woods that I custom designed myself. And there was a lot on my plate in my 20s and 30s. And I just really felt like I had to try to be very efficient about that. And trend following was a way of making sure that I always captured every major trend. And as I told you before, previously, in some years, as little as 2 or 3 trades would be the difference at Trendstead between making money that year and breaking even. So you had to capture every one of those big ones, and trend following would always mathematically capture a very large move. It couldn't fail to do that. And that gave me that reassurance that that's what I was going for. All this other stuff that you do every day, little losses, the 2/3 of the time that you lose money, that's all a lot of work to get you nowhere.
Yeah, and I mean, while we're on the topic of trends, do you find that the structure of trends has changed from, say, I don't know, 10, 20 years ago to how they are now? Like, is it fair to say that trends might have been much cleaner cut back then, and in today's market, the trends tend to jump around a lot more?
It could be. I frankly haven't taken the time to try to do that kind of analysis in the recent years, and I have been retired 12 years, so I would say that, yeah, there's some choppiness out there, and a lot of it could be driven by shorter-term computer action. But the way I like to think of the trading world that I have sort of observed over the last 3 decades, probably, almost 4 decades now, I guess, I think that the use of computers has sped up everything. So in the days when, that's lightning and thunder out our window here, in case you hear it in the background.
All right, yeah.
A little monsoon action in Arizona today.
All right.
I think the whole world in trading can now move, say, a few billion shares, where they used to back when I came out of college in '74. A really good day at the end of the 73-74 bear market, which lasted 2 years, was 10 million shares on the New York Stock Exchange. To put that in perspective, SPYs trade hundreds of millions of shares all by itself. One instrument trades literally 20, 30, 40 times the amount that the entire New York Stock Exchange traded in '74, because they were doing it all by hand. There was tickets, there was telephone calls, there was a lot of running around and very inefficient approaches to doing everything. So now you can do all that a lot faster, and you can even tell your computer to make the decision faster, to transmit it faster. Everything's sped up. So the way I like to look at it is, I don't know that the trends have changed all that much, but they probably happen a lot faster. So to me, what constitutes a full trend? It's kind of like a large cycle of human psychology when it comes to investing. There's the I don't want to ever get into the stock market again stage. Then there's the stage where stocks start going up, but I don't trust it. And then they go up a little further, and I don't know, maybe I should get into this. And then you start hearing about it at cocktail parties, and you almost have to buy it at that point. And by the time you get around to doing it, it's actually at the high and about ready to reverse that psychology and go the other way. Well, now a lot of that psychological shift from depression to euphoria seems to happen a lot quicker. We have telecommunications, we have, blogs and all sorts of news coming to our phones. So we know what's the latest on the Greek crisis and what is the prime minister going to say. And there's 25 people analyzing what he's going to say or what he's not going to say. And it's compressing. In the old days, you had to wait till the Wall Street Journal showed up to get some of this stuff. Nowadays, everything's electronic. Everything can react quickly. So I don't know that trends aren't there as much as the speed of those trends and the psychological changes that go through the market happen a lot faster, I think, than they used to in the old days.
Okay, sure. That's really well said, Tom. When we were initially speaking by email, you'd observed that there is an obsession, or seems to be an obsession, with predicting rather than being in the now amongst many traders today. Would you like to expand on this? I mean, I feel like you've got some interesting insights to share on this topic.
Well, yeah. To me, I get asked a lot, even at friends, parties, whatever, that people find out I used to be a trader. And we start talking about investing. It's something that affects almost everybody. And you'll get on conversations about, well, what do you think is going to happen to the dollar? What do you think is going to happen here? What do you think the government is going to do here? And I can carry on an intelligent conversation on economics. I used to have to pretty much know what countries were doing with their currencies, and I'd be fairly well read on that, if for no other reason than during a client interview where some major bank is trying to hire me to manage their currencies, that I can speak intelligently about various economies and at least appear, even though it has nothing to do whatsoever with my trading, to be intelligent and knowledgeable about various economic things that are going around the world. And I've continued to do that. I followed this whole Euro thing and the Greece thing with fascination, because in 1997, when people were interviewing me, I absolutely 100%, with no punches pulled at all, said that the euro is a dumb idea and it will never last long term. It cannot. You can't base all sorts of different political systems into a single currency that's based on a whole bunch of different balance sheets. It won't happen. Somebody's going to cheat. Somebody's not going to pull, their weight. Other people are going to be getting the shaft on it and having to pay for the people who aren't doing it right. And that's what you're seeing now. Germany, some of the German people got to be getting fed up with the attitude of places like Greece and Italy and Portugal, Spain, and other places that seem to be, socialist and debt-ridden and don't seem to be able to get their act together at all, financially speaking. And how long are you going to run that until you just say, I've got enough? And then you break it apart again. So I've always thought it was a dumb idea. Well, the prediction of that is all good and fine, but in reality, to trade, all I care about in trading is what should my portfolio be positioned this moment right now, period. Nothing more than that. You don't know what tomorrow's going to bring. You don't care a whole lot about what yesterday brought, because that's already gone and never coming back. You really need to concentrate on looking at your portfolio And I've heard Paul Tudor Jones say this on occasion, where he likes to start each day assuming that all his positions are wrong. Like he's starting all over again, and he's reanalyzing where does he want to be right now. And if he assumes that everything's wrong, he's critical then about every position. He tries to decide, no, I do like that position. I want to hold it on again for another day. I think that's trying to force himself to be in the now, and that's a good thing. It's the only thing you have the control as a trader of doing is buying or selling right now. You can't buy it 3 weeks from now. It's not going to, there's no point to that.
Yeah, that's a really good point. I'm glad you brought that up, Tom. That's excellent. So something else I've heard you talking about in sort of past interviews, maybe this was on Michael Coville's podcast, but you were talking about a coin flip concept. And what you were referring to was sort of how entries are less important than sort of money management and good risk management and exits.
Yeah, I did the random study. I just took the computers and I had them create a random number generator. And at the end of every day, if I didn't have a position in any one of, like, I forget how many markets, I think I did 8 markets. Somebody else in Austria replicated it with 20 markets. It came out the same. In fact, they might have even made more money than I did. But we were all slightly positive, not robustly positive, just slightly. But what it came down to is the same concept I mentioned already. If you trade all year long, and 2 or 3 trades are the difference between making a very nice profit versus breaking even, then you must be in on those trades someplace. And once you get in on those trades, you need to let them run and mature and bring you those very large profits that you seek. A random number generator that just simply says, okay, I don't care which way I go. Markets could go down a lot, they could go up a lot. I'm just going to flip a coin. Whatever it says, the next morning I'm going to buy the open or sell the open, as the case may be. But once I get that new position, I have to try to assume it's the next really, really big winner that I've got. So I need to trail my stops at a logical level, give it enough room to move, to be safely restricting the risk, but at the same time giving it room for normal movement. So things like average true range, things like breakouts on charts, all of those types of things, depending on how sophisticated you want to be about it, could come into play to give the market normal movement, but to allow that profit to keep building and building and building over the long run for that one trade. As soon as it hits that stop, that tells you, well, that trend was not the one you were looking for that major, that major trade that would pay its way, pay the way for the portfolio to be successful for you. So what you'd end up with is you'd be out of the market and flip it again. Well, random number is going to give you 50% of them are going to be buys and 50% are going to be sells. It isn't going to be long until you're going to match up with that trend. When you are on that big trend, that's going to make all the money for you. And that's how you're going to make the slight amounts of profit for the year. You're going to have lots of losers, you're going to have some gainers, and you're going to have 1 or 2 or 3 very, very large gainers. And those are the ones you have to be in on, and a random number generator will give you those.
Okay, sure. So I'd like to move it along a little bit now and sort of touch on the subject of psychology. And I think I could almost quote you saying from other interviews that psychology is probably the most important aspect of profitable trading. So why do you believe this to be the most important aspect?
All right, well, I would say good trading falls into 3 different things that have to happen. The first one, which everybody spends all their time on, is the buy-sell decision. You have to have a way to say, this is how I would buy or sell a market, a stock, or whatever it is that you're trading. Secondly, you'll have to answer the question of how much should I buy and what types of instruments should I buy. I call that whole area the sort of portfolio management, risk management, volatility management area. And you have to be successful at that too. The third area, and the most important one in my opinion, and the one that a lot of people spend the least amount of time thinking about, is your own psychology. Because you as the human being who ultimately, even in the case of fully automated Trendstat back in the day, I had the power as the owner of Trendstat to go in and pull the plug on the computer or override it or do whatever, because I owned the company 100%. So if my psychology wasn't in good shape and my knowledge of what we were doing comfortable with what we had created, then the first time I go through a drawdown, I'm going to start second guessing myself and all those computers, and I'm going to start telling my computer staff, oh, we need a whole new way of doing things, and let's go research this latest hot strategy that seems to have made 50% last year. And I could go buy black boxes or build black boxes, what's the difference? And keep switching and trading and fail time after time after time because my psychology wasn't right. So even though I was automated, you still have to have a good, balanced mind about what you're doing. Trading, like for instance, a good example that I've heard Dr. Van Tharp talk about, good trading is following your strategy that day. It is not whether you made money or lost money that day. It's simply following your strategy. And that's a very profound thing. Hit me a long, long time ago when I heard him say that. I thought, yeah, that's perfect. That's exactly what I do every day. And that's why he and I worked together a few years at least. I helped him out with some seminars he was doing, and I found it fascinating to meet a lot of people around the world. And we had a good time doing them until my schedule got so busy it got unreasonable to do them anymore. But that was a very succinct and smart way of putting it. Good trading is following your strategy. It's not, good trading isn't making money and bad trading losing money. Good strategy development is what you need to do. Once you have that strategy, you need to follow it and to actually execute it. And the time to change your strategy isn't at the heat of the moment, halfway through the trading session when your particular position is going against you by 3% and you aren't sure whether you should pull the plug on it or not. You should have already figured that out, and it should be just blindly done. And when you're out of the position and the markets are closed, if you want to sit back and think about what just went on and try to come up with a better way, all good and fine. I'm not saying anybody shouldn't be constantly striving. I was sitting here, one of the reasons I called you a little bit late today was I got completely mesmerized by some stock research that I was doing. So I still am doing it here at 62 years old, retired. And I think you have to keep working and getting better, but you have to stick to whatever it is that you're coming up with unless you can figure out a better way. And I think a lot of people don't do that. I think they pull the plug on it, or they buy the black box and 6 months later they throw it out and they change everything they're doing, and they're adding so many layers of filters. I've had people at Facebook give me a message and ask me questions, and I'll say, well, tell me what you're doing, and I'll see if I can react to it. And they'll go into this involved explanation of all the different filtering this, and they only do it if the ADX is that, and on and on and on and on. I'm wondering how they ever get a trade to happen. They get so many filters in the thing that they're trying to achieve perfection. And it's so complicated, it's probably not workable, and they're likely to miss those 2 or 3 very large trades that are going to pay the way. And because they filtered those trades out somehow. So I encourage people to really understand their own mind. I think some people are a little more cut out for trading than others. I think that sometimes extremely cerebral, highly intellectual, they view themselves as smarter than everybody else. They're brilliant. They sometimes have a hard time with trading because they just know too much. And some of the best traders, if you look at some of the floor traders, the people that have come off the streets that really didn't know a whole lot about investing at all, certainly don't have the MBA or anything, but they're successful traders because they find something that works and they stick to it, and they don't let the markets beat them up, because they don't really have that mental side of them that wants to analyze and theoretically understand everything out there. They just want to make some money and go home, and so that's what they do. And so it's something to think about. Everybody needs to study their own psychology and try to ask themselves, what could they be doing to balance themselves out more, so that when they're doing actual trading functions, that they can stay in the now, they can analyze where they want to be fairly unemotional about it, and react quickly. That's really what good trading is. And that's psychology. And the first two, you can do all the work you want, but if you don't have the psychology, you'll never execute those first two.
Yeah, that's an excellent answer, Tom. Very, very well said. And when Jack Schwager interviewed you for the Newmarket Wizards, he actually dubbed you as Mr. Serenity because of your cool, calm and collected style of trading. So, I mean, how were you able to actually achieve this and maintain this evenly keeled mindset, even through times of drawdown?
I've asked myself that question a number of times, and the only thing I can think of that seems to play in my mind about history and my life looking back is that I was so darn busy doing so many things that didn't involve sitting by a phone or in front of a quote machine. And I had so many varied interests that were outside the markets. I've run into people that in the middle of the night wake up and they want to see a quote machine down by their bed and to know what the euro's doing tonight, or weird. That's obsessive to me. I like, if I'm going to cook dinner tonight. I like helping other traders. I yesterday was pruning my front yard. I love to do sort of an Italian landscape scheme with everything's flowering. I hand prune all my bushes and trees and do it myself. And there's so many things for me to fill up my day that trading just becomes sort of one of the many, many things. And by doing that, it sort of removes the attention to my conscious brain of all the different pre-crisis is doing this, and oh my God, gold's up $10, and all these different things that go on that could capture your mind and all of a sudden pull you down some kind of a psychological hole. Because I was so busy, because I allowed the computers to do their things, because I spent time programming those computers to do what I wanted them to do, and I knew they were doing that, it sort of gave me that peace of mind to, wonder what I was going to cook for dinner that night, or something else, or concentrate on my golf game, or have fun vacationing someplace. I didn't have to be obsessed with every day, read the paper, read the quote machines, look at the charts, agonize over everything. That's where I think a lot of traders, including Jack, I believe, back in the day when he interviewed me, he was very caffeinated. He New York, fast, go-go personality, constantly, driving, and a lot of the market wizards that he interviewed, some of which aren't around anymore, were pretty fast, high-risk guys in the end, and some of them blew up and didn't make it over the long run. By comparison, I was pretty boring, but where I was unusual was the kind of the systematic, keep it simple, don't get stressed out over it. I think that appealed to Jack in a way because he sort of wanted to adapt some of that for himself. He was just the opposite, and I think that he found it appealing in a way. And that's probably how that chapter got written somehow. But it was a fun process. I enjoyed Jack, and he's a great guy.
Yeah, and just to elaborate on that, also during the interview with Jack, you spoke about viewing your life like a movie. So what did you mean by this, and how does this have a positive impact on your life, and probably more specifically, a positive impact on your trading?
If you watch a movie, you think about a movie that you've recently gone to see, the scene that is up on the screen right that moment is always going to be the now. So you are allowed to, guess where the plot's going, You might guess right, you might guess wrong. It's kind of like the markets. You might think it's going to go up more, but it might not. But you know what you're looking at right there, because it's on the screen right now. If you pay attention to right now, then you can enjoy and allow a horror flick to horrify you, or an emotional film to make you cry, or a comedy to make you laugh at that moment, because you paid attention and there was a joke there and you said, that's funny. Okay, so your emotions can go all over the place, but you aren't attaching yourself. You know it's a film. It's there for entertainment. You still have your own life, your own beliefs, your own everything inside you. So I like to think of the markets and life as sort of a movie. And you kind of know which way the movie's headed, sort of, but life throws you a lot of unexpected turns, so do the markets. And I think you just have to, kind of look at it and say, okay, that was interesting. Now, what are we going to do now? And how do you react to it? And what was your strategy supposed to do during that new information or new change in the conditions? And I think it keeps you a little bit separated emotionally from the actual trade, to look at it as a movie, than to feel like trading is your life and you're surrounded by it in every way you turn and look. The market, you wake up and you go to the market and you're checking the market before you go to sleep, and you got your phone in front of you all day long during lunch. You're not carrying on conversations with people because you're worried about what's happening with the euro. And that to me is not watching a movie. That would be kind of losing yourself in the middle of the movie.
Yeah, I like that concept. I found that part of the interview really interesting. So, I'm glad I sort of brought that up and got you to share that with the listeners. I think that's really interesting. So it seems like you've made a conscious effort throughout your years as a money manager, and even still to this day, during retirement, that your way of trading was designed to fit the lifestyle that you wanted to live, and not the other way around.
Yeah, I think a lot of people, again, Facebook and Twitter and all that, I must have like 1,000 something people that follow my Twitter stuff that I put out every now and again. It really started out as me trying to help out my stepson and my brother-in-law know which way I was putting my hedges on and taking them off, and it grew from there to all sorts of people signing up like it was a free service on which direction the market's taking lately or something. So, but I get a lot of calls and messages from people about how they view how do I trade? How does Tom Basso in his retirement trade? And I hate to be rude, but I feel like saying to them, why do you care? You should be designing what you do for you. Why would you want to do, I have a different net worth, I have a different expertise level, I have different computer equipment than you do. I may have different legal restrictions in terms of the markets I can trade. Some people live in India and they're asking me questions. I have no idea what the Indian stock market looks like, or what the regulations are, or what the brokerage conditions there are. Never ever traded an Indian stock, don't plan to lately, unless something changes. I just don't know anything about it. So why are you trying to apply what I'm doing to your life? It'd be better for you to be developing what it is that you want to do on your own. And that's exactly what I've done. I'm in retirement. I do spend a little time trading every day. Some days like today, as I just mentioned a while back, I got immersed in a little bit of stock research because I had some ideas I wanted to explore and think about. I didn't come to any profound conclusions, sadly, but it did certainly burn up a couple hours of my day. And nothing's changed. Tomorrow I'll do the same thing I did today in terms of trading, but it gives me some pause to think about it and all that. But I'm designing something that I can manage myself, that I can go on vacation and take my PC along and maybe spend 20 minutes to a half an hour a day. That's the most on a vacation I'm willing to part from the vacation. If I can get it all done in a short amount of time, they have an internet connection on a cruise ship, let's say, or wherever, I can get my job done every day, continue to trade my strategy, and it's designed around having me be able to do that. And I find so many people looking at systems and strategies that, man, they have full-time jobs, and I'm thinking, how are you going to do that with a full-time job? You're supposed to be out there talking to customers or building widgets, and how are you going to be able to focus and pull it off? You're going to miss trades. You don't have enough capital to diversify it. There's lots and lots of problems you see right out of the gate. The biggest thing I find with a lot of people is capital. They want to start from nothing, and they'll tell me they've got $2,000, and how do I start trading futures contracts? And I kind of scratch my head on that one, because I have to admit, I started with about a $2,000 or $3,000 account, had no clue what I was doing, and I'm sure glad that I figured it out, because I ended up losing money for 4 years, and it took a long while to get to where break-even occurred. But as I got larger in size, more diversified, and got better risk control, volatility control, it all came together. I think trying to do all that with $2,000 is just mathematically impossible. So people are undercapitalized, they don't have a knowledge of what they're facing, and I think it's sad that they aren't thinking through what should they be doing to design something for them. If everybody listens to this broadcast and could just sit back and say, how could I make my own trading strategy my own? Make it exclusively mine, make it fit my lifestyle, my capital, my resources, my expertise levels. They're going to be so much more capable of hitting that psychological sweet spot of being able to stay in the now and do what they need to do because it's theirs. They don't have to worry about what Tom's doing with his stuff, or what Michael Covell's doing with his stuff, or Jack Schwager with his stuff. It doesn't make any difference. It's only important what I should be doing with my stuff. And I think that's what, if everybody could get that one thing out of this interview, I will have done great service to mankind.
Yeah, absolutely. No, 100% agree with that. And from listening to you in various other interviews, it's clear that you're a big believer in taking full responsibility for all aspects of your life. So I'd love to hear your thoughts on why you feel so strongly about this.
It's empowering, basically. Once I figured out that if I, through trading, was responsible for everything, including, I believe I told you earlier about the tip that I started my stock trading on, and it ended up being a lousy tip, and I had no idea what I was doing, and I blamed the guy that gave me the tip and blamed the company for not doing what it should be doing and everything else. But that's not empowering at all. You have to say to yourself, no, wait a second. I'm the one that called up, put the 100 shares on. I'm the one that's responsible. I'm responsible for figuring out what went wrong there and what would I do to make it better next time, and developing trading strategies. It's all on me. Nobody else is going to do it. Nobody else is responsible. The market is going to go through large ups, abrupt downs. It's going to have a lot of noise at times. It's going to be dull and boring at other times. That's what markets do. You can't blame the market for your problems. You got to take it on yourself and say, what can I do to deal with all of what mankind's going to throw at me over my lifetime? And when you answer that question, you'll be developing a pretty good trading strategy that'll suit you. And I think, sadly, around the world today, and Greece is in the news, there's a good example, Greece is not taking responsibility for their own mismanagement. So there's this tendency amongst a lot of various factions of society today to either blame somebody else or to expect somebody else to take care of some of their problems. There's less and less self-responsibility in society today. And I don't think that's leading us in the right direction at all. It seems to me that we're getting lots of governments around the world in trouble financially, more and more defaults. Argentina's not looking too good. Venezuela's a disaster. The United States is spending way beyond its means. We're just a little bigger and stronger, and so far so good. But this whole thing starts caving in. I don't know how the world reacts to that. It's going to end up being pretty messy because there's a lot of governments around the world that are going to be in trouble financially. And when people just stop giving them money to, through government bonds and loans and things, or they deflate or inflate their currency by just printing too much of it, people are going to suffer in that country. And it's going to get nasty if people don't take responsibility and get the job done. So I think that's the whole thing about self-responsibility to me, is it gives you a little bit of that peace of mind, and that you have the ability to do something about it instead of having life kind of throw things at you and you kind of react to them and feel like life is throwing you hard turns, and it's this guy's fault for not giving me that promotion. It's that guy or that woman who cut me off today that caused me to veer off the road or whatever. I mean, if you try to take responsibility for everything that happens, then you're going to be a little bit better at reacting and doing what's necessary to lead your life in a good way and make positive contributions to society, make positive contributions to your trading strategy. All of those things are going to be enhanced by self-responsibility.
Yeah, for sure. I mean, you touched on so many great points there, but Tom, we should probably start to wrap things up here, but let me ask you one more question. And you like to say, enjoy the ride. You often end tweets with this and these three words. And while they're very simple, I feel like there's a deeper message here. Would you mind sharing that with us? And what's the significance of this phrase?
Well, the significance of it is sort of a philosophical one. Life is like a ride. You get your ups and downs and unexpected surprises and all that, and in the end you're dead. So you might as well enjoy the ride. I think people make too much of some things. I know all sorts of traders that can't quit because they're so addicted to it. They identify themselves as traders. They don't identify themselves as human beings that are fathers and husbands and neighbors to other people. They instead are just immersed in this thing called trading. Or you could say the same thing about people who are teachers or people who are salesmen, people who install shades and blinds. There's all sorts of examples I can tell you about that I have friends that are well past normal retirement, but they just can't stop doing what they're doing because they identify with that. They haven't created an identity for themselves, outside of that. And the enjoy the ride thing is just basically to look at life like a movie, enjoy the ride. Just like most movies, there's unexpected twists, and you laugh, and you're emotional, and you should be able to enjoy all that. Because life's short, and why not do that? There's no point. There's no point to doing anything other than that, really. And I think the ups and downs of the market, when I usually get a signal change and all of a sudden people, I end it, enjoy the ride. It's like today we had the down signal come in at the time we're doing this interview. And it was just midday, and I saw the hedges go on, so I got on Twitter and I put it out to everybody, and I get 5 new people following me, and it gets shared all over the place. And it's kind of weird from my standpoint, but in reality, I had a down day today monetarily. I didn't go down as much as the market did, so that was good. I guess I buffered a little bit of risk. If the market continues down, I'll look really good. If the market turns around tomorrow and goes up, I'll look stupid again. And that's fine because I'm enjoying the ride. I'm going to go, work on a beautiful dinner for tonight, and I'm going to enjoy myself during the evening, and I'm not going to think about it a lot. Tomorrow I'll do the same thing again, and I'll continue to enjoy the ride.
That's excellent, Tom. Again, awesome advice. So, well, this has been nothing short of incredible, and like I mentioned earlier, it's a true honour to be speaking with you. So, again, thanks so much for coming on the podcast today, Tom.
Oh, my pleasure.
And before we let you go, do you want to share with listeners perhaps where they can connect with you on and maybe your Twitter handle?
I'm at Basso, Basso, _TOM.
Okay, good one. We'll make sure to put a link to that in the show notes at least.
The way to get a hold of me is actually on Facebook. Just put in Tom Basso, TOM and BASSO in Scottsdale, Arizona. There's only one of me.
All right, excellent. And we'll put a link to your Facebook profile as well, so people can connect with you on there. That'd be excellent.
Probably on Facebook, because my new granddaughter gets a lot of photos on Facebook, it seems. I'm probably on there more often than I am on Twitter. Twitter is linked to, in that if I do a tweet, it automatically goes to my Facebook page, but it doesn't go the other way around.
Oh, right. Okay, it's all connected.
I tend to stay on Facebook more than I do. And the other thing you could always do, if somebody has an involved question that's a little bit beyond normal messaging length, I've had people use the same old tom@trendstat.com, which is my old email address from back when I was still in the industry. I've kept the...
We'll definitely have
Come to the end of this episode.
Just at Luke Cummings 81, and our
unlimited time to reach the profit target.
him to becoming a stockbroker, which then led him to becoming a trader. Now years of... Hey there, what's up team? Welcome back to another episode of the Chat with Traders podcast, and you're listening to episode number 31. Now this week I spoke with Luke Cummings. He's an Australian equities trader with 14 plus years of experience on his side. After making a last-minute decision that journalism wasn't going to be a good fit for him, Luke went into a finance degree which led him to becoming a stockbroker, which then led him to becoming a trader. Nowadays, Luke remains an active trader, of course, and also operates a hedge fund based in Sydney. As well as this, he also runs a model portfolio service and trading blog, which goes by the name of The Long and Short of It. And we keep things fresh in this interview by discussing trading methods and strategies that haven't really been spoken about in previous episodes. Additionally, Luke shares some of the common traps that often catch entry-level traders and how you may be able to avoid the avoidable with some insight. For all the links and resources mentioned in this interview, all you need to do is go to chatwithtraders.com/31 and you'll be able to see all the show notes there. Alright guys, well I hope you enjoy this interview. I'm Aaron Fifield, your host of Chat with Traders, and here is this week's guest, Luke Cummings. Hey Luke, what's going on, man? How's your day been?
Hi Aaron, very well, thank you. Day's going well. Looking forward to chatting.
No doubt, that's good to hear, man. Thanks a lot for making the time to come on the show. It's really good to have you here. And there's a number of things I'm keen to speak with you about today. Of course, we all want to know about your development as a trader, sort of from day one to where you are right now. And I'm also interested to get into some details about a strategy which you regularly trade, which is a takeover strategy. It's something we haven't really discussed on the podcast in the past, and it'll be good to hear more about this. But let's kick it off with your introduction to the markets. So where did this journey as a trader begin for you?
Sure. Look, to be honest, I guess I kind of stumbled into trading somewhat. I'd had no real exposure to the share market in my younger years. Grew up in country New South Wales, which is the state of Australia for your American listeners, and moved to Sydney when I finished school, started studying at night, working in the daytime. And one of the first jobs I had just happened to be working for an international fund manager. Obviously, buying and selling shares and currencies and whatnot as part of their portfolio management. It was very much an administrative-based role, so my job was to help settle trades and move cash and reconcile positions and so on and so forth. So no direct exposure to the market as such, but we're certainly aware of some of the things that were happening in the office at the time. My next step after that was I took a job actually at an online broker, E-Trade here in Australia. I don't think I was quite 18, or maybe I just turned 18 at that stage. So I finished school reasonably young. And I was just working in their customer service division at E-Trade, which was very interesting. It was April 2000. I actually started there about a week before the NASDAQ tech crash happened. which was quite eye-opening at the time. But really was there with no preconceived ideas about the market. I had read some books and had some, I guess, exposure at university to the market. Anyone who's kind of got a finance degree, I guess, one of the first things you get taught is that the market is efficient, at least relatively efficient. And at that stage, I really had no reason to think otherwise or to believe otherwise. Of course, having exposure to people who are trading online and they're calling in and they're asking questions about the website and their positions and different things, to, I guess, sense their emotions through that period of the tech crash was very interesting, because they sort of say you can tell a lot about a person when they're under pressure, when money's involved, and that was certainly an eye-opening experience. But a colleague who I worked with there took a job at a broking firm probably about 3 years after we'd been working there. I got on pretty well with him socially. I wouldn't have said he was a great friend of mine, but we'd always gotten along well. And an opportunity came up to go and work at the firm that he was working at. Part of the pretense under which we were lured there was, all of these client accounts that they had that were dormant and needed servicing, that weren't being serviced at the time. Seemed like a really good opportunity. And I guess the reality was, when we got there, that the number of clients or prospects that existed were less than we'd been led to believe. And we sort of figured out that, if we're going to rely only on broking commissions for our livelihood, that we probably wouldn't be doing too well. So we also had a bit of time on our hands, because we weren't as busy as we had been led to believe. So we just sort of started looking at the market and doing a little bit of trading ourselves. Obviously, we have exposure to clients who are doing something similar. And, to be quite honest, one of my business partners, who's still my the colleague that I was talking about, who's now one of my business partners, just stumbled across this thing one day and sort of said, look, I think there's an angle here. And I was like, sounds great in theory, but, I've been to university and I've studied finance. I know that the market's efficient, and, something that simple surely isn't going to work, or at least not consistently. There must be something we're missing. And, I wouldn't say we paper traded in the way that people, I guess, think about paper trading now, but we watched a couple of these situations evolve, and, we're like, well, it looks like there's an angle here. And I guess we just sort of started to, systemically exploit that and to look for those types of situations. And it was actually a really profitable little niche that we'd found. And I guess, really that was the start of the process for me. I took that job without having any intention of being a trader. It just sort of evolved that way. And that was, I think, 2003 or 2004. And in one form or another, we've been at it ever since.
Okay, that's excellent. So I'm keen to sort of break that journey down a little bit more and touch on some of the points you mentioned. So just before I do that, though, what was it about trading that actually appealed to you? Or maybe not even trading, but just the markets in general? Because, I mean, when you're young, you have the opportunity to go pretty much any direction you like in terms of your career. What was it about the markets and trading that really got your attention?
Yeah, it's a good question. I actually intended to be a journalist initially, and that was very much my plan. Right up until the time I finished school, I was going to study journalism. And at the last moment, for whatever reason, I just decided that I didn't think I wanted to be a journalist. And I really was just looking for a job, to be perfectly honest. I knew that I wouldn't have the luxury of going to university full time without working. And it just so happened that one of the first roles that I stumbled across was the job, administrative job with the fund manager that I mentioned earlier. I think once I got a little bit more exposure to the markets, though, I just think it's a fascinating thing, and I'm not sure necessarily that I thought about it in those terms at the time. But you have this thing that every single day there's something different, as in there's no set pattern to how things evolve throughout the course of the day. You can be having a quiet day. Right now it's 2:15 in the afternoon here in Sydney. Something might be about to happen in 5 minutes time that I couldn't foresee or wasn't expecting, that could be one of the best opportunities that we have of the year. I think I was really drawn to the fact also that you can make money that isn't directly correlated to your effort, in the sense that in my school holidays, when I was still at school, I was doing some manual work like landscape gardening. My job was really to do the hard yakka, I guess, of the digging and the moving and the lifting and whatnot. and you come home at the end of every day and you're exhausted and you've earned, whatever, $15, $20 an hour, but you can only earn more money by working more, and it's hard work. And then you have, trading, which, of course, you need to put effort into that. And as time's evolved, we've developed systems and whatever else. But the idea that a little bit of effort can make you a little bit of money or can make you a lot of money, and that you don't necessarily know in advance which it's going to be, was certainly appealing to me. I think all traders probably at some level, are driven by a desire to have a better life or a better lifestyle, to have money. I think somewhere along the way, the money becomes less important, actually, probably once you start to, consistently make it. But I think definitely for me, I didn't grow up in a wealthy household. No one in my house talked about stocks. I'm not even sure that I knew anyone who was trading or investing in stocks, at least not directly. So I think the idea that, you could build a better life for yourself, and that it wasn't through manual labor as such, was probably, at least at the time, what appealed to me.
Yeah, I really like that answer. And I think a lot of people listening, including myself, can, really relate to that. So you mentioned there that you were at university, and was it an economics degree?
It was a finance degree, which I guess had an economics component, a finance component, accounting component, so on and so forth.
Okay, so you mentioned that they sort of taught that the markets were efficient, but when you sort of started trading with your partner, like you mentioned there, you were sort of saying that the markets weren't efficient. What do you mean by efficient and inefficient sort of markets?
Sure. So I guess, if you sort of think about university and finance or economics, we have this concept of the efficient market hypothesis. And really, in a nutshell, what that tells you is that in its most purest form, everything that should impact the price of a security, so whether it be a stock or otherwise, at any point in time is priced into that security. So the idea is that, by knowing information about, the PE multiple or the company's earnings, or, by looking at a chart or whatever, that there shouldn't be any discernible ongoing advantage by knowing that information, because it's already in the price. Now, in its purest form, they teach you at university that, it includes all known information and all unknown information, and that's, I think, called pure form efficient. And then they have this concept of, semi-form efficient, which is that all public information is in the price, but information, inside information, I guess, is not in the price at that point in time. And I think, sort of logically that makes sense. Certainly if you've had no reason up until that point to think otherwise, at a fundamental level, to me at least, it sort of made sense. It's like, well, okay, if everyone knows that, the current earnings are this, or that this company's released a new product, or, that the economy is doing this, or whatever else, it makes sense that these things are priced efficiently. Now, I think as things evolve and as you learn, you realize that, that's an efficiency at a point in time, is probably the argument that, that is making, or that concept is making. And of course, prices can move as new things develop. So, maybe an existing product's more successful than the company and the market had anticipated. Maybe it's less successful. Maybe, there's a currency impact for one of its earnings of one of its divisions. But I actually realized, very early on, and my partner and I realized that even that couldn't account for what we were seeing, because every day stocks are moving really with no discernible reason for them to move. So, you can make an argument that maybe information is evolving, or that someone who, has an incentive to buy or sell a security has learnt something new that maybe they were previously not aware of. But I think that, in a lot of stocks, if they're liquid enough, that's probably not enough to account for the reason that you see some of these securities move in the range that they move on a daily basis. And I think, that combined with the fact that we'd sort of found this, little niche that we were exploiting quite profitably, it was really telling us that, well, the market's not efficient at all, at least certainly in some respects. So I think that, there are some instruments probably where you can make an argument that the market is reasonably efficient because there are so many people looking at them, and information about what drives prices is very readily available. But there's a bunch of stocks and I'm sure other instruments as well. And stocks, I guess, is our area of expertise that people just aren't looking at or paying attention to, or there are angles that they haven't thought of. And one thing for us, I guess, is that I've listened to some of your previous podcasts on the site, and I'm slowly working through the rest of them. But Tim Sykes was saying that you were talking to him about his edge and why he chooses small caps or penny stocks, and he sort of used the example of if you're going to play basketball, do you want to play against Michael Jordan, or I'm not sure it's politically correct, but do you want to play against a midget? And it's a funny analogy because I kind of agree with him in that I think there are areas of the market that are harder to compete in. I mean, if someone like Goldman Sachs is throwing all of their resources at an area that I'm trying to compete with them in, I think that's very difficult. I think, where we try to play a lot of the time is in areas that, Goldman Sachs probably isn't paying attention to because it's too small in terms of, what it can add to their bottom line, or it's an area that, these guys go to the same universities and colleges that I went to that teach you that certain things are efficient or can't exist or aren't possible. And I think that leads to them ignoring a lot of areas of the market that can actually be exploited. And I suspect that of all the people you're interviewing who are trading for a living, I mean, they all at some level believe that the market, and probably have proof that the market's not efficient, because if the market was efficient, you can't make your living trading, like they do and like I do. So that was a real eye-opener for me, I guess, is that, one of your other interviews, someone mentioned, stages of development, and one is, you're making money, but you can't figure out why. And then you're not making money and you can't figure out why, which is maybe worse. And then, you're not making money, you know why, and then you're making money and you know why. And I think that's the thing. Like, if you're making money and you really want to make a career out of trading, I think you really need to be able to put your finger on, pretty quickly, at least at the point where you're going to scale up in terms of the time and financial resources that you commit to it. You've got to understand why it is that you're making money and where that advantage is coming from, because randomness can account for a lot in the markets and in life, right? You do a trade that makes money, doesn't necessarily mean it was a good trade. You do a trade that loses money, it doesn't necessarily mean it was a bad trade. I think people confuse the end result of what they did with the intent that they had, or the reason for them taking the trade in the first place. And I think that was important to us early on, was to try and figure out, hey, are we just lucky here, or have we actually found an inefficiency in the market? And sitting where I sit now, and for some time, I definitely believe that the market isn't efficient, at least in some areas.
Okay, yeah, that's a really great answer. And thanks for really expanding on that too. So all in all, would you say your degree from university and your experience as a stockbroker, did you find that this had any benefit to you when it actually came to trading your own money?
Look, definitely. Maybe not for the reason that I would expect, though, or that listeners would expect. I mean, the university component, I think, was really great. One, for exposing me to things in terms of terminology and concepts and whatnot that I just wouldn't have had exposure to otherwise. But once you get past that initial fundamental knowledge base, I think it's really great, looking at it in hindsight, to know or understand what everybody else in the market, at least who are finance professionals who are working as portfolio managers or prop traders or whatever they're doing at all these firms. I think it's great to understand what they're taught and why their belief systems are what they are. So from a university perspective, I think that was really great. From a broking perspective, I mean, I think outside looking in, you think about a customer service role at an online broker. It actually sounds like a pretty terrible job. But I have to be honest, that the two business partners that I have, we all came through, E-Trade at similar times. We didn't necessarily work together, but we all had that grounding or that base coming through E-Trade. And the cool thing about that was that you're not getting paid very much, but you're going to work every single day and you're learning about the market. So you're learning about how the market actually physically operates and some of the rules and regulations that govern it, and some of the idiosyncrasies of the market. in terms of the market itself, but then you also have the benefit of seeing human emotion in operation more or less in real time, because you're talking to these people over the phone who are having problems, have questions about whatever, but you can't help but figure out I guess what their emotional headspace is, and you get some exposure to the types of trades and things that they're doing. So I actually can't imagine being in the position that we're in right now had we not had that education, in online broking, because it's basically like getting paid for 3 or 4 years to do an apprenticeship or an internship where you get to learn everything about the market. And I think, the alternative to that would have been trying to learn all of that stuff at night or on weekends or before work, or, in addition to having other jobs. I think would have been really difficult. Moving on to when I became an actual broker and was giving advice to people and looking after accounts. Also very interesting, I think, the way people react to making profits, the way people react to making losses, the amount of opportunities you would call people with and say, hey, look, here's a really great trade. Here's the downside. Here's why I think you should do it. And, their reasons for not doing it or whatever, I think is very interesting. So, yeah, if I had my time again, I think the path that all three of us took to get to where we are now was really perfect. And the other cool thing was that, in the year 2000, online trading hadn't existed in this country for very long. It hadn't existed in any country for very long. A lot of the customers at E-Trade were still using dial-up internet and couldn't talk on the phone at the same time they're using their internet. And it was sort of just, a crazy time. And it was kind of nice because it's not like coming into an industry where there are people with 30 or 40 years worth of experience that you don't have. At most, there's probably people with a couple of extra years experience trading online than what, I had at that time. So I think timing was beneficial in that regard.
Yeah, right. That's really interesting. You kind of mentioned a little bit earlier, you talked about once you did start trading, you and the partner who you were trading with came across sort of a niche or a little area, a type of trade or strategy that you could exploit, and you were making decent money from this strategy you discovered. Can you talk to us a little bit about maybe how you discovered that strategy, and are you still running with that strategy today?
Yeah, sure. Look, this credit for finding the strategy definitely goes to my partner at the time. I've actually never really discussed it with him in detail. I presume he just sort of stumbled across it by accident. We sort of found a way to exploit a loophole around capital raising in typically smaller cap stocks. To get access to discounted securities, that some of these companies were offering. Of course, depending on the company, sometimes no discount, frankly, is big enough to want to give them money. Other times, the opportunities are attractive. So, sadly, the loophole we were exploiting no longer exists. The rules were changed such that the way we were obtaining access to them at the time no longer exists, which is a shame. But we basically went through the process of doing this ourselves. And because we were somewhat capital constrained at the time, there were really two forms of leverage for us. One was to share those opportunities with our clients, which we certainly endeavored to do as much as we possibly could, and had a lot of clients who made a lot of money from that at the time. And the second way was for us to get our hands on more capital ourselves. I mentioned to you when we were chatting earlier that the way that we did that at the time, which I definitely do not advocate to anyone under any circumstances, is we actually use credit cards because we're young guys. Like I was only probably 20 or 21 at that stage. I didn't have any money. I probably still had a little bit of consumer debt from university and buying a car and all these things that you sort of do. So we sometimes are making 5, 10, 15% a month from some of these trades pretty consistently. So even if you're having to pay a bank 15, 16% a year in interest, which sort of sounds crazy saying it now, but it was a smart thing for us to do. And we'll probably get to this later on in terms of how our trading strategy has evolved through time. But one thing that, or a couple of things about that was, one, we needed to be pretty damn sure that we could make money consistently, given that we're using someone else's money. But it also made us, I think, very mindful of risk, and sometimes that it's just better to take the fat, easy part of profit out of a trade without a lot of risk, rather than really going for the entire amount of profit that might be in the trade. So I think if you use a baseball analogy, sometimes a base hit or a double is better than a home run if you could get that base hit or the double, more frequently than you would get the home run. So that was what we did. But I actually think, and I don't have proof of this, but I think the strategy we were running and the extent to which we scaled it amongst our clients, and it sort of became a reasonably well-known strategy, certainly at least within a niche in the Australian market, probably was what at least partially contributed to the subsequent rule change about that. So it was a cool little thing. And, one thing we don't really know now is whether or not maybe we should have kept it a little quieter and we'd still be trading it now, because it just wouldn't have become such a prominent thing. But, onwards and upwards, no regrets. But it was a cool thing. If we hadn't found that, I don't think that we'd be doing what we're doing today, and we wouldn't be talking about this. So that was pretty cool. And I guess the interesting thing is that, sort of a long way to answer your question, but, you sort of think about how people become traders and the preparation they do, and maybe they go to a course. I've listened to your own interview about starting out with GAN and going to a seminar and learning about that. And some people read books and learn about fundamentals, and you've spoken to people on this podcast who are crazy into programming and back testing and different things. It sort of seemed a bit surreal that we kind of just stumbled across this thing that no one was really talking about, and it wasn't particularly sophisticated, and it was just really easy to exploit it for profit at the time. That was sort of weird, because even things like having a trading plan and things, I mean, all those things come after, but all of the things that you think that you should do and that you need to know in advance to start making money in the market, we weren't doing any of those things. And some of our friends and colleagues who were working at other firms and things like big name financial firms sort of knew what we're doing. They're like, you guys are crazy. Like, what are you wasting your time on all these small ridiculous trades for? Like, what's the point? I felt, and I think probably my business partner at the time probably felt a little bit of an inferiority complex, where it's like, we're not really serious, as in no one's taking us serious. This is kind of a small strategy that is a bit of a niche, and it was almost embarrassing to talk to people about it. But it just became such a big thing, and we made so much money from it. And it's funny now, looking back on that, and some of the people who at the time were like, you guys don't know what you're doing, you're just lucky, and loophole's going to close and that'll be it, you guys will have to get other jobs and things. Some of those people now are like, okay, what else have you guys got? Like, tell me some other strategies, what should I be buying, or whatever. And I think that's been an interesting process to go through. I wish I could say that we set out with intent to become professional traders and did all these cool things, and that we're super smart and great at math and all these things, but it just, for us at least, hasn't really worked out that way. And I think if I look back, the fact that we weren't doing what everyone else was doing, and that you couldn't just turn up somewhere and learn what we were trading in a course or read it in a book, it's actually probably what made it work in some ways, because we just kind of found something that no one else was looking at the time.
Right. Okay. So right at the start of that, you mentioned you were sort of purchasing discount securities. What do you mean by discount? Just so we understand before we move on.
Sure. So looking in a purest example, which is not the strategy we were using at the time, but in Australia, Westpac Bank owns a fund manager called BT, or partially owns a fund manager called BT. American listeners can look it up online briefly if they want to, but we did an offer recently where they sold down part of their holding. Westpac sold down part of their holding in BT, and the reason they did that was because in Australia they're talking about changing some rules around the level of capital that banks have to hold, and the penalty from a capital perspective of them continuing to hold BT, I guess in the bank's view, was greater than the benefit of continuing to have the shareholding in BT that they did. So, very basic level, Westpac says anyone who's an existing BT shareholder or who is an existing Westpac shareholder will have the ability to buy BT shares at a fixed price of $8.20. Now, this is for existing shareholders only. So if you don't hold shares in BT or you don't hold shares in Westpac, and that announcement is made, then there's no way for you to participate. Many years ago, if you didn't already own those shares, sometimes they would say anyone who's a shareholder in a week or two's time, or 3 weeks' time, whatever it's going to be, will be entitled to participate in that offer. So in the case of BT, which is sort of underway at the moment, BT announced, or Westpac announced, they were doing that sale when the share price was $8.20 about 2.5 weeks ago. Of course, we've had a lot of market volatility in that time, but the last week or so, the market's rallied pretty hard. BT shares as of yesterday were almost at $10. Today they're, I think about $9.50 or something. It's quite a big price gap there, right? So if you have the ability to buy BT shares at $8.20 and they're currently trading at $9.50, it doesn't really matter what you think the outlook is for BT. You don't need to want to own BT for any great period of time. You're basically being offered something that's worth $9.50 today for $8.20. As long as you think that between now when you buy BT and when you're able to sell them, when your new shares are allocated, that's sort of a no-brainer transaction, right? Like, it's like me saying to you, give me $8 and I'll give you 10. It's like, well, what's the catch? That seems a bit too good to be true. But it exists, and the thing is now there's no exploitable angle because the window is closed by the time that's announced. But previously, that window wasn't closed, and that was something that we took advantage of as much as we could when the rules existed in that format. So what we're basically trying to do is figure out, how do we buy $10 for $8, or how do we buy $5 for $4, or whatever the case may be.
Okay, sure, yeah, that makes perfect sense.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in
current times today.
Sure. So I think at a fundamental level, the premise hasn't changed for us in that we're not trading the same strategy that we were back then. But one great thing about that strategy was that the reward on offer was outsized relative to the risk that we were taking. So I think you're always taught, and we talked about that, my university degree earlier. The idea is that to get more reward, in theory, you have to take on more risk, and I think fundamentally that's pretty well accepted. What we're really looking for are situations where we think that the reward on offer exceeds the level of risk involved in us taking that transaction. And that maybe sounds a little strange or a little crazy, but the idea is the same as that loophole we found before. There are other things in the market that where that exists, I think, and we really have a couple of different components to our business now. So the original business partner or colleague at the time that I mentioned, they started working with more than 10 years ago, is still one of my business partners today. I have a second business partner as well who joined along the way. And the two of them primarily are focused on really short-term stuff. So non-client facing stuff, typically day trading. We try and be pretty flat at the end of every day. And it's time intensive. They're every day, at least while the market's open, sitting glued to their screens, looking for opportunities and trading. So there's that element of our business, and I'm not really actively involved in that these days, just because it's so time intensive, and in order to do some other things within the business, it's difficult to do that if you're glued to a screen all day. So that's one part of what we're doing. The second part is we have a managed fund or a hedge fund which trades longer term type strategies. So day trading isn't really appropriate for that vehicle. So our takeover strategy, which you mentioned earlier, fits within the fund, plus some other kind of longer term scalable type strategies. And I guess the more recent development there is the blog that we've started to share some of our ideas, some of our more simple ideas in the takeover space that retail investors are capable of implementing themselves without it having to be through our fund or needing any special help to do. But the one thing that drives all of those areas or all those business divisions is this idea of risk reward. So what we're really trying to do in the first instance is make sure that we really strongly understand the downside in each situation. And I guess upside is secondary to that. I think one mistake that a lot of people make when it comes to trading is they're really thinking about, what's my potential reward here? How much money can I make? And their position sizes are really dictated by, what they're imagining their profits are going to be if things go in their favor. We're the complete opposite of that. We're really trying to figure out, okay, we're happy to risk X amount per trade, for a stock standard, what I'll call opportunity. And that really dictates our position size. And I guess we'll cover the takeover thing in a little bit more detail shortly. But some of the opportunities in that space are much more more interesting from a risk reward perspective than your standard opportunity. So we have some discretion to vary our position size accordingly in that situation. I think if you're pigeonholing what we're doing, it's I call it rules-based discretionary trading. So we have a fairly fixed framework around what we're looking for in all situations, and lots of alerts and triggers and things that alert us to opportunities. But all of it has human intervention. So it's always someone looking at that saying, is that opportunity as good as it appears to be? Yes, it is, let's take it. Or alternatively, no, it's not for X, Y, and Z reason, and therefore we're not taking it. And look, probably the best example I can give of a trade where I think that the reward is outsized relative to the risk. It's one we did recently for our fund and through our newsletter, or through our blog. And that was in a stock called Panos, Australia. PNA was the ASX code. And the history of Panos, very briefly, was that they had a copper mine or several copper mines. Major shareholder was a Chinese company, had made a couple of approaches to Panos previously about taking them over at higher prices than where the takeover subsequently happened. At the time, Panos board said, no, we're not interested. The price isn't high enough. We really went through that period of 6 months or so of commodity price corrections. And the major shareholder, Chinese shareholder, comes back and says, we're making another takeover offer. Takeover offers can vary quite considerably in terms of how they're structured, but the cool thing about this most recent offer for Panos was that the price at which the takeover was being made was guaranteed. So it's basically called an unconditional takeover. And I think $1.71 from memory was the takeover price. We trade so many of these, I can't remember exactly, but let's call it $1.71 for argument's sake. As soon as that takeover is announced, Panos is trading at $1.72. So you can basically buy Panos as much as you like, more or less, for a number of days at $1.72 or thereabouts, knowing fine well that no matter what happens, so if there's no improved bid, even if the market tanks during that time, you're going to be able to sell that stock at $1.71. So that's really your hard stop loss that you've got in place, at least for the period that the bid exists. But it wasn't a crazy thought to think that Panos might get an improved bid, maybe not a competing bid from a different shareholder or a different company, given the reasonable shareholding that the Chinese company already had. But the bid that they'd pitched most recently was about 20 or 30% below where the bid had been pitched previously. So it wasn't ridiculous to think that the bid could be improved by 10 or 15% above its current level. In order to get board acceptance and get shareholder acceptance. So, the way that looks is that if the takeover price is $1.71 and it gets a 10% bump, the new price becomes $1.88. If you look at that, what you were risking in that situation, you're really only risking that 1 cent per share because you can get that $1.71, yet you have the potential to get $1.85 or 88 or more, potentially $2. So for us, I love that trade because I know exactly at the outset what my downside is. I've got that locked in. I can position size accordingly. And if the trade works out, then the multiple of reward relative to risk that you get is very, very great. The headline percentage, it might only be a 10% return on the capital invested. But if you look at your return on risk, if you get a bump in the share price or in the offer price, it's almost unheard of. So that's not to say that Panos was definitely going to get that better offer. It's very possible that the Chinese company just says, look, that's our best and final offer, too bad, and we lose a cent a share. But at the outset, that's a nice trade for us to take. And as it turned out, they got a bump of almost 10%. I think $1.85 ended up being the price that it was taken out on. So we made 8 or 9% headline return on the trade, but had a very big position size because we had that downside built in, and we really got about 14 or 15 times what we'd risked as a return on the trade. So that, in a nutshell, is probably the best example I can give you of what our holy grail trade looks like.
Okay, yeah, that's really interesting. So, I mean, you obviously sort of talked a lot about an example there of sort of the takeover strategy, but if we could just sort of take it back to step one. What's the general objective of this type of strategy? So let's focus in on your actual takeover strategy. What's the general objective of this?
Look, so the general objective really is, which applies across our whole business, is to try and take lowish risk trades with good payoffs. The great thing about the takeover strategy specifically, from our perspective, but also from our investors' perspective, is that takeovers have generally pretty low correlation to the market. So once a stock is under takeover, depending on the level of conditions attached to whether the offer is likely to proceed, more often than not, it's no longer trading in line with the broader market. So you don't need to worry about having a position that you wake up tomorrow morning and the Dow is down 5%. Your takeover positions just aren't going to get sold off, or if they do, they shouldn't be, and it corrects itself pretty quickly. So it's a really low volatility strategy for us in terms of it has low market beta. And that's part of the reason that we actually decided to put it in a fund, and that we've rolled it out through the blog because I think there are a lot of people out there, certainly in Australia this is evident, maybe less so in the US, but I presume it's a similar issue. Lots of investors who have had share market risk previously or have it now, and they really don't want the volatility that goes with that. The share market's great in terms of being a trader or being an investor, holding managed funds, whatever, when it's going up. But people don't want those massive drawdowns that you get in the GFC in an extreme example, even the hit that our market took, and that I guess a lot of global markets took last week when we had the dual issues of China's market falling over, and also these issues in Greece. I think people don't like that as much as in advance they may think that their risk profile is that they're happy to take some risk in order to get the upside. I don't really think that fundamentally that's the case. But at the moment, these people don't really have the choice to not be in the share market because the returns on deposits in bank accounts are so low at the moment that, especially if you're a retiree or you're getting towards retirement and you need that income to live, it's just not on offer. So what we do or aim to do with the takeover strategy is show people how to get share market like returns with much lower volatility or downside risk than what that would usually entail. So we definitely have strategies that we can make more money with, but the returns are more volatile. You're going to experience larger drawdowns and probably more frequent drawdowns. The cool thing about the takeover strategy is you don't really tend to get those drawdowns or big drawdowns because you're not linked to the market as such. There are other factors at play, and if you're pretty good at figuring out what those factors are and only taking those trades where you're comfortable that the risks are minimal, you should have pretty low market beta using this strategy.
Okay, right. So how do you find out if a company is about to be taken over, and how do you sort of know how true that is? Like, is it possible that it could be a false rumor?
Yeah, well, the great thing about the strategy, at least as we run it, is that it doesn't require knowing in advance. So our strategy actually is that we wait until the takeover has been announced and it's formal, and then we buy the shares. And that might seem counterintuitive because, what you think about is you want to buy a share today that gets a takeover bid tomorrow at 40% above its current price and you make money. The thing about that is it's very hard to predict. So, of course, there are rumors. If it's a genuine rumor and you really know the information, then you have it illegally at that point, and so that kind of rules out that option. If it's a rumor, you're undoubtedly not the only person who knows that rumor and who knows how true it is. And if you're just buying stocks purely because they're perhaps going to be subject to takeovers, you don't get that smoothness of return or that lack of volatility that I was talking about earlier. And there are definitely funds out there who buy stocks that they think could become subject to takeover. What we're really interested in is buying stocks that are already under takeover that may get an improved bid and or a counter bid from another party. So if you think about it like an option, I guess, anyone who kind of has basic knowledge of options knows that there are various factors that go into pricing an option. One is volatility of the underlying security. Obviously, the time that, until expiry of that option, interest rates play a factor, and so on. But, we're taught that time value has, or that time has value in an option. And the great thing about these takeovers is that you're buying this option, it's a synthetic option, over future upside in the share price because of an improved or competing offer. But you're not really paying for that in the way that you would normally pay for an option. So if you find like a listed option, over a security, they're pretty efficiently priced, right? There are market makers in that market, and everyone knows the Black-Scholes formula, and there's not too much variation in terms of it. It's hard to buy cheap options, but that's one way that we can buy options, synthetic call options, very cheaply over a takeover situation. And I think if we're really boiling down why the strategy works, that's it, because we're getting the ability to participate in an upside quite cheaply, which isn't to say that you always get a better offer or that you get a competing offer. You definitely don't. But you get enough of them, and in some instances the offers or the subsequent offers are so good that you only need 2 or 3 great trades like that a year, a bunch of okay trades, and you make more than enough money every year from that strategy. So at a fundamental level, that's what we're doing. So we're not trying to anticipate who's going to be taken over. We just wait for the announcements that someone is being taken over, make sure that we think it's a credible target, a credible bidder, that the downside is known and limited, and then position accordingly in the hope that something else is going to happen.
Right, okay. And with this particular strategy, what's sort of the time frame we're looking at from when we get into a position and when we exit completely? What's the sort of holding time of one of these trades, generally speaking?
Sure. Look, I'd say probably minimum a month, and 6 months. 6 to 9 months would sort of be the maximum time period typically, and I'd say about 3 to 4 months on average. So if a bid is made today for a company and there are no further developments, meaning that there's no improved bid, there's no competing bid, usually they take about 3 months to come to a natural conclusion. If the share price improves in the interim, we may look to exit the position early if we think that the risk reward is no longer in our favour, or that the additional benefit by waiting those extra months is now not sufficient. If you start to get competing bids or improved bids coming in, as part of the trade, usually would get bumped out to 6 months, maybe 9. But the good news is typically that the longer the trade's going for, the more money you're making along the way, as in a trade that you have open 6 months from today doesn't have the same bid level that it had when you took the trade. There's chances are being 1, 2, 3, 4 improvements in the bid along the way.
Right, okay. No, that's really good. So what I might do is, but obviously before the interview, you sent me through a PDF document which had sort of a bit of an overview of the strategy we've just sort of discussed here, the takeover strategy. And it had a few case study examples in there as well. So I might put a link to that in the show notes. So if anyone wants to find out more about this, just go to chatwithtraders.com and you'll find it in the show notes below the interview. But let's keep this moving. So I'm keen to ask you just kind of some general advice. So from your experience, what are some of the common mistakes you see new traders making when they come to the market?
Look, I think there's a few things. I think a lot of people maybe think that it's easier than it is, depending on what experience they've had up until that point in time. So, you're at a barbecue and, your buddy tells you about some stock that he bought 3 weeks ago and it's up 25 or 30%, someone else who's in your family who, has been day trading. I guess this was a big thing around 2000, who's, making $3,000 a day and they've quit their job or whatever. And I think you're looking at those people going, wow, this is, pretty easy. Maybe you've bought a stock or two yourself, same thing, you're making money. And then all of a sudden you're not. And usually that's because, people are making money without necessarily knowing why they're making money. Luck is definitely a factor, right place, right time. Obviously, if the market's going up, generally and going up strongly, then rising tide lifts all boats, and it's sort of easy to make money. Somewhere along the way, inevitably that reverses. I think, some people, if they're trading a specific stock, maybe they paid 50 cents for it and, saw it get as high as 70 and, now it's back to 35. So it must be great buying now because it's been to 70 before. I should buy more. I should hang on to my existing position, whatever. And then they lose money. So I think, that's sort of one thing is that, and I think in life generally, it's easy to look around at other people and assume they're having more success than you are, or that, they've got something that you don't. And, I think it's, as they say this about gamblers, right? You always hear about gamblers' winnings, but you never hear about their, the times that they lose. I sort of feel like, not necessarily intentionally, but family and friends, maybe, and even brokers who don't have your best interest at heart are telling you about all the times that, you missed out on making money because you're not trading shares. So I think that's an element of it. Not necessarily having a plan around, downside, like how much money am I willing to lose on this position or on, a series of trades before I revisit what I'm doing. Where's my stop loss on this trade? Like, where am I wrong and where am I getting out of it? What flows on from that is, getting stopped out of a position because you're supposed to and you've had the discipline to be stopped out. And then you watch the share rebound strongly to, higher than where it was trading before. So then you think, oh, well, if I didn't have that stop loss, I'd be making so much money now. So, maybe I shouldn't have stop losses in future, or maybe I should not pay attention to my stop losses. And then, it all becomes a bit wishy-washy, because it's like, well, okay, I've got this stop, but how do I decide whether I'm executing it or not? Is that just something I decide at the time based on how I feel and my intuition? Or so look, there's that. I think so on one hand, I think that's people underestimating how difficult it is to consistently make money. But I think the flip side of that is that you look at the market and you think about the people who are participants in that market. So I'll use Goldman Sachs as the gold star example in terms of at least their profitability and their resources and whatnot. All the way down to smaller, I guess, day traders or swing traders who are individuals who do that for a living. I think you can assume that can be really difficult, and you can go to a lot of these courses you go to. That I've had exposure to in the early years by going along and watching them. I've had exposure in my later years by being one of the presenters or speakers at these events, and some of the things that these people talk about when you pay for these seminars, it just sounds so complex and so difficult, and you can walk away thinking that if you can remember those 300 different chart patterns that you're definitely going to make money, or if you can, master the 50 fundamental analysis ratios that, you read in the book, that you're going to be able to make money, or, and that if you can't do those things, then that means you can't be successful. I think that's a big mistake for beginners as well. I think, either assuming you can do what everyone else is doing, and it just works out is, I think, a mistake. But also assuming that it's impossible to do what the very best are doing is a mistake. And I think, probably fear and greed, drive both of those things, as they do, in the markets generally. I think, if I was giving a new person advice, I mean, obviously you have to learn somehow, right? So you learn by reading, you learn by going to seminars. Sometimes you learn by doing and maybe losing a little bit of money. But I think it's all part of the journey to try and understand. I listened to the interview that you did where you talk about GAN and how much time you spent kind of studying that in the early days, and reading the books, and you've been to the seminars and whatever. And then somewhere along the way, you just kind of figured out that maybe it wasn't all that you thought it was, or maybe it wasn't for you. And the good news is, by the sounds of things, it didn't really cost you much in terms of dollars, maybe a bit of time to get to that point. And I think that you need to learn and have some exposure to all of those things. But I think you just need to understand that nothing is as great as it seems from the outside looking in, as in there is no perfect thing in the markets that is always going to make you money, that you can master and then that's it. It just doesn't work like that. And unfortunately, I think that in our industry there are some people who are holding themselves out as experts who are anything but. They're experts at presenting courses and providing education, and really know the ins and outs of the 300 chart patterns and systems that they referred to earlier, who either haven't really traded a share a day in their life, or they have but not particularly successfully, and they figured out that it's better for them to be educators. And I have no problem with that if it's on a disclosed basis, that you're not holding yourself out to be something that you're not. But I think that's a big trap for new people, is that you want to grab someone and hold on to them as the person you need to be like. And it's definitely important to have role models and mentors and whatever else. I would just say that attaching yourself probably to the right people is important, but kind of just being a little bit skeptical about everything. I'd like to think I'm an optimist in life generally, but I feel in the market you have to just be a little bit skeptical and a little bit neurotic, because sometimes things that look too good to be true, actually are too good to be true, and sometimes things that look too good to be true actually are real and can be exploited. But at the start, it's hard to figure that out, and you sort of don't want it to cost you too much money, real money, to kind of get to that point and figure it out. So I think, thinking that you can just turn up and do a course or two and become a great trader is a pipe dream. But, alternatively, you don't have to be a mathematical genius or, the smartest person in the room to be able to make money from the markets, because there's lots of different ways. You just have to, get to the point where you understand how you're going to make money and what's going to stop you from making money.
Yeah, absolutely. I mean, that's such a good answer, Luke. Really, really good points you hit on there. Let's just do one more question, and then we should probably wrap this up. So, I'm interested to know. This is a little bit different. Besides your blog, of course, the long and the short of it, Are there any blogs or resources that you yourself frequently visit or use to stay in tune with the market?
Yeah, look, there definitely are lots of, I guess, different resources. It's probably one thing about my job that I think people from the outside wouldn't appreciate is how much time you just have to spend reading things and learning about things. Most of which ends up, just to be perfectly honest, being completely useless or non-usable, at least at the time. But you can only uncover things by going looking for them. And sometimes you'll maybe pick something up today that you can't use, but in 6 months or 12 months, you'll be able to use them. So, look, in Australia, definitely the Australian Financial Review, I read every day. The business section of all of our major newspapers, so the Australian, Sydney Morning Herald, I read the New York Times, Wall Street Journal, Financial Times, Bloomberg, CNBC. I get a bunch of kind of emails daily that summarize financial news and whatnot. And then just ad hoc things that maybe I'll come across depending on what sort of trades we're working on at the time. But I think being well read in terms of regular content, but also some of those great classic trading books. I mean, I know you interviewed Jack Schwager a couple of weeks ago. I think if I think about my favorite trading books, Market Wizards and New Market Wizards would be amongst the top 5 undoubtedly, just for the insight you get to other people who are doing things that, for me, really helps solidify that there are a million different ways you can do things, different personality types, different strategies, and they all work. So I think understanding other people's journeys, where they went wrong, what strategies they've used successfully, which I guess is part of what you're aiming to achieve with this podcast, right? You're giving people exposure to different traders who have different strategies and systems, who can talk about what works and what doesn't, and maybe you learn that way rather than having to learn for yourself, which takes more time and can be more costly.
All right, that's a really great, another great answer there, Luke. So thanks a lot for doing this. And I've certainly picked up a few things from this discussion, and I'm sure anyone listening has also. But before you go, do you want to share with listeners where they can go to find out more about you and your trading methods?
Yeah, sure. So, look, definitely, people can visit our blog, which we just recently established. So it's just www.longandsshortofit.com.au. I'll get you to put that in the show notes, perhaps, so people can easily find it. Also, we have a managed or a hedge fund that I mentioned earlier. So that's just www.789assetmanagement.com.au. Just getting back to the blog, actually, we'll set up a promo code so that anyone who's listening today who thinks that maybe they'd like to trade the takeover strategy, have a bit more information sent to them. We'll do a discount there, 20% off our usual subscription, so that anyone who's interested can take advantage of that. It's actually a 14-day free trial anyway for people to have a look around before they commit any money. And then anyone who uses the promo code can get an ongoing discount on their subscription.
Good one. So what's the promo code?
It's a good question, actually. We'll put that in the show notes if that's okay. We've got one set up. I just don't have the details of it at hand.
Okay, sure. Yeah. Well, of course, the promo code will be in the show notes. All the links will be also in the show notes. And are you on Twitter or anything like that?
Yeah, I am. So on Twitter, personally, I'm just at Luke Cummings 81. And our blog, we're set up at Long Short of It as well. So anyone can reach out to me that way. Obviously, get in contact via either of those websites if they'd like to do so.
That's really good. All right. Well, thanks a lot for doing this, Luke. And until next time, take care, and we'll talk soon.
Thanks, Aaron. Appreciate it. Really good to chat to you.
The 33rd episode of the Chat with Traders podcast. Thank you very much for tuning in. I'm your host, Aaron Fifield. Now, this week, our guest is an equities trader from Southampton, UK. His name is Chris Sayce, and his journey to becoming a trader kicked off roughly 7 years ago after his interest in markets was piqued from reading through a book about stocks. While these days Chris has found his edge, he did spin his wheels for several years to begin with, and also managed to run several accounts into the ground. During this time, one of the greater turning points came when Chris found another trader who was willing to pass down his experience and offer him some much needed guidance. And as we all understand, to have a mentor on your side is extremely valuable. So I asked Chris a number of questions around this subject, which I'm hoping you may find helpful. We also discussed the importance of repetition in your learning, how to build discipline, and also touch on some mindset challenges that can be early roadblocks for developing traders. I feel like many of you listening will find Chris's story to be relatable, and I'm pretty sure you'll take away a few important lessons from this interview. So let's get into it. I'm Aaron Fifield, and here is this week's guest, Chris Sayce. Hey Chris, awesome to have you on the show. How's it going?
Yeah, good, thanks. How are you?
I am very well. Besides the fact that it's freezing cold here this morning, I'm doing really well. But so we've been speaking for a while, obviously before we hit the record button, and I'm excited about some of the topics we're going to discuss today. Some of those topics being mentorship and psychology. Mm-hmm. The psychology is something you've really emphasized, so I'm keen to hear more about this. But first of all, we want to hear about you and where your trading journey began. So I guess my first question would be, what were you doing prior to trading, and what inspired you to turn to the markets?
Well, it's about 7 years ago. I had a small business, and I had Christmas time off. It wasn't it wasn't in the finance industry at all. It was doing something completely different, and have absolutely no past experience with the stock market at all. No friends, no family really into it, other than I guess their pensions or whatever. But I certainly wasn't involved with anything. And just one Christmas, I had some time off. I went into a bookshop and I saw a book on stocks. It was, silly title of how anyone can make money or something. And I just bought it for fun. Started reading it, and it sounded quite interesting. So I opened up a demo account with a company. Saw a share, but bought it, but forgot about it for a few days, and came back and found out that I was I don't know, £1,600 up or something, and figured that's not a bad way to live. I haven't done anything for a few days. So I kind of finished reading that book and opened up an actual account and did exactly the same thing. Saw the exact same share drop. I put £500 in, bought it, and about 8 hours later I got what I now know is a margin call. Anyway, I just closed it out and made a loss, put another £500 in, did the same thing with something else. And that was basically kind of my start. And from there, I then just kept buying books, kept trying to teach myself on the internet. And it just went on like that for a while, kept kind of blowing up. But I didn't really realise what that was at the time. And it was probably a good few months down the line when I got a charting package. And again, at this point, I didn't know anybody who deals in shares at all. So I couldn't ask anybody at all. That kind of came later. So, like I said, I got this charting package, and once I learned how to use it, was kind of looking through it and started to see recurring things. And that it kind of took a long time to really kind of understand what I was seeing. But again, teaching myself, I kind of got eventually to the easiest way to describe it is just what the system was, which was it was buy a breakout and use a 480R stop. and hold it for a long time, and it looks like you make money on it. That was basically what I saw, but I can describe that now because I know what it is. I didn't know then what it was, if that makes sense. It was just something that I saw within a lot of shares. So I guess really the path to that was just looking at lots and lots of charts. This thing had everything from US stocks to UK stocks, and all of them. So there were thousands and thousands of charts. So you really kind of got to learn, what charts look like, and again, like I said, what these patterns were that you see. And predominantly, it was trending. It was from bottom left to top right. That was what I was seeing. But how to trade it was, I didn't really know at the time. And then I guess I stumbled across one of Michael Cavell's books, and I remember reading it, and I remember it made no sense to me whatsoever. The only thing I could really work out was that the charts looked the same, but I had no idea that there was this thing called trend following. And it was only when it was one of my aha moments when I kind of realised what it was, and I then started looking it up on the internet, and that was really when I started to kind of accelerate a lot. And then I found a mentor online, and he helped me out a lot with it. And he had his own system, which I tried to adopt, and probably couldn't really, wasn't mine. But ultimately, all that experience led to how I trade today, really. So that's kind of, a brief history on it.
Yeah, no, that's really good. So we're going to get into that a little bit deeper. So let's just sort of take it right back to the start when you sort of picked up a book. It was kind of random, started reading it, and, shortly after you started, obviously you had your demo account, which you did well. You put live money on the line and lost it. I'm curious to know, what did your partner think of this at the time? Like, it was a little bit random, it was sort of something out of the blue that you hadn't really talked too much about before, and now you've just sort of started trading, and you've started losing money, $500 at a time. Like, it starts to add up. What did your partner make of this?
Well, at the time, it wasn't a huge thing, because it wasn't a lot of money. Obviously, no one wants to lose, $500, £500, wherever, but it wasn't big money that was losing, and also I didn't know what I was doing. And I think probably because I had the business, don't get me wrong, there wasn't loads of money coming in from that, but ultimately, I used to make decisions daily that I wouldn't consult anyone with. That was just the nature of what I did at the time. So I certainly wasn't putting in £500, and that was being used to pay the mortgage. Obviously, in hindsight, it's very easy to turn around and say, don't obviously get risk money that you can't afford to lose. But at the time, I didn't know that. And the same as if anyone else, starts in the same way, they won't realise what any form of money management is. So I guess in that sense, I was quite lucky. I'm quite lucky that I didn't go and put thousands and thousands of pounds in, thinking that I could have traded it up like I did with that just one trade at the beginning. So yeah, that was kind of fortunate.
Yeah, I mean, that's a good point. So even then, when you did sort of run a few accounts into the ground, even though they weren't, big accounts, like you mentioned, that you were just sort of starting out small, what was it that sort of motivated you to keep pushing on? Like, why did you not go, this doesn't work, or this is too hard? What was it about it that sort of motivated you to keep going?
Probably stubbornness. I'm quite competitive anyway, and I think it was that when you first start, I think you kind of start off with this idea that you can make a lot of money doing it. Now I made thousands on that first trade, the demo account, which, like I said, it wasn't real money, but it was, wow, I made money there, and I didn't do anything. I didn't physically have to go to work and kind of, do X, Y, Z. I literally sat at home for a few days over the Christmas period and made money. So I think it was that drove me. Then it was the game. I've always enjoyed strategy games, and it was the market to me is like the ultimate strategy game, and you kind of realize that when you first start, and then of course you couple that with the fact that you can make you make some money out of it. It probably is what kept me going. But I must admit, I've never thought at any point about this isn't right. I think it was just something that I first started and kind of clicked with straight away. So I guess I was fortunate there as well.
Okay, sure. So you mentioned that you, of course, read this book right at the start. Mm-hmm. Later on, you sort of read one of Michael Coville's books. Was there anything else in between there that you were really getting stuck into and studying, besides just looking at charts? Was there any other sort of resources, or did you do any courses or books? Like, was there anything else that you were learning how to trade from?
So I've got a ton of books, probably 100 trading books now, and I did used to buy quite a lot of them, but it was that none of them really made any sense at the start. One book that really did, and actually this was probably just before I read Cavell's book, was one of Van Tharp's books. Now, they are a bit deep to start with if you don't kind of understand it, but it kind of brought into play a few elements of a strategy, risk management, psychology, and that was what then kind of, it probably started me on the track of, okay, there must be some sort of formula to this. And I guess ultimately then that might have been the start of, looking for a holy grail. Obviously, I know that doesn't exist now, but back then it was probably those little things that kind of started me getting more interested. And that was where I, thought about getting the charting package. And then ultimately, I guess it was throughout the time, there's been lots and lots of books that I've owned that I've read and picked out little bits from. I've never done any courses, and the internet was obviously helpful because of that. You can type in anything. You type in trend following, you type in day trading, whatever, online, and a whole host of things come up. But I certainly didn't do a course. I didn't subscribe to anything then. It was all just self-taught, and I'd hear something or read something, pivot point or moving average or whatever option, I don't know, something, and I would Google it, watch YouTube videos on it, and just really try and teach myself everything that I could. And it's just kind of built up from there, really.
Sure, yeah, no, that's really good. So if you had to pinpoint just a couple of your biggest challenges or hurdles between the point where you were starting out to becoming a profitable trader, what would you say these were? First of all, entering the beginner's cycle and then exiting the beginner's cycle. So what I mean is so I've spoken there about how I heard a few things, risk management, strategy, psychology, etc. Those are kind of the beginning of where you realize, okay, so there's something in this. So before a strategy might be buy this because it looks nice. I don't know, whatever people do when they first start trading. But then you realise actually that there is some sort of strategy in this, and as I mentioned before, what I was actually doing it to start with was buying a breakout. That was my first kind of strategy I ever put together, and it was basically putting that bit together, and then after a while trying something different. So, let's say the entry point was a breakout, the exit point was a 4 ATR. I then might try a 2 ATR. I then might try, I don't know, something else. Selling when the price has gone up for 3 days, and it was all that tinkering around that then leads to reading more books, which have then, of course, got more strategies in. The internet is full of strategies as well, not to mention all the ones you can pay for. So you're kind of going around in this circle where you're really not focusing on your strategy at all. You're tinkering constantly, and that's just not a way to trade. And when you realize that I think is when you exit the beginner's cycle. That's when you really then start to focus on yourself. You start to focus on your strategy, and that's really, I think, that was when I started to become
consistently profitable.
Okay, good one. And at what point did you? Well, first of all, let me ask. From when you started to when you became somewhat consistently profitable, how long was that time there?
Ooh, maybe 4 years, 5 years, 4 years, I think. A bit like I say, I've been quite fortunate. I haven't lost a ton of money purely because I did have a few big winners to start with, and probably the one thing that I've always been just generally in life is that if things are too good to be true, they generally are. Now, anyone that can one guarantee make you money all the time, you're very wary of those people, and I think it's been that's kind of constantly kept me going as well, because you can't make a lot of money with, we're talking like 100% gains in a day kind of thing. There's got to be a downside to that. And of course there is. That was just very, very bad money management. And I didn't realize that at the time. But it was that instead of getting euphoric and thinking, brilliant, I'm going to do this every day, I'm going to be a millionaire by the end of the year, I think I was more cautious and thinking, okay, well, I've made some money now, how have I done it? And I think it's constant reflection on what I was doing that probably kept me going. And it probably kept me in the beginner cycle a lot longer than I would have hoped for, because of everything I was doing I was then reflecting on, and I might actually change something. And ultimately, I have ended up pretty much with a system that I very first started off with.
Okay, excellent. So, in that case, at what point did you feel comfortable to focus your attention purely on trading and let go of the business?
Well, I still do bits now for it, but I certainly more my trading is what I do on a daily basis. I've got a few interests elsewhere that I do as and when I can, but yeah, I rely on my trading. And I guess it was just when my account got big enough. I'm confident enough in what I do. I know it works, and now it really is just a case of continuing to do the process that I know works, if that makes sense. So I don't trade into intraday or anything. I use end of day charts predominantly, and the daytime I spend either working on myself and how I think about the market, and reviewing what I've done, particularly reviewing trades. That was always something that I've been quite big on. I've always had two portfolios, and one is the real one, and the second one is one that I call discipline, and that is my make-believe one. That is, if I had done the trades like I was supposed to have done and didn't do anything wrong, that is where all the gains are in there. And that one, incidentally, is about 400% above the one that my real one. But that's what keeps me going. By looking in there, it was okay. That I can show you trades from several years, or 3 or 4 years ago, where I might have sold on a dark day. When I really shouldn't have done. Got scared out of a position, and it ultimately went on to be a huge winner. I've got lots of charts like that, and again with the word discipline written in the middle of them. So that kind of keeps me focused.
Okay, I really like that. So you've got obviously your live account, which has funded real money in it, and then you've got, how does that other portfolio work? That's a demo account, is that right?
Well, you can. So I've got several accounts with different brokers, and the chart package that I use, you can keep tracks of your portfolio in there. So I've just got two portfolios in there, and like I said, one is the real account, and the second is the discipline account. And like I said, I really wish it was the discipline one that was the real one, but it keeps me, like I said, keeps me focused, and keeps me, every time I go to make an exit, I do kind of have a look through that chart and make sure that it is a valid exit. I'm not just doing it because of it's going down and I want that money. It needs to be the right exit. It needs to be part of my strategy. Otherwise, I've got to keep hold of it. That's what the plan says. the plan makes money. It's not me, it's the plan. So, I've just got to stick to it.
Got it. Okay, so it's a feature of the software. I really like that. That's such a really good idea. I appreciate you sharing that with us. Now, from the few things you've mentioned to me offline, I get the impression that repetition is a key ingredient to your development as a trader. So would you be able to shine some light on the importance of repetition to you and how you continually go over and revisit material that you study over and over again?
Well, see, I think with the internet being how it is, Twitter in particular, there is so much on Twitter that is really good. There's also so much on there that's utter nonsense. So you really need to kind of have a kind of very, very good noise filter. But I went into trading many years ago with a set of beliefs, whatever they were aren't important now. And the same as you, Will, and anyone else who's listening has got their beliefs about the markets, about, however they trade. And when you read a book, when you talk to someone, whatever it is, you're ultimately, you're obviously, you're gaining more information and your beliefs might change. And I think that the repetition part is just kind of going back over everything that you've done. And whilst today you might, whoever you've been chatting to or whatever you might read or watch on YouTube or whatever might be conflicting to those beliefs, sometimes you need to just go back and look at everything you've done in the past and either discount what you've been told or does it add any value to your portfolio? And this is where, like I said, my discipline portfolio comes in, because every day I look through it, every morning I just go through it when I'm, like I said, I don't trade throughout the day. So I'm quite fortunate that I get a lot of hours to really just work on my psychology and work on my, my strategy really. I'll just look through that portfolio and see what does a good entry look like? What does a good exit look like? And deeper than that, what does a pullback look like? When it's quite easy, of course, when your portfolio sits at all-time highs. But what does it look like when you've had a 10% drawdown or something? How does that look on? Let's say on this software package, it graphs your profits. So I like to go back and say, what does my chart look like when I'm in a drawdown, and see it. And then, of course, I fast forward it and I go, okay, so it looks like this now. And when it picks up again, it will look like this. And so it kind of reassures me that the drawdown isn't anything, to worry about. It's just part of the trading plan, or, part of the trading process, should I say. And I think that really helps, or it helps me anyway.
Okay, sure. That's really good. So let's move this along and get into some discussion about mentorship and the impact it's had on your trading. So if you could start by telling us how you met your mentor and what actually motivated you in the first place to seek out a mentor.
So to start with, it was that I knew I was onto something with the charting software, and like I said, seeing what I was seeing, reading a few books, and I just didn't know how to put it all together. And that was when I was really just looking for it sounds quite sad actually, but I was looking for someone to talk to, because I don't know any traders. I do now, but back then I didn't. I just had a ton of books, some information, some charting software, and it was so much chaos that I was kind of, I didn't know if what I knew was the right thing to know, if that makes any sense. I just, if someone was there going, yeah, no, you're spot on there, but you should have a think about this and this, or whatever, it would have made things a lot easier instead of having to try and figure it out myself. So I knew that what I was interested in was trend following, so I Googled it and found my mentor online, and I sent him an email. I think we spoke on the phone actually for a long time, and eventually he agreed to mentor me. He came down to see me, and he showed me his style. And this is probably where I'd say I made a mistake and probably extended my learning period by a good 6, 7 or 8 months or whatever, because I immediately kind of threw out the window what I'd been working on and adopted and tried to adopt his system. And it was then that I started tinkering around with things, and that was when, they say about, you find a system that suits, and that was really what I wasn't doing. I was playing around with his system, and so eventually I went back to what I was doing, and this was where I found the mentorship invaluable, was when I started explaining things to him like that, and instead of him kind of telling me, no, you're doing it wrong, he would ask other questions. So let's say he traded a breakout and I happened to buy it on pullbacks. That's my favourite strategy. And instead of him saying, "Oh well, a pullback is an exit signal," in his strategy, but of course for me it was my entry. So he would then ask, "Okay, so where do you define your risk? Where do you put your stop?" And he would ask questions like that would actually get me thinking about my strategy, as opposed to feeling that I needed to justify why I wasn't using his, if that makes sense. And that was kind of what I thought, what I think a mentor is actually really valuable.
Yeah, okay. So you mentioned that you found him online. How did you find him online? Did he have a website or a blog, and was he offering mentorship, or did you sort of approach him about this?
Yeah, so he ran a blog, and it was a paid mentorship. You can follow his signals if you wanted to, which a lot of people, I know there's a lot of services out there that are like that. But I guess to start with, that was what I did. But it was when I met with him and spoke with him that he wasn't just selling. He wasn't selling signals. If that, you can do that. That's part of what he does. You could just copy what he does. But that wasn't what I was about. I was looking to become my own trader, a trader of with my own kind of set of beliefs and strategy, etc., and do it for myself. He would, and with him, you could trade your own pension fund and just copy his trades entry when he said he has a Twitter feed as well that you can enter. And that's what I think, there's quite a lot of services on the internet that do. But it was when it came to the mentorship, he really, really did go in, help me out and help me understand what I was trying to achieve with my system. And that was when he kind of put his system aside and helped me develop mine and asked me questions about it. And then also, tell me things to consider. So, maybe consider the risk part of it and, that kind of thing, really.
What's the kind of level of interaction between yourself and your mentor? Like, is it sort of scheduled once a week that you have a Skype call, or like how often do you guys communicate, and how do you go about that?
Well, now we just communicate, via Twitter or Skype or whatever, just for kind of fun, just talk about the markets, emails or whatever. But during the kind of the learning process, all the time, he has got a protected Twitter feed that you become part of, and there's a load of other traders on there as well, and he kind of you'll all be tweeting throughout the day. Equally, he used to ring constantly, maybe once a week or whatever, to kind of see how you're getting on. Is there anything that you can help with? Via email all the time, and depending on where you are in the country, he would come and see you. He really was, it was kind of, he was being a mentor. It was unlimited. It wasn't a service that was kind of, one email a day or whatever. You genuinely did feel like you had someone on your side that was helping you out, which like I said, I think that was good, especially when you first start, because you've got so many questions. I mean, I used to email him constantly, particularly on down days, big, let's say that the recent pullback in the markets, that kind of thing years ago I would have got scared out of big time. And, now you kind of on days like that, you speak to him and it's almost like that little bit of reassurance, actually, no, just hold on, because your strategy does cater for this kind of thing. Look at a chart. You wouldn't be able to tell when the Japanese earthquake hit, or you wouldn't be able to, because of the trend has gone from bottom left to top right. It's incorporated all of that. And, it was on days like that you kind of needed a mentor. And that was what I found really good. It wasn't, you wouldn't ask a question and have to wait 4 or 5 days for an answer. It was straight away, really, which is a really good service.
Yeah, that's really valuable. And I mean, pretty much most traders coming up need someone like that, who can be there for them. So, just maybe in sort of summary, some of the highlights or standout points, like what are some of the lessons that he's passed on to you, which really helped you to see things a lot clearer?
Risk management, more than anything, more than definitely kind of not entering too many trades at the same time. He trades a shorter system to me. They're kind of not necessarily relevant to my system, but for his, I would say, he would teach you that, not to take too many trades on the same day, because of, we all know that can, if you've got one or two, you shouldn't enter 4 or 5 trades in one day. All of them are showing, a loss, get and enter another 3 or 4 the next day, another 3 or 4 the next day, that kind of thing. You need to stagger it. You need to kind of enter a couple, make sure that, they're kind of, they are making a profit, and you can kind of build up from there. That was a big thing. You don't have to trade a lot. You really don't, to make really good money. I think his blog site, I haven't checked it, but it was something. He's up something like 400% in 3 or 4 years. So he's doing very, very well. And he's been sat out the market for the last 4 weeks, I think. And it's things like that is absolutely invaluable, to kind of realise that you don't have to trade every day at all to make really good money. And you combine that with the right risk. And like I said, you've got a very profitable system. The other thing was understanding that actually you don't need to risk a lot of money to make a lot either. He risks 2%, which is actually quite high, I think. But 2% of your account isn't a lot, and yet this is a guy, like I said, who is making 400% and risking 2%, on each trade. So that again was important, but the main thing was the psychology, was teaching you to probably have faith in your system more than anything. That your system works. Of course, that gets into a whole other topic about system testing and all that kind of thing, but we probably won't go there. But your system works, so you just need to have faith in what you're doing. And like I said, go back to the dark days when the market's down day after day after day, and you really, you're probably then thinking, well, this system doesn't really work. I might go short, but it's short in an uptrend is a silly thing to do. And the other thing is, well, does the system really work? Has it stopped working? There's all these things. Trading is full of kind of things that kind of counteract, counteract that, like arguments. But it's days like that he would then reassure you a bit more in the early period. And that, like I said, that I think is really, really important.
Absolutely, yeah. That's all really great. So yeah, thanks a lot for sharing that, Chris.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, I'd like to steer the conversation in the direction of your style of trading and sort of your methodology. We've kind of talked about it a little bit, but just maybe give us an overview of your actual approach to trading.
Okay, so probably my routine is the easiest thing to describe. Is that I don't use scans. I just don't. I think that's probably come from the early days of just looking at charts and trying to figure things, try and see things. But in the UK, the FTSE 350 is 350 stocks, so that's not really a huge amount of stocks to look through. So I don't use scans. I look through all of those at least once a day, sometimes 3 or 4 times, and that gives me an overall state of the market. You'll be able to see off that. For example, are a lot of stocks consolidating? Are a lot of stocks selling off? Are a lot of stocks breaking out? Are they breaking out and failing? Are they pulling back and giving a lot of reversal signals? So that kind of, I think, gives you a very good understanding of what's going on in the market. And then I would plot support and resistance on charts. And obviously, you could then combine that with kind of, I guess, like a Davis box method or whatever. But, I don't draw the boxes. But you can see support and resistance if it's getting higher, like a ladder or whatever. That's the start of a trend. I've got plotted on the charts the 50, 100 and 200-day moving average. And I wouldn't use those for an entry, but obviously you can then, that gives you a feel for the stock. And every stock, I think, is different. They have a different buying and selling pattern. Some stocks don't pay any attention to moving averages at all, but they do pay attention to support and resistance. So therefore, that gives you a good place to either enter, also gives you a good place to exit. Some stocks do absolutely hug the 50-day moving average. And as soon as it closes below that, and maybe 2 days in a row, the kind of character of that stock has changed, and that then would be an exit signal. And some stocks don't pay attention to anything, and that for that I may just have like a volatility stop, so like a 4 ATR. But ultimately, I buy on pullbacks. I look for things that are already in trends. And I enter on a pullback, but the pullback must be to an obvious place. So, like I said, it must be a moving average or a support, or a support line. And then ultimately, I like to see a kind of reversal candle in there, just something that shows me. My favourite ones are kind of a really nice spike down with a bit of volume on it. I don't really trade volume, but that's kind of a pretty good kind of pattern for me. And that then gives me a good place to enter, shows me that buyers are stepping in, and it gives me a good place to put my stop. So kind of get all the things that I need out of that, and then I just, like I say, ride it up and, hopefully hold it for a long time. Ultimately, though, if it closes below, that entry point, I'll sell it very, very quickly.
So you said there, hold it for a long time. What would your average, sort of generally speaking, holding time be for a position?
Well, hopefully months. That my big winners I've held all through the recent crisis, and most of them are back at all-time highs. I find with trend following, particularly on stocks, I don't really know about forex and futures markets. I mean, I know what they are, but I've never traded them, so I can't really comment on the characteristics of those markets. But particularly in stocks, when they go wrong very, very quickly. Kind of staircase up, elevator down all the time. So you've got to be prepared for that. But you find that if you enter on a pullback, it will very quickly tell you if you're wrong, like possibly even the next day. So you need to be prepared to exit very quickly. But then it's just a case of holding, and then I would tend to add on the next pullback, and the next one, and the next one, and the next one. And hopefully, like my biggest winner is maybe 14 months old at the moment, and luckily it's showing no signs of backing down at the moment.
Nice one. That's really good. So before sort of adapting this, I don't know if you'd call it a swing trading sort of methodology, or it's sort of borderline position trading if you're holding for a number of months, I guess you could say. But did you ever attempt to trade intraday, like day trading?
Yes, and it nearly drove me mental. I couldn't believe what I was experiencing. I certainly believe that you've got a mental capacity, an emotional capacity, and whatever you want to call it, 100% or whatever. And I just couldn't make that many decisions in that day, and let alone do it 5 days a week. I really would love to go and sit in a day trader's office and see how they do it, but I saw there was something in pivot points, and I tried to do it, and I just couldn't. It really kind of it really messed me up in my head, really. I'm in a very good place psychologically, and I like trading end of day data. I like seeing, I've mentioned before about breakouts. I think breakouts that they break out in the first hour of the day, I'm a bit dubious of them. But if you see something that's held on to its gains throughout the day, I think that's a solid entry. And I was trying to do that, but intraday on a 5-minute chart, and I really couldn't. I couldn't make that many decisions. I couldn't enter, exit with a loss, enter, exit with a loss, enter, exit with a loss. You get the pattern there, and then get 2 or 3 winners throughout the day, and have to do that 10 times a day. I'm sure that day traders can tell me they don't trade that much, but this was what I was trying to do, and I tried it for a couple of months, and like I said, I just couldn't do it. It really made me mentally tired. And so I have to be more long term, and that goes back to finding a system that suits you. I'm sure you've had people on this show that they would think about how I trade, and think I'm crazy. I don't have to look at the markets throughout the day if I don't want to. I just do it because I enjoy them. I really can make all my decisions based off end of day data, and the rest of the time, particularly in the last few weeks when it's news has been. The market's been kind of headline driven. I've just turned everything off and come back at the end of the day and seen which stocks have held up and which I've had to sell. And I couldn't do that through day trading.
Yeah, I mean, that's a fair enough point too. So you've mentioned a couple times or a few times throughout this interview that the word system. So just so we understand, how systematic is your trading?
Okay. Yeah. So, system is in nothing is let's say robotic. It's certainly not every stock that does this I must enter here. Every stock that does this I must exit here. It's completely discretionary. So I do I stalk a number of stocks that are in uptrends. Some of them are sloppy uptrends. But I look for those periods of kind of exhaustion with on a pullback. I do trade breakouts occasionally, but I'm more successful trading pullbacks. And the only thing that is, I would say, systematic, but I guess that's to the point where I absolutely will exit is when my stop is hit, and that will be decided before I enter. So, like I said, there's one stock recently that I was in that hugged the 50-day moving average. So the easiest place to put the stop is below the 50-day moving average, a close below it, or if it was. This is where the discretion comes in. So if it closes below it and it closes on a pretty big candle, or it closes on it closes at the bottom of the range for the day, then I would just exit straight away. If, for example, during the day it's put in, there was kind of a wick on the end, I might say, okay, well, I'm going to exit as soon as it goes below that wick. So that kind of, in case a market maker's been pushing it around for whatever reason, because of course I'm not the only person looking at this stock. There is a lot of people that would notice that the 50-day moving average doesn't get breached a lot. So it's a very easy way to put your stop, and then just try to make sure that I'm not one of the weak ones that gets pushed out, and then obviously it motors on ahead, which has happened before. Equally, like I said, if it's support and resistance, then that's my exit. I'll know when. I'll decide that before I get in. So that's probably the part that is, let's say, if there is, systematic. But like I said, ultimately it is discretion. But there is one thing that I would point out on that, is that as much as it's discretion, and I have just commented then about sometimes I might look at my exit. There's no way I don't hold a losing trade. So I wouldn't, there is kind of scope there to interpret that as, he might, a stock might have dropped to whatever price level, and he might be in denial about it. That's absolutely not what I'm saying at all. I'm just saying that occasionally, they go back to Edsecote, follow your rules, know when to break your rules, that kind of thing. It's just a process that I know works for me, but there is no way that I would hold a losing stock if it's gone past my exit.
For sure. Okay. So, how do I say it? So how did you know, or maybe I should say, when did you know with a reasonable amount of confidence that you'd found an edge, that what you were trading actually worked? Like, when was the point when you were comfortable with that approach?
Well, my account value, really. It was, I track my equity curve, and it goes from bottom left to top right. It doesn't mean that there are some, drastic pullbacks in that. But, I could show you over the years, you can see they've got less and less. So, ultimately money is the way that, that will show, that will tell you when you're right, I think. I know that my system makes money. Now I know that, everyone else you've had on your show, their system makes money. I'm not, there is no holy grail in that sense. So it's really just about finding a system that works. Now I could probably find one that makes more, but I don't really want to. You can obviously, once you found your system and you plot in your numbers, you know what your let's say what your winning percentage is, or what your payoff ratio is, or whatever. You can then adapt your money management to kind of fit your bigger, your longer term goals. But ultimately, it was that I was looking at my equity curve and see it rising. The other thing that was probably, let's say, one of the real kind of again, like, aha moments was. I started off with a system, and I tinkered about for a while. I tried a bit of, try the day trading thing or whatever, and tried a few other strategies. And one day I just sat down and was just frustrated and a bit like, well, how's this happening? Meanwhile, my mentor has gone on and made a ton of money, and I'm sat there with a lot less than he's made. In terms of percentage returns or whatever. So what have I done wrong? And that's when, like I said, the psychology side really kind of kicks in, because it's not the strategies, okay? There's people out there that can trade pivot point strategies. There's people out there that can swing trade, day trade. They can fundamentally invest and make money. So everyone can. There is strategies out there for everyone. It was when I kind of went through my original strategy and looked at the initial trades and realised if I'd have carried on doing what I was doing, I would have made more than 80% more than I'd made that year, if that makes sense. It was then that I was actually like, okay, there's something in this. So what is it that I'm doing wrong? And that was, it probably, the end of the beginner's cycle was when I realised actually it's really not about the system. What makes you successful as a trader is probably learning about your mindset and how you deal with your system, if that makes sense. So, for example, on a pullback, you don't, or a down, a drawdown in your equity, you don't kind of jump ship and look for the next best thing. And it's really then that you then start to think, well, okay, so I'm in a drawdown at the moment, so what should I do? Okay, so on one hand you can go, you know what, the system's rubbish, it's not working, I'm going to find something new that does work. You go back to the beginning again. Or you kind of grow up and look at it from the kind of, let's say, a professional trader point of view and go, okay, is it the system? Does the system work? Yes. Okay, the system does work because it's made money in the past. What doesn't work at the moment? Is it the market conditions? And you go, yes. Or is it maybe I'm taking on too many trades, and you kind of, you start looking at that. And that, I think, is when you make a jump from kind of beginner to, let's say, more professional style of trading. You're just working on that constantly instead of going back and thinking about a whole new strategy.
So what were the certain aspects of your sort of psychology issues that you had to work through that were preventing you from sort of making potentially 80% more that year? Like, how did you, like, psychology, I guess it's kind of quite a broad topic, but how were you able to sort of pinpoint what it was and then sort of focus your attention on that to be able to resolve those psychology issues that were preventing you from making a lot less money?
To start with, it was driven by frustration. I'm sure that everyone must get to a point. There's one of the guys in Market Wizards' book, and you have to forgive me, I can't remember his name. Said there was a day when he lost a ton of money and turned around and said something, along the lines of, "What, am I this stupid?" And he says, "No, you just got to keep going." And that really is kind of part of it. I knew that the systems were making money, but I just wasn't implementing them right. I wasn't doing the right thing, and that was the bit that was frustrating. Why? What am I doing wrong? And that was, like I said, you then start kind of self-reflecting and really kind of looking, well, if that system makes money, there's, let's say one of these subscription services on the internet where you can buy, you can sign up to it and they give you the entry and the exit signals. Well, they make money they probably make money as a trader. You could get those same signals and not make money because you might do something wrong. It might be obviously your risk management and that kind of thing. Equally, it might be you might try and preempt the exit signal, you might preempt the entry signal, and that's nothing wrong with the strategy. Although when you first start out, you'll blame that strategy. That's down to you. That's your own fault. And I think it was it's from another book that I apologise to anyone that has written these, and I'm not referencing them, but where he says about you've got to take responsibility for everything you do, and you can do this in everyday life. And this is kind of, I think, something that I tried to do a few years ago, where every situation that goes on is your fault, and it's quite a big thing to say that, but everything that happens, let's say your partner comes in from work and she's in a bad mood and she lashes out at you. How's that your fault? And you constantly find a way that is, you start then looking at yourself a lot, a lot more in detail, and particularly with your trading. Kind of, why is this strategy? Why does it make money? In back testing, why does it not make money now? What am I doing wrong? And that's when you can be honest with yourself. That, I believe, is when you're kind of you make a massive leap in the right direction, and it's quite hard to do. Not a lot of people like being honest about themselves. I could probably list a lot of things that I know are wrong with me. One is I'm very impulsive. I've got an addictive personality, and these things. They're probably gambling is not a very good thing for me. Day trading, this is when I realized actually this isn't good, because I get impulsive, I make the wrong decisions, I jump into trades quickly and realize I've done the wrong thing, and that goes totally against my the way that I am. So therefore, I need to adapt my system to fit me, which is why I don't like looking at the markets throughout the day, because if I get I might get a rush, or I might, I might lose discipline. Whereas it's much easier for me to sit down in the evenings, look through thousands of, let's say 500 charts a night, and just make a decision whilst the markets are shut. I'll make a little short list of what I think I want to, enter or I want to watch. I might have another little look later on in the evening. I'll have another look in the morning. And if it still looks good, then I'll buy it. Equally, there have been times where, you get a bit giddy because your portfolio's up and you think, yeah, I'm going to buy that. You look at it next day and you're like, well, actually, it's kind of invalid. That's not the right entry. And you'll sit back and you'll wait. But it's only understanding that I've got that side to me that I'm able to then adapt my strategy to fit, kind of my the bits that I would consider pretty crap about my personality.
Sure, yeah. No, that's a lot of great points in there that you touched on, so I really appreciate that. We should probably start to wind things down, Chris, but let me ask you, is there a resource or a book or a video or anything you'd like to recommend to listeners to check out if they'd like to dive deeper into sort of understanding the psychology of professional trading?
Yeah. I mean, there's firstly, just keep rereading books that everyone else mentions. I think I've kind of touched briefly in the past with you about this, that things like Reminiscence of a Stock Operator, Market Wizards, etc. There's I've read Reminiscences over 100 times now, and each time I hear something new in it. And the reason is that there is pearls of wisdom in all of this, depending on different parts of your trading journey. So Reminiscences, to start with, is a really nice story about a guy that likes trading and makes a ton of money. That's the nice story that you hear at the beginning. Then you hear about, you might hear a part of his strategy the second time you read it. The second time you might hear about how he blew an account up, but he kept going. So, you might have blown up an account recently and you think, okay, well, he's done that. I've just got to keep going. And ultimately, you just keep kind of, every time you hear it, depending on what part of your journey you're on, you'll hear something new and relevant to what you're experiencing at that time, which is why I think those books are absolutely fantastic. The second was a YouTube video that Nick Raj put up called "What Makes a Successful Trader." I think it was a presentation he gave, and he talks about the two kind of facets of trading, kind of quantitative, it's easy for me to say, and qualitative, which is basically your strategy. He gives the best thing is he gives an analogy of a car. So the quantitative side would be driving the car. Put your foot on the gas, put your foot on the brake to stop, turn left, turn right, that kind of thing. But the qualitative side is learning about the roads, learning about, you get those idiot drivers that are indicating to go left. When you get that feeling, actually, they're going a bit fast to do that. So you don't pull out, you just hold back. And ultimately, they weren't going left. They just left their indicator on. And that's what I think is kind of what trading is about. You kind of learn those two parts. You learn, how to trade, and then you learn about everyone else around you in the markets. And that video is very, very good at describing it. But you have to watch it a lot to really kind of get all the points out of it. And again, I've watched it, loads and loads of times. And like I said, you kind of, once you realize that those two parts exist, you can work on one, which is your strategy, but then you should probably look at the other parts. What does it mean to you, and how does that affect your trading? And like I said, that was kind of a big thing for me.
Yeah, that's a really good video, that one. I've watched that myself, and obviously Nick Raj was on this podcast in the past, so if anyone wants to hear an interview with Nick, check out episode number 4. But all right, Chris, well, this has been really, really good, and I appreciate you making the time today to come on and speak to me and share with myself and also the listeners just a lot of really valuable information. It's been awesome, so thank you very much.
No problem.
And is there any way that listeners can get in touch with you if they'd like to sort of learn more about you or just sort of reach out?
Yeah, you can email me. So yeah, it's I guess you put it in the show notes, but it's Chris Sace 1983 at googlemail.com. Yeah, and that's a good way to reach me, really.
All right, sure. No trouble. We'll put that in the show notes. And yeah, if anyone wants to get in touch, they can just shoot you an email. But again, Chris, thank you very much for doing this, and take care, and let's talk soon.
Yeah, no problem.
this.
Thanks for having me on. It's an
To stay updated with each great new episode,
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market
A book which has been well received by the trading community and has plenty of 5-star ratings and reviews on Amazon. During this interview, we cover the great focus Kevin places on trading multiple strategies in multiple markets to achieve a smoother equity curve. So we kind of hit on a little bit of diversification. It's very interesting. And he also walks us through his development process for taking an algorithmic trading strategy from objectives and initial idea through to total automation. Plus, we cover plenty more as well. And even if you're not familiar with this side of trading or this particular style of trading, you shouldn't have too much trouble keeping up because Kevin does an excellent job of explaining everything. Now, guys, just real quick before we get into it, I'm going to ask once again, if you haven't already done so, could you please leave a very brief review on the podcast and iTunes? I can't express how helpful this is. It's just a really easy way that you can support the podcast. So if you can do this, just go to chatwithtraders.com/iTunes. Again, huge help and I really appreciate it. All right, I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is this week's guest, Kevin Davey. Hey, Kevin, great to be speaking with you. How's it going?
Great. Well, thanks for having me, Aaron.
Absolutely no trouble. It's my pleasure. I mean, thank you for coming on the podcast. We've been speaking for a little bit beforehand, and I mean, we're going to dig into some really interesting topics here. Algorithmic trading will, of course, be the big one. And I know you've got plenty to share on this, so it's going to be good. But before we get into trading specifics, let's cover your background and the journey you've been on to getting to where you are now. So, Kevin, tell us about your introduction to trading, and if you could, take it back one step further and give us some background about what you were doing before this time also.
Okay. Well, my introduction to trading was really, I got an ad that came through the mail that said, hey, you can make a ton of money by trading commodities. And at the time, I was a couple years out of college, and I didn't even really know what all that was. I had just started in a career. I was in engineering, actually aerospace engineering. So I was working on fighter aircraft, and I was just starting to get settled in a career and started to have some money to invest. And I saw this about commodities, how you could make all this money. And I think the example I was given was actually sugar. And it showed, hey, if you bought sugar all the way up here, you would have made, hundreds of thousands of dollars kind of thing. And so at that point, I was like, wow, this is pretty cool. And so that kind of started it and started me down the road of, doing research and, of course, opening an account, because everybody's always excited to open an account as soon as they can. And within, I don't know, a few weeks, I lost 10 or 15%, 20%, something like that. So then I did the reverse of the strategy I was trying to trade, and I lost a bunch more. And all of a sudden, my account's down like 60% in a very short time. And so, but by that time I was kind of hooked. I was like, wow, well, if I can lose money this quickly, I could probably make it this quickly. That was my naive way of thinking. And that really just had me progress down the road of trying a bunch of different things over the years. Most things didn't work. And then eventually I kind of started to do more mechanical trading system. I always liked the rule aspect, actually, from like day one. But there were times where I did discretionary trading and that type of thing. And eventually I just kind of settled on, hey, these mechanical algorithmic trading strategies that you just follow the rules and just execute them. And if you've evaluated them right and tested them right, they should produce, some kind of profit over time. And that's kind of where my journey's led. And that's what I do today, is just create strategies and trade a lot of the ones that I have. And always have new strategies waiting to go in case something happens to some of my existing ones, and I just continue on that journey.
Excellent. Yeah, that's really good. So let's not brush over those first couple years, and I'm keen to hear more about what was going through your head when you lost sort of around about 60% of your initial capital, and you decided to, take a step aside and reassess things. Like, I mean, most people, I presume, would probably do that once they've run out of capital to actually trade with. They'd step back and then rethink things. But you sort of noticed that this isn't going right. I need to do something here. So what was your next step from there? Like, what were you learning? What were you studying? And how did you go about this?
Okay. Well, really, what happened after, I almost blew out that first account, I kind of took a step back and I just started reading as much as I possibly could. So at the time, this is about 25 years ago, the internet didn't exist, so there weren't all these trading websites and forums where you could get information. So a lot of it was just books and magazines, some of the trading magazines, and I was just kind of devouring all that. As much as I could possibly get information-wise, I did. And it didn't really matter what style of trading was discussed. It was just talking about trading, and that's what really interested me is, I was just kind of on a fact-finding mission that I just wanted to see what other people did and how other people succeeded. Maybe that would help. And, I looked at things like, obviously, like Elliott wave and Gann theory and all these different things. And, I kind of said, well, hey, that doesn't really fit me, or this kind of does. And eventually I got to the point where I started testing some of this stuff. And at the time, I don't even know if tools like TradeStation or anything like that was available to do the testing. So I was doing a lot of the testing by hand. I had done some computer programming before. So I got a hold of some data and created my own trading systems and a way to evaluate them. And I did that for quite a while. And, that whole thing led down the road of over-optimizing, curve fitting, too many rules, too many parameters. And, you'd get these ridiculously good results, and they'd be like, oh, well, I didn't even include commissions on that or slippage. Didn't even really understand at the time what slippage was because I hadn't traded that much. But eventually, over time, I started to realize that, hey, most of these systems look so good, but they're just bogus. They're not going to work. I kind of knew that just from my experience getting creamed right at the beginning. So I was just able to kind of keep on and develop more systems, but not actually trade them right away, and just kind of watch them. And eventually I got to the point where I felt comfortable enough to actually start trading some of these things. Now, the problem was I was working full time, so I couldn't place orders all day long. I had to do like end of day systems. And at the time, there really wasn't software to, at least for a retail trader, to even automate things that would never even entered my mind. So I was just doing these simple end of day systems. And, on and off, I had some success. And along the way, I did a bunch of other things. I looked at things like scale trading, where you buy on a scale down and you keep adding to a losing position, and I got killed with that. So I was doing other things along the same time, but eventually I just kind of settled on this mechanical type trading. And make a long story short, eventually I actually had a little bit of success. And then once that happened, then I started to get some confidence in what I was doing, and that kind of led me just to where I ended up today.
Okay, no, that's excellent. So if we had to boil it down to just one or two of the greatest challenges you experienced earlier on, What would you say these were? I mean, I think it's really good to highlight these because a lot of listeners can really resonate and perhaps if they're having similar challenges, learn about how you overcame these challenges. So, I mean, you kind of mentioned curve fitting and that, but was there anything else that you really struggled with early on?
That was probably the biggest thing. But I guess I would generalize it a little bit more. Learning how to properly test and evaluate a strategy. That was the biggest challenge because there wasn't a whole ton of information out there about that back when I started doing it. And, even the stuff I read probably didn't sink in enough because, until you actually do some of it, then you become more experienced with it. And then you realize, oh, this guy in this book was making sense. And I didn't understand it at the time. But, even when I started using tools like TradeStation, which is what I primarily use now, unfortunately, the way they set up the software, it makes it really easy to make a lot of bad decisions. The easiest thing to do is you open up a chart, then you insert a couple strategies, and then you optimize it, and then you get the best results, and then you go and trade it. And a lot of people still do that. And, and I certainly looked at that either in the stuff I was custom doing or when I actually started doing with TradeStation. So, and that's totally the wrong approach to take. It leads to so many bad things that I can't even describe them all. But that's probably the biggest challenge is knowing how to test and evaluate the right way.
Okay, sure. And you also mentioned in your previous answer that you were still holding down a job for quite some time while you were trading. So at what point did you feel comfortable and confident to take the leap and make that transition to trading full time?
Well, I think I did this in 2007 was actually when or 2008, I'm sorry, when I actually made the leap. So I've been trading full time for over 7 years now. And what happened was in 2005, 6, and 7, I finished in the World Cup of Futures Trading Championship. I finished in first place one of the years and second place the other 2 years. And so it was 3 years in a row. I finished in first or second. And each of those years I had over 100% return. So that gave me quite a bit of confidence that, hey, I kind of know what I'm doing. Maybe I should do this full time. And the way it worked out career-wise with what I was doing, I had an opportunity to leave the company I was working with and get basically like a lump sum of money at that time. And so I thought, well, hey, that'll help keep me going as I start to transition to this full-time trading, because the last thing you want to do when you're a full-time trader is be sucking off your account to pay for living expenses. And eventually I had to do some of that, but at least this gave me a little bit of room. But the biggest thing, with just going full-time, I probably, looking back on it, I think I started not too soon, but with way too little capital. And if I had probably 10 times the amount of capital to start with, I would have been a lot better off back then. But, that's one of those things, you think you have enough and then you start doing it and you realize, ooh, when you start getting into drawdowns and you have to withdraw money too for living expenses, it becomes psychologically, it really kind of hits you.
Yeah, absolutely. And I mean, that's very impressive that you were able to take out the winning spot on several competitions there while you're still holding down a part-time job. I think that's very cool. And I can definitely see how that would be a huge confidence boost. But even still, I mean, did you notice, were there any notable differences in your trading habits when you did transition to full-time trading? Like you didn't have the regular income any longer that you could rely on and fall back on. Did your trading habits change in any way, shape, or form?
Yeah, especially in the beginning, uh, because now I had all day to trade basically, and that was part of the problem because I started to do some of that where uh, I just started to do some discretionary trading, which I really couldn't do. Having a full-time job, obviously, I couldn't really trade during the day. Now all of a sudden I had the time to do it, so I said, "Hey, why don't I try doing some of this discretionary trading during the day?" And that didn't work out too well. Otherwise, I'd be still doing it. But that was a big thing. And the other thing was just becoming disciplined enough to say, okay, well, now I have all this extra time, but I've got to be working more on systems and new strategies and that type of thing. And that was something I really probably wasn't prepared enough for. But after a few months, I kind of realized that, wow, I've really got to step up what I'm doing. I think I was kind of in the mode initially that, well, yeah, I'm full-time trading, but it doesn't mean it has to take up all my time. And after a few months, I realized, well, I'm not going to survive doing that. So I got to be working a lot more. And actually now I bet compared to what I used to do career-wise with the part-time trading, I'm sure I'm spending more time now doing the full-time trading.
Right, okay. So let's now talk about what has been working really well for you. So Kevin, if you could, tell us how you would describe your style of trading as far as markets, timeframes, and approach, etc.
Okay. Well, what I do now is I'm looking any markets, really any time frames, and any kind of strategy. I try not to pigeonhole myself and say, well, I'm only going to look at the ES, or I'm only going to look at crude oil, or something like that. Basically, any liquid market is fair game. And then time frame wise, I'll look to develop strategies that are intraday. I don't have as many of those because those are just harder, I think, at least for me, to develop. But I have a lot of swing systems that last days to weeks. I even have some systems that last up to months. So different markets, different time frames, and then completely different strategies. I will, if I find something that works in a particular market, I might try to apply it to different markets and see how it works. But for the most part, I don't necessarily expect that to happen or demand that it happens. Some people say, well, hey, I need a strategy that works in 10 different markets or I'm not going to trade it. I think that I understand why they're saying that, but my experience is you don't really need that. You can find, have some strategies that only work in one particular market, but they work pretty well. And so I will trade them. So that's kind of where I've gone. So I just developed systems for any market, any time frame, and any kind of strategy. And as long as it meets certain goals, and it was also developed using the development process I normally use, then I'm good to trade it. And so right now, for example, I think I'm just over 80 different strategies that I'm trading, either automated, some are manual, but all different kinds of markets and that type of thing. So, for example, when the ES crashed, and then it went back up a week and a half ago, I was short quite a few ES put options. And my options, because I do option selling as part of how I trade, and those options accounts got really nailed where they lost probably just over 15% of their account value in 1 month. But I was also trading all these other strategies that aren't option strategies. There's plain future strategies, and those made up for it. So overall, I was able to make money for the month of August, but that really speaks to, I think, some of the diversification I was doing. And that's kind of just probably where my trading will be going from here, is just developing more systems and just trying to diversify more.
Okay, and I know you're obviously very big on diversifying and having multiple systems, trading multiple markets simultaneously. What's like, you've mentioned some of the advantages there, but like I think there's additional advantages as well. Like, does it also help smooth out your overall equity curve? And is there any other benefits that make this such a important piece of your trading success?
Yeah, absolutely. I mean, the equity curve smoothing has always been one of my goals, and one way I measure that is just my monthly returns, percentage returns, measuring the standard deviation of those returns, and it's gone down by a factor of, I think, 3 or 4 in the last 4 or 5 years, as I've gone from probably trading 5 strategies or so to getting up to where I'm at now. So that's one of the huge benefits of it. The other thing, there's a couple other things that are kind of interesting that people probably don't think about initially, but let's just say you're trading 20 strategies, for example. If you allocate capital to each one is 5% of your account, roughly. And if one of those strategies breaks, it's not going to kill your account. Yeah, it's going to hurt, but you've only allocated so much to it that it's not going to wipe you out. Where people trading one strategy, if that strategy does bad, it just wipes them out. The flip side to that is trading one strategy, if it does really well, then you'll have higher returns. But as a full-time trader, I'm not really aiming for those super huge returns anymore. I'm aiming for something that's a little more consistent and that will tend, what I hope is, last longer. So I'm willing to give up some of that upside so I don't have that downside. And the other big thing with trading a lot of strategies that probably not a lot of people realize is it becomes really hard to, what I would say, cheat on a system. And by cheating, I mean, you'll see a signal, even if it's automated, and you'll say, oh, it shouldn't be doing that. There's a Fed announcement in a few minutes, so I'm going to turn that strategy off and exit that position. That's what a lot of people do with their automated systems or even mechanical systems that are manual. They'll override them and turn them off. That's not good, because now you're going against what your historical testing said. It said to do something, now you're doing something else. Are you going to make it better or worse? I don't know. Probably you'll make it worse, but the point is it's different. But yet when you have 20 systems, it becomes really hard to cheat on those systems, because you're going to be overwhelmed. Oh, system A, am I following it or not? I don't know. Well, system B, I know I'm doing the exact opposite of what I should be. And you're trying to keep track of all this. It's much easier just to let the systems run and then deal with the consequences of that, which means, you put things in place to quit those systems that are bad, but you don't overrule them with what you're doing. So that's one of a big benefit of trading a lot of strategies.
Okay, sure. Yeah, now you hit on a lot of really great points there. Thank you for sharing those, Kevin.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, maybe I should have asked this a little bit earlier, but I mean, what actually attracts you to algorithmic or systematic trading? And in your opinion, like, what are the major benefits of this actual approach?
Well, I think the biggest thing is you can evaluate it before you start trading it. And that to me is huge when you start thinking about your confidence in something. You know, I know a lot of people will look at a chart that'll be of 2 weeks and they'll see a certain pattern and they'll see 5 instances of it and, 4 of them worked, and they'll say, hey, that's good, I'm going to go. Well, to me, that's just awful. It's an awful habit to do. So I want to evaluate something, and I want 100 trades, 200 trades, 500 trades. I have some back tests going back that have like 2,000 or 3,000 trades. That's the biggest benefit, I think, because I know over history that it's worked. Now, does it mean it's going to work going forward? Well, absolutely not. But all things being equal, would you rather trade a system that you knew worked in the past and you were hoping it would keep working in the future, or would you want to trade one that either you didn't know how it did in the past or you knew it lost money in the past? In that case, I think the answer is pretty clear. You want to go with what's worked and take your chances with that. And that's probably the biggest thing I get out of mechanical trading. I can look at history and said, well, yeah, this has made money in the past, and therefore I'm willing to take a chance with it working in the future.
Sure. Okay. Now, those are some great benefits, but as we're constantly reminded, there's no such thing as the quote-unquote holy grail when it comes to trading. So what are perhaps some of the cons or some of the negatives that come with being an algorithmic trader?
I would say probably the biggest con that people tend to fall into is they try to make a holy grail. And the way they do that is they will go through and they'll run a test of 5 years, 10 years, and they'll get some results, and the results will look pretty good. The equity curve kind of goes up, and it looks decent, but they'll say, oh, I can do better, and they'll go back and they'll add some rules and filters, and then they'll look at, oh, it looks better, and then they'll go back and they'll look at the results and say, oh, if I didn't trade on a Tuesday, my results would be a whole bunch better. So they take out Tuesdays. Of course, the equity curve looks better. And they keep doing that. And they fool themselves into thinking because they made this better looking back test, this historical test, that it's going to continue on into the future. And that's usually not even true, and the exact opposite is usually true. It's kind of strange, but the more you try to make something better, the more you try to perfect it, the worse it actually becomes. And that's probably the biggest trap that I see people falling into, and the biggest con or disadvantage of algorithmic trading is people think because they can test Therefore, they should do everything possible to make the test great. And that gets a lot of people into some serious trouble.
Okay, but in saying that, is there still, to a certain extent, it's a good idea to try and optimize your strategy? Like, is there a thin line between optimizing and then over optimizing and curve fitting?
Oh yeah, definitely. I mean, I still optimize. I use what's called walk forward analysis, which keeps data out of sample, and so I'll optimize over a certain period, but then I'll apply those parameters to brand new data and see how it's done. And I'll do that approach, and that works a lot better than just traditional optimizing. But even that, where people get messed up is they'll get results that are walk forward results, but then they'll go back and change their system 5, 10 times, and then all of a sudden what they think is out of sample data isn't really out of sample, because they've run it so many times. So yeah, there's definitely a fine line. And I always tell the story that I have some systems where I have 2 or 3 lines of code almost. I have a line for entry and a line for exit, and maybe I'll optimize. There'll be something to optimize on each line, so maybe 2 variables to optimize. And if that looks decent, I will stop there. And some people think that's crazy. They'll say, well, you got to add more filters and more, conditions. And, that doesn't seem to work. I mean, I know people who've spent 5, 6 years currently working on one particular system, and they have thousands of lines of code, and they're no better off. They've just over-optimized to the nth degree. And, I guess my rule of thumb always with this is if you start to feel a little uneasy that you might be doing too much optimizing, you've probably already gone past that point where you have. And it's definitely time to stop at that point.
Yeah, that's really interesting. Just a couple of the words or the terms you used in there. I just want to make sure that listeners understand. So there's a couple you mentioned there was out of sample and then walk forward. Would you mind just explaining what those 2 terms refer to?
Okay. Well, if you're doing any kind of back testing, normally what most people do is they will test up until today and optimize, and then take those parameters and start trading them. That would be optimization with it's all in sample, because by in sample I mean they've made their decision based on optimized data. So that's the first one. But then there's some people who said, well, I'm going to test for 5 years, but then leave the last 2 years of history. I'm not going to optimize that, and I'm just going to apply those parameters to those 2 years and see how it did. That's an out of sample test. So you optimized on one set of data, but then you applied those parameters to another set of data. That's an out of sample test. And then the walk forward is actually just a process that kind of takes that to a further degree, where you optimize and put it to a set of parameters for a limited amount of time. Then you optimize, you move the optimization, you walk the optimization window, and you apply it to another set of time. And basically what you do then at the end is put together all these pieces of out of sample periods together to get a full out of sample curve. And if you do it right, it really is truly out of sample data that your system is being evaluated on. And that tends to work a lot better than a fully optimized system. Now, none of those are as good as live testing. Obviously the best test always is going to be live testing. And, you can certainly do that. And a lot of people, part of my process I actually do some of that, where even though I've done the walk forward testing, I don't go and trade something immediately. If I develop something tonight, I'm not going to trade it tomorrow. I'm going to let it sit for a while and see what happens in real time. And that seems to also help eliminate some of those systems that, we've all had them, that as soon as you start trading them, they go and start, they go into this huge drawdown. And you're like, why does this always happen to me, kind of thing? But that kind of helps with it, just waiting a while, and which most people don't do.
Excellent. Thanks for explaining those, Kevin. That's really good. Now, I'd like to talk probably a little bit more about the actual development of a system or an algorithm. So if you could, maybe just give us an overview of your process for developing an algorithm. Like, if you could just briefly hit on each one of the stages involved, going from maybe initial idea through to actually going live with an algorithm.
Well, the first thing, even before you come up with the idea, you really have to know what your goals and objectives are. And most people just bypass that completely, but it helps set expectations, because if you're looking for a strategy that returns, say, 300% a year with a 10% drawdown, you're never going to find it. But so you got to have realistic goals to start. Then, ideas. I talk a lot about what I call a strategy factory, which is kind of describes my whole process, where trading ideas come in the door, come in your factory, you work on them, and then what either comes out at the end is either a full-blown strategy that you can actually trade, or it's junk, which is what most ideas turn out to be. And, it just goes in the scrap heap. But it all starts with ideas. Ideas are your raw material. And if you run out of ideas, well, you have nothing to test, right? And part of the running a factory is having lots of ideas to go through the factory to test. And so I make sure I probably have in one point in time 50 or 60 ideas of things I want to test. And honestly, I just don't have enough time to test them all. I wish I did, but I never lack for testing. I never say to myself, boy, I wish I had something to test. I can't think of anything. So you need that reservoir of ideas. So then usually what I do is I just run a quick test on it. You don't need to go through the whole process of running these detailed tests. A lot of times just a limited period testing, a simple test will tell you if your idea holds any water, if it has any merit to it at all. And that's a quick way to kind of go through a lot of ideas. So I do that. Then I go into a detailed testing, which includes the walk forward testing and some optimization. And assuming that passes, then I run some random simulations, some Monte Carlo simulations, because, just because a certain walk forward test equity curve looked a certain way doesn't mean that's the way it will happen in the future. You can take those trades and just mix them up, and you get something totally different. So it gives you some more probabilities of what's occurring. So if that passes, and at each of those steps, there's certain criteria that I use to say, well, okay, this can go on to the next step, or no, it's junk, I'm giving up, moving on to my next idea. Once it goes through the random simulations, then I actually just put it in what I call incubation, but it just sits on a shelf basically for a period of time, and I go and check it periodically to make sure to see what it's doing. But then at the end of it, I'll say, yes, I think I'm going to trade it, or no, I'm not, or I need to evaluate it longer. And I just evaluate it once a month. And I do that right now probably with 100, somewhere between 100 and 150 strategies that I look at least once a month. And, at that point, sometimes I'll bring new ones in. And that's probably the last step is you say, well, I've got this portfolio of strategies I'm trading, and I have some extra capital. So either I'm going to bring in more strategies, or maybe I'm going to increase the size of the ones I already have. It kind of becomes a trade-off. Should I increase size of ones I have, or should I just bring in new ones? And there's some criteria that I go through to determine what to do there. And that's pretty much it, and then I'll go live with it. And but then even once you go live, the important thing, you have to monitor those strategies, make sure they're actually performing, and you also have some criteria in place to tell you when you're going to stop. Most people don't think of, that's one thing most people don't think about. They don't think about when they're going to stop trading a system. Especially, think about it. You just created a system and you're all excited about all the money you're going to make. The last thing you're thinking about is, well, what if the strategy doesn't work? What do I do? Most people don't think about it. But that's exactly the time you should be thinking about it. And you should say, hey, if the strategy does this, if it has this kind of drawdown or whatever, I'm going to quit trading it. And that kind of completes the process, and it's kind of the loop back to monitor your performance. And then it just becomes almost as simple as it sounds. It's just doing that process again and again and again, hundreds of times to create new strategies.
Okay, so have you ever had a situation where, like similar to what you described, you've gone through all this testing and this process, you've gone live with a strategy, only to find out that it's not performing anywhere near as well as it was during the testing phase, and it's actually given you quite poor results. Have you ever had an experience like that, and how did you treat it, if that's the case?
Oh, yeah, definitely. I mean, whether it's I do something wrong in the testing and I don't even realize it, or the market's changed. For example, in my book, I have a couple Euro systems that were doing pretty well up until mid 2014, when volatility started to reach record lows in the Euro, and then those systems stopped working. They really haven't recovered at all, even though the volatility's picked back up. But the structure of the market, I think, has actually changed a little bit. So yeah, I definitely have some that don't quite work out. And the big thing I do is I just say, well, here's my criteria for when I'm going to cut that strategy out of the portfolio. And, because otherwise, if you don't do that, you could eventually get to the point where the strategy just takes over and ruins your account. And you don't want that. You want to cut those. It's just like trading. You want to cut the losers and let the winners run. And whether that's a particular trade, or if you look at a bigger picture of strategies, you want to do the same thing. You just want to cut your losing strategies before they get too bad.
Okay, that's an excellent point. Now, I feel as though many people may perceive algorithmic trading as an area that is probably quite daunting. Do you feel like this is actually an accurate assumption, or do you feel like it's probably not that much more difficult to learn than it is to become a good discretionary trader?
I think there's two different skill sets, because if you want to become a discretionary trader, I think it's really important to understand the market and understand price action and that type of thing. Where if you're being an algorithmic trader, that might not be as big of a concern. So, and what I mean by that is, a lot of times I'll see an idea and I don't know if it's good or bad based on my market knowledge. So what I'll do is I'll just test it, and that will tell me if it's good or bad. So in that respect, you don't necessarily have to be, a deep market theorist to be good at algorithmic trading. What you really have to be good at is your approach to evaluating ideas. And you have to do that properly. And if you don't do that properly, then it's that old computer phrase, garbage in, garbage out. If you don't do things right, you're just going to get garbage, and you think you're going to have these great results, and you're not. But normally what I tell people, as long as they can program even simple strategies in whatever trading platform, and if they can test simple strategies, they probably know enough to at least take that next step and learn how to test properly. You know, as long as you can do that, you're good enough. You know, some people think they need to spend years of coding with their particular software language to be able to trade algorithmically. And actually, I think that is more of a detriment because you don't need to do a lot of fancy things. You know, for example, I have systems that the entry is literally if the close is greater than the close of 10 bars ago, buy the next bar. I mean, that can be a simple entry like that, and that can work. And, you know, you can put an exit or two with it, and those kind of things can actually work pretty good. And my philosophy always is, well, the simplest things usually tend to work the best going forward because what you're doing, you're not putting a lot of demands on the market for the future. You know, you're just saying, hey, if this little thing is true, buy. You know, you're not saying, well, hey, if the momentum's up and the RSI is this and the ADX is this and your MACD is doing something, you know, a lot of people think the more conditions they impose, the better off they are. And it's actually the opposite. The less you impose, the better off you are.
Okay, that's really good. That's an excellent point. And for someone who might be interested in moving towards algorithmic trading but doesn't know how to go about it, what would you suggest to them might be a good first few steps?
Well, obviously, probably reading my book once they get a little familiar, at least with the futures markets. That's a good one. There's other good system development books out there. Bob Pardo wrote probably the classic book a while back, and that's a good book. And there's books by Tomasini. One, it's called I can't remember the title offhand. I think it's called Trading Systems. Jackal and Tomasini. That's a good book. So there's some good books that will give you some of the basics of testing. And then the other part of it is to actually just fire up that software, whether it's Ninja or TradeStation, Multicharts, OmniBroker, whatever it is, and learn how to program simple systems in that language and, you know, do some simple optimization, be able to look at a performance report and see what's going on. That's the way you start getting a feel for this algorithmic trading. And once you get to that point, then it's, okay, well, now I'm going to learn to test the correct way. And then it's just a matter of programming lots of ideas and trying them out.
Sure, excellent. Okay, well, I'll make sure to put links to all those books you just mentioned there in the show notes. So if anyone wants to check those out, just go to chatwithtraders.com/38 and you'll find links on that page. Now, this is a question that actually came in through the Chat with Traders site, and I thought it was a really good one, and you're probably the right person to ask. Can you survive as a trader over the next 30 years without learning much about code?
Well, that's a good question. I personally would not want to, but I think if you are willing to spend the time sitting in front of your computer day after day, and you know, I'm assuming you're going to be a discretionary trader, you might be able to do okay. I don't really know because my world, I know a lot more algorithmic type, mechanical type traders, and you know, a lot of them have had success. I don't know a lot of discretionary traders to begin with. So, you know, knowing that they are having success, I don't really know for sure. So, yeah, that's, I guess if you decide, hey, I'm going to go discretionary trading, you know, it's possible. But obviously, if you want to do any kind of algorithmic, mechanical type trading and any kind of testing evaluation, I think you really have to learn to do some coding.
I think that's a good answer. And I mean, it is quite a tricky question, really. But I mean, Kevin, this has been really good. So let's just do one last question, then we'll probably wind things down. So I like to ask this to pretty much everyone who comes on the show. So, if you had to sum it up for us, what's the main reason why you believe most traders never succeed?
Oh boy. um, there's probably a couple reasons. So I don't know if I'll be able to give you one, but psychology and having an edge. And the ironic thing is those two go together. So some people think it's all about psychology. Got to have the right psychology. I got to journal my feelings, blah, blah, blah. Well, that's great. But if you don't have an edge, all the psychology in the world isn't going to make you profitable. Okay. But even if you do have an edge, if you don't have the right psychology, so for example, if you're a mechanical trader and your psychology is such that you have to overrule the system, you're not going to be successful doing that. So you need both of those pieces, and if you only have one and not the other, you're still going to fail. And a lot of people don't get that. They think it's either all about psychology or it's all about finding an edge. And really the truth is you got to have both. And that's probably the biggest key out there.
100%. That's a brilliant answer, Kevin, and an awesome way to take us out. So, before you go, can you share with listeners where they can go to find out more about you and connect with you?
Sure. My website's www.kjtradingsystems.com, and you can go there and read a bunch of stuff. And you can also, most of the pages have contact forms at the bottom where you can contact me, or you can just send me an email at it's kdavey, KDAVEY, at kjtradingsystems.com. Just send me an email. I'm just here trading pretty much full time, so I see all the emails. No one else answers any of my emails or anything like that, so they can reach me that way too.
Really good. And do you want to share the title of your book?
Sure. It's called Building Winning Algorithmic Trading Systems. It's kind of a big title, and then there's a nice subtitle. It's a trader's journey from data mining to Monte Carlo simulation to live trading. And in that book, I talk more about the process we kind of talked about today, Aaron. And in the beginning of the book, I kind of lay out my trading history. So it's more of a narrative in the beginning. And what a lot of people have told me is they kind of identify with a lot of the struggles I went through. But I think it's kind of important to see the struggles before you see the ultimate success, because a lot of people think trading's just all, hey, I'm going to start trading, it's going to be easy, and it's really anything but. I always tell people it's the hardest way to make easy money that's out there.
I like that. I like it. Yeah, I mean, that's a book I'm really keen to check out for myself. So anyone who wants links, of course, everything will be at chatwithtraders.com/38, including a link to Kevin's book. And last of all, you're on Twitter as well, aren't you?
Yeah, it's my Twitter is KJ Trading, and yeah, people can reach me that way too.
Awesome. All right, very good. So go follow Kevin on Twitter, and Kevin, take care, and let's speak very soon.
All right. Well, hey, thanks for having me here today, Aaron.
My pleasure. Thank you very much.
All right.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
thrilled to have you with me. Now, before I even introduce my guest for this week's interview, I just want to say I've been receiving a bunch of great feedback on the show lately, which is really cool. So I'd like to give a big thanks and a shout out to anyone who has either emailed me, commented on the site, hit me up on Twitter, or even left a review on iTunes. I really appreciate it. The support is incredible, so thank you very much. All right, so my guest on the podcast this week is Jack Little of mercenarytrader.com. Jack is a global macro trader who originally started out as an international commodity broker. Today, he now has more than 17 years of skin in the game and is a very competitive trader. He's also a keen poker player and believes there are many crossovers between poker and trading, which of course makes for some interesting conversation during this episode. Also during this episode, we speak about how Jack thinks of trading in terms of probabilistic outcomes instead of attempting to quote-unquote predict the future. We spend quite some time on the subject, and I myself found his views on this particularly interesting. Another highlight would be mastering the art of the big bet, where Jack shares insight to the times when you should press harder on a trade to make profits that have a real impact. Now guys, just a final reminder for the mentoring giveaway. Entries close this Friday, 6th of November at midnight Eastern Standard Time. So just in case you haven't already heard, this is your chance to win a free 90-minute one-on-one mentoring session with a seasoned pro trader. Who are these traders? Well, they are Chris Sace, Zach Hurwitz, and Brad Jelinek. Each have plenty of real market experience, very genuine, and most importantly, active traders who've previously featured on this podcast. Now, seeing as there are 3 mentors, there will be 3 winners also. So to enter, just go to chatwithtraders.com/win, that's WIN, and enter your email address. That's it. It's very simple. And I'd just like to add in here, this level of access is generally very difficult to come by. We have an experienced trader who is willing to block out their time to sit down with you and do what they can to help you see better results. So please make the most of this opportunity and go to chatwithtraders.com/win to enter now. All right, now time for this week's interview. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and please welcome my guest for episode 45, Jack Little of Mercenary Trader. Hey Jack, welcome to the podcast, man. How's it going?
Good. Thanks for having me. Going really well.
Awesome. Good to hear. And no trouble whatsoever. It's awesome to be speaking with you, and thanks so much for taking the time to do this. I've been keen to speak with you for quite a while now, and I think this will be quite an interesting discussion because you've got some strong opinions and a slightly unique way of looking at things, which of course we're going to really dive into. Plus, I'm hoping there will be plenty of poker analogies thrown in the mix too, so I'm looking forward to it.
I'll work on that, yeah.
Awesome. So, first things first, take us back in time to when you first got involved with trading. How were you introduced to markets, and also share with us what were you doing before this time also?
Okay, so I was introduced to markets in college, and basically, so I majored in English and philosophy. I was very much a left-handed, right-brain creative arts guy. And I originally thought that I was going to wind up as a professor. And I had this vision of being an academic. One of those cool professors, kind of like Robin Williams in Dead Poets Society, wearing the tweed jacket and writing books in summers and all this. And I just thought I would be this cool English professor who wrote books. But then I had my dream completely shattered by one of my philosophy professors who basically said, look, going into academia is terrible. Your life's going to be terrible for like the first 5 years. It's awful. There's all these petty fights. And he just convinced me that academia would be a terrible idea. So I was completely set adrift, and I had no idea what I was going to do with my life because my cushy dream of being an English PhD was shattered because I thought it would be awful. And I didn't know what I was going to do, and then I came across this book on my buddy's dorm room floor, this guy who lived on my hall. And that book was The Investment Biker by Jim Rogers. And this was around 1995 or 1996. And so I picked up this book, Investment Biker, which was all about this guy, this ex-hedge fund manager who takes a motorcycle trip around the world with his girlfriend and decides whether or not to invest in the countries that he passes through. And I had never really been exposed to markets, but I immediately thought, okay, making money by traveling around and thinking is the coolest job on the planet. So I decided immediately from there I have to get into markets, and I pretty immediately fell in love with macro because of the whole top-down sweeping perspective of looking at countries and currencies and things like that. And so I stayed an English and philosophy major because I was already halfway through college, but then I just started interning at stock brokerages and read a couple hundred books and just jumped in with both feet. And then when I got out of school, I decided that I wanted to go into commodities. I thought that was the best route in. I didn't really want to do stocks. I was already bitten by the macro bug and had read Market Wizards and stuff. And everybody was in Chicago for commodities, except there was this one little boutique firm that had clients all over the country and the world that was run out of Lake Tahoe. And the boss had moved it to Lake Tahoe just because he liked to ski. So I wound up, my first job out of school was becoming an institutional commodity broker. And I had a whole bunch of hedge clients and worked with farmers and cattle ranchers and currency hedgers and scrap metal dealers and things like that. And I also worked with a bunch of speculators, and my largest client was a Russian hedge fund. And a bunch of these guys would put in orders over ICQ, this old instant message system. And that's sort of how I got started. This Jim Rogers book led me to commodities, and I did commodities for a couple years, and then I switched over to equity trading partnership, and just sort of expanded from there. But that was the beginning. I was an English and philosophy guy and found a book on a dorm room floor and became fascinated by markets and came in through commodities and then got into stocks. And now we pretty much do everything.
And here we are now. So
yeah,
what a great story. Okay, so let's take it back to the beginning there. You said when you jumped in with both feet. So I take it that you had a little bit of experience trading independently before you went to work with the firm. Is that correct?
Well, a little bit, but not a whole lot. I jumped in just in terms of reading everything I could get my hands on, and then I had this friend of mine who had introduced me to markets, introduced me to his broker, and he got us into some penny stocks that wound up doing terribly. And so I learned pretty early on, don't invest in penny stocks. And I did some dumb things early on, but mainly I had a mental education of just reading a whole lot of stuff and then watching a lot of people before I went into the commodity brokerage business. I spent a couple of years, 2 or 3 summers as an intern at Raymond James Financial, which was really interesting. I was working for a really successful stockbroker who sold his big thing was biotech stocks, and he loved these crazy stories about, this drug that's going to do X or this technology that's going to do Y. And I just saw a lot of interesting different sides of the business. Traded a little bit, soaked up a lot of information. I really, my first couple years as a commodity broker is when I learned, learned some good lessons and some hard lessons about trading.
Okay, so your role as a commodity broker, what exactly did that involve?
Well, we were a boutique firm that had both institutional clients and retail clients. So I played support to my boss, who had a bunch of clients, and he's been in markets for a couple decades. And so he had a lot of hedging clients. So for example, farmers would call in and need to hedge their wheat or soybean crop, or scrap metal dealers would want to hedge their copper futures positions. And so I would get on the phone and take orders from people and give reports to people and things like that. And then I started, I'm sorry about that, there's a little construction going on in the building here. And then I started helping clients construct hedge positions. So I started working with people saying, I want to hedge this risk. And I said, okay, let's figure out a plan. You can do X and Y and Z. And then we put the positions on. And then we also had a bunch of people who were just straight up speculators and just trading futures, because they wanted to trade aggressively, and everything from some really smart traders to just flat out gamblers. So I took a whole bunch of orders back in the days when you still had to write orders on paper tickets and use a timestamp, and then call into the trading floor and yell at brokers for bad fills, and also constructed hedges for people, and just ran the gamut of different types of clients in futures markets.
Okay, excellent. So how long were you with this firm before you decided to move on, and walk us through your next step from there?
Sure, I was with the commodity firm for about 3 years, and it was a great education because I started in the fall of 1998, and I proceeded to observe the worst secular commodity bear market in history up to that point. In 1999, commodities were basically going straight down while stocks were going straight up, and the dollar was very strong because all this capital was flowing into U.S. markets. And so I got to experience this horrifying commodity bear market, which was very interesting. And I was at that, like I say, I was at that firm about 3 years. There was this giant clearing firm, Refco, which has since blown up, and they were sort of dominating the commodity business at the time, and commodities were just looking very ugly and bearish. And right about the time of 2001 or 2002, I decided that I had sort of gotten my education in the commodity space and wanted to make a change. So I was there roughly until early 2002, and then I decided to pack up and leave, and I did some freelance writing. I had some relationships there where I was writing about trading and writing about markets, and actually got involved in making contributions to Michael Covell's book, The Trend Following Guy. I had done a big study on trend following while I was at the brokerage. And from there, I went into an equity trading partnership with a friend who would come into a large amount of capital through an inheritance. And we set up a partnership where I traded a big chunk of it for him and learned to trade stocks through the market meltdown in 2002 when Enron and WorldCom and all those guys were blowing up. So that was another really interesting experience.
Okay, so tell us a little bit about that experience. I mean, were you affected by those names you mentioned blowing up, or how did you go through that period?
We wound up making a little bit of money, but basically breaking even. And I was still learning a lot of things about trading at that point. We did okay though, because I had risk management already tattooed into my brain. Because now my path is a little bit unique in that I learned to trade basically with futures and then went to stocks second. And so when you learn to trade with futures first, it's like you learn to work with dynamite, and then you understand how risk works. And I was naturally, had a bearish bent from all these macro guys that I had been absorbing. So being in a crash, it was kind of fun. It was mostly getting used to, though, these huge wide swings, and I still had not really figured out my methodology or my market style yet. So we were probably more active than we should have. I traded in and out too much relative to what I would do now, but we did okay basically for the time, for how violent and crazy it was. So it was a great education, basically, in living through that kind of market.
Sure. Okay. So, would you be able to share with us some of the obstacles you had to overcome, during your earlier years, kind of up to the point where we're at right now, and what areas of trading were particularly difficult for you when starting out?
Sure. I would say some obstacles in the areas of discipline. I think one of the biggest things that I had to do was learn to develop a total picture of market awareness. In the beginning, it was funny because I had learned so much I had read Market Wizards and read all these books, but I didn't really understand the impact of macro. And the guy I was working for didn't either. And so a funny story in retrospect was in 99, all these commodities were going straight down, and my boss, the boss of the commodity brokerage, was a longtime bull on commodities, and he kept trying to buy things, thinking, well, this is the bottom. And meanwhile, the US dollar was just going straight up. I mean, the US dollar was just being powered by all this capital flowing into the US equity markets, and it was just going vertical. And now my attitude would have obviously been, duh, of course commodities are going to do terrible because the dollar is so strong. But he wasn't aware of that relationship. He didn't even pay any attention to it. And so I didn't think to pay attention to it because I was looking at so many other things. And so I guess you could say in the beginning, I had so many things I was trying to pay attention to that I missed some really important things just because there's so much stuff. So if somebody says to you, listen, there are 15 things about trading that you really need to understand, and you're trying to absorb them all at once, you'll be lucky if you get 10 of them, and then you'll forget about 5, and those 5 that you forget about will come around and kick your butt. And then you cycle around and you remember those, and you forget about some different ones. And there's this gradual iterative process where eventually you absorb everything, but you sort of have to run around and put out fires until you have this total picture of knowledge. And I never really had any direct mentors except the guys in the books. I never worked for another trader who was just a great trader, so I had to learn everything through sort of trial and error and reading from afar and things like that. And that was challenging. And then I guess just really putting a sort of worldview and style together and figuring out who I was in markets and how I wanted to approach them and what the important things were.
Yeah, that's great. I really like how you summarized that. So let's change gears now and focus in more on your style of trading that you've adapted and you're trading, in current times. So Jack, speak to us about how you would define your methodology for trading.
Okay, how would we define our methodology? Well, let's see. We're top-down, we're global macro in terms of we pay attention to the whole world and capital flows and the big things that are going on, but we're also bottom-up in that we're willing to trade anything. So we will trade commodities and currencies from the top-level view, but we will also drill all the way down and invest in individual stocks and hold individual companies for long-term positions if they look good. We have what we call sort of a combination of a systematic discretionary hybrid. And by that I mean, traditionally when you think of systematic traders versus discretionary, on the systematic side, mechanical traders hand all their rules over to a computer, whereas discretionary traders make all the decisions themselves. But we are a hybrid in the sense of we have a lot of things that we do systematically, like for example, our position management will follow a lot of systematic rules, but we're discretionary in our decision making. So we're sort of like a cyborg in that we're like a human who puts on a mech suit. We're enabled with a computer jetpack, where we use computers, but we also use human decisions. And as I say, we're able to trade anything, commodities, currencies, stocks, anything liquid. And we're typically looking for swing trades or longer term trades where our favorite holding period is weeks to months. A really great trade, we'll hold a really great trade for many months, 10 months, a year, longer. And we're also looking for very big bets. We're strong believers in the philosophy that most of the time you trade small, and every once in a while things really come together and you see an excellent opportunity, and that's when you really scale up. And that's how real profits are made, because of the way the market distributes profits in a very fat tail kind of process.
Now, I think it was Peter Brandt, who just on a side note is a legendary trader, and I also believe he's a good friend of yours. And he was featured on this podcast for episode 36, if anyone wants to check that out. He described you as having an unconventional macroeconomic perspective. And you've kind of just spoke about it there. But could you speak a little bit more on the subject, especially if someone is maybe completely unfamiliar with the whole idea of macroeconomic perspective? Like, what are some of the things you take into consideration when analyzing the market from a 10,000 foot view?
Sure. So The metaphor I like best, I forget where it came from, but there's a great metaphor, is if you think of the markets like a mountain, like a giant mountain, like Mount Everest or something, and bottom-up investors and people who only look at individual companies are sort of like they're walking around at the base of the mountain. And they're not looking up, they're not paying attention to weather, they're just seeing what's happening right there in the valley. And meanwhile, macro is up higher, the higher elevation levels of the mountain where storms can form and big weather systems. And so macro comes into play where if you're hanging out around the mountain and you're not paying attention to the weather and it turns really nasty, then you can wind up having thunder and lightning and boulders coming down on your head and so on. And so macro is paying attention to the total picture of the weather system and everything from what's happening down in the valley all the way up to the higher levels, including when there's big storms and thunder and lightning. And because of that, macro traders traditionally do well when there's more volatility. They do well and make more money when things are frightening. Whereas when the skies are blue and the sun is shining, that's when bottom-up investors tend to do better, and value investors and things like that will make more money. And so to analyze the macro picture, you look at things like interest rates and levels of inflation and risk appetite in markets, basic valuation levels. Are stocks overvalued or undervalued? Are we in a period of building risk appetite in a boom? Are we in a bust, and dealing with the aftermath of a crisis? You're looking at big long-term cycles. There are economic cycles of booms and busts. You're looking at capital flows all over the world. Money's like this big wave that's sloshing out of one market and into another market. You're looking at things that governments do. Governments will sometimes take really big drastic measures that have powerful effects on a market. Like, for example, China decided to prop up its stock market, and so they created this crazy bull market in Chinese equities, and then it crashed because it was unsustainable. And China created a housing bubble in Australia because Australia was selling all these base metals to China, and that in turn pumped up the Australian housing market with all this profit that was flowing in. So you're looking at these really big relationships, and then you're sort of playing a chess game to figure out what's going to happen next. And then you make bets based on that, which is very different than the traditional investor is only going to look at a single company and figure out what are the fundamentals for this stock. Or a trader might only look at a chart, whereas a macro trader says, well, we're going to look at everything.
Okay, so in that case, could you perhaps give us an example of either a recent scenario or just some of the things you like to see lining up before you actually commit to taking a trade or taking a position? Like, what gives you final conviction on a trade?
Sure. So at any given time, we have what we call themes about the market, where we're developing ideas and opinions on what's happening, and we're developing scenarios, sort of like movie plots, and we're saying, okay, X could happen or Y could happen based on following what's happening in markets, and then we pay attention to price to get a sense of which of these, what thesis is confirming. So if we're very bearish on crude oil, for example, then we want to see follow through on crude oil charts in a bearish direction to confirm that the thesis that we believe is playing out. So, for example, one of our large trades in 2014 was right around Thanksgiving. The news came out that Saudi Arabia was not going to cut production, and it became clear that they were going to try and punish the U.S. shale producers. And so Saudi Arabia basically started an oil war. And energy stocks had begun to break down, and you could see this breakdown on the charts. And we realized, wow, the Saudis are serious. They're going to try and drive the price of oil down to put shale producers out of business. This is going to be really bad for energy stocks. And so we shorted energy stocks, and it was a great trade. So you're looking for a theory about what's going to happen relating to supply and demand, or something strategic. And then you use price to confirm that your idea is correct and to enter the position when price is telling you, yes, it's happening, or price is giving you a green light.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So I'd like to dig into a topic and spend some time on this. So I'd like to speak about certainty and probability. I know you have plenty to say on this subject, so help us to understand how you think about trading as a game of expectation and how you think about probabilities.
Okay. Well, one of the unique things about us is that we don't believe in prediction. We think prediction is kind of silly. And the purpose of being in markets is not to predict anything. It is simply to assess odds and probabilities. So we will spend a lot of time developing scenarios like here's what we think could happen, or here's what we think is likely to happen. But this is not at all the same as a prediction. This is more like saying here are the odds and probabilities of the situation, and so here is what makes a good bet. So when somebody goes on Bloomberg television and says, I think X in the markets is going to happen in 6 months, we generally think that person is stupid because nobody knows what's going to happen in the market in 6 months. And making money in markets is not about making successful predictions. It's about making positive expectation wagers. So an analogy for this, at the poker table, you never have perfect information and you never actually know what's going to happen next unless you're cheating. So in poker, you'll have a certain situation where you can use the information from how your opponent has acted and what the cards say to say, okay, I'm going to do X because there's a very high probability this is the right move. And then you have a positive expectation. If you ran that scenario 1,000 times, you would make money on it. And so the way we view all of trading is that you're not trying to predict the future, you're just trying to make positive expectation bets where you're in line with the odds and probabilities. And if you do that enough times, then you'll make a lot of money. There will be certain times where you have very strong certainty, you feel very strongly something's going to happen, or you have high conviction on a trade. But once again, you're not guaranteed it's going to happen, you just have strong conviction, and so you make a larger bet. But this attitude of gearing everything to odds and probabilities while not actually predicting anything is very different than what most people are used to. Most people crave some kind of false certainty without recognizing that the type of certainty people typically crave or want is impossible to have. Nobody can have it. And so We don't think trading is about certainty at all. It's just about odds, basically.
Okay, so for someone who does think in terms of predicting and feels the need to want to predict the market, how can they shift their mindset to think more in terms of probabilistic outcomes?
Well, I would say how to shift their mindset. Well, first of all, I would say just think philosophically about the challenge of prediction and think about how hard, if not impossible, it is, just because there are so many variables, there are so many things that none of us know, or things that could go wrong that we had no idea about. If you just take a small number of variables in any situation and then you magnify those towards all the variables happening in the market, we basically, something could come out of left field at any time, anywhere, and render any prediction useless. So first I would say recognize sort of the folly of it, and then recognize all of the success that traders and value investors and trend followers and business people and others have had simply aligning themselves with probabilities. So a really successful value investor will look at a company and he'll say, I don't know what's going to happen in the future, but I know that this company is really undervalued relative to its assets and the stock is really cheap. So if I buy it, good things will probably happen. Or an entrepreneur will say, this is a great market to expand into. I don't know what's going to happen, but I know it's probably good to make a bet here. A venture capitalist will say, I don't know if this startup is going to succeed or not, but it looks like it could be a 10x or a 100x, so I'll make a bet on it, and I can be wrong 9 times out of 10, and I'll still make a lot of money. So if you look around, there's a lot of models that work well from just taking a pure probability expectation. And also another group that's made hundreds or made tens to hundreds of billions over decades is the trend followers, particularly in futures in the CTA space. And these guys don't predict anything at all. They just run algorithms where they expect trends to persist. So I would say the first thing is sort of do a study of markets and see what works for people, and then just shift this mindset where you don't care about predicting the future. You just want to focus on odds, and because this is what so many winners do. Whereas typically the people who are trying to predict are the guys who show up on CNBC or something, and they're trying to build a track record of saying, oh, I said X and then it happened. But that's not actually related to making money.
Yeah, okay. So where would someone even begin to start trying to figure out their odds or the probabilities that, they would make money if they were to do this? Like, where would someone even start trying to discover those numbers?
Where would... I guess that's a really good question. I haven't really thought about an optimal introductory book to probability and statistics. I guess if somebody wanted to start philosophically, they might, Taleb's books might be good. Nassim Taleb in terms of The Black Swan, I believe, and his other one, I forget the name of his first book, just talking about, the philosophy of uncertainty. And then I would say just getting into a basic understanding of probability and statistics. Poker could be a great training ground for learning to think probabilistically, because almost every decision in poker is just simply a pure probability decision, where you say, if I repeated the situation 1,000 times, would my action make money? And you look at, there's a potential wager and there's the size of the pot, and you multiply the potential amount of money you could win towards times the percentage probability of your action, and if it comes out to a certain formula, then you take it because it's a positive expectation over the long run. So I would say philosophically, Taleb's books are probably a good place to start, like The Black Swan, and I'm blanking on the first one that he wrote now. Anti-Fragile is another good one. And for actually just learning the math, I would say check out poker and read some good poker books and figure out how professional poker players make money, and that'll give you a sense of that world of moving towards probability.
Okay, cool. Well, I'll try and link to a few of those resources you just mentioned there in the show notes. So anyone listening, they'll be at chatwithtraders.com/45, and there'll be links there. So Jack, when did you actually begin to think in this type of way? Like, what put you onto this way of thinking? Or is it something that you've had throughout your entire trading career?
My way of thinking has evolved from trying to reverse engineer the styles of the traders that I decided to be like from the very beginning. So, in my first year or two of being interested in markets, I read all the Market Wizards books, the original Market Wizards and new Market Wizards and stock market wizards and so on. And my attitude was kind of, I want to be like those guys. Jerry Seinfeld talks about when he was starting out and thinking about being a comedian, his attitude was just, I want to be one of those guys, like one of those guys who gets up on stage. He wanted to be a comedian. My attitude was, I want to be like one of those guys, meaning market wizards. And I particularly picked out Stanley Druckenmiller and Paul Tudor Jones and Victor Sperandio as three names that come to mind of guys that really influenced me. And I just sort of read everything about what they thought and tried to reverse engineer it and say, okay, why does this make sense? Why does this worldview make sense? And then I took that input and I built my own understanding around it. So, and then another big influence on me from the beginning was the Soros idea of fallibilism, where he would go around saying, hey, I might be wrong. I could be wrong about everything and I could change my mind at any time. But at the same time, when I really feel like I'm right, I'll make a huge bet. That just made a lot of sense to me from the beginning. So I had this seed of trying to emulate and reverse engineer these sort of mentors from afar. And I just sort of built my own knowledge around those seeds as the years went by.
Okay, so just while we're still on the topic of probabilities and expectancy and that type of thing, I mean, there might be some traders who are listening to this and they think, okay, this sounds good in theory, but how well does this translate into real trading outcomes? Like, once you actually try to put this into practice, how difficult is it to not skew your odds?
I would say I think about it a little bit differently. I think understanding probability and expectation is more about understanding how markets work and how trading systems work. It's more information that you get from the situation. That may sound weird, so let me try and explain. So let's say, for example, a long-time swing trader analyzes thousands of trades, and they recognize that their average hit rate is 45%. Then they'll know, okay, the odds of me being successful on this next trade are 45%. And so then they can build a probability sense around that. Or you look at a situation and you say, based on my past analysis, the odds here are X. So it's more like how accurate your assessments are going to be are dependent on the information you get from the market. Like the better your analysis is, the better your understanding of actual probability is. So it's not that you start out and say, I assume X probability and this is how it's going to be. It's more like you pull that information from the market and it helps you. Another factor here is that when you understand the nature of probability and what I'm talking about, it actually changes the way you trade and the way you think about trades. So for example, one thing that a lot of traders don't realize is the incredible prevalence of the 90-10 ratio in terms of profit distribution. One thing I like to mention is there's this great book called Trading Risk by a guy named Ken Grant. And this guy, Ken Grant, was a risk manager for a bunch of the top hedge funds in the world. He worked for SAC, he worked for Tudor, he worked for More Capital, a bunch of others. And this guy has seen literally hundreds and hundreds of track records from the best traders in the world, all the managers at these funds. And in his book, he said that one of the things that blew him away is looking at all these hundreds of track records over and over again. He saw this 90-10 pattern where 90% of profits came from 10% of trades. And it was persistent, or even 95-5. And it was persistent across all kinds of styles and markets and long and short and blah, blah, blah. It was just everywhere. So when you understand something like that, a light bulb goes on and you say, there's something probability driven here about how the market distributes profits. And then that influences your expectation and your psychology and a whole bunch of other things. So I think it's more about developing a philosophy and an information flow of understanding the mechanics of how markets work than it is setting something up and expecting it to be right or wrong. Our message is not here's a tool you can use. It's more like, hey, this is how markets actually work, and the better you understand how markets actually work, the better you will function. If that makes sense.
Yeah, no, that's really interesting. I like the way you explain that. So yeah, thank you very much, Jack. Let's keep this moving along, and I'd like to get into your thoughts on some more general pointers for developing traders to take into consideration. So can you talk about the subject of pressing harder when the opportunity arises and betting bigger when the time is right? Has this been an important factor to your success, and what are your views on fixed position sizing also?
Sure. I think position sizing is one of the biggest factors, if not the most dominant factor, in trading success. If you are a discretionary trader, and it's also, this replicates all across what you see in investing and markets and business and in life. I think that being able to make the very large bet at the right time is absolutely, if you don't have this, the odds are much lower that you will succeed. When you look at how the market distributes profits are distributed on a fat tail basis, meaning profits are not just distributed regularly every day. They're very lumpy. They come in individual, they come along sort of semi-rarely. And this is why I think what I was saying about Ken Grant, he observed all these P&Ls that were 90-10 or 95-5, and Peter Brandt has said the same thing. His P&L was 90-10. You see this pattern over and over again, and what that implies is when a position is really, really attractive, you want to be able to take a very large position. And if you don't do that, then you're at risk of simply getting chopped up or ground to death because the light is not worth the candle. There's a popular trading phrase out there that says, if you worry about the losses, the profits will take care of themselves. And I think that viewpoint is actually very, very wrong. I think it's totally wrong. I think you absolutely want to worry about the losses in terms of having risk management, but also if you don't bet really big when the time is right, then there's not even a reason to be there. And the extra profits from betting very big when the time is right are what makes the whole thing worth it. The other interesting thing about this is that value investors and poker players, those disciplines, and even entrepreneurship all show the exact same pattern of when it's a really great opportunity, you want to make a really big bet. Warren Buffett in the beginning wrote in his 1965 letter, he said, listen, we're willing to put 40% of our whole partnership funds into one stock if it's the right stock. And, he made some huge bets. Really successful entrepreneurs have made really huge bets, and poker players in high-stakes cash game poker, once again, your profit ratio is going to be like 95-5. Maybe 5% of the hands you play, if not 2%, are going to produce the vast majority of your profits. So you see this happening over and over again where the big bet is really important. I think that this is actually one of the things that happens to quote-unquote experienced traders. New traders tend to trade too big and blow up and then, lose their capital. And then they become experienced and they become super conservative and they always want to take small positions and always want to be careful with their risk. And then their accounts stay small and dinky forever and they never really make any money and they wound up, it's like they're eating stale bread and drinking watery soup. And they never actually make the profits to justify trading. And that's because they haven't mastered the art of making the big bet, which is so, so important. It's the reason why you're there.
Okay, so just to add on that, how do you yourself sense when the time is right to take a larger position or bet larger?
Sure. So I recently wrote about this. There are a number of factors that just sort of all come together, and I used four words to describe this recently, and they were alignment, resonance, clarity, and flow. So by alignment, meaning if you're looking at this trade, are things above and below the trade in alignment with your idea? So like if you're bullish on semiconductors, does the whole tech space look bullish? Do other semiconductors stocks look bullish? Is there alignment there? Clarity, do you really see the situation clearly? Do you really see why this is an excellent trading idea? Is it powerful in your mind's eye? And then resonance, are all the parts and pieces of the puzzle pointing in the same direction? Is there good risk appetite? Are the trends flowing well? Other things, and then flow is is this a flowing market where you've got a nice counter trend and you're about to resume a nice trend, or is it choppy and gross? And there's these different factors that you look at, and when all those factors line up together and they just all come together, that's when you get this instinct based on all these factors that are shining green lights to just really press harder than normal situations when you're trading smaller.
Okay, and just in line with your style of trading, when you do take a larger position, is it sort of likely that you're going to jump all in right at the beginning, or do you tend to pyramid as the trade evolves?
We will tend to pyramid as the trade evolves. However, we will also take much larger positions from the start if we have high conviction, and then it's also influenced by P&L, how much profit cushion we have. So if we have high conviction on a trade, we might take a significantly larger position to start, but then we'll also add to it. The more aggressive we are, the bigger the position we'll take to start, and the more that we'll add. And we're willing to vary our position size by as much as 40 or 50 to 1, and possibly even 100 to 1 under extreme circumstances. So initial position size does vary with conviction, but we also definitely pyramid when we see the opportunity to.
Okay, well said. So I'll definitely try and link to that article you mentioned just before in the show notes. And I mean, just while we're talking about your writing, I mean, there's just so many great one-liners in your writing. I was spending a lot of time on your website last night, and something I discovered or came across, which I'd like to quote you on here, because I just thought it was brilliant. So you said, traders waste a lot of time on things that have no bearing on their P&L. If a line of inquiry has no direct or indirect bearing on your P&L, then why are you expending energy and effort? So could you tell us a little more about your reasoning for making this statement, or perhaps you could give us some examples of how aspiring traders could spend their time more wisely?
Sure. Well, I think a lot of activity and effort is devoted towards the wrong things or towards useless things. So a classic example is, let's say you have a chart that has 5 or 6 different indicators on it, and all those indicators are based on oscillators or momentum. So if you're looking at MACD and then you're looking at something else and you're layering something else on top of that, this is like looking at the same thing 5 different times, and it's all saying the same thing. So you really didn't need all that extra. You're seeking false confirmation by finding yes men to agree with the first thing, which is a waste of time. Or if let's say somebody has a strongly bullish view on oil, they think oil is going to go up, and then they read a bunch more articles all saying the same thing, but they don't get any new information. It's like, well, why did you need to spend all that time reconfirming an opinion that you already had? So there's just a whole lot of inefficiency, and sometimes that inefficiency is aimed at ego, or reconfirming a bias that you already have, or repeating information in a way that's not useful. And so I think there are a lot of behaviors in trading, where if you really look at them and you examine them and say, what's the return on investment from behavior, you'll realize, you know what, I could just stop doing that. I could just cut that out. And I think a lot of traders they're not thinking about the habits they have, that they would be better off if they just stopped doing those things.
Yeah, I think that's a really important thing that you highlight there. I mean, that really resonated with me. I quite liked that. So again, something else I'll try and link to in the show notes. But another article you wrote was on form and technique. And in it, you spoke about what separates market participants who are average traders and those who are serious competitors. Would you mind just sharing a little bit about that now with us?
Sure. Well, I think there's a level of, to be a serious competitor, there's a level of professionalism that you have to aspire to, and that just is created by a certain amount of training and focus, and it just shows up in a sort of discipline and consistency that other people don't have. So say, for example, that you are serious about being a martial arts competitor, and you wanted to win martial arts competitions and other things, then you would practice and show extreme discipline and rigor, and your form would be very good. You would be able to move through the kata and the different disciplinary movements, and you would know them very well as a function of your desire to succeed, and that would help you. Whereas somebody who's not as serious and not as devoted might be sloppy. There would be, they would have much looser movements. They would do a bunch of small things that aren't as efficient, and they wouldn't be nearly as likely to be successful. And so really understanding high quality form and technique and focusing on the best technique is what's going to help you make the best decisions on a day in, day out basis, and lower the odds that you make any significant mistakes, which might reduce your performance. And that really, over the long run, all those little things really add up.
Yeah, 100%. Now, Jack, we've discussed some really great topics here, but as we know, trading isn't black and white. So at the end of the day, how important is experience to bring this all together?
Well, I think experience is absolutely crucial and irreplaceable, because without experience, you cannot really make good decisions in real time. And the reason I say that is because if you had a whole bunch of books from, master traders, and it was the best education in the world, but then you had to go out and actually make decisions from those books, the flow of market data coming at you and the amount of decisions you have to make in the analysis and the time window that you have, you wouldn't be able to make decisions fast enough. You can't go look up a book every time you get confused about something. So, when you're acting in real time. So part of what experience does is experience is the process of downloading and assimilating all these various nuances and subtleties of information and knitting them together in your head. And another thing that experience does is when you have experience, you run into weird or odd situations that come up very infrequently. And the only way to come across these situations is to get experience in the first place. So you kind of need to build that experience or work with someone who has it in order to really be at the place where you can trade comfortably with large size and have a lot of exposure at the right times, which is sort of what it's all about. So I would say, you have to have it and you have to build it. There's no real way around that.
Yeah, well said, Jack. Now, just a few more questions before we bring this to a close. So one thing I'd like to ask you is, markets and trading aside, how do you spend your time when you're not in front of the screen and need to shut off?
Okay, that's a good question. Let's see. I really enjoy outdoor activities. I really enjoy snowboarding and hiking. My fiance and I have a 5-month-old Rottweiler puppy named George Soros. We named him after the famous speculator.
Very cool.
And yeah, he's a blast to play with. Really enjoy traveling and spending time with friends and colleagues. Poker, of course. But really, I guess I would say it centers around outdoor activities and travel and, great food and great culture. Really enjoy visiting world-class cities and then, coming home again. Outdoors, travel and culture, and spending time with friends and family.
Excellent. So one more question. If you weren't trading, what do you think you would be doing?
I would be a professional poker player, no question. There is just it's amazing the amount of profit that is still in that game, and it's for similar reasons to what you see in trading. It's just because 9 out of 10 people at that table, or even 9 out of 10 people who think they're professional, don't actually have the requisite discipline or even the requisite mathematical training to really be serious, and that just creates a whole lot of profit opportunity. So
yeah. So what came first? Were you into poker before you got into trading, or was it the other way around?
I was into trading long before poker. I came across poker about 10 years into my trading journey, in that I had a friend and client who I was having lunch with 2 or 3 times a week. And he was this brilliant software entrepreneur who was also had Asperger's. And so he would just super focus on these things. And he had become obsessed with poker. And he just kept talking about it. And it was all he would talk about when we had lunch. And after about 6 or 7 of these lunches, I realized, you know what, poker sounds a lot like trading. So I took it up as a hobby because of the similarities to trading. And I was delighted to find that they're so similar. They're both, it's amazing how much they overlap.
Yeah, I have no doubt. So not that I've played it before, but yeah, definitely I take your word on that. So how competitively do you play, or is it still just a hobby for you?
I played pretty seriously for a while always keeping it in the background. I was playing 20 hours a week for a while actually working and doing market research at the table. They let you have a laptop as long as you don't slow the game down, and so I had a laptop in my lap while I was playing. I was playing. I've played medium to high stakes for a while. I was playing high stakes in the Bellagio, where the average stack was between $10,000 and $20,000. Overall, I take it pretty seriously. But of course, trading is far more important. I think in the future, one of the things that we'd like to do, we plan to actually start a poker team, in part because we can teach people the methodology that I created around poker, and also in part because poker is just an excellent training ground for trading. To become good at poker, you have to really learn math and statistics and probability on your feet, and you also have to control emotional swings and understand extreme probability cycles and fat tails. So poker is one of the best training grounds you could have for becoming a top-level macro trader. So I've sort of backburnered it a little bit right now because we've got so many other big projects, but we're going to bring it back around and probably start a poker team in the next year or two.
That's really interesting, and I mean, you're definitely in the right place for it, being
exactly,
the city of Las Vegas. So, yep. Jack, tell listeners where they can go to find out more about you and how they can connect with you.
Sure. Our website is mercenarytrader.com. And we post a bunch of stuff up there. We're about to do a complete overhaul and website relaunch. I'm excited about that. We write daily, and we have an e-letter that goes out. You can get our stuff in our inbox. You can also find me on Twitter. My Twitter handle is mercenaryjack, and I'm pretty active on there. And you'll get some of my sarcastic humor and pieces of news, and I also tweet our articles up there. So really, yeah, visit mercenarytrader.com or check out Mercenary Jack on Twitter, and you'll be plugged into our stream.
Awesome. Really good. So yeah, guys, definitely check out mercenarytrader.com. There's a ton of great articles there which have been written by Jack. So plenty of great reading. Jack, thanks so much for doing this. It's been an absolute pleasure speaking with you, and hope to catch up again soon.
Sure. It was excellent. Thanks again.
Thank you. Hey guys, hope you enjoyed the interview with Jack here. He was a really interesting guest, and it was great to learn more about how he views markets and trading. Now, just a final reminder to take us out here. The giveaway to win a free one-on-one 90-minute mentoring session is coming to a close this Friday, 6th of November at midnight Eastern Standard Time. So if you haven't already entered, go to chatwithtraders.com/win, WIN, to enter now. This is your last chance to be one of 3 winners. So, I mean, this is just an awesome opportunity to get access to a seasoned pro trader who is genuinely keen to help you improve and become a better trader. So, time is ticking, guys. Go to chatwithtraders.com/win, WIN. Go there now, enter your email address. That's it. It's very simple. Best of luck to you. And if we don't speak in the meantime, I'll catch you again next week.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next
Thank you very much for tuning in. Now, I have a very special guest on the podcast this week who I'm excited to introduce you to. His name is Haim Bodek, although some refer to him as the Algo Arms Dealer, and I totally understand why. Haim began his trading career at Hull Trading, a prestigious firm well known for driving forward innovation in the domain of automated trading. Following Hull, Haim then went into significant roles at Goldman Sachs and UBS, which are all discussed during the interview. But to further set the scene, in 2007, Haim founded Trading Machines, a high-frequency trading operation, and at the peak, Trading Machines accounted for 0.5% of all options trading volume with a team of 25, one of who was Brian Weiner from episode 40. All was well for a couple years until the beginning of 2009, when Trading Machines ran into issues and began to bleed money for unknown reasons. Until Haim later discovered at the root of the problem was secretive order types being used by a select few firms, giving them an unfair advantage to front-run the orders of other participants. With this discovery, Haim went to the SEC to raise his concern about such order types, and little did he know at the time that this would be the beginning for one of the most sophisticated and complex investigations carried out by the SEC in US history. So of course, we speak about all of this in much more detail during the interview. And we also speak about another fascinating topic, which is the payment for order flow. Haim shares with us what is really happening to your orders after you click the button to buy or sell. And you might even be surprised to find out that a large majority of retail orders never even make it to an exchange. So just from listening to this interview, you'll quickly realize Haim has an incredible knowledge of market microstructure. And in case you find that some parts are a little technical, then this may be one episode worth a second run. Just while you're listening, I'd love it if you could please leave a brief review on the podcast in iTunes. It's a very quick and easy way to support Chat with Traders. All you need to do is go to chatwithtraders.com/iTunes and follow the prompts. That will be a huge help, so thank you. All right, it's time. I'm your host, Darren Fifield. This is the Chat with Traders podcast, and please welcome my guest for this week's interview, Haim Bodek. Haim, welcome to the podcast, man. How's it going?
Going well. How you doing?
I am excellent, thank you. And thank you very much for doing this. It's great to be speaking with you. Now, here's how I picture the interview playing out. So we'll have three major talking points, right? They'll be walking through the roles you've had over the years, so working at Hull, Goldman, UBS, and of course, Trading Machines. And secondly, really keen to get into the topic of blowing the whistle on HFT secretive order types, and then what's happening to retail order flow. So if that sounds good to you, let's dig into it.
Okay.
Awesome. So Haim, share with us how you got started in finance and what was it like to work at Hull Trading? Because, I mean, just quickly, from my understanding, they were a very prestigious firm regarded by many as pioneers in the realm of automated trading. So what was that like?
Yeah, well, I'm still pretty nostalgic about the experience, and I know a lot of my former colleagues also are. I got into Hull. I guess most people who joined the firm probably had unusual backgrounds that were relevant. I started out working under a entrepreneurial professor named Bob Grossman, doing credit card fraud detection using machine learning algorithms. So I was really kind of oriented around large data, detecting patterns, and had some good successes with that project with Visa. And at the time, there was a lot of hype about using those methods in finance, and it was kind of funny. But there was actually an advertisement that said, wanted individual to use machine learning algorithms to forecast markets. So I applied and got the job.
Excellent. So what was your role at Hull Trading there? Like, what were you doing on a day-to-day basis?
Well, the role changed. I mean, I was still very green, and Hull was a good environment for they really focused on taking scientists or other technical types and basically grooming them. Um, I was probably in the financial engineering group one of the stronger programmers, and there was a lot of competition for like the pure quant jobs. And I kind of started out, working on machine learning and forecasting. Then I started to work on basically the data infrastructure for all the financial engineering models. And eventually that kind of led into a role where I was one of the few people who focused on the intersection between what we think of as the three disciplines in the field. So at Hull, there was basically a financial engineering group, which is the quants. You had a technology group where the developers were situated, and then you had trading. And Hull traded on the floor. They also traded electronically. And my role kind of evolved to be the guy who sat in between those groups. Eventually, it was in the early 2000s. The role that I had at Hull started to actually have a name. People had a hard time describing what I did, but we call it strategy now, and it's basically the algorithmic trading part of this type of business. So I started to focus on quite literally the intersection in terms of how those three functional areas, trading, financial engineering, and technology, were actually all bound into a system that could execute trades strategically, on the exchanges.
Right, okay. And after Hull was acquired by Goldman Sachs, what happened next? Is that when you went to UBS, or did you stay on at Goldman for a while there?
Yeah, I stayed on for a while. It was actually pretty interesting and difficult time because Goldman actually acquired Spear Leeds and Kellogg, the very big NYSE specialist operation, and there was basically an integration effort between Hull, SLK, and Goldman, and a lot of people burned out on that. That was a pretty, I don't know what the word is, but ambitious integration. And I think the guys who were probably the happiest there were people who found roles at Goldman that were, that leveraged their skill set, but wasn't really in the middle of this very difficult integration of these businesses. So you actually saw quite a lot of attrition over that period, and people from the firm ended up setting up and joining other desks, and that's really how the DNA got around the street. I joined UBS after that. A group of guys went there, and I joined up with that group and focused mostly on the U.S. operation. And in about 2 years, we kind of replicated the entire kind of business model that we had done at Hull. So it was a pretty successful group. It was called EVT, Electronic Volatility Trading. And, I guess, towards the end of my stay there, probably I think the last year and a half, I took over the group globally as co-head.
Okay, so that's a pretty major role, isn't it?
Yeah, I benefited from the fact that the things that I focused on, what we had in the early 2000s, mid 2000s options industry is we had the markets were basically going from floor-based exchanges to hybrid, which was a combination of floor and electronic, to purely electronic. And they're really because the floor was primarily how business was conducted in the options space. There really weren't a lot of people who did what I did. I kind of cut my teeth working on European options in the late 90s, and those markets were automated. So, my career basically, I got a leg up on a lot of the other people because as markets went electronic, a guy who, what is my task? My task is to put literally 300,000 or 400,000 bids and offers across 500 names, hundreds of options per name. And I have to put all those out and do it in a manner, where we don't lose money. I mean, you think about it, it's about making money, but there's been some pretty big blowups in the options market making space because of how difficult it is to actually trade that many different securities and to react, really within milliseconds to the changing prices of them.
Okay, excellent. No, that's really interesting. Now, this is what I'm really keen to hear more about. So tell us about trading machines. What motivated you to start the firm? How did you go about it? And what type of operation was this?
Yeah, well, I guess in 2007, the options market in the U.S. Had what was known as the penny pilot, and there were 13 names that were quoted in pennies instead of the nickel increments that had existed beforehand. And when I looked at how those names were trading, I thought to myself that these products were actually quite similar to maybe how the Korean market traded, and I came to the conclusion that the way that market making would operate in the U.S. would necessarily have to change. So basically, the margins would be so thin that option market makers wouldn't be able to do traditional bid offer capture, or spread capture is what we call it sometimes. So I kind of came to the conclusion that I was going to have to rebuild, and that it was going to have to be a we were fast at the time, but I kind of felt we needed to really pursue the low latency game harder than maybe what was possible at a bank. And at that time there were many high frequency trading firms in the equities universe that were really pushing the arms race there. And to just kind of give you some more color, it's a very complicated decision I made, to leave and go do my own firm. But we also had the integration of stock exchanges and option exchanges. The stock exchanges purchased the option exchanges, and then they cut the option exchanges over onto the stock technology platforms. And then over that time, they started to roll out, the stock market has certain business models. One's called the maker-taker system, which is a system of where two individuals trade and one gets a rebate. We'll talk about that maybe later in the interview, but the other guy pays a fee, and you start getting all this. I thought of it as cross-contamination. You got all this stock market high frequency trading tradition started kind of molding into or melding, I guess, into the into the option space. And then you also had some of these HFT firms, which were doing very well, start to set up options operations and compete in the options space. So in this period of transition, I felt that I needed to be ahead of the game, and so I needed to go build a new, an entirely new business model. Originally we were going to go to basically a hedge fund that was affiliated with an investment bank, but then it kind of evolved, and I realized I could go independent. So we set up trading machines, and it was basically a high frequency trading firm for options. We traded. We hired from all the major operations. We tried to get people who had that kind of expertise. I think at our peak we're about 25 people, and we launched into the market, and we were traded pretty consistently about 0.5% of the U.S. options market over the lifetime of the firm, when it was actively trading.
Yeah, that's really impressive that you were doing such high volume. I mean, 0.5% of all options trading, that's very significant. So that volume, just so we understand, that volume that's spread across lots and lots of small trades, or alternatively spread across a few larger trades.
No, yeah, it's spread across lots and lots of small trades. Because of how the stock market worked, we ended up doing a lot more, many more transactions in the stock market than in the options market. But still, it was, definitely, as far as like high frequency trading and options goes, we were the closest thing to it. We specialized in basically basically operating as an informal market maker, very much the way the high frequency traders now work, where they don't necessarily have market making status or obligations. So we would basically opportunistically provide liquidity or take liquidity in names when we identified mispricings, and we centered a lot of the business over short-term intraday volatility forecasting, and that was kind of our bread and butter.
Okay. Yeah, so to summarize, where was your edge at trading machines? Was it essentially the speed of execution? Was it the number of trades? Or was it the complexity? Because you were running over 1 million lines of code. So I'd love it if you could expand on this, please.
Well, the edge, I mean, I don't really think of speed as an edge in the way people talk about it. Speed is basically used when you have a competitive relationship with other traders out there. So if you guys are both triggered by the same events to try to go after the same trade, then speed matters because you need to be faster than the other guy. That will tend to occur in the option space. If a stock moves, the options, the theoretical values change, and there'll be a race to kind of hit the quotes that are stale out in the market or resting orders. And then there, the market makers who are, and call it high frequency option traders, everyone's trying to hit the mispriced options, but they're also trying to cancel and update their quotes, which are stale. So there's that's kind of the arms race that we have. I don't really think in any kind of efficient market that becomes your bread and butter. You have to have something more than that. We focus quite a bit, as I said, on the volatility piece, and this is the implied volatility. In many ways, that can be a surrogate for supply and demand in the options for basically buying pressure or selling pressure. So we tended to develop models where we can get on the right side of that pressure to either buy or sell options. And the other thing that most people don't understand about the options business, which is really absolutely necessary and central to the way we get an edge, is really, we'll call it risk management, but it doesn't mean the same thing it means in, let's say, the stock or futures world. Risk management and options is really about finding the most effective and cheapest hedge for previous trades that you've done, and that tends to mean that every single trade you do has a component of it in which it's either beneficial to you from a risk management perspective, or the opposite, or increases your risk. And options are can change quite dramatically over the day, and if you do not actually manage your portfolio, which will be very complex, with incredible precision, you basically will not be able to lock in or realize any of the alpha that you have in a way that isn't exposed to what we call adverse selection or slippage.
Okay, that's really interesting. Now, the Wall Street Code, the documentary that you were featured in, at one point the voiceover said, and I'm paraphrasing here, you had written an algorithm that would generate a guaranteed income. So I'm really curious to know, how was this possible to guarantee an algorithm would always win?
These, a lot of the stuff that has hit the media or that's in a documentary, there's always some kind of translation there. Okay, so this guaranteed profit that is talked about in the in various manner in the let's say the HFT industry or I was in the high frequency option industry, even if you have some type of pure arbitrage, you still have execution risk, right? This kind of guaranteed return isn't really the right way to describe the activity. But there are strategies that, with if they have very high execution certainty and very aggressive and tight and precise risk management, can basically approximate they will appear to have a very stable return, and the positions that they create are, in our case, we did actually try to target positions that were, approximations of what would be riskless portfolios. So there's a tradition to target that doesn't mean you actually can achieve it. As I said, the execution risk, the risk that you cannot actually execute the legs of the strategy effectively and cost effectively. That's one of the main things that's going to stop any strategy that's going after a guaranteed profit. But when you look at these businesses, when they're the types of strategies that that statement may have referred to, they will tend to have very high. I don't know if your listeners are familiar with metrics like the Sharpe ratio, but it's a measure of risk over return versus some type of benchmark, and those metrics for the HFT business will be very, very high, and the P&L distributions. Lots and lots of trades. They will look. Many of the businesses will look like literally very close to a straight line in terms of profit. That was the case actually for the portfolio we ran at Trading Machines on a gross basis, but gross P&L looked very, very. The slope of that was pretty straight, but we had a lot of difficulty with fee structure, and the fees, had quite a adverse impact on us, especially the fees associated with stock trading and hedging.
Okay, very interesting. That was well said, Haim. Thanks for really explaining that to us. Around 2009, Trading Machines began to lose money. So tell us about this time. I believe it was about 12 months before you even got to the root of the problem. So what was going on? What was that time like for you during those 12 months?
Well, it's interesting. I mean, what happened? So we were basically building the year that Regulation NMS was rolled out, and that body of regulation really restructured how the U.S. stock market operated. I guess it did also apply to the options market, but it had features that were basically problematic for high frequency trading strategies in the stock universe. So what happened is that in 2000, from 2007 to 2009, the exchanges basically started to create features, primarily features that were requested by high frequency trading firms in the stock market. And these, they in particular they created order types and what I call order matching engine called practices. They basically modified the order handling of the stock exchanges, and the period of probably some of the most intense modification was over the period of 2009. Now, my firm had launched trading in August of 2008, and we we launched a month before the financial crisis struck, and then after that you had just incredible market conditions and volatilities that were 200% volatilities. You had such anomalous markets, and there was a lot of dislocation and a lot of edge. So I did not really appreciate or I was not really able to witness the called the nuances and how the stock market had changed. I mean, I do actually remember it was December 2008 was the first time I started seeing odd behavior in my stock executions. And what I did is I started to avoid venues that that I thought were just toxic, right? That were the lots of us in the business are trying to trade against order flow that isn't informed, and some venues have a different composition than others. And my initial thought was, hey, these particular trading venues are toxic, and I basically tuned my system to trade on the venues that were that look better. And what happened is in the end, I started having more and more of my trading concentrated in only a few venues. So I had kind of learned that most of the market was toxic. And what had actually happened over that period of time is the exchanges were modifying how their systems worked and introducing features that basically supercharged the profits of these high frequency stock traders. These features were introduced without adequate disclosure, and the exchanges were in no way, they would visit all their clients, but they weren't talking about the high frequency trading features with any, with the firms that looked like they were the counterparty to high frequency traders. So we must have looked like what an exchange would call a customer, right? Whereas certain high frequency trading firms in stock would be thought of as liquidity providers. So customers were basically not really informed about these order types, and the exchanges would come in and give you all this information on how they operated, but just miss, they just kind of skip over anything that had to do with the kind of features of high frequency traders were actually requesting at that time. So what happened, it's kind of a long story here, but what happened in May 2009 is that the last exchange in the US basically modified its order handling to accommodate HFT, and that was direct edge. They introduced an order type called hide not slide, and what I try to explain to people is when you introduce a particular order type, it doesn't just have features in its intrinsic to itself and how it operates, but the code, the actual code in terms of how the electronic exchange works and how its order matching engine works has to be modified and has to define how does that order type interact with the other order types, right? And that's something I've tried to explain in my book, The Problem HFT. It's not just that metaphorically the exchanges are introducing a queen onto the checkerboard. They're also defining how that queen interacts with other pieces. And it turned out that the pieces or the order types I were using were heavily disadvantaged by in the interaction with the hide not slide order type. So really, what happened is we just started bleeding, and it looked like my guys rolled out a bug. I was actually at my sister's wedding in late May 2009. I was gone for a week, and I came back, and the stock trading had changed in to a point where we were basically making money in the options and hemorrhaging all of it into the stock market. And it was quite perplexing because a change like that is usually triggered by a software release or a mistake that the trading firm does. So it didn't really, I've been in the business for over a decade at that time, and it just was not clear to me. There wasn't like there wasn't like a circular or any type of information that had been delivered to me specifically that had indicated that exchange should change their market structure. There's somewhat of a paper trail, but it was such an extreme change, and it wasn't really communicated to the client, to the members of the exchange in the way that it should have been. So I'm sitting there, and it just didn't occur to me that this type of what really looked like a bug, hemorrhaging this money, was actually just the exchange redefining how my orders interacted with HFT orders, and literally just rolling out code that changed how my trading operated.
Okay, yeah. So I appreciate you explaining that for us. That's really insightful. And shortly after you spoke out about this and revealed your concern to the SEC, why did you decide to blow the whistle on these secretive HFT order types?
That's a long story. I didn't really know what I was getting into. First of all, I'll just say there's a tradition. Blair Hull, founder of Hull Trading, he went on the record and called out the Nasdaq market maker collusion and what was known as the Christie Schultz scandal. That was an episode in kind of stock market history where Nasdaq market makers were colluding and keeping spreads artificially wide, and a pair of academic researchers discovered this and wrote a paper. Why do these market makers avoid odd prices? Really, is what they had discovered, and why are they skipping every other price and keeping the spreads are artificially wide because of that. And turned out that they were colluding, and the industry was actually fined, I think, close to $1 billion in penalties because of this activity. And Blair was one of the first insiders to actually go on the record, and I think it was in the LA Times, and actually note a particular name, and that he basically got a phone call from the market maker telling him to get out of his game, and he went on the record on it. Another example is one of the great kind of leaders in the options industry, Tom Pettifree, for 5 years was lobbying heavily and very vocal about eliminating a loophole that allowed queue jumping, the same kind of stuff I turned in the stock market. There was actually a kind of a queue jumping loophole in the options market where we call them customer market makers or barnacles, but basically professional traders learned that they could masquerade as retail customers and get customer priority and leap ahead of the other market makers. And he was very, very, as I said, vocal, and I think deserves a lot of the credit for what eventually happened. Was 2010, the options market basically created a solution for this problem and eliminated it by creating what's known as the professional customer designation. So basically, if you trade too much and you try to take advantage of that loophole too much, the loophole still does exist, you actually have to change your status and then you no longer can exploit the loophole. So here, the two names, big names in my industry, are both associated with significant market reform. Of course, both of them, were able to do that because they had very, very successful, operations. And I think, what was different about me is I decided to call out these issues, maybe in the same style, I thought, as these other great leaders did, but I called them out after my firm failed. So I wasn't in the same kind of position that they were, and I didn't realize how important it was to, to be. I mean, this has taken up 5 years of my life now, and no way did I think that was going to happen.
Yeah, so I mean, it was a very bold move, and I really want everyone listening to understand how bold of a move that was. I mean, were you at all concerned about your reputation or what the repercussions might have been? I mean, even on a personal safety level, because I imagine there were many people who were upset by you doing this.
Yeah, it's funny. It was bold. I mean, I think, again, I was kind of insulated. I didn't realize how insulated I was from other parts of the industry by getting, that experience in the ivory tower. I didn't really understand, and you've probably seen, the last few years been quite a number of major penalties and fines. I didn't realize how prevalent it was across the industry to exploit the gray and to often cross into the black lines, between unethical behavior and, let's say, illegal behavior. It was not, whole trading was all about being smarter than the other guy. And I kind of grew up on that. There was a former colleague of mine who said to me, he says, it ruined us. We weren't ready for the real world where it's shadier. So, I guess I didn't actually realize what I was going up against until I, had already disclosed this stuff to Scott Patterson, who started reporting on it in the Wall Street Journal. The information I gave resulted in extensive investigations. That took 4 years. The Direct Edge case. Direct Edge was eventually fined, the largest fine in U.S. history against an exchange, which is $14 million for improperly or inadequately disclosing their order types, right? This long path, which was successul in the end. That case, for example, the Direct Edge case, it was. I was informed that was the most sophisticated case that the SEC had ever done in terms of complexity and sophistication of the abuses. So this whole process and my opponents, it started out as I thought I was going against a small segment of the industry that was, taking advantage of the system, and I was convinced at the time that it would have been discovered, by the regulators. And halfway in, I realized that I didn't go against a small part of the industry. I went against the dominant practices in the industry. So, again, when you do something like this, you take a shot out, and you throw, metaphorically, you're just throwing a fist out there. You don't actually know who you're hitting, and you're right that as you get feedback, and in my case, I went against some very, very powerful, entrenched people. You look at this and you're like, did I make the right move? Am I doing the right thing? And you get a little bit nervous and anxious, especially when the industry. I mean, you get more heat and more negative feedback, the more significant the issue is, and the more if you're right, you're going to get trapped for 5 years. I didn't realize that, but that's a very common experience for whistleblowers. If you're wrong or it doesn't matter that much, then it just goes. You might report it, but no, it doesn't result in any big action. In my case, there must have been somewhere between 40 and 50 regulatory filings that exchanges were forced to provide to accurately describe how all of the HFT features operated. It was a war. It was a so anyway, I don't recommend it, but it's not something I'd recommend other people to do. But I guess how did I get through it? I just have a property. I guess it helped me out here. It's when I started to get nervous about what I was doing, I kind of doubled down on the trying to prove I was right, and that meant that I kind of outworked a lot of people on the other side. The precision of my information basically put I provided so much detail and accurate information that needed to be looked at carefully by regulators. What I believe happened is that just created so much heat on the practices that they weren't really able to mount any kind of opposition, to me. I mean, other whistleblowers will get heavily smeared. That didn't really happen with me, and it was definitely done, privately. But I didn't have to go through a big, public battle where exchanges were saying statements to kind of disprove me publicly. And I'll give you an example. Let me think. I'm forgetting actually who there's a Nobel laureate. I'm just forgetting his name. But in the Christie Schultz case, NASDAQ hired very, very reputable people to basically attack the opposition. And it was complete. They were completely wrong, but these people that were hired, these experts, but they really made it very painful for people who were trying to turn in those practices. And in my case, I mean, it was very public. There was, let's say, a debate, but I mean, yeah. Sorry. I mean, it's a long, it was a long process, but I survived it.
Oh, that's awesome. So to summarize the investigation, I mean, because this was a huge investigation, what was the outcome? Like, just to summarize it for us, what was the outcome and what's been achieved or changed since?
Well, the main thing that was achieved, was you can really think of the investigations, and there were multiple ones because there were multiple targets. When the enforcement division looks at these issues, they need to come to a place where they determine. First of all, they have to look at the accuracy of the allegations, right? But then after that, they have to look at, is this unethical behavior or is it illegal behavior, right? And they have to, lots of things I work on, with regard to, call it regulation of high frequency trading. It's not actually clear, where that line is between unethical and illegal, and that takes a lot of very talented people with securities law background to determine. And the thing is, the SEC Enforcement Division is only going to be pursuing violations of securities law. So if the law is not violated, or then or maybe the law is not defined, is not defined well enough to address the issue, then it basically becomes a policy issue. So a lot of the things that I turned in ended up becoming, a policy issue, and everything really kind of revolved around disclosure. So you had the Office of Compliance Inspections and Examinations did an order type audit where they had all the exchanges submit very extensive information on how they made order types, how they disclosed them, the whole process, which ones existed, and that was actually completely a separate initiative from the enforcement investigations. And then about a year ago, Chairman Mary Jo White, she mandated that all of the exchanges use last year, this is 2014, she basically said that the exchanges needed to reassess all the regulatory filings and determine if their order types were accurately disclosed, and also to assess if the order types were operating as intended, and if there weren't unintended consequences. It was a very kind of also very significant initiative, and most of the exchanges were extremely responsive and put out a lot of revisions and clarified how the order types worked, changed certain features. There was many of the issues that I was concerned about were addressed through disclosure. I thought some of them would be ripped out that were approved. I was kind of shocked that, I've been very critical of queue jumping behavior and those that was actually approved. But, what I learned through the process is that the SEC is actually pretty liberal in terms of allowing different types of call it functionality on exchanges. They just demand that there's adequate disclosure, right? Okay. So that's so in the case of Direct Edge, that's a case where that exchange basically was not responsive enough and had significant lapses in their disclosure, and I think if they had been had addressed the issues earlier and had been more cooperative, maybe you wouldn't have seen the same result.
Sure. Okay.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, You don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, Haim, let's change gears and bring this back to a retail level. Because I know we're on some time constraints here, but the big question, does HFT affect retail traders?
Yeah, well, HFT in general affects retail traders. Yeah, I would actually lean on the side of a slight positive effect. And I think what retail traders don't understand, and I really don't like the narrative that's been going on in the market structure debate or the Flash Boys debate. High frequency traders tend, not to trade in on venues where they are able to trade with retail. I mean, retail orders do not retail market orders do not tend to go to the major exchanges. And when I mean that, I mean there are reports that the retail brokers file, 606 reports, and you will see that that exchanges often will have a reported zero. Not a single market order was sent to that exchange. And retail traders, they send a lot of market orders. So those market orders, they don't go to the exchange where the HFT is trading. They often do not go to a dark pool. They often go to what we call an internalizer or a wholesale market maker or off exchange market maker. What does that mean? Basically means that those orders are bought and they are traded. These off exchange market makers will trade against those orders, those retail market orders, really without competition. So how does HFT affect that type of trading? Well, the upstairs market makers have to match the best price on the exchange, right? That's, they're basically sitting on the sidelines and they get to trade at the prices they see that really the high frequency traders are posting. So the more aggressive and the tighter that high frequency traders trade, the more that they tighten markets, they're actually squeezing the margins of the upstairs market makers. So that's why I say there's a little bit of a positive impact. And I know this from experience that when the high frequency traders came in, the upstairs market makers had actually quite a difficult time and continue to do so because the high frequency traders tighten the markets and often would tighten them to a point where the upstairs market maker couldn't make that much money if he matched the high frequency trader's price. So that's probably not what you would expect, right? I mean, I've been extremely critical of HFT, but I will say that part of the reason they can trade so tight is they've got all those super advantages that caused me grief, right? So in a way, retail's benefiting from the fact that firms like mine were basically abused.
Okay, so something you mentioned in there, which I just want to dive into a little bit deeper and not skim over it too much, is the how does the payment for order flow works? Could you just explain that to us in a little more detail?
Yeah, it's a very old practice. It's getting a lot of attention now. We actually are seeing some class action lawsuits targeting it. Before I explain how it operates, I'll say that one of the major innovators of payment for order flow is Bernie Madoff. So that's kind of the origin. what he did and other firms in that space is they they basically buy retail order, literally buy, through a kickback, a payment for order flow, we call it, and from retail brokers. So they say, look, don't send your order to the exchange, send it to me. I'll match the exchange's price, and I'll pay you for it. And if you think about that payment, it's kind of like a profit sharing if you think about it, right? The market maker's giving up part of the profit he would make on the spread and giving it back to the broker as a kickback. Why would a off exchange market maker do that? Why do they do that? Well, it all has to do with this concept of what we call adverse selection. But basically, when you trade out in the market and you're posting your quotes, you basically are giving all of the sharks in the market, all of the other fast firms, the option to trade you against you when you're wrong. Maybe you're not fast enough updating your quotes. Maybe you're providing liquidity to a huge, let's say a large pension that their order is gonna move the market, and market makers don't want to trade against order flow that moves the price against them because then they just lose money. So retail is very, very attractive because it tends to be small, and smaller orders don't move the market as frequently as larger orders. But the other thing about it, and I know retail guys probably don't like this, but statistically, it looks uninformed. I mean, you can look at large volume of trades of retail traders, and you can see, what is the, what is the kind of average alpha or average information that kind of edge information edge, let's call it, right, that these orders have, and the answer is zero. It's near zero. So when you trade against a retail guy, you make very close to the actual spread. When you trade against a pension or a mutual fund, you actually get a lot of adverse selection or bleed, and that will look like that's basically price movement that erodes your profit. You don't make the full spread when you trade against other types of counterparties. So it's actually quite simple. It sounds complicated, but it's just, I'm going to say it again in a very simple way. It's like, the way I'm actually look kind of down on these guys. It's like there's an upstairs market maker. He can't compete in the regular market that well. So he basically buys orders from, buys dummies. He wants dummies to trade with, and he basically pays brokers to send them the dummies. These firms that have been engaged in this have had, many of them have gone under in the last 15 years, and Madoff's obviously was one of the biggest, and that whole entire business collapsed. It actually was rebranded as surge trading, I think, and still went under. These firms, were really unable to develop market making operations that could compete in the regular exchanges. The HFTs basically were more sophisticated compared to these kind of upstairs market makers. So, I do give credit to the HFTs for, being able to trade, even though I'm very, really against the cheats and the unlevel playing field. They are able to make markets in the exchanges aggressively, and that's good. Otherwise, we just have these other guys just cherry picking off exchange, and then we'd have wide spreads. It'd be worse.
Okay, so just to wrap this up for us, is the retail trader disadvantaged in any way by the way that the payment for order flow works?
Well, disadvantaged, there's definitely arguments to be made that that the order handling is not optimal, and that is really there's certain firms that are now have lawsuits against them because they handled orders to basically maximize the kickbacks, right? Well, the problem with maximizing the kickbacks, I'll give you a very clear, actually, example here. If I go to, if I'm a retail broker and I go to market maker says he's gonna, he's gonna pay me a quarter penny per share for my orders, right? He could actually give me a kickback, or if I was looking to get my customers the best execution, I might say, hey, don't give me the kickback. Just give me a quarter penny price improvement. Give me a better price for every single share you trade, right? So these brokers actually have a choice. They can actually negotiate to get you a better price, or they can just, take the kickback and pocket it. And what they do is they know that the regulators are concerned about the level, the amount of price improvement. So what they'll tend to do is give a de minimis price improvement. They'll basically say, look, give me a little bit of price improvement on average versus what might have been available on exchanges, and then give me all the rest of it as a kickback, right? On top of that, they will basically, as I said, send orders to either trading venues, and it's complicated. I don't want to get to all of it, but basically, trading venues also have rebates or kind of a payment for order flow arrangement. When a broker basically maximizes the kickbacks that they get, not only are they not passing on the value of those kickbacks to their traders in the form of price improvement, but the places that have the highest kickbacks tend to be the places, especially if when talking about trading venues, where which are the most expensive to trade for the liquidity, for the other side of the trade. So what that basically means is you don't get filled as frequently if you try to maximize rebates and kickbacks. So very simply here, retail traders should be getting, significant price improvement. They're not getting it. The way things are routed now are probably dramatically reducing their fill rates for orders that they post. So if you're a retail trader and you post orders and you don't get filled frequently, what you should know is that your broker has a lot of options for trying to get that order done. And if you're not getting filled, maybe your broker is not sending those orders to places where they're likely to get filled because he's trying to maximize kickback. So these are all the details about it. But the other thing I'll point out is the all these payments and kickbacks I'm talking about, they are very significant. Some brokers will get close to like 50% of their net income from these types of payments. But these brokers are basically charging commissions that are ridiculously high when compared to the kickbacks. So, I guess I would say that the commissions are even more egregious for many of the retail brokers than all of the funny business I just spoke about. And there's a deep irony there because the reason why the SEC permits all the kickbacks is the argument is it's supposed to reduce the commission rates. That's the whole reason they're permitted. And so for a trader to pay high commissions, retail trader, get very little price improvement, and have their their orders have lower fill rates because they're routed incorrectly, and for their broker to be getting 50% of their net income by monetizing that trader's order is basically, from my perspective, the retail broker is basically just stealing money from the trader. And what should he do? There's the answer. The trader should move to there's certain firms that will, some firms charge $8 or $9 for a 100-share order, and others charge $1 or less. And retail traders, I'm just shocked why anybody would go to the traditional retail brokers when there are firms that cater to semi-pro kind of people. If I'm going to open up a retail account, I'm going to open it up at a broker that caters to high volume active traders who are demanding that their costs are less than $1 for every 100 shares.
Absolutely, yeah. Well, Haim, this is a fascinating subject, and I mean, this whole conversation has been really fascinating. I know we could keep going on for much longer yet, but I know you've got to run, so I mean, thank you very much for doing this. I really appreciate you coming on. Before you do go, can you share with listeners where they can go to find out more about you, and where can they connect with you?
Oh yeah, well, the first thing you should do if you're interested in any of this stuff, I tend to tweet quite frequently. I usually tweet about the regulatory developments, firms that are getting hit, and some of the things that are being argued about in the market structure community. But HAIM BODEK, Chaim Bodek. That's my handle on Twitter. I have a website, chaimbodek.com. There are a lot of resources there. There's also a link there to a research site that I have that has lots of videos, and it's called decimuscapitalmarkets.com, but it's best to just get to it by going to chaimbodek.com and then clicking the link. But the Decimus site has videos and white papers, probably 20 videos on there or something. You can sign up for free. There's a little, and I just approve anybody who signs up, so there shouldn't be any issue. And let me do another plug also. Just other things, if you want to hear my story, Scott Patterson wrote, or you want to read about it, Scott Patterson wrote a book called Dark Pools. I'm about a quarter of that book. It tells the whole trading machine story. There's the documentary, The Wall Street Code, which I'm featured in, and that's on YouTube. There's also a documentary, the New Wolves of Wall Street, which I've got my story is also told in that. And lastly, I've got two market structure books. One, The Problem of HFT, that's what a lot of people go to after they read Dark Pools. And then we recently released a new book called The Market Structure Crisis, which really talks about all the issues, not just the high frequency trading issue.
Excellent. Yeah, very cool. And I'll make sure to add links to all of those at chatwithtraders.com. Definitely, guys, read Dark Pools. Awesome book. I've read it. And The Wall Street Code, also highly recommend that. I mean, I've watched that probably 4 or 5 times. Such a great documentary, and yeah, you'll really enjoy it. So, Haim, thank you very much for doing this. I hope to have you on again sometime soon, because there's much more we could speak about. But yeah, thank you, and let's talk again soon.
Okay, thanks.
brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics?
First of all, welcome to the Big 50, and second, a big thanks for joining me. Now, you may recall for episode 25, which was almost 6 months ago now, I invited Zach Hurwitz back onto the podcast to grill me about my own trading progress. Well, we're obviously another 25 episodes on now, so I thought it'd be a good point to check in with you and give another update on how I'm tracking. So, Zach joins me again for this week's episode. Just a quick intro. Zach originally appeared on the podcast for episode 11, where he shared a great deal of insight into how he uses VWAP, being the volume weighted average price, at the core of his trading strategy. He's also become a very good friend of mine since we first met at the beginning of this year, 2015, and has personally helped me a great deal with my own trading. During this episode, you'll find the first part is mostly Zach asking questions for me to answer. Then we switch it up, and the later part is me asking questions for Zach to answer. Just to add on that, pretty much every question asked during this episode has been crowdsourced. So if you contributed a question last week, then there's a very good chance you'll hear it asked at some point during this episode. As you may have already seen, this is a pretty extensive episode. It runs much longer than normal. So if you make it all the way to the end, then props to you, and I totally understand if you need to break this up and don't listen to it all at once. 2 things just quickly before we get into it. I know we have a lot to get through. Zach is again offering a free 30-minute one-on-one coaching session to any trader listening who is, of course, serious and feels as though they could really do with some help. A very generous offer, and if you'd like to take him up on it, then send Zach an email. His address is tradingcoachz@gmail.com. And the second point I'd like to add is if you have any questions or comments for Zach or myself, just go to chatwithtraders.com/50, scroll to the bottom of the page and drop a line in the comments area. Both Zach and I will be keeping a close eye on this to respond to anyone and look forward to interacting with you there. So that's chatwithtraders.com/50. All right, let's get into it. I'm your host, Aaron Fifield. As you already know, this is the Chat with Traders podcast, and please welcome my guest for episode 50, Zach Hurwitz. All right, and we're recording. Zach, what's going on, man? How are you?
Doing good, Aaron. Thanks so much for having me back on the podcast, and congratulations on 50 awesome episodes. I should say 49, a little anticipatory that this one's going to be so good.
Yeah, I mean, we've just reached 500,000 downloads, 500,000 downloads, so it's a pretty cool milestone to hit. And I mean, thank you to everyone listening. I just want to really put that out there because I, obviously appreciate the support and everyone listening in. yeah, it's a cool milestone to hit.
I love how nonchalant you are that you're like, yeah, 500,000 downloads. It's pretty cool, guys. I have 600 Twitter followers, Aaron. Come on, let's talk. 500,000 is a giant number. You should be really excited about that. I know everybody is thrilled for you, not only the success, but the fact that you've got, I mean, where do you go from here? I know we're going to talk about that in a little bit, but in 50 episodes, you've already covered so much ground.
Yeah. I mean, I've got plenty great guests lined up, especially in the early part of 2016 already. So, yeah, we've still got a long way to go. But, yeah, I mean, fill us in on what's been happening since episode 25 when you were last on the podcast.
Well, I started using this new website called twitter.com. I don't know if you've heard of it. It's pretty big these days. The kids are using it. And just developing my own site, thevwap.com. And go check it out. We're going to be launching in 2016 with a recorded course and plenty of other great VWAP material, as you might imagine. Just keeping busy. Believe it or not, I'm still receiving like 5 to 10 emails a week from traders from the episode that I did with you back in March of this year. So it's been 9 months. I still get 5 to 10 emails a week. I mean, I'm thrilled, though. I'm glad that what I say has resonated with so many people. So I'm sure you feel the same way, right?
Yeah, that's awesome. That's really good to hear. So, I mean, episode 50, last time we spoke was episode 25, and I sort of gave a bit of an update on where I was at with my trading, some of the goals I was hoping to achieve, and just some of the things I'd been learning. And we also, asked you a few questions as well. So this time for episode 50, we're going to do something similar, but we've crowdsourced a lot of the questions. So I sent an email out earlier this week and I had an overwhelming response of questions. Hopefully I can answer the questions you guys have been asking. So Zach, I know you've got a bunch of questions that are aimed at me over there. What's first on the list?
Yeah, well, the question on everyone's mind since episode 25. Last time you were aiming to have an automated strategy within 6 months. Have you reached this goal?
The short answer is no, not quite. I have covered steady ground on it. I'm not at a level where I'm trading an algorithm. It's not automated. I don't have a profitable strategy ready to deploy into the market. I'm still quite a way away from that stage. But in saying that, I mean, I have really been digging into the code over the last 6 months and just really building my knowledge up on how to program. I have created a few basic algorithms that do work, and they have all the functionality there. They're not algorithms that would be worthwhile trading though, but they're a good starting point, a good base to kind of build from. Yeah, so that's the short answer.
Yeah, I'm sure, like you're saying, you've learned so much from just creating any system. It doesn't even have to be anything close to your actual thesis about how to trade, but learning even a moving average cross or breakout to new highs. Some basic strategy will teach you so much about coding and identifying a lot of these systems. What do you think has caused you to not quite reach the goal that you set? Was there anything that held you back?
Yeah, I mean, probably was slightly naive and thinking I could learn how to program and then use that programming knowledge to code or script and a profitable strategy.
Are you separating that like learning the trading and learning the coding are two totally different like paths of learning?
Essentially, yeah, because I mean, to go in the algorithmic direction, you do need to have a pretty solid understanding of how to program. You also need to then identify a strategy that can be programmed, because the strategy or the type of setups that I was trading kind of earlier this year and later last year are quite difficult to program. I mean, that's one of the things I learned as well, was because those types of strategies were very visual, as things such as like horizontal support and resistance are very hard, well, for me at this level, are quite hard to
identify and track a prior support level or prior swing low or swing high.
Yeah,
Yeah.
definitely. So one of the things I have learned is that there's quite a big difference in the type of strategies that can be used discretionarily and those that can be used in a quantitative, more systematic way. So, I mean, that was probably one of the things, is just a bit naive on how steep the actual learning curve was. I also questioned myself quite a lot over the last 6 months about whether I was doing the right thing, whether learning, Python scripting language was the right direction. But I know there's easier ways to achieve the goal of, systematic automated trading. For some reason, they just didn't really appeal to me, and Python really stood out, and I just felt like it was a more valuable skill to have in the long run. I mean, some of the other things I was considering was, obviously going back to, languages like ThinkScript, or maybe I should have been using something like TradeStation. They've also got their easy language. The cool thing about Python is it's open sourced, so you can use it on any platform. You're not limited in that regards. And I guess probably the other reason, which I found a bit challenging, was it kind of time constraints. Because I'm not trading full time, which means I need to try and find an income in other areas, which means that I've still been doing the occasional graphical web design job. As much as I hate it, it's money coming in. So, I've had that. I've been running the podcast. You've also got your personal life away from the computer as well.
You have a personal life?
Yeah, there's a small one there.
Oh my God, I missed out. I forgot. Yeah. I was going to give you a hard time. I was going to say, what the hell else have you been doing with your time, Aaron? It's not like you have a podcast or anything to run.
Yeah. So one of the things I think it's good that I can identify what's been holding me back. Well, not holding me back, but what's slowed my progress a little bit. I don't know if that's even the right word, but
you remember when we talked about this, I think a couple of months back, when you were deciding between the languages, you made a really good point about back testability, that whatever strategy you're trying to code or identify or eventually employ or deploy, as our favorite word for algo trading, right? Deploy it. You'd said Python and I know TradeScript, this is one advantage they both have, TradeStation's easy language versus ThinkScript. One advantage that Python and TradeStation have over ThinkScript is that they're back testable. They're easy to kind of vet the strategy on the fly. Did that factor into the kind of delay?
Yeah, absolutely. I mean, because I know it would have been easier for me to maybe use something like TradeStation, but I think I try to look at things in a very big picture. I think I might have mentioned this last time. And I think in the long run, knowing an open sourced programming language that's a lot more versatile, has pretty much the only limitation to it is your own creativity, is going to be more valuable in the long run. Yeah, and I mean, one of the things, I was coding earlier today for a few hours before we got on the call here, and I was, just running a few back tests, and you could just see, you would, obviously hit the back test button, and it would draw out the equity curve, over the period that you were back testing a strategy. And some of these strategies, they just, they spike up at the beginning, and then that for the next, let's say 3 years that you're back testing, it's just going down, 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 just keeps going down. And it's just really cool to see that. And I think that is quite powerful because, what I was back testing was a strategy that some people will be trading that, or some people will be trading something very similar, but they've never back tested it. They're kind of trading blind in some regards. So it was just, I think there's a lot of power in being able to see just how that performed in the past. Even if it's not going to perform exactly like that in the future, right then and there that that's not something you're going to continue to trade.
It's like there's 3 levels of awareness. There's the people who are like not aware at all of any thing resembling an equity curve for their strategy. There's people who have an idea but haven't gotten the equity curve yet. And then there's people who have the equity curve. So being able to see it, I think that's a great point, that there are people putting this into practice who don't know their numbers, but you're seeing almost like the fabric of the fates. You're seeing someone's life, that they don't know that they're about to undertake, right? Now, obviously, not every trading record with a given strategy is going to be the same. You'd have to Monte Carlo it to see exactly how many different permutations there are and how many different potential paths with the same trading report. Have you gotten into Monte Carlo backtesting by chance, for anyone who's listening who might be interested in Aaron's experience with Monte Carlo?
Very little is the short answer. That's definitely something I'm keen to explore, in the months going forward. I have done some basic Monte Carlo work in Python, mainly following tutorials, but that's all been really helpful as well. That's definitely something I'm going to need to learn and dig into a lot more going forward, though.
For anyone who's wondering, I'll give a super cursory explanation of Monte Carlo. Imagine you had 100 trades, but you took them in a different order. So they all had the same outcome of the last 100 trades of yours that we're examining, but they came in a different order. What if all your winners came at the beginning, or all your winners came at the end? That would dramatically affect how your sort of net output at the very end of the 100 trades would come out to. Monte Carlo scrambles those trades and their order hundreds, thousands, tens of thousands of times and gives you a kind of best and worst case scenario, so to speak.
Yeah, and I think if anyone actually wants to look at that a little bit more, Phil Lawrence.
Exactly, link them to Phil's article, yeah.
Yeah, so I'll put a link to that in the show notes. That article, many of you have probably already read it. It's called The Numbers You Wish You Knew About Your Trading. He's got a great explanation that actually hits on Monte Carlo in that, as well as some good visualizations and screenshots of tests he's done. So, that'll go into that a little bit more. So, what other questions have we got on the list there, Zach?
Sure. Well, one question that I think a lot of traders would want to hear about from you is, by nature, what type of trader are you?
Yes.
And, go ahead.
Yeah, so the type of trading that I'm naturally attracted to, probably just because that's what I was first introduced to when I got into trading, is swing trading. So and when I say swing trading, holding positions anywhere from a couple days to a couple weeks. I don't really like to hold anything beyond that. Talking holding for a couple months, that can get a bit boring. Not really a day trader. That doesn't really appeal to me too much. Although in saying that, my goal with, moving in the algorithmic trading direction is to have strategies that operate on a number of time frames. And one of those time frames would most definitely be intraday strategies. So I'd like to layer it with, a couple intraday strategies, a couple swing trading strategies, and then maybe even, a couple longer term strategies as well. And that's something I picked up from speaking with Kevin Davey. I think that was episode 39. It was around about that time. And he said that having, a basket of strategies actually helps you smooth out your equity curve over time as well. So, that was a good takeaway from that interview.
Well, it's a good point that he's making, that you can't build one strategy to solve every type of market. You need a grouping or kind of cadre, and an armory of strategies to apply to a variety of markets. You don't have to apply to every single one. You don't have to have something in your basket for each type of market. You just try and cover as much ground as you can and produce a smoother equity curve, as you're saying.
Yeah, 100%.
I think you're also being a little bit modest, not to give too much away to the listeners, but, you and I have done a little bit of day trading together, actually, and Aaron's being modest. He's a pretty talented intraday trader, but what's I think really cool is that you're picking a strategy that fits with your style of kind of your personality, right? You know that you don't want to be impulsive staring at the screen for 8 hours a day. It's not going to fit with all your other obligations. You need something that's automated, more even-keeled, maybe a longer-term strategy, but not quite investing,
Exactly, yeah. I think you hit the nail on the head.
Sure. Yeah. How do you feel about your progress to date, even though you haven't hit the target you're aiming for? Are you discouraged at all by this?
Well, there's definitely been times over the last 6 months where I have been pretty disappointed, but then I sort of stop and think, right? So I think back to where I very first began. So when I very first decided I was going to start learning how to code, right? I didn't even know what an integer was. I didn't know what a float was. I didn't know what a function, a method. I didn't have any idea. And I look at what I'm doing, what I've been doing earlier today before we jumped on this call, and right now at this point, I've been able to code an algorithm from scratch. Admittedly, it is fairly basic, but it works, and it's a good starting base, something to build from there. So yeah, I've definitely been disappointed with my progress at times, but I think everything always takes a lot longer than you anticipate that it will. Plus, the knowledge that I've acquired from doing 25 interviews since we last spoke, or spoke and recorded it, is huge. It definitely helps me, whether I trade like those traders or not. There's still something I can take away from everyone, and we're probably going to get into that a little bit more as we go. But yeah, overall, I think I'm okay with where I'm at. It would be nice, I'm not really actively trading at the moment. Instead of spending, a couple hours after the market closes each day looking at charts and that sort of thing, I find myself still looking at charts, at least a few times a week, but I'm usually spending a good few hours each night learning how to code and program and that sort of thing. So it's a little bit different to, I think, most people that I speak to during the week, like people who email me who listen to the show. I think it's a little bit of a different path than what many other people decide to take. And yeah, obviously I just hope I'm doing the right thing.
You realize how this relates to what other traders experience in their own trading career? They expect it to be, they set the bar so high, right? They say, all right, well, in 6 months, I'm going to have $1 million acquired from my, proprietary strategy of so-and-so and so-and-so that I'm going to enact 8 hours a day with no failure, with, absolute consistency and total risk management. And on the second day, they screw something up. They go, oh my God, this is way harder than I thought. We experience failure so frequently in trading because we set the bar for success so ungodly high, right? Look, I didn't want to bark at you on the last interview and say 6 months. There's no way you're going to get a strategy up and running in 6 months. I wanted to be encouraging, but look, that's an aggressive goal for anyone, even a very seasoned coder, to go from ground level to tested and implemented that quickly. It can be done, and it can be done in a simplistic manner. But I think, like you're saying, you've learned so much from just doing the basics. It's like owning your first car. You probably learned quite a bit about how to take care of a car from that first vehicle. God rest its soul. Right?
Absolutely. Yeah. Yeah. Totally agree.
Yeah. All right. So how are you measuring your progress? Are you journaling? Do you use spreadsheets? Do you document results? How deep are you into the back testing? Or is this more like you're still doing the coursework?
Yeah. So one of the things I kind of like about programming is that it's quite easy to measure your progress. Whereas you're a discretionary trader, or it's just a trader in general, some weeks you're up, some weeks you're down, and it's always up and down. And it's quite hard to know if you're actually getting better, like you're acquiring more knowledge, but are you actually getting better? With in a programming sense, either it works or it doesn't work. And you start to code things that are slightly more complex. Not to say I'm actually doing anything super complex right now, but things start to gather momentum, I guess, is a way to say it.
A good phrase, sorry to jump in, a good phrase from Phil that just came to mind, shells. The idea of building a shell that can be used in anyone's script, but then applied to another. I know this is more of a kind of proper programming term that I'm, of course, a non-programmer, like kind of learning myself as I'm learning code, but building a shell that you can use, a construct that you might use somewhere else, whether it's, like I said, a moving average cross or a counter of how many bars since an event has occurred. These things can be useful to systems down the road. So building a subcomponent might be valuable even if it doesn't turn into a fully fledged, up and running, deployed system.
Absolutely. I mean, I've found that even over the last couple of weeks. Like if I create something, like a new script, I'm often copying and pasting blocks from past scripts into the new one and just tweaking it a little bit to suit. And then obviously adding to that as well. So yeah, and I mean, just to add on that, I have been I've got like a personal blog. I don't really promote it and put it out there, mainly because there's not really much on it. I've probably been a little bit slack on that. When I was doing a little bit of day trading earlier this year on demo, I should mention that. I was journaling all my trades on there with screenshots and that type of thing. So I was doing that. It's now sort of turned into a place where I just put important notes that I want to remember about programming. And then also, I'm still obviously looking at charts, quite a few times each week. And I find, the type of setups that I was looking for going back to earlier this year and into last year, I'm still saving those onto what you'd probably call like a watch list. And one of the things which I think is quite beneficial is watching those setups sort of unfold. Okay, so obviously you identify it before the trade signals, but then following it. So following it signals whether I take the trade or not. I mean, I've only taken a handful of trades this year. I'll still keep it on my watch list for the next sort of, month or two, just to see how it unfolds, to see how maybe I could have better, just think about how you maybe could have better managed your stops and that sort of thing. I don't think I'm being very clear here, but keeping it on your watch list to watch how it unfolds past whether you took the trade or not. Like, don't just scrap it from your watch list. Keep it on there and see how it progresses and moves.
You know what this is like? This is like doing homework and flipping to the back of the book and looking at the answers instead of doing the work. When you actually watch the setup, I'm serious, when you watch the setup, you're working through the problem, even if you're going to get the answer anyway. You're going to get the answers to the test after the test, but it's kind of like, well, I still need to learn how to think about it. I think that's so cool that you're constantly kind of giving yourself these little mini quizzes of the setups. Did I identify it right? How could I have done this better? Was I early? Was I late? Is my stop too tight? Is it too wide? Etc.
Yeah, I mean, that sort of thing, I mean, I keep them saved there and it's going to be a big help. It continues to be a big help in identifying better setups, better entries, and that sort of thing. Like, there's a lot to be learned from actually following a trade through.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
You know, that website that I shared with you guys, and I hope, you go check it out, twitter.com. I'm messing with you guys, obviously. I'm posting a lot of my trades on Twitter because finding trades like that and keeping a record of them that you can go back and look and say, on this date, at this time, this was the opportunity. My God, to be able to document that and aggregate it. Are you saving any like spreadsheets or Excel output of any of the systems?
No, not at this stage. I'm probably not at the level where that would be too beneficial in regards to back testing. But
sure.
Hopefully in the next couple of months, I'll be starting to build up a good backlog of spreadsheets.
There's a great quote I have here in my notes. I think it was from the originators of the C programming sort of suite language. Make it work, then make it right, then make it fast. Like, it's okay if you're just on the make it work part. That's what everyone starts with.
Yeah, that's actually really good. I like that because, some of the coding I've been doing, I know it's not the most efficient way. And I know it's kind of a little bit rough, but it's just first step. Yeah, exactly like you said, is get it to work and then go through and optimize it. And
then get it right and then get it fast. By the way, make sure you mistakenly attribute that quote to me and not to whoever said it so that I get credit for it. Okay,
sure,
Zach Hurwitz said this. I'm messing around. What are you studying and working on at the moment? Are there any resources that you're finding helpful right now? I imagine there are so many traders out there who are like, wait, if Aaron's saying that it's doable, then you're right. It probably is doable. I should go check this out. Where should they start?
Okay, well, I can share a couple resources that have been really helpful for me in learning Python, and I'm not saying you should go out there and start learning Python, but if you want to, Codecademy has an awesome course on learning, the good fundamentals of the language. It's a very extensive course. It's free, and every different sort of lesson, that's probably not the right word, topic, whatever, you have to actually write out the script. So you're not watching videos, you're not just reading a book. It's very interactive, and it actually makes you write things out before you move on. So that's been helpful. What else? There's been I've done a couple courses on Udemy. I think one of them was called the Ultimate or Python Bootcamp or something along those lines. That's a really awesome course. So I'd recommend anyone who wants to learn, just the fundamentals of that language. That'll just teach you, like I said, the fundamentals of the language. It's not going to teach you how to apply it to a trading domain, but you've got to learn that to start before we can go any further. I've also been reading quite a few, quantitative trading books. Inside the Black Box is a really cool book by Rishi Narang. He's actually going to be on the podcast in a couple of weeks' time, so I'm pretty excited about that.
That's awesome.
Yeah. He'll be really good. His book is really insightful.
Is that something that somebody without any experience in quantitative trading could read and appreciate? Because I remember that feeling of like, I want to buy this book, but I'm going to feel like an idiot if I buy it and look at it and go, I got to Google like half of the words in this book. Is it something that you could get into, or is it kind of over your head, but you're going to try and get more of it over time? Or
it's probably a little bit, I mean, it's probably a little bit over my head still, but I kind of just take the attitude. It kind of just feels like sometimes I'm just drinking from a fire hose. Like I'm going to take some of it in. And just the more I go over things, you know, it's kind of like when you set out to learn something new. I mean, most people can probably relate it back to when they were younger, right? They had a favorite band. When they first discovered the band, they didn't know anything about them. But, you know, you kind of, you know, when you're young, you're a teeny bopper, you kind of obsess over a band, right? And before you know it, in a couple of months' time, you know everything about all the band members and that sort of thing. It's very much the same. You know what I mean? You just kind of got to almost obsess over things, and you just start to learn more and more, and it just becomes almost like second nature after a while. Like the more you go over the basics, like I've done, I don't know, probably 3-4 Python courses, probably a few more than that actually, all just going over the fundamentals of the language. Not even applying it to a trading sense, just learning the basics of the language. But it's been good to do it from different people because everyone has their own unique way of explaining things.
You know, one thing, if I might jump in, you're kind of hitting on the Yoda principle. This is what I call the idea that like Yoda didn't start as Yoda. Like he wasn't a wise old sage when he was born, right? I mean, he started somewhere. He had a teacher. He grew into be this incredible, you know, teacher of other Jedi, but no one, you know, is born with knowledge. Like you say, you know, you start out somewhere and you go at whatever pace you can and you acquire skills, and eventually one day you can become, you know, a 9,000-year-old, 900-year-old little green Muppet teaching Luke Skywalker. Right?
Yeah.
We all have dreams.
Yeah. And I mean, that's the thing is like no one's born with the knowledge on how to do anything. You know what I mean? It's just a skill that if you want to learn, you just set your mind to it and you just go out there and learn it. So you just accept that it's going to take time and just be prepared to put in the work.
I was going to say, just remember all traders started out thinking CNBC is where they're going to get like, you know, finger on the pulse market knowledge, like with CNBC. You know, everybody believes early on, and then they get a little jaded, they get a little experienced, then they grow up a little bit, then they start searching, they go through the struggle. And those that make it through the wandering struggle are the ones who become professional traders. They, you know, persevere.
100%. And Zach, just something I want to ask you, which I probably should have asked a little bit earlier, but you asked me about how I'm keeping track of my progress and am I journaling and that sort of thing. And there was actually a few questions that came in about that subject. So I'd like to put it to you and ask you, what tips or pointers would you give to other traders who need some guidance about journaling? Like what exactly should be in a journal besides what price you bought and sold at?
I think, okay, this is a good question. Every trader journals a different way. I journal like a scrapbook. Like I put some screen caps, some text notes, maybe an audio recording of like how I feel at the end of the day. And I just throw it all in a folder with that date. That's just me though, right? Some people want a Word document. Other people make a database or a spreadsheet. It depends on how quantitative or qualitative you are. For me, it's a lot of the visceral that I want to capture. I want to figure out how I felt that day, why I felt that day. Was it internal or external to the sort of trading ecosystem? Meaning, was I upset about something that happened in trading, or did I not get enough sleep the night before? Did I fight with my girlfriend? Did I kind of want to observe the behavioral triggers that might be happening around me too. There are so many other things other than just like what price you buy and sell. What was the market doing when you took the trade? You know, was it trending or was it a non-trending environment? Was it a big reversal day? That sort of thing. What type of trading day did it appear to be when you took the trade? Something I'm big on, you know, numerically scoring your trades just on your own, you know, your own personal scoring of 1 to 5. How confident were you in that trade? It's not bad if you take a 1 or 2 confidence trade, meaning low confidence. Presumably, you know, your risk is appropriately smaller to reflect that it's like, hey, I don't think this is going to work. But if it does, then great. I'm in a wonderful trade for 8 cents of risk or some, you know, modest amount. What was your risk reward on the trade? How good was your entry? What time of day did you enter? Things like that. I think the more you trade, it's sort of like going out on dates. The more dates you go out on, the more you notice kind of commonalities. Like if the girl you're going out for a coffee date with doesn't show up for the first 20 or 30 minutes, she's like super late. Maybe that's not a good match. And for the record, for me, that would be a great match. I'm always running on Hurwitz time. Anybody who's taken me up on that free consult knows that I'm usually running 5 to 10 minutes behind. What a great, if it's 5 or 10 minutes, that's awesome. That's a success, Anyway. With journaling, I think you have to figure out what appeals to you, because journaling sucks. And we all know it. We all know it. Nobody enjoys writing, especially about their losses, right? Part of what I talk about, like the circle of good trading, the last point in the circle is to review with clarity. It's your job to keep your head held high, look straight in the eyes of your trading report, and see it for what it is. Because if you're one of those people who and I've had days like that, I know we have all had days like this, it hits 4:01 p.m. Eastern, and I'm force quitting Thinkorswim. I'm get out of my fucking face. I can't be looking at you right now because the trading report is so bad for the day. Nobody wants to get there. We all want to be able to look at it, and even if we have a losing day, kind of be motivated. Well, you know what I'll do? I'll take some screenshots of the day, and I'll be able to look back at what I saw when I have a clearer head. I can't tell you how transformative that is for traders. It's like holding a mirror up to themselves. They can finally see the struggles that they're experiencing. I used to do that when I was a younger kid in my teenage years. Here's a little bit of my teeny bopper, teen angst therapy. And by the way, we're going to come back to that. I want to know what band you were talking about. But I used to open a TextPad file on my computer, close my eyes, and just type, just sort of like stream of consciousness. After I was done, a couple minutes of writing, I would go back and I'd read it through and just observe my own feelings, like what I'm experiencing, but not saying, my own kind of internal monologue. And that was what helped me in journaling my own kind of thoughts and feelings and applying the same thing, like I was saying, a stream of consciousness rant. So maybe one day after, 250 episodes, we'll do for special subscribers, we'll release the unedited audio notes of Zach Hurwitz cursing at himself after a bad trading day. No, I'm just kidding. All right, now back to the important question, Aaron, because you almost glossed over this. You said you were teeny bopper and you followed a band obsessively. What band are you talking about? Because I know you're talking about a band. What is it?
I'd probably rather not say.
No, you have to tell us. You can't mention it and then not tell us. I'll tell you what. I'll tell you. I have a terrible one that I liked too. So go ahead. You give me one, and then I'll give you one.
I'm probably going to say Good Charlotte. That was one of them.
Oh my God!
I know there's a few others.
Oh my God, Aaron!
I'm trying to think.
No, dude. Okay,
I'm trying to think of a better example.
That's a great example. Thank you. That has made my night. The band I liked. Prepare yourself. It was Creed.
Oh yeah, that's pretty shocking.
Did you just hear 10,000 listeners simultaneously? Here, we're keeping with the Star Wars theme, right? It's I sense a disturbance in the Force. 1,000 voices cried out at once. It's seriously, people are just Good Charlotte and Creed. Who am I listening to on this podcast?
Yeah, that's a bad combo. So just going back to the journaling, let's quickly move off that.
Yeah. Come on, I couldn't skip over the band. All right, go ahead.
So on the journaling, it's probably one thing to journal your trades and keep records of, what you've been doing, your activity. How often should someone maybe make a conscious effort to go back and review their journaling?
Do a small review every weekend, Saturday or Sunday. You don't want to do it end of Friday. Come on, nobody's got a clear mind at the end of Friday. We're all burned out, right? Small review. So we're talking maybe 20 to 30 minutes, and then maybe a larger review of an hour or two to review the weekly kind of notes. And remember, this doesn't have to be a regimented, detailed, multi-page report. Journal the way that you're going to journal. You know what I'm saying? Do what fits with your personal style. So make it enjoyable for you. Like I was mentioning, the scrapbooking. That's something I can do kind of on the fly as I think about it, as something strikes me about the day or something that I've written in chat. I can just grab that and copy and paste it. That's easier to me than writing a paragraph about each trade at the end of the day. It is going to take up a lot of time. Obviously, if you do this every day, if you review the notes, it's something you have to add into your workflow. I don't know if daily review is really that important. I'm not trying to sound lazy here, but it really is. It's more about, I think, the weekly. One data point does not a trend make. So you're going to have terrible days. They are going to happen where everything is wrong. And, nothing's going right. The best setups don't work. You fat finger a trade and maybe buy too much of it, and then it goes against you. And you got to make it through it. It's the prepare yourselves, guys. Cheesy traderism incoming. If you want to be here for the good days, you got to be here for all of the days. You just have to show up and trade. You don't get to just show up on the good trading days. You have to make it through all of the difficult ones as well. But I don't think it's as beneficial to necessarily spend a ton of time reviewing each day's notes until the end of the week. That's all.
Yeah. So I guess that kind of just goes back to that trading mantra everyone's heard 1,000 times, is just do what fits you. Find a trading approach that fits you. Find a journaling approach that fits in with your schedule, and just stick to it.
You know why people react so negatively to that, though? It's because it sounds like we're talking about our spirit animal, like our Patronus from Harry Potter. You know what I mean? Who is your style of trading that calls to you, Aaron Fifield? And it's not that easy. It's not like you find, I belong in House Gryffindor. I belong as an RSI trader. It's never going to be that simple. I think what we're saying is figure out what elements of trading really appeal to you. For example, I'm a very visual learner. I like pattern-based trading. That's just fun to me. It's more fun than, reading the tape, right? That doesn't mean that that's a bad strategy or that you shouldn't consider it or that it might appeal directly to you, but to each their own. And you have to find something that is intellectually fulfilling, and in the same way, hopefully, obviously, very profitable too.
Yeah, no, that's really well said, actually.
The trading Patronus part, right? The Harry Potter reference, obviously.
Of course.
Just messing around. All right, so do you mind if I keep going? Do you have? I know you've got some questions for me interspersed too.
Yeah, no, keep going. I know we've got a bunch here to get through.
I know. So. I gotta grill you, man. I'm sorry. This is a tough one. Are you ever worried that your work for Chat with Traders is somehow spreading you too thin, maybe even hindering your ability to become the trader you want to be?
Yeah, and I'm glad someone actually asked this question, because it's been something I've been thinking about a little bit lately. Sometimes I think, maybe it possibly is, because it does take quite a lot of time to obviously run the podcast. First of all, you've got to actually find people who qualify for an interview. Then you've actually got to get them to agree, and then you've got to lock in a time. There's a lot involved before you even get to recording the interview. And then obviously it needs editing, it needs, show notes, all that sort of stuff. So yeah, there's a lot of work involved, and it does take up quite a lot of time. But I am learning so much from it. And I think whether I trade directly like the traders I interview or not, there's always a few good takeaways in there for me, which I can apply to my own trading. And, they might just be something that just sticks in the back of my mind. But the time factor is something I'm aware of. And I think that's good that I am mindful of that. And one of the ways I actually plan on tackling that going into 2016 is I have a virtual assistant who I'm actually interviewing for a virtual assistant at the moment to help out with things.
That's great.
And I'm also probably bringing someone on to help out with research for the traders I interview. So that's definitely going to cut back my time quite a lot, which will allow me to spend more time on my trading. But in saying that, I am still spending 2 to 3 hours most nights on my trading, mostly learning coding and programming and quantitative methods and that sort of thing. But one of the things which I really liked from one of the interviews I've done since episode 25 was Tom Dante. I think it was episode 36, I think. He was awesome, and one of the quotes he said was, "If you're not working on your edge, someone else is." And I really loved it, how he just went into depth, really went into talking about how trading is such a competitive business. And it kind of gave me a bit of a wake up. Even though I am spending a few hours each day, I always feel like I can be doing more and I should be doing more, because the ultimate goal for me is to become a better trader. And, you know, there's guys who are doing this 8 hours a day plus, you know, focusing on their trading. If I'm only doing a couple hours at night, you know, is that enough? So short answer is, yeah, it has crossed my mind, but I also think the podcast is hugely beneficial to myself, and also going off what many listeners have told me, also think it's beneficial to many other people, which I really like. So, I mean, I don't think I'm doing it just for selfish reasons. Yeah, and I mean, like I said, I'm going to be bringing a couple people on next year to help out, just take the workload off my hands. Not entirely, but, you know, more hands make light work, as they say.
When you first answered, when I said, you know, you're worried that it's hindering the ability to become the trader, and you said yes, I got chills. I was like, wait, so is this the end of the podcast? It's like, all right, guys, that's it. Thanks so much for listening to Chat with Traders. Last episode, we're gone, we're out. We got to go get working on our edge, because, you know, if not, someone else will be. I think it's such a great quote from Dante. Like, oh my goodness, that freaked me out the first time I heard it, because it really is true. It's like, while you're watching a football game, someone else is learning how to code in Python.
Mm-hmm.
That's probably the truth. So, like, you know, stop messing about. Like, you've got better things to be doing.
Yeah, I almost want to get that printed out and stick it on my wall.
Yeah,
I think it's a brilliant quote, and that's definitely one of those points that's stuck in the back of my mind. So yeah, I mean, I wouldn't have heard that if it wasn't for the podcast, you know. So there's so many benefits to doing it.
And especially some of these perfect little quotable moments, writing them down in your own handwriting or printing them out. I mean, putting them on your wall next to you. I know this is kind of a common traderism. This is a thing that we all do. I remember when I was in college, I would write, you know, never forget to sell this if it breaks below so-and-so, and put it on my monitor, start screaming about something. My buddy would come in the room and he'd look at the Post-it notes and he'd pick one of them off and he'd hand it to me and he'd go, well, you know, it's your handwriting. Like, you wrote this and now you're complaining about it. And like, you should maybe listen to this guy who wrote this Post-it note that is in your handwriting. You know what I'm saying, dude? Kind of pointing out to me like, hey, listen, no one else is in control of this. Like, you're the one who not only fails, but sees the success. All you have to do is take it.
Absolutely. And I mean, I think that's something I'll just add in there is one of the things I've kind of been aware of, but it's just kind of really become more obvious, is that in trading, no one's there to tell you what to do. Like, it's completely you and the markets. Like, it's not like, okay, so if you're running a business, you've got clients, like you have deadlines, you need to get things to people before certain times. When you're trading, it's just you and the market, and no one's there to tell you to put in the time to, to tell you what you should and shouldn't be doing. Like, you need to really take responsibility.
You're only accountable to like the math and the markets. You're not accountable to anyone else. There's no driver of what to do next.
Absolutely. And I mean, that's become sort of really obvious to me this year. And I think, I think one of the good things to be is just really mindful about and honest with yourself. Like, are you putting in the time? Are you doing what you can be to, reach your goals and reach the level of trading that you want to be at? Like, if you're not, then you need to, take a step back and think about, well, how can I change things? What should I be doing?
That's another interesting point. Like, it's okay to be not serious about trading. It's okay if you're not trying to learn how to trade right now, or you don't have the time, you don't have the capital, you don't have the patience, not the right life arrangement scenario. You know what I mean? It's okay if you're not serious about trading. It's okay if you're serious about trading. You know what's not okay is telling people you're serious about trading and not being serious about it. Now, I mean, we're kind of preaching to the choir, right? If you're listening to this podcast, odds are you're doing the hard work. You're seeking out, further education on these subjects. Like, you're probably doing the right thing. But there are plenty of people out there who claim to be putting in the effort and the time, and they're really not. They're just kind of fluffing themselves up.
Yeah.
And like we said, you want to be able to look at your report with your head held high. You want to be able to say, I gave it my all. I did absolutely everything that I possibly could. this is a point I was going to make later, but it kind of comes up right now. It's like there are two universes from this day, from this point forward. One in which you do whatever it takes to become a successful trader, whether that's weeks or months or years from now. And then the other universe where trading's so tough. It's a young man's game. Glenn Gross reference. But people kind of complain and commiserate and I'll get around to it. Maybe I'll learn risk management. But what about this indicator? And they get easily distracted and pulled to the next thing. They never really take stock of where they are or where they want to be. The two universes. It's the same universe, but in one you succeed and in the other you're always remembering what it would have felt like if maybe you had tried to succeed just once. You can choose which universe you live in. It doesn't matter if you're 16 or 60. You get to choose which world you go forth in. It's easy to, it's easy to get psyched up and say it. It's a little harder to actually put it in practice. I feel like that's what trading is all about, though. It's like the repetitive. It's the consistency. It's not about getting psyched up one day, having a good Monday trading, and then screwing up Tuesday, Wednesday, Thursday, Friday. It's about every single day for the next 20, 30, 50, whatever years of your trading career. Mm-hmm. And that's why you have to plan for that longevity.
For sure. So
tell me, this is the question that I know everybody asks me if I know, like I've got some secret information about which are your favorite episodes, but are there any interviews that have resonated with you particularly? Are there highlights, kind of memorable takeaways, episodes 25 to 49?
Yeah, that's another question that came up quite a lot. And, I totally understand why people are asking that. It's a good question. And, this is obviously fresh in my mind, but the interview with Haim Bodek last week was, I was pretty stoked with that interview. Pretty stoked just to get him on the show. Just his whole story is so fascinating, and just like his level of understanding on the market microstructure is just probably unfathomable for most of us.
It's like having Julian Assange on your program, or Edward Snowden. It's like literally at that level, guys. I hope you realize how big Haim Bodek is. He's awesome.
Yeah, like just the magnitude of what he did, you know what I mean? Just the whole story was really cool to be able to speak with him and get it on the podcast. And I also liked how he spoke about payment for order flow, because that's just something I was unaware of. Like, I'll put my hands up and say I knew nothing about that. And I think probably many people listening were unaware of that as well. So that was a really interesting topic. Just another one of the benefits of doing the podcast. Yeah, and then obviously I've mentioned Tom Dante reinforcing how competitive trading is. And one of the things he also mentioned, which I found really interesting, was learning from your mistakes quickly. Not just learning from your mistakes, but learning from them quickly. That's another one of the things that's just stuck in the back of my mind. I think you're going to be able to say this in a much more poetic way than I can, Zach. But if you are continually doing average things, right? You're just continually getting average results. And maybe if it's not even in trading, maybe like, just in life, you begin to accept that, whether on a subconscious level. I don't know. I don't know enough about this type of thing. It's just kind of what I'm almost seeing here. Is if you become used to poor results, it's harder for you to actually progress and move forward like you want to. I don't know. Did that make sense?
Well, it's not only, what I think it is? It's the accepting of the results. If you look at poor results and go, that's not me, I'm better than that. I can do, you're fighting the kind of malaise, the kind of the complacency. I picture it as like molasses or sluggishness. That's what I'm visualizing here. This idea of but this is all I am. I'm just a suffering trader. This is that victimization loop of but the market makers, they know where my stops are. They're always going to know. It's well, come on, man. You gotta be not okay failing. You gotta fight back. Get up off the mat and at least throw a punch, even if you're gonna get knocked down again. Being unwilling to accept them is the important part. And I like that, becoming used to poor results. You're just...
Yeah, you just kind of accept them, and it's not okay. You've got to be, again, it just comes back to the thing. comes back to that thing, being very mindful of where you're at and
being self-aware.
Yeah, self-aware.
Exactly.
That's it. So also Jack Schwager was phenomenal to have him on the podcast. Obviously learned a lot from him. Very well spoken, incredibly insightful for obvious reasons.
I was going to say, if he wasn't, he would be a super big letdown, wouldn't he be? It's like Jack Schwager saying nothing. No, he was great. It was a fantastic interview.
And that was, he actually told me afterwards that's the longest interview he's ever done, which was pretty cool.
Goodness.
I'll take that.
Yeah.
Peter Brandt, he was another really great interview. One of the things I really took away from speaking with Peter is, I don't know if simplicity is the right word, but I just love how the type of setups he trades, they're very, I don't know if simple is the right word, but I mean, they're just horizontal support and resistance, trading a longer time frame, and obviously it's just worked out very well for him. I learned a lot from his insight, also about risk management, that it's okay to take small positions. You don't have to swing for the fences every trade, and that's why he's continued to stay in the game for 45 years, which is incredible.
Yeah, that's quite a trading record. You know what word kind of comes to mind when I think about Peter Brandt? It's almost like elemental.
Mm-hmm.
Like we're dealing with like elements of nature. We're dealing with the building blocks of the world around us when we talk about his trading style, and I think that's why it's so successful. It's not a bunch of bells and whistles and this particular little indicator and this tweak and this particular setup. He's trading from one place on the chart to the next. I think he's reduced it, or distilled it, I should say, rather than reduced. Here I am, a novice trader in my, when I compare to Peter Brandt, talking about how he's like reduced his trading. He's distilled his trading down to the essential elements. And I think you were going to say something to this effect, that kind of, all the great traders you've interviewed and what you hope to bring to your own game is that clarity of vision for oneself and one's trading. Like, you must know who you are, know what you're good at, and know what you suck at. Like, if you want to feel good, focus on what you're good at and good at alone, right? And that's all. If you want to get better, you got to know every aspect of yourself. You have to know every angle, your best side and your worst side.
Yeah, definitely. And another great takeaway that just comes to mind from the interviews since episode 25, Dan Shapiro, he was really cool, a lot of high energy, obviously, and just really dug into the emotional side of things, which I think was good for a lot of listeners. That's something I hear come up quite often. Obviously, I speak with many listeners through emails, Twitter, etc. Psychology side seems to be, quite challenging for many. That's definitely one to check out if you haven't. And another thing he said, which I quite liked, and I'm paraphrasing here, but he said, like, he kind of took a step back and looked at a chart and thought, where can I consistently make $100 from this chart? And I really liked that point. I don't know if that's going to resonate with everyone, but just looking at a chart and seeing if there's something that comes up, something that repeats, that you can act on and you can take out just a small chunk. And that's something also Linda Raschke spoke about, is just taking a trade and just taking out a small chunk of a move and just taking it onto the next one, do it again.
Well, it's training you to think about repeatable events rather than a one-off. Like, everybody likes to talk about KBIO, the massive short squeeze, kind of takeover, reverse merger, blah, blah, blah from the last couple of weeks. Everybody likes thinking about those giant percentage moves, but they happen extremely rarely. Like, why would you look at a chart and observe that one event and focus in on that? That's like, instead of observing that the sun is out, you pay attention to the one day there's an eclipse. You talk about how dark the sun is. It's like, no. You're focused on the wrong part of all of this. Like, look at the other 364 days out of this year. You know what I mean? Where there's no eclipse.
Yeah.
You have to see the chart for what it is. You have to, see opportunity in a consistent sense instead of just this one particular crazy event that traders kind of habitually focus on. And why not? They're exciting. They're kind of a marquee event, right? There's something that everybody's paying attention to. I think this is why momentum trading is so like highly sought after. It's exciting. It's sexy, right? You're trading where there's big movement. I understand it. That doesn't mean it's reliable or it's the best,
Yeah, that's a great point.
So I cheated. I was saying, I guess one of the points that I think you're going to be answering this next question with, but what are some of the commonalities between many of the, traders and particularly the great traders that you've interviewed?
Yeah, so like you mentioned, obviously they are very clear on who they are. They know what they do, and they know what they do trade, and they know what they don't trade. So I think that's important, is being able to answer that for yourself and accept what you are going to trade and what you're not going to trade. That's something I've definitely taken on board. We're speaking kind of like similarities here. So another thing I think is a similarity between many of the traders I've interviewed is they haven't succeeded by chance. So it's not like they got to their level of success and made the profits they did by a fluke. It was it really came down to their incredible work ethic. I think that's definitely one of the big commonalities between everyone I've interviewed, and a lot of them took years to get there. I haven't done a tally, but many traders who I've interviewed have said that they took 4 or 5 years before they started to see some consistency. And many of the traders I've interviewed have obviously been trading a lot longer than that. So just understanding and accepting that it's going to take time.
You have to just stay alive for the first few years.
Yeah.
That's really all it is. It's not about thriving. It's just not dying as a trader.
Mm-hmm. Yeah. So that's definitely a big one. They haven't got to where they are now as a fluke. It comes down to their work ethic. That's what I strongly believe.
So how are you applying kind of like what you're learning to your own trading and your methodology?
Yeah, this is another question that came up quite often. So it's a tricky one to answer, actually, because it's not like I'm applying everything I'm learning in like a systematic process of absorbing their knowledge. But like I mentioned, certain things just subconsciously stick in your mind and they stay around. I think just overall, it's just given me a deeper understanding of the landscape of trading, and it's going to pay off in the long run. There's just no way possible it's made me I'm worse off for doing this. Some things that I've heard have given me extra conviction that I am doing the right thing, which has been nice. But it's also, there has been a couple moments where I could have easily been distracted by, the shiny ball syndrome, but that's something I've always been very conscious of. So even if I don't trade, I think I've mentioned this already, directly like some of the guys I've interviewed, obviously that'd be very tricky. There's always things you can take away and learn and just keep in mind.
You know what it is, man? It's that everybody thinks that there's like a secret conversation that happens between you and the guest, like shortly after you wrap up the interview, where you're like, "Hey, so Peter Brandt, like just tell me, man, like what do I set my RSI to? Can you just tell me like what length of moving average?" And Peter's like, "Oh yes, you just have to use this and this," and he gives you the like inside scoop. So people want to know, like, where do you get your hot tips from?
Yeah,
I'm totally kidding.
I think it's important that I say this, and I don't want to be a dick about it, but like, everyone who's listening has the same insight that I do. So we're both hearing like the same things. I just want to express that to make sure that people aren't just listening; they're actually listening and really sort of absorbing the content, taking on the wisdom that many of these traders are sharing. Because it's easy to do that. It's easy just to listen and not act on it. Like, what's that saying? Knowledge is useless without action. I don't know, paraphrasing. Something along those lines.
So tell me, what were your beliefs and expectations about trading, like before you got started in trading compared to now? I always think that's funny to ask people, like, when you were not a trader, what did you think about trading that the minute you got in here, you're like, oh my God, I was totally wrong about all of this. Is there anything that's dramatically changed compared to when you started?
Yeah, I think when I first started, I definitely did think it was going to be a lot easier than it is. 100%, I thought that. I thought, if I just read these few textbooks, I should be good in 6 months, and I'll, be making substantial money. Right? That's what I thought, and I remember thinking that traders just must laugh at the rest of the world because they just earn so much money. And I mean, I still think that probably is the case for many, but it takes a long time to get to that point. Um, so it's definitely a lot harder than I thought. And I also realized that there are many ways to succeed. I mean, I know we've all heard this before, but that's one of the things that I understand is, I mean, obviously I was introduced to trading with a specific style and a specific methodology. But, I've since learned that there's just many, many ways to succeed and to make money in markets. And it's also your background is irrelevant, I feel, meaning like your level of education. I don't think that's because, I mean, many people use that as an excuse. They're like, oh, I don't know this, oh, I don't know that.
Yeah, well, I never took a class in finance, so who am I qualified to? I know what you mean. Yep.
Yeah. So I think people's background is irrelevant. It's what do they say? It's about where you're going, not where you've come from. So,
well, it's saying that trading is a meritocratic thing. It doesn't matter who you are, what car you drive, how tall you are, how good looking you are, who your dad was. Nobody gives a shit. It matters about your next trades. It's not even about the trades you have taken. There's the saying of you're only as good as your next trade. Not even the trade you're currently in, but the next trade. Because a man who can't find another trade and who can't manage that future position, that's a person who's done trading.
Yeah.
You know what I'm saying?
Yeah.
It's an ongoing process. And if you make it anything less, if you make it a one-off process, so to all you guys out there who have all of your account in some shitty little pharmaceutical letter ticker stock, you know what I mean? This one's for you guys. You got to plan on trading tomorrow too. You can't just risk it all to try and double up. That's not a strategy for success. It will work until it doesn't. And when it doesn't, of course, then you're done trading.
Yeah, it's got to be sustainable. I think that's a really key word, actually. That's something I've picked up from, I think that was Mike Bellafiore. I've probably mentioned this on episode 25, but that's a really key word, I think, to trading success is have an approach that's sustainable. But I mean, another thing that's changed, or I've come to believe about trading, is that things can be as complex or as simple as you want to make them. And a lot of people say keep it simple, and that's probably a fair thing to say. But I mean, I've come to realize that some people actually thrive off complexity, and I don't think that's a bad thing. I think that's okay. But I mean, it just goes to show that it's, you can make this fit you. So it can be as complex as you want to make it, or it can be as simple as you want to make it. That's another thing I've come to realize.
I think it's the difference between inductive and deductive learners. Inductive learners tend to get 80% of the material, in 20% of the time. And then there's the deductive people who will get 100% of the material, but maybe in 100% of the time. They're going to take longer, but they'll get full completion. Right? That's just two different learning styles. That's not to say one is better. One might be faster, one might be more holistic. I mean, just depends. And there's not to say that one really is superior in the market. I've seen successful traders of both types.
Yeah. So let me throw this back to you, Zach. What beliefs did you have, and what expectations did you have about trading before getting started?
Oh my God, I'm thinking back to, all right, this is really embarrassing, guys. I used to chart like channels on Google Finance charts. I remember I'd be in class and I'd pull up a ticker on like Google Finance. This is back in like 2007, 2008. And this is before I had Thinkorswim even. And I thought it was going to be so easy as to define two trend lines and just buy every time it hits that lower trend line and sell at the peak. Like I was measuring out how much money I was going to be making if I was trading 2 or 3 or 500 shares. Like I was counting my money. Like I had planned to make this with absolutely, no deviation, no wrinkle in the fabric. And you start trading live, and you say, well, what do you mean I didn't get filled? Wait, what do you mean commissions are? Oh, what do you mean I just clicked that button too many times and now I have to pay extra commission? It's just you start appreciating more of the friction. The loss to entropy, just the kind of the energy loss, and therefore profitability loss in trading that you don't account for. You think it's going to be so easy, as you say. I remember thinking that the markets were going to be stable. You have to remember, I learned about the markets in 2007 when things were going perfectly fine. There was just the first inklings of some systemic crisis. What does that mean? Systemic? You mean it hurts the whole system? How could the banks be interwoven? Nobody knew what subprime was, credit default swaps, etc. All these derivatives. I think the markets kind of were a fierce reality check for everyone around that time, that they are violent, that they are uncaring. They're like nature. They'll burn you or freeze you or blow you off a cliff, and they don't care because you're just another animal on this planet. This goes back to that idea of like elemental. When you're dealing with the elements, they can be friendly, they can be quite indifferent, quite scary, and we have to have respect for them. I guess I kind of had that arrogance of, we as humans will control the elements around us. Man versus nature. What if it's man versus financial markets nature? Oftentimes in trading, it's not you versus them, it's you versus you. That's a concept I know a lot of people have said before, but that's what makes for such an evenly matched battle. That's why trading is so hard. You are always fighting your next limitation. You are always struggling to take the leap to the next lily pad, the next stepping stone, without being able to see it sometimes. There's a great quote, sometimes you just have to take the leap and build your wings on the way down. And of course, that's a very ominous quote if you're not building your wings. That goes back to the two universes. If you're working in that first universe where you're working hard to be a great trader, you're pretty confident, I'm going to sprout wings any minute now. If you're not, you don't have much faith. You're just sort of biding your time until you hit the ground. And that kind of grim reality, of course, no trader wants to hear. This goes back to why trading education is such a marketing-driven kind of industry. People want to be enticed. They want to be encouraged. They want to be uplifted. They don't want the reality check. They don't want the kind of the grim information about risk management. They want the sexy. They want the exciting. And there's definitely something to be said for being engaging, being entertaining, and relatable. But there's also something to be said for teaching people survival skills. You know what I mean? It's like being a survival instructor and trying to just show people, I don't know, pictures of hot girls in outdoor clothes, or I don't know, hunting clothes or whatever. It's not going to do them very much good when they're freezing to death and they forgot how to build a shelter.
I think this might be a good time to say a quote. How's that go?
Yeah, absolutely. Everything that we've been taught up until this point has been to make us feel better than it could ever make us trade. We're given all these tools that make us feel important and on the pulse of the market. It's almost like we're in our own Fidelity commercial of aren't you a modern trader on top of, the fast-moving financial markets? Well, you and your analytics is this cheesy kind of get psyched, Mr. Trader, because you're going to be powerful one day. Truth is, it's like the little speak and say stroller you give to a toddler to make them feel like they're interacting with the world around them, and really it's just keeping them busy. It's the same thing with our indicators, our crappy little beginner technical analysis. It's unfair because I think there are people who are really putting in hard work, trying to learn the more, like you're saying, some people thrive on complexity or they seek it out. Those who are looking for the more sophisticated pieces of technical analysis, they deserve access to it. Quick little plug. That's why I'm so adamant about teaching the institutional trading strategy of volume weighted average price at thevweb.com. I'm just kidding. No, it's so important that traders realize what we're given is to occupy us, to kind of I don't want to say waylay us, but to kind of hold us back, to just to to occupy us, I think is the best way to fill our time, to pass the time, to bide our time. That's really what it is. And it's insulting when you realize that, because we deserve better. We're the same people as, I don't want to say Peter Brandt, because he is such a legend. It's not like all of us are Peter Brandt, but we're all human beings. So is Peter Brandt. What's to say, when he started out, he didn't doubt himself. I bet you if you asked every trader, did you ever doubt yourself? Anybody who tells you that they always believed, they're just straight up lying. I think we talked about this in my first interview, the kind of poisonous self-talk that traders go through when you're really down on yourself. Like, why do you think it cuts right to your core when you know what to say to push your own buttons? It's because you are you. You know your weakness. You know what you're the most ashamed of in your trading. You know what you are so bad at that you don't even want to tell your other trading friends about. You know what you do. You don't have to tell me. You don't have to tell Aaron. You don't have to tell us. That's fine. But admit it to yourself. Start being honest with yourself so that you have more, I want to say like self-credibility, like self-esteem, self-value, worth. So that you start trusting your intuition. So that you say, I'm pretty self-aware of this. Like, I know if I'm going to screw this up. I'm not screwing this up. This is a good trading approach. And it's okay if I go through a drawdown. Because this isn't me. This is the approach that I'm taking. It allows you kind of shield or deflect a bit of the burden, the ego blame that we all put upon ourselves. And if we're not careful, like you were saying, you're not accountable to anyone. Well, you're also not protected or bolstered, kind of emboldened by anyone else. In a normal business, in a partnership, you have partners who are going to say, oh, you're having a bad day? Well, tough shit. We got work to do, buddy. Let's go. And psych you back up. Many traders really don't have that. That's something that a lot of traders who reached out to me from the offering from episode 11 have said, I don't know any other traders. Where am I going to meet them? Right? On a forum online at a meetup group? That's ridiculous. Would traders succeed without a kind of social element? I don't really know. Have you ever, weird thought experiment, right? If you locked a trader in a room, you gave them enough food and water and air, of course, but they had enough time and money, I guess. You got to give them enough of everything, right? But would they be able to really succeed in trading if they had all the trading books, maybe all of Chat with Traders podcasts, if they had everything except for actually connecting with other traders and being held accountable to other traders and seeing how other traders do it? I think it is so instructive to see other traders struggling with the same things. It is cathartic to go through that. Oh my God, thank God I'm not the only guy who gets stopped out at the lows. Or, buys a stock today and it goes nowhere and you forget about it tomorrow. And of course, that's the trend day. People need to see that you are doing something that is perfectly fine. It is right. It is part of the path. And it goes back to that whole trusting of the process that we young guys get to be like, what the fuck are you talking about? Trust the process. We're too young to appreciate any process. We just see the hard work and the struggle, and we're waiting for that process to pay off. I'm checking my hypothetical watch, my Rolex, right? I'm kidding. I don't have a Rolex, but looking at my watch going when is this process going to pay off? When I'm 30 or 35 or 40? It's hard to trust in the process when you're early in the process. You need to connect with other traders who are going through the same thing, maybe a little further along the path. Or instead of looking up the ladder, maybe you should look a little further down the ladder. This is something we're going to be talking about, working with other developing traders who aren't at the same level as you. This goes back to kind of how I got really passionate about trading. I moved from it just being a fun thing to do while I was looking for a job fresh out of college and into something that I could do for the rest of my life. What do they say? If you love what you do, you never work a day in your life.
Yeah, that's a brilliant quote, and I really actually like that experiment you kind of suggested there. I think that'd be really interesting to find out how people would perform in that type of environment.
Who do you want to lock into a room for 6 months? Do you have any traders who you want? We could pick a really annoying trader and just lock him away for 6 months and not have to talk to him. If you volunteer me for this experiment, I'm going to be pissed, Aaron. No, I'm just kidding.
No, I'm thinking some of the Twitter trolls.
Yeah, exactly. We'll just lock them in a room with each other, and yeah,
and they can prove themselves there.
Oh, that's too funny.
So let's change this up a little bit, because we got a lot of questions coming in that listeners want the answer to from you. So I've got a big long list here. We've already over an hour into it. I think this is going to be a long episode. So,
I think so too.
but-
Did you want to? I actually, I'm sorry to interrupt. Do you mind if I get one more question in before we move on to my topic?
Yeah, sure.
You speak with so many of your listeners too, and I gotta applaud you for that. Because, like, look, I thought I talked to a lot of traders. Guys, trust me. You think I have it bad? Aaron. I love that you guys reach out to him. I know Aaron does too. He doesn't want you to stop or anything, but it's great that you get to connect with so many of the people who say, I'm sure, overwhelmingly positive things about the podcast. Are there any like common struggles? This is maybe that cathartic moment of like, show people what everybody experiences, you know?
Yeah, so that's a good question. Some of the things that tend to come up quite often in the emails I receive, which is awesome. I love hearing from all the listeners and that, so keep it up. One of the things that keeps coming up is many people think they're so close to profitability. They think like they're almost there. I don't know that I have the solution for that, but that's definitely a common theme. People think they're very close. They've almost made it. They've almost got consistency, but they don't. Not yet, they don't. Maybe you can expand on that. Like, why do people always think they're so close? Like, are they so close, or is there something missing there?
Yeah, I know what you mean. I don't think people are right. I'm sorry to give you guys the bad news. I don't think you're as close as you think. That doesn't mean you can't get there. That doesn't mean it's unattainable, but it's a lot further than you think. I mean, look at Aaron. We were just talking about this, man. 6 months ago, or whenever, right? We expected we were going to have a working algo by now, but there's a million things that come up. Life gets in the way of your best laid plans, and that's totally fine. I would say if you asked a room of 100 traders if they're good or close to profitability, 99 would tell you yes, and the one who didn't say anything is the profitable trader out of the bunch. You know what I'm saying? The people who are the most vocal are often not the best traders. Sometimes, the quiet, diminutive, tiny voice, just, oh yeah, I'm over here just watching the markets, no big deal. But I understand the wanting to feel, hey, I am this close. I am right there, man. And if it just, if just risk management, if I could just nail down risk management. And it's like, guys, people write books about risk management. People write multiple textbooks about risk management. People's jobs, in some cases, are to be risk managers for a firm. You know what I mean? This is not something you can just master quickly and then you'll become profitable. It's like an engine. It's a million different intricate parts all working together in the right order and the right rhythm. And that's what's really important about when we keep saying, like, find something that fits to your personality. We're saying find something that is moving to the beat of, the song that you are playing, so to speak, right? I mean, you want to play something in rhythm with what you're playing. You don't want it to be a total mismatch that requires you to, let's say, wake up at a totally different, hour of the day, or trade a different style, or trade a different product. Maybe you're not you don't like trading Forex, but you have to trade Forex, for example. I don't want to discourage people. I don't want you to think you're never going to get there. It's just be realistic with yourself about how long this is going to take. Part of this is, and I think here's what you're getting at, managing expectations. If you don't manage your expectations well, you are going to get really upset at yourself. The poisonous self-talk is going to come back. I'm sure, Aaron, you even felt that. Like, you get discouraged sometimes when you say, oh, I should be a lot further along. God, if only I had more time, if I'd spent more time on the code. This isn't your fault. Come on, you know what I mean? Like, it's fine. We're talking about a multi-decade long process, and you have to treat it like something.
Yeah, and I mean, that's something I was going to add, actually, is, interviewing Kunal. He brought this up on episode 20. He said, what is it to spend a couple years now? Just accept it's going to take a couple years. It's going to take a few years. Just really drill down and learn what you can now, because this is something you very well might be doing for the next 30 to 40 years. So I think, that's something worthwhile mentioning onto what you said there.
Yeah, you don't need to be good right now. You have to be good when you have more money, when this is a higher stakes game, when you're highly experienced and you know exactly what to be looking for. That's when you need to be good at trading. You need to keep, like a sponge, absorbing information until it's your time to strike and dump all of that information back into the market. And it's okay if that's not right now. Traders are so adamant about proving to others that they're real. that they're using real money. It's like they're so worried about being considered fake. They got to go prove it with real money. I know this is what you're going to say. They rush into real trading, right?
Yeah, yeah. And I mean, I think it ties in really well as many people also seem to be trading knowing that they don't have an edge, like actually knowing they don't have an edge, or they're very unsure about things.
You got to fake it until you make it. They got to just to get that experience. And that's what everyone says, right? You got to go really experience the markets to learn anything. And it's like, but I don't know what strategy I should be trading. What am I doing? Am I just watching? Yeah.
Yeah. And I mean, they kind of, it's like they almost rush into trading real money because they feel like that's what they should be doing. Even though, everyone knows 90 to 95% of traders fail. I mean, I don't know where that statistic came from, but I'd say it's pretty accurate. I'd lean more towards the 95%, but, it's a game where so many people fail, yet people just like rush into it. And I think that's probably the wrong approach.
When people ask, how can that be if there's a winner and a loser to every trade? Well, of course, traders are not equal size, right? There are some disproportionate traders who are much larger and represent thousands and thousands, many, many percent of the failing traders' accounts, all aggregated, are under the control of the few separate solid traders. That's your goal, is to be a black hole of wealth, to just absorb and kind of attract money wherever there's an opportunity. Because if you're constantly growing in both skill and in account size, who cares when you get there? You're going to get there. You can rest easy in that and kind of act in a risk-appropriate manner, confident that you will arrive eventually.
Totally. So let's roll into some of the questions that listeners contributed that they want you to answer. So I guess probably the first question is, how did you structure your study when you first started out? I think that's a good place to start right at the beginning. So how did you first structure your study when starting out?
Well, you remember what I said about Yoda, right? He didn't begin like Yoda. He probably was just, he wasn't a master when he started out. I didn't really structure my study at all because I didn't know that I needed to structure my study. I was one of those traders who thought they needed to get that real-time market experience. I was trading when I was still in college, just the last semester that I was at Tufts up in Boston. And I mean, I think back to, I spent a lot of time on Tim Knight's website, Slope of Hope. He's awesome. Evil Speculator, another blog that I spent a lot of time on that I think they're still up and running. I really was seeking to connect with other traders, other people. And when I found chat rooms, it was a step closer to real connection. And eventually, I think I really took it to networking and connecting with traders, kind of an individual connection and study via Skype or the telephone or even just email exchange. And I think that's, we were talking about the social aspect of trading before. Networking cannot be overstated. You absolutely must start trying to find other people with whom you can connect, even if it's just other developing traders. I think part of my trading development, really going from an okay trader, an intermediate trader, to a more advanced trader, was counseling other traders with whom I'd interact, almost just as a peer, as a friend, not as a trading coach. I think they saw that I had an aptitude for trading and teaching, and they wanted to learn more about how I was able to pick this up relatively quickly. That encouraged me to kind of evaluate, is this reproducible? Is it replicable? Can I counsel others on it? Can I observe? Am I self-aware enough? Am I aware of, let's say, others? You might recall, I think, from the first episode we did, so episode 11, the Greek axiom, you cannot see that which is in your own knapsack. You can't see the thing you carry on your back. You know what I mean? We all struggle to see our own problems, but it's a lot easier to see the struggles of other traders. And I think, as I was saying to something from a prior question, you don't have to look just up the ladder at who can help you. Sometimes you look further down the ladder to who you can help bring up. That really reaffirms the fundamentals of your own trading game. And that particularly helped me to develop, because it made me ask the question of what are they doing wrong that I also do wrong? And what are they doing right that I could be doing? This kind of goes back to, I think, like when I worked at a recording studio back in college. I always thought it was easier to gain insight from like what not to do from working with amateur artists versus like really professional, seasoned, they kind of like make it look easy guys. I wanted to know how the developing musicians would screw up so that like I could see how other guitarists or other producers or recording engineers would similarly screw up. If the guys I was working with were all just pros, like the best in the business, I'd probably not absorb like even 1% of what the pros were doing. They make it look effortless. The struggle of the amateurs, in a way, was a better learning experience for me than watching a seasoned veteran. I think it's the same way with trading. There's real value in being connected to other developing traders. We were just talking about how it's like cathartic to hear somebody put a voice to the same struggles you thought you were the only person who ever experienced it. You know, it's very humbling also to realize that even the best capitalized and best, backgrounded people, like the people who, let's say, have a quantitative finance degree. Listen, I love you guys out there, but it may or may not help you. There are plenty of people with quant finance degrees who suck as traders. They may be great systems engineers. They may be great analysts. They may be superior mathematicians. They're probably all out there like cursing my name right now. But you know what I'm saying? It's each trader is his own person and needs to be self-aware enough, or needs to know, like we said, your strengths as well as your own weaknesses. So early on, connecting with other traders was such a huge part of me going from being just okay to like, how am I going to be better than this guy? How am I going to be better than the best? How can I, maybe just in a more incremental way, how can I just be a better Zach? I don't need to be Paul Tudor Jones tomorrow. I'm probably not going to be anyway, so why not give up on that dream? It's like the difference between goals and dreams. Dreams are like, one day I'll figure out how to get there. Goals are like, I know how to get there, and all I have to do is X and then Y and then Z. Kind of focusing on the goals for now. You'll get to the dreams. The dreams will come, but they are a series of components. And one of them for me was like connecting with other traders, having a more personal engagement and involvement with the markets. I don't know. It would really kind of freak me out if we had to truly be alone as traders. Not only is it fun, it kind of keeps us, in good spirits, and it keeps it lively, and it's more enjoyable. But I think there's a real educational benefit to it also. Short answer: no structure early on. I was meandering. Like I went through the struggle too. I took 2 and 3 month long breaks from trading, where I really had to ask myself, like, am I cut out for this? Is this the right business for me? Should I be taking my skills and going elsewhere? And this is 2008, 2009. I'm sure a lot of people were questioning themselves at that point in time. It was a weird feeling back then, and I don't even know if I have enough perspective, because that's right when I came into the market. But I just remember the thought of, so I'm 22, I've got a degree from a good school, and the people I'm competing with have 15 to 20 years experience working at Lehman Brothers or Bear Stearns, or one of these firms that has let 150,000 of their employees go, and all of a sudden I'm competing for a job with these guys. I'm outclassed. And that's kind of where I started with trading. I knew it was something I could pick up on relatively quickly. It's something that had always interested me. Why not me? And I think that's where every trader kind of starts. It's almost like, maybe I'm not going to be the guy to win the lottery, but couldn't I learn something about price patterns and markets? It's almost like I may not be smart enough to be the next Chaim Bodek, but I'm smart enough to realize that this can be done a better way. Maybe it's managing your own retirement. Maybe it is just a pure active trading, like a speculative account. Maybe it's your dream is to enact, like we say, like a quantitative system. I talk to a lot of non-traders who say, it's always been my dream. Usually engineers, right? Guys who look at the markets and they say, this can't be that difficult. And of course, I laugh because, you and I know this, like, oh, it's so much more difficult than you possibly can imagine. I think we said that on the first episode that I did with you. It was, everybody thinks trading is like 8 hours of making, $1,000 an hour and doing cocaine off of a stripper. Like in reality, it's 20 hours of like lonely struggle every day in front of a series of computer screens. It's not quite the glamorous profession everyone would like you to believe,
Absolutely. Yeah, I mean, a bunch of really great points in that answer, Zach. That was awesome. Now, something else that comes up quite often. It was funny, like a lot of the questions were quite similar. Like we seemed to be able to group them fairly well. And one of those questions was, what do you do if you're a young trader with limited capital and or limited time? So what are some of the first steps that a new trader should do who has, you know, a lack of resources and time in terms of like time and capital?
You can pay the tuition of the market in either time or money. You got to pay one. If you don't have money, time is your only option. And so I think you have to make a decision about benefiting future you instead of present you. You have to stop thinking about how am I going to learn this really quickly and start making $1,000 a day with my, you know, $2,000 account. And it's just unrealistic. You have to plan for success later. You know, someone I think once told me, it's like, you know, easy achievement is the achievement you can get right now. It's winning in a video game or, you know, betting on a sports match or something like that, right? Hard achievement takes time. That's why it's hard. You do the things that suck, that are difficult, that other people aren't going to do. This goes back to, you know, if you're not working on your edge, someone else is. There are people who will get up at the crack of dawn and work all day later than you know, stay at the office later than you will. The best you can do is to try and catch up to them. I don't mean you got to put in a ton of time. I mean, this is, I think, the freedom that a lot of traders are seeking. They think they're seeking financial freedom. They're looking for flexibility freedom. They're looking for the ability to like be a father, to be a husband, to be a, you know, a friend, to work part-time and trade part-time and not be consumed by this. That's the flexibility, like that's the freedom that we are all aspiring to. And I mean, some people I can understand. It's really just a limitation of capital. Once they have more money, they'll feel more free. They can take more time. Like, okay, great. I think it's about like, if I'm going to be a trader, how am I going to maintain my life? You know, we were joking about like having a personal life. It really is important to have balance in all things. I don't think I traded any better during those 20-hour days and the all-nighter, you know, kind of like trading futures overnight, and then you do a full session of equities, and then you trade another session of futures or equities, and then futures, and then equities. It doesn't make you trade better. It's not like you get paid hourly for being in the market. I mean, this is a common misconception, right? People tell you, oh, you're a trader, you must make money. It's like, yeah, nobody pays me. I make money if I'm good. I don't get paid for showing up. You know what I mean? That's why you see a lot of guys with no edge just sort of gambling. They're trading for the present. You know, if they win, hey, right? And if not, oh, well. This is as good as it's going to get for them. It's like if a coin flip, if 50-50 was the best the odds would ever be for you, once the odds became 50-50, you'd be like, all right, let's do it. Let's go. This is no better than, you know, no worse than any other shot. For those of us who aspire to have longevity in our careers, we have to figure out how to survive to trade the next day. It's not about making money today. It's about making it to the next day. You know, we as humans, you remember what you're saying, like, you know, it's like, I've been doing this long enough, I'd be embarrassed if I were bad at it. You know, it's like, I feel like you acquire through osmosis, if nothing else, as you last longer and longer in trading, more and more things. There aren't the kind of epiphanies, the eureka moments, the breakthroughs as there are early on in trading. But that's because you're more experienced, right? It's a more nuanced lesson that you may be learning. Maybe it's more of a lesson about yourself rather than a realization of like, oh, so you mean when I go short, I'm betting on the downside? Oh, you know, it's like those kind of initial awakenings you have when you're a trader and you go, I get it. So you can bet on both directions in the market. Huh, how about that? You know, it's not, you're not going to have those massive awakenings later in your trading career, but you are going to continue to develop to the point that if you make it a year in trading, I mean, like, people should respect not the, you know, 20-something-year-old fund managers, the hot hands. You should respect the guys who have been in this business for 40 or 50 years. Longevity is what's to be respected. And you know I'm serious because I'm a 29-year-old hotshot trying to convince you that, you know, I'm the one to be listened to. Now, I really have tremendous respect for people who have transitioned across multiple market shocks, multiple market regimes, different bull and bear cycles, different presidents, different, you know, just different regimes. It's just incredible when you think about how much they've seen. It's like when you look at a 300-year-old tree and you're like, oh, the stories that tree must be able to tell. Can you imagine a trader who's been in the market for 50 years? I think they'd tell you that everything we're seeing today, it's happened before and it will happen again. Actually, this goes back to the earlier question about structuring your study when you start out. Reading Reminiscences of a Stock Operator, the kind of semi-fictional account of Jesse Livermore, that really struck me because it made me realize like everything that I'm experiencing, this guy experienced 100 years ago with none of the technology. And he put, great phrasing, very eloquent, elegant way of saying, some of the things that we are still experiencing, that we traders are still struggling with. So the best way is through experience. And that experience, fortunately, can be approximated with simulated trading. Like anybody who tells you that sim trading is entirely useless probably owns or works at a brokerage firm. They want you to trade because they get paid by your commissions. And so, of course, they're going to call bullshit on sim trading. I mean, look, it's obvious that it lacks the gravitas of real money. I mean, I think that should be obvious if you're just now realizing that like simulated trading probably doesn't have the same emotional impact. Maybe trading's not for you. But like, I've seen students get emotional about sim trading before during a session. Like, then again, I've seen people lose their minds over way stupider stuff than just, the market and simulated trading. You can accrue the experience of technical analysis, of risk management, of juggling multiple trades at the same time. You can get a lot of this experience without risking any money, but you do have to commit time. If you don't want to commit time, go ahead, put $50,000 into an account, start trading. You will learn a lot of lessons, and they will be expensive lessons, my friend. It's almost like the difference between at a university, they allow you to audit a course where you can literally just attend. You don't get credit for the course necessarily, but you still get the information, you get the experience. Right now, when you're not a trader, when you're an aspiring trader or an early stage developing trader, give up on getting credit for the course. You just got to go sit in and see if this is all gibberish to you or if it's something that really resonates. What if you found that trading's not for you? Thank goodness you didn't put real money down. And what if you found that trading really is for you? Oh my God, then that's awesome. I mean, you figured out that you're really good at something that can make you thousands of dollars. Either outcome is going to be a positive. So,
yeah, and I'd just like to add on to that. I mean, like, I don't think that having a lack of capital is, I don't think that really holds any water. Like, I think that shouldn't act as a barrier, and it shouldn't stop you getting into trading because you have so much to learn before you should even consider putting some real money on the line that, having a lack of capital right now should be maybe one of the least of your worries when first getting into trading.
A common thing I hear is, Zach, if I just had $1 million, then I would trade so much better. I'd have enough money to trade a bunch of positions at the same time. I wouldn't be limited in my sizing. I could scale in, scale out. I could blah, blah, blah. You know what I say is no, you'd be the same crappy trader that you are now. You just have $1 million. You have more money, right? You wouldn't like become a different person because you're well capitalized. You got to respect that like learning to trade with 100 shares or 100,000 shares with some obvious differences, impact on the market, execution, approach, and strategy, right? But like, you're making the same essential decision. Is this market likely to go higher? If so, then I need to find a way of getting involved in a risk-appropriate fashion. There is no excuse anymore. If this were 20 years ago where there wasn't, simulated trading technology, I want to say like market replay, I want to say backtest broker. Thinkorswim has a great feature on demand. I use this with my students all the time. Once they've learned the VWAP trading methodology, we can like replay a trading day in like fast forward. So we can fit a couple trading days into one session, kind of like sit side by side and like tag team the market. We can watch the same simulated day at the same speed, kind of in lockstep. It is incredible the opportunities that this has afforded people. I have traders in different parts of the world or who are working during market hours, and so they would never otherwise be able to trade a real account or even a simulated account. Something like on demand is awesome because they can trade in the middle of the night. They can trade, in their spare time whenever it's convenient for them. I think that's a great way of saying it, Aaron. There is no excuse anymore.
Yeah, absolutely. I mean, I obviously fully agree with that. So, in your journey to becoming a profitable trader, would you say that you attribute your success to a few moments and milestones, or was it something gradual and rather the accumulation of many small victories?
I mean, I definitely had the moments. I definitely had the milestones. Um, I think it's like a series of important firsts would be a good way of phrasing it, like your first $1,000 day. And not that, I mean, look, it's more about percentage than dollar, but like everybody dreams of making $1,000 in a day, right? I mean, every trader listening to this podcast has thought about like, oh man, wouldn't that be a cool like level to break? My first week with 5 profitable days, I felt really good after that. Like your first successful short trade, your first, you know what I mean? There are also negative milestones. First time you've been stuck in a halted company. First time you've filled like way below the market due to illiquidity. Like, you've been stopped out and you get at the worst price of the entire day. And you're like, you lost $600 in the blink of an eye just because of a market stop. First time you stay up all night reading Seeking Alpha because you're stuck in a shitty position and you're terrified. Believe me, you have not been a trader until you have freaked out up all night trying to read what other idiots who are stuck in the position are doing and thinking. And when you're just desperate, you are voracious for knowledge. I mean, this brings me back to like the earlier answer about being on the blogs and in the chat rooms, and like, God, that takes me back. That feeling of like not knowing what the outcome is. And I think this is the difference between like having a system and not having a system. You still won't know the outcome, but you'll know what outcomes you're choosing between, or you're going to, which 2 outcomes may occur. You'll know what a win looks like, and you'll know what a loss looks like, as opposed to when you don't have a system or an approach, you're terrified. I mean, you could wake up the next day and the stock just drops. And what do you do? Where's your stop? What's your plan? What's your thesis? And I had none of that early on. So I mean, I think about those milestones, those kind of moments that stick out. The gradual stuff, look, you eventually have to get fed up with it. Okay, here we go. It's sort of like when you grow up with your nutrition. You kind of turn into an adult and say, all right, I gotta have some vegetables. Like I've eaten nothing but Pringles and soda for the last 20 years of my life. It's time to maybe give my body something better. You get more mature about what you put in to your to your trading brain. Are you reading the same annoying guys on Twitter who you just think are funny? They may not be very insightful, but whatever. Are you listening to the same market recap just because that's what you've always listened to? Okay, I don't know this guy, so I'm gonna talk a little shit. Oscar, what's his name? Oscar Carboni. He's a guy who does like market recap videos. I remember watching him back in like 2008, 2009, and it was just like a habit. It was just a thing that I watched because when I started. And I caught myself like a year into trading. I was still watching those videos. They didn't give me any information whatsoever, but it was just habit. It was part of my routine. And it's almost like a bad habit that I had picked up. You need to start asking yourself, what are the bad habits? Who are the useless traders that I talk to, that I commiserate with, just because we're buddies? It doesn't mean you can't talk to them, but stop comparing notes about the next day. They're probably not that useful anyway. Find someone who you really genuinely admire their work ethic. And ask if you can just sit silently with them on Skype and listen to them, go through their prep or something. Be a sponge. You know what I mean? That's what's going to help you with the sort of gradual wins rather than the massive milestone. Like, look, obviously I'm going to say something like, well, when I first found VWAP, that really clicked with me. But even that, it took me a while to really appreciate what I had. I thought it was just another indicator. I'd become so jaded with all of the other indicators and being told, well, all you have to do is use a fast stochastic. That's the key. Or, whatever someone else has told you is going to work and it's just designed to make you feel better. You know what I mean? There will be those break points, those kind of aha moments, the eureka, the epiphany. But they're few and far between. And like I said, they get fewer and fewer as you go on in trading. It's just refining a process and not screwing up the results. Your results should reflect more of your system than your personality. You know what I mean? It's like it should be more about your design, your plotting of the course, rather than, oh well, I grabbed the steering wheel and turned the car at the last minute and I screwed this up. It's like, don't make discretionary mistakes. Make systematic mistakes if you're going to make them. Make something that you can evaluate and then learn from and then change, rather than, oh well, I got nervous at the very last second and then I stopped out. You know what I mean? That's shooting from the hip. That's undisciplined behavior. You may not be a robot, but my God, you can be a more disciplined human. You can be a more mechanical human, let's say, right?
Yeah, I really like that answer. That's excellent. And I also really like this question that someone sent in. I think this is spot on. They say, rather than what did you do to become profitable, what did you stop doing to become profitable? I think it probably leads on from that last question a little bit, but yeah.
So I noticed that losing trades was really negatively impacting my profitability. So just by eliminating losers from my trading record entirely, that no, I'm messing around. Obviously, that's like somebody telling, well, I learned the secret was to buy low, and then this is the key to sell high. Actually, no. Sincere answer. What did I stop doing? I stopped trying to get a better price. I was always that guy who I would see the setup and I would say to myself, just 2 more cents, just 2 more pennies. Cause that's, if I'm trading 300 shares, it's going to be $6. That'll cover commissions or something. I'd rationalize to myself, just a little more, just a little more, just a little more. And that's like, that's poking the bear a little bit. That's like, it's like, pushing someone's buttons. You're messing with them a little bit, but you're just pushing them to see how far they'll go. Eventually, the stock is going to take off and move without you. And you're going to be like, damn it, I missed it, because I was trying to get that, that best price. And same with the exit. The Jesse Livermore quote is, the most expensive eighth is the first eighth and the last eighth. And of course, that's like when stocks were still trading in eighths. So the first tick and the last tick, or the first penny and the last penny. I've seen so many traders ride a terrible position, not off into the sunset, but what's the opposite? Like off into the abyss, directly into the sun, right? They ride it into hell, because they didn't give up on the position when it came back to break even. They said, well, what about 5 cents above break even? That'll cover commissions. And it's almost like penny wise, pound foolish, right? That's a common mistake. When you see a setup, your job is to get in the trade in a risk-appropriate fashion. It doesn't mean, just buy it willy-nilly, sort of like wherever. But it definitely means be more humble about being perfect. You're not going to be perfect. You're not. No offense, but you're listening to a podcast with other traders talking about how to be perfect. You are not perfect. You, listener of the podcast right now, probably not perfect. Truth be told, Aaron and I also very much not perfect. I think you guys have realized that by now. But giving up on perfection. This kind of goes back to like what I said in the ebook, right? Stop trying to prove it to your girlfriend, to your family, to your trader friends that you're an awesome trader. Just dissociate from the identity of being a trader. Give up on proving to others or bragging about it, or it's all fluff. It's just the fluff that we fill ourselves up with before we make the leap to the more nutritious, kind of substantive meals for our trading brain, right? Here's another one. I mean, this applies to what you're doing with coding and quantitative trading. I stopped expecting one system to encompass the entire market. So early on, this particularly in my trading career, my coding career within trading, I was trying to make one system to rule them all, like one system to fit all. And I realize now that markets that are going through different regimes are like different weather. You've got to dress differently. Yeah, it's all outdoors, but it's cold outdoors or sunny outdoors or windy outdoors or rainy outdoors. They're very different styles of just going outdoors. It's not quite that simple. It's not so simple to be able to say, well, I'll code something to reflect every different outcome within the market. There are too many different permutations. The best you can do is build, think about like building a trap. You can't build one trap to catch every animal out there that you're trying to trap. You have to build different traps for squirrels or for a fox or for a, I don't know, a wild hog, or I don't know, what are other people trap? I'm not much of a hunter, but you know what I'm saying, right? You have to build different traps for the different creature you're trying to pursue. Similarly, for different setups, there's a totally different system. And how nice and flexible it is. It's like giving, instead of one single system, one equation to fit them all, you kind of let the system flex to, encompass the entirety of the market. The up days, the down days, the sideways days, the up days that become down days, the up days that become sideways days, and vice versa, and every permutation of that. No one system is gonna kill them all. And I'll tell you, if you do come up with that system, the one system that works for everything, please give me a call. I'll leave my email address at the end because I'll buy it from you. I'm kidding, of course. It's the holy grail. Yeah. I mean that is a really great question because it talks about not just what is the secret to trading, but what do traders do thinking that they're doing it right. It's like driving through a skid in a car. Sometimes you're oversteering, you're overcorrecting. It's like you're doing too much. I often teach people, like, when you get in a good trend trade, your job is to go into a coma. Is to forget that you're in that trade. If you're in a trend, think about it. Literally, it's probably moving in your favor. Check back in on it. Wake up every now and then. But, you can kind of forget that you have to watch it like a hawk. You don't need to be so intent on every candle matters. Not every candle is created equally. Not every candle matters. And therefore, you kind of need to be an overseer of different systems, of different setups, of different price patterns. You have to be a manager of trades, not a trader. I know that sounds weird. I mean, that's okay. There we go. Another title for my book, right? Don't Be a Trader by Zach Hurwitz. You know what I mean? Wouldn't that be a great name for a book about trading? Don't be a trader. Anyway, all right. Sorry, long-winded answer.
No, that's awesome. That's really good. So this one here is kind of like a two-part question, I guess. So when is the right time to seek out a mentor or some sort of education? And how does one go about selecting a mentor from all the folks out there offering their services? Like, how can they drill down on one that's right for them?
That's a good question. Trying to think of when's the definition point of when you plateau. That's a good open-ended answer. When you reach a point of absence of development, where you're not getting worse, but you're just not getting better. That's usually when people seek out trading education. Whenever there's and there are multiple plateaus throughout the trading kind of trajectory, if you will. When you go from an aspiring trader to a novice trader, then you kind of flatline for a while, start making some breakthroughs, really get into where you're being realistic about risk management and having to be disciplined and consistent. Then you become an intermediate trader. Then you plateau for another couple months or a year. At each break point, that's usually when people will want to say, even if I can't get there right now, what do I need to be doing to get closer or, headed more in that direction? I honestly, something I see a lot, and I've kept abreast of a lot of the sort of trading education out there for obvious reasons, as I'm a trading educator myself. You want to find somebody who's a good trader, but you really want to find somebody who's a great teacher. And everybody's focused on finding a good trader. They can be a millionaire and the worst communicator. They could be totally unrelatable. They could be kind of a dick. It doesn't help you, right? Seeing excellence is not as helpful as you think. You remember what I was saying about working in a recording studio? The pros make it look easy. You watch Jimi Hendrix play a solo and it just looks like what he is born to do. You watch some idiot try and half-ass their way through, a Jimi Hendrix solo. You're going to see, oh, wow, look, he's not tuned correctly. He bent that note, a couple cents off the right note. I can see here. You can see so much more from... I don't know how else to say it, from somebody who is ready to be a good communicator and connect, I guess, what the elements of good trading are, rather than just, hey, watch me do it. I can show you. It's not always that simple. They have to be the right type of teacher, not just the right type of trader. I think for a lot of these guys, no names, right? But they're just marketers. They're entertainers. I think for them, teaching is a chore. You obviously want to find somebody who, I don't want to say is going to put up with you, but who it's not a chore for them. You want to find somebody who's really all about teaching traders, and is going to be understanding with wherever you are as a trader. They're not going to be frustrated that you're not moving faster, or that you are moving quickly. Some people will say, "Oh, but you got to go through my entire course offering." It's like, well, but what if I'm picking up on it more quickly, dude? I don't need that much education. You want to find somebody who's going to fit to your speed. I mean, the same way that we talk about finding a trading style that fits to your personality. You know, I think it reaffirms the foundation of my own trading and system, and it challenges me to reproduce it. Like that's what I like about being kind of a mentor or an educator. I think when it comes down to it, you should be treated as an intelligent trader who wants to improve, not like a radio receiver for their marketing campaign. That is a huge distinction. And I only say that because there are so many people who are just marketers. On the flip side of that, I love it when you can see somebody who is so genuine and psyched about talking about trading. Like you mentioned Dan Shapiro. He's awesome. I know him from my Seglushi days. He immediately comes to mind. You can just tell that guy like eats, breathes, like sleeps and shits trading. You know what I mean? Yeah. As far as selecting someone from everyone who's out there, look for somebody who's also willing to, take a little bit of time listening to you, because it's really not about you having to pick up on everything. It's about the mentor finding, what's the recipe for success for you. Whether it's deductive or inductive learner, whether it's visual or experiential, or auditory, right? You like listening to people talk about it. Different styles of learning. I wish I had been an English teacher for a couple of years. I think it would have made me an even better coach. But just, learning about the different styles of student that you're going to get. You want to find a coach who's going to pay attention to that. I think it's also worth saying, just so people know I'm not talking my own book. Guys, there are thousands of great trading educators out there. There are a lot of people who aren't actual trading coaches, but who are going to be great trading allies. There are people out there, probably some great unknowns that I hope Aaron's going to have on between, episode 50 and 75 or 50 and 100, who you'll probably hear from. Find somebody who resonates with you, who when you hear someone talk, you say, I could listen to that guy talk about this for hours. And obviously, I guess we're like almost 2 hours into the podcast. If you're bored with us talking right now, then don't seek us out for education. No, I'm just messing around. But find somebody who you feel like you could hang out with, who you could talk with. Somebody who is both entertaining and relatable. Certainly that's important, but a really good teacher and a good communicator.
Yeah, well said, Zach. Emotions is a big one, right? So we hear it all the time. Do you really feel almost no emotion with a systems-based approach? I mean, this is kind of maybe a common myth that some people might have the wrong perception on. I mean, even with a strategy to trade, you must get frustrated at times, right? Would you be able to expand on this a little bit?
Oh, man. Yeah, I still get frustrated. I still get frustrated a lot. And those of you who know me know that I like to preach this kind of easygoing, even-keeled attitude. Look, everybody's going to get pissed. You're going to get frustrated that you're emphasizing the wrong system on the wrong type of day. So even the system's doing all the work for trading and identifying the trades and managing them, but you're emphasizing or paying more attention to the wrong type of system. There are days that I'm very upset at myself. But okay, you can't eliminate risk. You can minimize it. You can't eliminate fear. You can manage it. That way you're going to have strategic regrets. You're not going to have tactical regrets. This is the whole, I'd rather run aground because I charted the course incorrectly than because I tried to steer the ship or the car or whatever, on a whim. That makes me feel dumb when I try and act on my trading plan and actively screw it up. That's when I beat myself up. That's when the poisonous self-talk. That's when the bile and the poison Zach comes back out. All systems lose money. Great systems lose less. So think about that. All systems are going to have terrible days. They're going to make 10 losing trades in a row. You're going to doubt yourself. You're going to doubt that you were ever a good trader. You're going to doubt that the data is right. Oh my God, you're going to doubt everything. And then you're going to get over it. You're going to get over the doubt and disillusionment and disbelief and frustration. And I think I read somewhere about like, eventually you're going to get over all this bullshit and it's going to be worth it. And that really stuck with me. It's true. You're going to find little things that you say, I may not be a genius, but I know what a bull flag looks like, and this is a bull flag. And then it breaks outward and upward of the bull flag, and you're long, and you're saying, hey, I may not be the best, but I'm learning. I'm getting better. You got to take the small victories and remind yourself for every time, like I say this all the time, it's almost like if you take the cow, you deserve the milk. So that's like the old phrase, if you want the milk, you got to take the cow. Like if you want the upside, you got to take the downside. If you are going to hold yourself accountable for all the failures, you deserve a little bit of the patting yourself on the back when you do it right. Like this isn't all luck when you do it right, and it's all your fault when you do it wrong. So I try and remind myself, what's one thing that I've done right today? What's a good trade what's a good read that I had? Where did I dodge a really shitty trade? Actually, it's really funny. So we talk about how like trading and life work together. This is a good strategy for a fight. If you're fighting with your girlfriend or your significant other, just say, honey, just say one nice thing about me. I'm going to say one nice thing about you. Let's just remind ourselves that we actually like each other. You know what I mean? Like when you're deep in a fight. Similarly, you got to you're not accountable to anyone else in trading. You have to be both your supervisor. You have to bear down on yourself, and you have to indulge and kind of remind yourself you're a good person, you're a good trader, and you're going to make it. You have to be both the superego and the id, as I think I've said in prior interviews. If it's a trading plan that you don't have to trust yourself to follow because it's a system, like there is no alternative, that's a trading plan that I could follow. Like, remember that I'm a human being. I'm going to have days where I want to click the mouse more than the system says I should. There are days where I'm going to get nervous and want to stop out of a trade. One of my trader friends runs a stopless reversionary system, and he's like, oh man, was that a wake-up call? Some days where I'm looking at these trades and they are just crushing me, but I realize this is a statistically profitable event, and it may not work this time, but it's part of my plan. I'm trading small enough risk to where even if this totally botches me, it totally screws me, I'm still a small loss. I can afford to take this loss because it's within my plan. Losses that are outside of my plan, like that's when I start, that's what tilts me so hard, when I make mistakes that are outside of my plan, right? If I can have losing trades, that's not a mistake. A mistake is when I deviate from the path.
Okay, sure. That's excellent. Now, Zach, we had a few questions that came in around scanning. I know we've still got a bit to get through, so I'm going to try and merge these together. How do you go about finding setups that meet your criteria? What tools do you use, and what tools are helpful for you? And are there certain filters that you find are really good at narrowing down a long list of stocks?
Yeah, well, there's quite a few products that you can use. The products that I have used in the past. So I've used my brokerage platform, Thinkorswim, but almost every brokerage has some sort of good basic scanning or filtering feature. Finviz.com, Finviz.com. I'm sure everybody knows about that. There is like the third-party alerts program that I use. Anybody who's more interested in hearing about that, obviously shoot me an email, tradingcoachz@gmail. Happy to tell you more about that. When it comes down to like what filters or what do you use, you got to make it more general. I don't think there's like any one set of filters. It's not like you can look for a certain grouping of stocks and that's the grouping you should be looking for. It's different, obviously, for every trading style. If you think generically about scanning, I always pare it down into like there's 3 layers to scanning. There's like universals. These are things that are true at the very beginning of the trading day. Like it's a U.S. domestic stock. It's closing over $10 a share. It's got 1 million shares on average over the last 20 days. I'm just making this up, but these are like universals, things that are universally true that make up the realm of potential, candidates for you. Then there's conditions, which is the next, nuanced layer, which is sort of things that must already be true but can change throughout the day. It's, let's say, above a VWAP. Its RSI is below 20. I'm making these up. Just conditions, things that must already be true. And then finally, there's triggers, elements about the setup that when they hit, like that's when you want to know about the trade. That's the shortest term, the most responsive aspect of all three. So universals, conditions, and triggers. And you start realizing like what sophistication with which you're scanning the market based on, am I doing more universals? Because if I am, I'm probably on finviz.com. I'm probably doing like a daily level filter for, what meets my broad criteria. If I'm doing conditions, I'm trying to, filter down even further from the 1,000 stocks I could trade into maybe the 100 stocks that I might want to trade today. And then triggers, which is what I'm using, record for me the exact moment that all of my criteria were met. And if I were a perfect robot, I would have taken this trade. That's when it gets into like triggers. What is the actual event? What is the aspect, the facet that changes ever so slightly? And that's the trigger to get into the trade. I know a lot of like people are going to want me to give some like actual answer to this. Some common ones that I hear in terms of filters that I would agree with. So things that I either use or other traders I know use. Average volume versus current volume. So you can think of this like volume normalized or relative volume or like a volume multiple. I've heard all of these phrases before. What is today's volume versus the average historical? Because you can quickly get a sense like, wait, we're trading 3 times the average day's volume and it's like 11 o'clock in the morning. Oh my God, that's a heavily traded stock for the day. Kind of gives you an idea of where participation is surging. I personally track things like standard deviation width, just because that to me is a measurement of like relative opportunity, how much width there is on a chart for me to capture. And for every chart, every trader, it's going to be different on every chart. Some traders watch average true range, ADX, a measure of kind of trendingness of a stock, the average directional index. These are just the kind of common ones that I've seen across many different traders that seem to be helpful. None of these are the triggers. These are more like conditions or universals. Triggers are obviously up to each trader to decide where am I on that spectrum of like responsive or credible. Am I trying to be more responsive where I get a lot of signals, but a lot of the signals are kind of crappy? Or am I willing to wait for a confirmation? I'm going to be patient. I'm going to get a worse price than the responsive guy, but I'm going to make absolutely sure that I'm getting, a confirmed signal. There are trade-offs to each one, of course, and there's no right answer, but I hate to say that. I wish there was a right answer. It's like, oh yeah, you just got to pick a responsive. Just don't worry about being credible. Just get a bunch of signals. You're going to be fine.
Yeah, well, I really liked how you explained those 3 layers. I think that's really helpful in terms of how to think about approaching the scanning process. I think universals, conditions, triggers, I think that's spot on. That's really good.
And if there's anybody, I know I'm doing a dangerous thing. I already did one dangerous thing in this podcast, telling 10,000 people that I used to listen to Creed. But if you have questions about the scanning process, if you're curious about how to scan better, how to do better, what I use, anything more about this, sincerely, shoot me an email, right? This is what I'm here for. This is what other traders are here for. I'm eager to talk to people who are going through this, especially if you can write it out in bullet points. It's almost like there's an old traderism of, if you can write it logically, then it can be coded. If it can be coded, it can be back-tested. If it can be back-tested, it can be vetted. And if it's vetted, then my God, you've got a good system. Go trade that with confidence. And if not, if it's crap, well, thank goodness, you've just dodged a bullet, right? You were almost trading this really crappy system. So start with that logical outlining. Write it in plain English. I really mean this. In the emails that I'm going to be getting, I really hope there's a lot of bullet points and bonus points, extra credit for you guys if you use universals, conditions, and triggers. Because I think it's a good way of organizing sort of like, where do I stand? Am I doing like zoomed out filtering, or am I doing really microscopic zoomed in analysis and searching?
Okay, excellent. Now, there's obviously a bunch of questions we received around VWAP. Okay, people know you as the VWAP guy.
What's VWAP? I'm not familiar with that, Aaron.
Well, let's tackle that. So for anyone who might have maybe forgotten or isn't really familiar with VWAP, let's just give us a quick overview of how you incorporate VWAP into your trading.
All right, this is going to be a challenge, right? For anybody who knows me, you know how talkative I am. I'm sure you can tell on this podcast already, so I'll try and be swift. VWAP is a more accurate, honest average price. It's a benchmark line that institutional traders have used for decades. It moves proportionally more or less to reflect the current bar's volume as a function of the day's total volume. So like simply put, if there's high volume, there's more impact on the average. If there's low volume, there's very little impact on the average. It starts every day at the beginning of the market. It resets at market close. So it's giving you a day's cumulative average price. There's no periodicity to it. VWAP kind of reflects the democracy of the market more accurately, I like to say. It's like one vote per share, not one vote per trader. So there's a lot of, shares maybe to one trader, and therefore that trader gets to vote many more times in this hypothetical democracy. It's like the Animal Farm quote from George Orwell, one of my favorite authors. All animals are created equal, but some animals are more equal than others. It's kind of ridiculous double speak, but seriously, like some traders are more important than others. We kind of have to admit that. And so we more accurately reflect that democracy by affording more significance to the bigger volume bars and therefore to the bigger traders. We all know, we intuitively, we know that the big traders move the market. So why shouldn't we account for that with our technical analysis? And the institutions use it literally every day. And I mean that literally every day to determine where and sort of how aggressively to enter or exit their positions. I think it's about time that retail traders understood the market around us a little bit better. I think VWAP is a first but huge step for many traders that I speak with. I would say you don't need much preparation or nightly research. There's no need to watch the news or read the tape. It's pattern-based. I've made the strategy very visual, color-coded, easy to learn. I think it's all about what are the big traders using to enter or exit a trade. And the answer is often a VWAP-based execution assist algorithm, sometimes called like a guaranteed VWAP order. And that may be a big mouthful, but it's basically, haven't you ever wondered what the institutional traders are watching? Haven't you ever kind of considered that maybe there's something else out there? And that's volume weighted average price. I was lucky enough to have learned about it in my own retail trading career,
Okay, so VWAP's quite commonly used on an intraday time frame. Mm-hmm. Are there variations of the VWAP strategy to account for maybe different markets or different time frames? Could you share with us a little bit more about that?
Yeah, absolutely. I have been a productive, busy little beaver in the coding world. I've created like a dozen custom indicators. I created them not only while I myself was developing my own VWAP approach, but afterwards, as I had more and more students who would request, hey man, could you visualize this for me? Or could you put a label on my charts to tell me when something's happened? So yes, I've created a ton of different sort of variations on VWAP, but I think the philosophy of an intraday VWAP, obviously an intraday market, as I was describing, starts early in the morning, resets at the end of the day. That's the plain vanilla intraday VWAP. Then there's an ongoing, or as I call it, kind of a multi-day VWAP, which is essentially a continuation VWAP over the course of more than one day. It's the same math, but it's applied to 2 days, to 5 days, to 20 days, for example. And this gives us a more intermediate term benchmark. So this is more for swing traders or day traders who are looking at multiple days for context. So I'm a big fan of like a 5-day chart. Tracking these more intermediate term volume weighted average prices give us the same otherwise hidden support and resistance that we look for with a VWAP, but applied to longer and longer time frames. And so people may say like, why, wait a minute, didn't you just tell me that these institutional traders, they care about the intraday VWAP? The key is that the institutional traders are often trading at a much longer time frame than we retail traders. Like we click the mouse and we're in a trade instantaneously or almost instantaneously. If we were trading 1,000 shares or a couple $1 million worth of any given stock, it's going to take us a couple hours to fill. It may even take us multiple days. And so that's where the multi-day VWAP strategy kind of stems from. It also is very intuitive that if something important happens, like a turning point or a tipping point, or what I call like an incident day, we're going to want to know what the definitional line, the average price since a given event. So in the same way we talk about VWAP as being like since the market open, what's the average price? And that's a pretty common question, right? I mean, we all kind of wonder that, what's the average price for the day? But the tools that we had been given is this, periodic moving averages that we had to set. Well, it's 128 bars into the day, and therefore it's 128 bar moving average. That just gets too clunky. And even the plain vanilla VWAP wasn't quite enough. Plain vanilla VWAP and multi-day VWAP. I've created a variety of other indicators, visualizations, and custom watch list columns for Thinkorswim that my traders use. I personally teach 4 trade types for the intraday market, and then multi-day VWAP, which is its own little segment. And that's predominantly for swing traders, like I said, but also for intraday traders who are looking for longer-term support or resistance.
Do you find that VWAP becomes less effective the more you zoom out on a time frame, or does it sort of serve a different purpose? Like you mentioned there, intraday is obviously for day traders, and then the multi-days are more aimed at swing traders or those looking for stronger points of support and resistance. Is it still effective, using a multi-day VWAP? Is that also just as effective or almost as effective as an intraday VWAP?
Sure. So, I mean, categorically, you're going to, just by the nature of the way a VWAP is calculated, as you add more and more volume into the total volume part of the comparison, because you remember a VWAP compares the current bar's volume to the total cumulative since inception. As you get 2, 3, 5, whatever days away from the inception of the VWAP, you're dealing with a larger and larger and larger accumulation of total volume. And so each bar that gets added to the calculation impacts it proportionately less. So sort of like human beings, as we get older, we slow down a little bit. Similarly, we're going to get further and further away from the VWAP the longer of a time frame over which we assess the VWAP. And that's just the nature of the calculation. It is going to get less responsive the longer and longer we take a VWAP over, right? But that's kind of how it should react when you think about it. We're asking for an accumulation of more and more market data. We're trying to encompass uptrends and downtrends, and maybe even if we stretch out to a longer time frame, bull markets and bear markets and totally different regimes. It's really going to be a challenge for a cumulative average price to fit very closely to the market. And so when you zoom out to a longer time frame, that definitely makes a case for other moving averages. But what I've found is when you're looking particularly in that, I call it the sweet spot between 1 and 5 days, you're dealing with intraday traders or short-term swing traders or people who are trying to execute a trade over the course of, let's say, 2, 3, or 5 days. These, let's say, a large hedge fund or a mutual fund, that they can't trade their entirety of their position in one day. You talk to these guys who are managing $20-some billion. They don't make a decision on a whim, right? I mean, they have to go to the investment committee, and then it gets approved and heads back to the execution team, who's actually going to enact the order over the course of the next couple days. Watching a multi-day VWAP has been one of the bigger breakthroughs I've personally had in my own VWAP education, thinking that it was solely intraday, and then kind of realizing, well, it's a natural extension, pun intended, to extend it on into the next day.
Okay, sure. So what markets is it most effective in? Does it work in options markets? What about Forex, futures, or, you obviously use it in equities predominantly. Sure. Is it just as effective in other markets, or can it even be applied to other markets?
Yeah, so without sounding like a blanket, oh my God, of course, it applies to absolutely everything under the sun. It applies best to equities, best to liquid, large cap, algorithmically controlled equities. I hate to say this, it does not work on that $3 little biotech stock. I should say it doesn't work as well. It probably still applies, but the less granularity you have, so the smaller the price of a stock, the harder it is to really see the type of action that we're looking for on a VWAP. You want to see something that is fluid and mobile and very liquid, and something that other VWAP algos are probably acting on this stock. It definitely applies to futures. I've coached quite a few futures traders in the last 2 months, particularly. It seems like the futures traders came out of the woodwork. Forex, without a centralized volume number, and there is no centralized Forex volume, we can't get a VWAP of like Euro USD, like the pure pair, but we can approximate it by looking at, so for all you Thinkorswim users, /6E would be the Euro futures code. You can use volume weighted average price on the futures proxy, if you will, for the underlying. So you can do that obviously with all the major currencies as they relate to the dollar. So that's kind of a workaround in the meantime. I used to say that this only worked on large cap equities. I realized that, KBIO, among many other, recent sort of momentum names, have shown me that it's really VWAP works best wherever there's other traders trying to execute orders. And that sounds like pretty much every stock under the sun. So I hate to give a bold, generic, all-encompassing kind of answer like that. I'd be cautious with Forex just because the lack of centralized volume, and you're dealing with a proxy. You're dealing with another contract that's supposed to reflect or relate somewhat of the volume, but it can't really show you the actual volume. As far as options go, because you asked about that too, let me answer that 2 ways. Like, yes, you can chart an option with VWAP, and that's actually something a couple of my students have pointed out to me. They said, I threw an option chart up there, and did you notice some of the same trade types that you taught me are applying here on the option? And that's not obviously rocket science. If they are tied to the underlying, which is the price chart of the stock, and the stock is exhibiting some sort of pattern, option's probably going to reflect that as well. But similarly, yes, the VWAP strategy can be used with carefully chosen strikes and risk tolerances. You just got to be careful you're not going to get destroyed by the Greeks because you're trading a totally technical approach, oblivious to the to the components of the options pricing model. So in that case, you couldn't blame anyone but yourself. You're trading a product designed for risk insurance, like it's a leveraged little vehicle for your trading purposes. It's like using the wrong end of your spoon to eat your cereal. Like, you shouldn't be surprised if that sucks. You're not using it for the way it was designed. You know what I mean? You can't hold the inventor of the spoon accountable if you misuse it. So I'm cautious with options. But yes, it can be done. And certainly anywhere where the underlying, the actual equity, is moving quite clearly according to a VWAP, absolutely. That's where there's no reason not to take that additional leverage, particularly if you are a skilled options trader and you're good at selecting the right strike. Right. Okay. Yeah. No, that's great. A few people have asked, what are some good VWAP resources? I mean, they're pretty few and far between from what I've seen online, but maybe you could share some insight on that. Okay, look, I have to plug my own website here because it's literally thevwap.com. I feel like that's a fairly safe bet. If you want to go learn about the VWAP, you might want to check that out. I thought about zachhurwitz.com, but I don't think my name is yet synonymous with VWAP. I'm working on it. Everything else that's out there is literally a quick Google away. So I can't say, oh, you should just check out so-and-so's blog. They've got everything on there. What I've seen on YouTube is literally laughably weak. And I'm even thinking about some of the interviews I've done in the past. I need to, you know what? Okay, how about that? I've got to change that. That's my trader resolution for 2016. My job is to put everyone else talking about VWAP to shame. I got to put so much content out there so that this question never gets asked again. And I say that in obviously a very positive way. I'm not upset. People are frustrated that there's not better resources for the VWAP. I think everyone will tell you the basics. No one will tell you the nuance, it seems. And that's what I'm trying to change. I mean, I've spent 4.5, 5 years of my life doing nothing but this. I've become a very boring person and an expert trader in this regard. I've sacrificed many hours of being cool in order to be good, because I realize that this is what's going to define me for the next several decades. This is how I'm going to make a name for myself.
Yeah, well, I mean, I think if you can put some more quality resources out there on VWAP, I think many would really appreciate that, and obviously would have somewhere to go to find out more about it, because like I mentioned, it is pretty scarce.
No, you're absolutely right. What I should say, so on the first podcast, on episode 11, first podcast in which I appeared, excuse me, I made the offer of anybody who wants to reach out and talk to me about their trading, or more specifically about VWAP, I will give you a free 30, 60-ish minute consult. That still stands, and I'll let that keep going through, let's say, I don't know, like the 1 year anniversary of that podcast, so like mid-March or something of 2016. Anybody who's still curious about this stuff, like don't go hunting on the internet for it. Just shoot me an email, shoot me a chat. We'll talk about it. I'll answer whatever questions I can for you.
Okay, and what is your email address?
So it's tradingcoachz at Gmail, TradingCoachZ at gmail.com.
All right, good one. Well, awesome offer. I mean, really appreciate it. I'm sure you're going to get a lot of people take you up on that, which is excellent.
Do you remember after that episode, when we were doing the follow-up call, like shortly after we had just like stopped recording, and you were like, do you realize what you've done? Like, do you know what you've just gotten yourself into? Like, I've got thousands of listeners every week, Zach. You're going to be swamped. And I remember being so arrogant as to think, like, oh, come on, like, I'm a nobody. Nobody knows me. Nobody's going to listen to my episode even. Like, I just thought it was cool what you were doing. You and I were kind of buddies early on, and we were like, why not? Well, now here we are. I'm still getting, 10 emails a week or so. But I'm sure it's the same with you. Like, when you hear an email from somebody who's like, oh, I love the podcast. It's really uplifted me and kind of kept me going. Like, that's what keeps you going, isn't it, Aaron? Like, isn't that partially why you're doing this? It's not just selfish about your own trading. It's about seeing what you can do for others.
Yeah, 100%. I mean, I love to hear that it is beneficial to others as well. And I mean, going off the feedback I get, I think it is. So, and plus, I want to make it bigger and better going forward as well. So always trying to improve. So let's change gears a little bit. Keep moving off VWAP there. Exits. Exits was another topic that seemed to pop up a little bit. People kind of seem to feel like there's more emphasis out there on when's a good time to get into the market, like when's a good time to put on a trade. Like, trade location seems to be quite big for many people, but where they struggle with is exiting those positions. So what should a trader think about in terms of exits? Like, I know it's going to vary depending on their approach, but what's a good way to think about exits?
I feel like you have to know what type of trader you are. I feel like you have to say before you put the trade on, even, I am a scalper. I'm going to take this target. It is short term. It will probably keep going. I will probably want to punch myself in the face, and that's fine because there will be another scalp that I will take. Or I'm a position trader. My job is to, like, this is sort of like what I am, right? I want to hold this for a couple hours. I want to trade it in through the end of the day because if it's trending, it's going to keep rewarding me. Or, I'm looking for a swing entry. I am not going to exit this position today, no matter what. I mean, unless it hits, let's say, my price stop. I'm going to give it a day at least to see how I feel with it before I start adjusting my target or pulling the stop higher. I see traders get into trouble a lot when they put the trade on, the trade looks good, it's going in their favor, and then they go, oh shit, I got to have a plan for this. Wait a minute. But, it's like the roller coaster is already going down the track at that point. And I don't mean necessarily down against them. I just mean it's already happening so quickly. Traders will either get overexcited or, maybe even discouraged if it's not taking on, it's not moving very much. I personally like that approach, by the way. If it's not moving within, let's say, 10 candles, or if it hasn't become profitable by a certain degree within 30, let's say 1 minute candles, within 30 minutes, giving yourself almost like a time stop. What ends up happening is you'll notice, hey, the positions that I sit in for a long time that go nowhere, it's almost like I'm waiting with a ton of exposure, a ton of risk, and no real upside. The trades that I am the most right about, and think about your own trading when you hear this, like, don't they immediately alert you to how freaking awesome they are? They just immediately take off, right? They rally, they pull back and hit support, and then they rally again, and they break to new highs. They're almost unequivocally good trades. They are evident. I mean, I think the same thing about like a trader when you meet them, and I'm sure you've had this, like, your trader friends, you meet somebody and you just are like, wow, that guy is just a positive force for some reason. He's prepared. He's helping others. He's got a good mindset. He's even keeled. It's like, I don't know. It takes a lot of inspiration from that. You want to have, like you said about your own episodes, guests. You want to have great clarity of your personality. Who are you, and what are you trying to accomplish? Because if you just put it in practice of, I'll put a trade on and figure it out, I think those are the most famous last words in trading. Let's just give it a little room, and or let's just see what happens, and it never ends well. You know what I mean? You have to define your criteria for exit ahead of time. You have to know what type of trader you are. Yeah. Absolutely.
That's really valid advice. So I really appreciate you sharing that, Zach. I'm just looking at the other questions we got on the list here. Psychology, coaching, and that. I think we've pretty much covered all of those throughout our other answers. So,
what, you don't want to talk for another hour and a half? I'm kidding.
I'm hoping we've still got a few people hanging in there listening.
I know. I was going to say to everyone who's made it through another 2 hours of Aaron and I babbling at each other, no, sincerely, thank you. And I got to say, Aaron, on behalf of every one of the 500,000 downloads, really, man, thank you for everything that you do for the trading community. We were just talking about these people who are like a force for good in the world, and I've heard it universally from everyone. I know you have a few haters out there, and I did actually, guys, I had tried to get Aaron to let me make him read mean tweets about the podcast, because I think that'd be hilarious. But I don't think we have time. We'll have to save that for maybe episode 75 or something like that.
That'll creep up soon as well.
Aaron, thank you so much for having me on, and keep doing what you're doing, man. I know you've got a few things that you want to say about the plans for the podcast going forward too. I mean, I'm sure people want to know, what are the next 25 or 50 episodes going to be like?
Yeah, so I mean, some of the things that I plan on, what can people expect going forward from this point on? I will be taking on sponsors for the podcast. So they'll be pretty unobtrusive, but hopefully I can get you guys access to some pretty sweet deals. I plan on aligning Chat with Traders with some really reputable and solid brands. I also plan on bringing on some people who might not be your typical traders. So maybe like some Bitcoin traders, people in like alternative markets. I was kind of thinking maybe someone who's like professional and sports betting, someone who's a professional gambler. I don't know if a professional gambler would call themselves a gambler. I'm not sure.
The term sounds bad, but yeah, exactly. Somebody who makes their money by speculating in almost certainly a systematic, very quantified fashion. Yeah.
Yeah, because I think there's lessons that can be learned and applied to trading from those who aren't, directly traders themselves. I mean, Jack Little, who was on the podcast a few weeks back, he was, or still is, a high stakes poker player, as well as a trader. And I found it really interesting to hear about how he views at things like probabilistic outcomes. So yeah, I hope to bring on some guys who are, not your typical traders, just to mix things up and keep things interesting. I want to bring on more guys who fly under the radar, who don't really have much of an online profile. Would be cool to hear from some guys who come from that side of things.
I know that's something that a lot of people would be interested to hear about. There are so many good traders who exist in the periphery of this business. I know we've talked about a couple of, like you were saying, the non-traditional, non-trader guys who might make it onto the podcast. And I know some of the guests that he's planning, guys. I can't say their names. Oh my God, they're so good. You should definitely, keep your ears peeled.
Yeah, and I mean, something that you suggested might be interesting is maybe bringing someone on who might have like the role of like a risk manager at like a prop firm, someone who might not directly trade themselves, but is very active in a trading environment, who could give some good insight from that angle as well. So that's all things to look forward to. Hopefully, yeah, have some awesome guests on next year as well. So I can't believe how quick this year's flown by. I can't believe it's episode 50 already. Yeah, it's been a fast year, that's for sure. So, Zach, let's wrap things up here. Where can listeners get in touch with you? So maybe share your Twitter, email, and web address.
Sure. So my Twitter handle is at Zach Hurwitz. That's ZACHHURWIT as in Tom, Z as in Zach. You can get me at email, which is tradingcoachz, all one word, no spaces, at gmail.com. You can also check out my website, thevwap.com, THEVWAP.com. You know, and also I think it's worth mentioning that I'm doing a bit of the coaching work through Chat with Traders. There's just such a phenomenal response. It is kind of, why didn't we do this sooner? And I've met so many good traders already through it. I'm excited for 2016.
Exactly, yeah. Okay, Zach. Well, yeah, I mean, so obviously Zach's offering the free 30-minute session that you can get with him. If you do decide to go past that, then you can just sign up at chatwithtraders.com/coaching and get a full session with him there, get one-on-one access. Pretty sweet deal. If you guys want to get in touch with me for any reason, Aaron at chatwithtraders.com is my email address. Obviously, the website's chatwithtraders.com. And on Twitter, I try to be pretty active on Twitter at chatwithtraders. So you can reach me through any of those avenues. And guys, if you have any questions for either Zach or myself, maybe we missed something, just go to chatwithtraders.com/50, scroll to the bottom of the page and just drop a comment or question in the comments area at the bottom of the page. And we'll be monitoring that very closely. So yeah, look forward to connecting more. All right, Zach, well, absolute pleasure speaking with you. Thank you very much for coming on. It's really appreciated. It's gone a bit longer than we expected, or kind of did expect, but
yeah.
It's been good, and I hope people have found some value from this discussion. Hope to have you on again very soon.
Absolutely, man. We'll have to talk in 2016 when I'm launching the site and the course. I was just going to say, on behalf of everyone who listens, thank you and congratulations on an awesome 50 episodes and 500,000 downloads. That's sweet, man. That's really impressive.
Much appreciated. Thank you very much.
Cool.
All right, Zach, take care.
You too.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it
we're at episode 52, and I had the great pleasure of speaking with Dr. Ernest Chan. While many traders in the quantitative arena will already be familiar with Ernie, I'll give just a quick 30-second intro, and then we'll get into the interview. So I guess you could say Ernie had somewhat of an unconventional introduction to trading. He started out on a research team at IBM, using machine learning and artificial intelligence techniques, teaching computers to understand human languages before joining a prop trading group. Today, Ernie has upwards of 15 years applying similar techniques to the domain of finance and trading, working with multiple prop firms and hedge funds across his career. And as of right now, Ernie is the managing member of QTS Capital Management. Just to top it off, Ernie has also written 2 books, Quantitative Trading and Algorithmic Trading, and he speaks at conferences regularly. Some of the topics we covered during this episode are diversification, capital allocation, generating strategy ideas, backtesting, and a whole lot more. And you can get a full recap on this episode at chatwithtraders.com/52. You can find everything there all in one place. All right, guys, let's do this. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is my guest from Toronto, Canada, Ernie Chan. Hey, Ernie, how's it going?
Oh, I'm fine. Thanks for talking to me, Aaron.
No trouble whatsoever. It's nice to be speaking with you. Thanks a million for doing this. I'm really keen to dig in and get some of your insight on how you've had such great success in markets. I've been looking forward to this. So let's begin by talking about how it all began for you. Firstly, you graduated with a PhD in physics. Where did you go from there?
Well, I went to IBM Research to do something quite different from physics in the field of really machine learning and artificial intelligence. So I spent about 3 years as a researcher there before I moved on to finance.
Okay, and what were some of the tasks that you were working on there with your AI and machine learning at IBM?
Well, the group is focused on teaching the computer to understand human language in all of its manifestations, such as machine translation, such as speech recognition, such as natural language understanding, meaning that understanding how to respond to a human inquiry, like nowadays if you speak to iPhone Siri, they will do whatever you tell them to do. That's the part of the research we did, and also how to retrieve relevant information in response to a human language query, like what Google is doing today. So, but bear in mind that was in 1994. At that time, Google did not exist, and Apple does not have iPhone yet. So we were, in the quite early stages of this kind of applications. But the interesting thing is that the group take a purely statistical approach. We do not have any people actually that really understand linguistics or anything. Everything is based on massive statistical models applied to data.
Okay, yeah, and I mean I can imagine a lot has changed since that time. So share with us, how did you actually get into trading?
Well, after IBM, I decided to move to live in New York City. IBM, though it's a great organization, has a research headquarters really in the middle of nowhere, and I prefer a more urban lifestyle. So I moved to Manhattan, and pretty much the only kind of jobs in Manhattan at that time that are suitable for a person with my background would be in finance. So I joined the data mining AI group at Morgan Stanley, and it's an internal consulting group that consult for many different business units. However, one of the business that we consult for are the trading desk of Morgan Stanley, and so we have given some opportunity to develop trading models. To see if they could be useful to some of our firm's traders. So that's really my first introduction to trading. Is really from a research, supplying machine learning algorithms for trading research, for trading strategies research.
Okay, so up until that point, you hadn't really had any interest or desire to really become a trader. It was more just those were the jobs that were available at the time. Is that right?
That's right. My interest was in machine learning and artificial intelligence. It's not necessarily in whatever domain that it can be applied to. I'm more interested in the approach, the technique, rather than the subject matter. So whether the subject matter is human language or financial data, it doesn't make too much difference to me.
Okay, yeah, that's really interesting. That's actually something I was going to ask you about. So you've beat me to it. But is that still the case for you?
Well, I retain my interest in machine learning and artificial intelligence, but I am also, evidently after focusing on one domain, which is trading, for about how many years that would be? Maybe about more than 15, 17 years. Obviously, I'm now very interested in financial market per se. So yes, my interest has narrowed considerably to one domain, which is finance. But I'm still, of course, interested in the techniques of machine learning and AI, though not on its application to other fields other than finance.
Sure. Okay, so following your position at Morgan Stanley, I mean, what was the next step from there onwards?
Well, the group in Morgan Stanley sort of scattered a little bit after I joined, because the main sponsor of the group was hired away by Deutsche Bank to head up their global equities trading. He became a very senior executive. He was a very senior executive at Morgan Stanley. He was the head of the U.S. equity trading at Morgan. But at Deutsche Bank, he became the global head of equities trading. So, it's a step up for him. But without this big sponsor behind our group, we a little bit at a loss for finding clients. So some of our colleagues decided to leave the firm and go on to Credit Suisse and started our own proprietary trading group. So that's I was asked to join them, and I agreed. So we went off to a prop trading group in Credit Suisse to apply these techniques that we have been researching all along.
Okay, good one. Now, I usually ask this question, and I'm not sure if it's quite so relevant to your background, but I'm going to ask it anyway, and you can give me your thoughts. So, let's say in the period of your first 5 years being involved with financial markets, what were some of the greatest difficulties you encountered that really challenged you?
Well, as with many of the algorithmic trading models, the greatest difficulty is that your model can look very good on a backtest basis, but it is very hard to know if it is actually going to perform well in practice. And when I first applied these techniques to trading, obviously I don't have a lot of experience and intuition about the financial market. And so I approach it in a rather theoretical, or you can say mechanical manner. And it turns out that actually almost every model that I and actually we produce didn't work in live trading. It worked perfectly in a backtest basis, but it's completely failed in the live trading. So that's certainly a big challenge for us.
Okay, yeah, that makes sense. So pretty much what you're saying is that even if you do have the the knowledge of machine learning and AI and those types of things, applying them to financial markets, it still is very beneficial to have an understanding of how the market operates. It's not just as black and white as that's a different data set that you're now working with.
Yes, because at that time at least the data set that is for financial markets are very sparse compared to other sort of machine learning data sets. Typically we would feed millions of articles into a machine learning system for it to teach it to understand human language, for example, literally millions. And whereas for financial data, especially if we are trading daily data, not high frequency trading, but daily data, there aren't enough data to really train the system properly. And so human intuition, I find, was necessary to really constrain the system so that it can result in sensible result, even with very limited data.
Right, okay. Yeah, that's really interesting. Now, Ernie, how would you describe your style of trading to anyone who is completely unfamiliar with your work? So share with us maybe the frequency that you're trading, what markets, and just a little bit of more insight to your quantitative approach.
Well, our focus is really in the intraday trading, but not high frequency trading. The reason for that particular time frame is that if it gives us a good enough Sharpe ratios, and and a good Sharpe ratio indicate a good statistical significance, so that we know that whatever result we are seeing is not pure luck. So there are enough trades to convince us that we are doing something correctly, not just random luck. But it is not high frequency trading, because to go into high frequency trading requires a much higher investment in the infrastructure that at our level of asset is not justified. So yeah, we focus on the intraday trading that holds for several hours on the average. And we focus initially on Forex because that's the most liquid market. And then later on we added the futures models and then also stocks models. So and now we actually dabble in options as well. So we are constantly looking for new models. So and we do not restrict ourselves in terms of what markets we can research and trade on.
Okay, so trading such a wide range of markets, do you find that the strategies you develop for each market are vastly different, or is it sometimes the case that a strategy for stocks may also work effectively on futures?
The strategies are vastly different. I know that there are futures traders, for example, who believe that you can trade orange juice future the same way as you trade the gold futures, and the same way that you can trade oil futures. If they can find such a model, all the power to them, I say, but we couldn't. So we have a separate model for every future. And you might say, well, that sounds like overfitting to the particular future. Well, the results speak for itself. The model that we focus on each market has a very decent Sharpe ratio and a decent return. So, and we have been running it for a while live, and it will not work on any other market. It just work on that single market. So practically for every single instrument, we have a separate model for it.
Okay, and how do you deal with that when you come to markets such as just the equities and stocks markets, as well as options? Or do you have do your strategies operate on just a basket of stocks, or are they still individual strategies for individual stocks?
Yes, stocks are different because we typically run stocks in a market neutral strategy. So essentially a stock selection model. So we have one model to select what stock to buy and sell every day. And so indeed the same selection model is applicable to all the stocks.
Okay, sure. So running multiple strategies at any given time, in your opinion, what are the benefits of doing this? And could you give us an idea on how many maybe different strategies you're running?
we run over 7 or 8 strategy. Now, some of them have very little allocation. Some of them have a large allocation, so they're not equally capitalized. So some of them are in an experimental stage, so they have a trivial allocation. So the benefit, of course, is diversification. As a portfolio are subject to many risks. There are risks due to, for example, if you're long only portfolio, of course, it will be subject to market risk. If you are market neutral, but somehow overweighted on, let's say, one sector of stocks and underweighted in the other sector of stock, so you will still have some factor risk. And even if and there are some other risks that are not so apparent. So, for example, you have if you're running options, portfolio, you might be have a negative vega, so you might be sensitive to volatility. So if volatility goes up, your portfolio will go down. Or you might be sensitive to interest rate. If interest rate goes up, your portfolio will go down. So every strategy has its sort of sensitivity to a particular risk: volatility, interest rate, market risk, factor risk, whatnot. And the goal of a well-balanced portfolio is that you want to neutralize any of these risks. So, and you can't do that with just one strategy. Each strategy is going to have a soft spot, and it's going to be vulnerable to particular risk. But if you're running multiple strategies, hopefully their sensitivity neutralize each other. So, a simple example is a long-short portfolio neutralize market risk. If you are, your long portfolio benefit from increase in stock index, but the short portfolio will be hurt. But the sum of those two, the net of those two sides of the portfolio, will practically have no risk. So that's what they call it market neutral. It will not be affected by the movement of the market index. And the same can be applied to any of these risk factors, whether it's volatility, interest rate, and so forth. And that's the goal of our portfolio, is to be neutral to any or most of these risk factors. Now, of course, we are not that smart. We cannot. We really haven't figured out exactly. Under some weird circumstance, there's some risks that we have not neutralized. But some of the obvious risks we have eliminated because of diversification.
Okay, yeah, that's excellent. Now, let's imagine that an entry-level quant has created a trading system. They have a single strategy and are satisfied with the results from testing it. Is it wise for them to trade this without having other strategies to diversify?
Yes, I mean you can't just sit there and wait for 10 different strategies to all be ready to go before we start trading. So when we started our fund, we only traded one strategy, and obviously it was a very risky portfolio, and so we had a big drawdown. So that was unfortunate. But if we were to do it again, we would have lowered the leverage a lot. So until we get diversified. So yes, I mean, if you have just one strategy, you could also you should start trading it, but one should not over lever one single strategy.
Great. Yeah, I think that's really well said, Ernie. Now, I understand your strategies are designed to catch momentum, and then some are also designed to capitalize on mean reverting. Do you have to decide which strategy types are best for the current market conditions by turning them on and off, or is this something that's programmed into your algorithms?
No, we have not found a way to be able to predict, in the next month, whether a momentum strategy will work or a reverting strategy will work. It is very easy, of course, to do it in hindsight. We say, oh, geez, this last month we should have just run the momentum strategy. We should not have run the mean reverting strategy. But how do you tell next month whether you should do so? We have not found a model that can do that. Other people claim that they have these kind of regimes shifting model, and again, all the power to them, but we couldn't. So what we do is that we, as I said, we run multiple models all at the same time, so that now some model will lose and some will gain. And hopefully the model that lose will lose less than the ones who gain, that gain. That's a very delicate balance, of course. We don't always do it right, so we do have some down months. We are not able to completely eliminate the risk so that we have up months, every month. That would be wonderful, but we didn't get to that perfection yet. But so far, it has been the case that indeed most months are positive, and the down months are down much less. Well, not much less, but less than the up months are up. So we did not suffer big drawdown in a well-balanced fund portfolio. And so, it seems that the approach at least worked to a decent extent.
Right. So with that being said, are there any discretionary elements to your trading style?
Well, there is some discretion element in terms of the allocation to the particular strategy. And the reason for that is that we constantly, some of our strategies are lucky enough to have worked from day one. And although they had been drawn down, never stopped working. So, we've been trading it for more than 4 years, and, they form the backbone of our fund. But there are other strategies that we started and it might work for a year, and then it become quite weak and start to lose money month after month. And so we need to reduce their leverage. Well, in that sense, it's somewhat systematically. We do reduce them based on their loss. But there are other strategy that we just created. Is a new strategy. Now, with a new strategy, you never know how much to allocate to it. I would say that it is imprudent to immediately allocate, just based on backtest. Oh, this strategy has a Sharpe ratio of 2. Let's allocate it based on the backtest Sharpe ratio. I think that would be imprudent, because no matter how well your backtest is, there is always the possibility of A, overfitting, data snooping bias, and B, regime change. So the live, and also thirdly, you don't know exactly what the market impact is until you actually trade it in substantial size. So therefore, when we start a new strategy, we are always starting it at a very low leverage and gradually increase it to the proper allocation. And that process is discretionary, because I don't see that there is a that's no way to sort of systematically increase a new strategy, because whatever systematic way that you can count on is based on backtest, and the backtest already says that this is great. So, but the point is that we don't believe the backtest. Since we don't completely believe the backtest, there's necessary discretion involved in how fast you increase the leverage. So that part, I would say that capital allocation in the face of dynamically changing strategy pool, some of them are dying, some of them are getting born. That process has a discretionary element to it.
Okay, that's really great. Now, I'm really keen to ask you more about backtesting actually in a little bit, but right now I'd like to ask you a couple questions about some of the less obvious differences between discretionary and quantitative trading. So let me ask you this. How does profit distribution differ between discretionary and quantitative strategies? And the reason I ask that is because some discretionary traders will say their profits are quite lumpy. So they'll say that 90% of their profits come from 10% of their trades. Do you find this is also the case with quant trading strategies, or is the equity curve somewhat smoother?
Well, I think that the difference is not between discretionary trading or algorithmic trading. The difference is between mean reverting and momentum strategies. Typically, the characteristic of a mean reverting strategy is that the profit of every trade is very similar. and almost every trade will be profitable, except there are a few trades, very rare trades, that will lose maybe 10 times the typical profit of a trade. That's the characteristic of a mean reverting strategy. Whether you're running a mean reverting strategy by discretion or by algorithm, it would have the same characteristic. The opposite occur for momentum strategy. Momentum strategy is such that a lot of trades will not be successful. In fact, they will lose a little bit of money. But once in a while, there will be a rare trade that will make 10 times as, or maybe more, profit than the typical losses of a momentum trade. So I would say that the sort of the profile of profits that you describe are really, I would say, differentiated by the whether it's mean reversion or momentum. Now, discretion or not, I think that the problem with discretion. Now, there's pros and cons to discretion versus algorithmic. The good thing about discretionary trading, is that you can take into the context of, macroeconomics. There are a lot of variables that you can take into context, like did a major earthquake just happen? Did some major government decision just being made in some corner of the world? Your model could not possibly take into account all those rare events, but a human can. So, a human can say, well, today obviously there's maybe a major default that is looming over Greece, and we don't want to trade the euro bonds or something like that. Then that would be perfectly sensible, a sensible discretionary decision. But your model would never be able to make that sort of decision. So that's the good thing about discretion trading, that you can take into the context and particularly rare events. But the problem with discretionary trading is that a human brain can focus on only very few things at a time, and research has shown that multitasking doesn't work. If you do multitasking, all you get is the degraded performance in every task that we do. So, as a discretionary trader, you're unlikely to be able to manage more than a small handful of strategies, and as a result, the equity curve will not be terribly smooth. And unless you're just running a very high frequency mean reverting strategy, but because of the lack of diversification for a discretionary trader, it is very unlikely that your Sharpe ratio will not be as high as a well-diversified algorithmic trading portfolio, and indeed it will look kind of rugged, the equity curve. And that might be why one might see a different shape of the equity curve, being not as smooth as algorithmic trading. It's simply a consequence of the lack of diversification in the discretionary case. I challenge a discretionary trader to run, 7 day trading strategies simultaneously. I don't know how they would be able to do that.
Yeah, that's very well said, Ernie. Thank you for explaining that. You mentioned in there that while you can't take all news and macro events into consideration, do you take some of these news events and sentiment into consideration when developing your strategies, or is it purely always just based off price?
Well, at this point, we in developing the strategy, we have not been able to take into account the news. But certainly nowadays, there are more and more vendors of news sentiment data. We may be able to incorporate that going forward. But even though the back test does not incorporate news sentiment, there are some exceptional events that we would take into account when we are trading the model live. So there are some rare occasions that we would indeed override a model, in the sense that we will shut down the model because we don't believe that the model has incorporated those events that is coming up. And so from a risk management point of view, we will not trade because of those events, such as natural disaster or major economic event. So That's another place where discretion would come in, is that because our model does not have news data as input, we feel that it is prudent to sometimes override a model and not trade because of some exceptional news.
Okay, yeah, I mean, that makes sense.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now let's talk a little bit about generating ideas. So, I mean, you probably get asked this quite regularly, but what's your process of finding ideas for viable trading strategies?
Well, I'm a sort of a vacuum cleaner of ideas out there in the public. And, I follow a number of Twitter accounts, and these are all accounts which regularly, on a daily basis, publish the headlines of new articles on finance and trading. So I would always make note of those that look interesting, and I will read them when I have time. And and I get ideas from some of them. I also, of course, always look for books on trading, from fairly elementary books to books that stands with equations or full spectrum of them. I regularly consume them, and then also in the course of live trading, oftentimes you will observe phenomenon from your P&L. And that's one thing that really distinguish between a researcher that just sit in the office and research and look at papers and look at data versus a trader who are actually watching the market in a real time, because the information, sometimes your brain would capture information when real money is at stake that you would never be able to capture if it's just backtesting. So I often would get inspirations from some particularly unusual P&L pattern during the day that can be utilized for developing new trading models. It's from a variety of sources that these trading ideas come from.
Yeah, that's a really great point. I'm glad you highlighted that. How do you feel about academic research on market studies and that type of thing? I mean, I think you kind of mentioned it there, but I mean, one of the things I've kind of heard about academic research is one of the precautions that you should take is that it's not necessarily realistic to replicate those results had it been, taken in a live market. I mean, are there any precautions that traders should be aware of if reading academic research?
Yes. Obviously, one should not just assume that these research are going to be profitable. And there are many reasons they may not turn out to be profitable. Some of them are because they have been overfitted to past data. Others are because they are have not taken into account transaction cost, and yet others are because the data they use are just not good enough. So yes, most research, after you read it and you try to replicate it, it might not work after you have fixed some of the deficiencies. However, at the same time, once in a while you will come across some ideas that work, and even after backtesting, and it still stand up to the scrutiny. And and you trade it live, and it continues to work. And we have been trading one such a strategy, so that's proof that occasionally academic research does work. Now, one important point that I have made in my books is that even though a strategy that comes from the academic research might work, it usually does not work exactly as described in the paper. So no matter what source of ideas we generate our trading strategy from, it does not mean that we are just like slavishly copy what we have read. It always means that we have to make major modification. So anything we read in the public domain is to be treated as an inspiration only. It is not to be treated as a recipe. And I've made it very clear in my book also that I have described many strategies, and there are occasionally reader would come back, email me and say, hey, this strategy, after a couple of years doesn't work anymore. What's going on? I say, well, first of all, I'm trading that strategy live, and it continues to work. Why is it that it worked for me but not for you? The reason is that I make modifications to the strategy that is slightly different from what I wrote in the book. So, and I encourage any reader to do the same. And I, in fact, urge them, make sure that they don't copy the strategies that anybody, not me, not anybody, not even a academic researcher's strategy in its entirety. Because obviously, very few people will be foolish enough to just, disclose 100% of their trade secrets in domain, not even an academic researcher. I can tell you that I've corresponded with many academic researchers, and if they are not only just doing pure academic research, but they may have an interest in a hedge fund, or maybe they are trading for their own account, there are some details that they have withheld from the model, and so did I. So it is very critical not to just slavishly follow a strategy that as written on the net or on the book or in the paper, but always make sure that you have modified it to your own taste and scrutinize it in using your own experience and your own criteria before you trade it.
Okay, so you mentioned in there that you have made modifications to your strategies over time. What's an example of making a modification? Like, when do you decide it's a good time to make a modification? And I mean, is there a difference between just making a modification and dropping that strategy because it no longer works? Like, how do you know when to make a modification and when to stop trading the strategy?
Well, there are occasions where it is quite obvious what is causing the strategy to lose money. for example, you might be running a Bollinger Band strategy for mean reversion, and you might find that the strategy lose money when the volatility suddenly increase, so that what the previous width of the Bollinger Band is too narrow to be appropriate for the current high volatility regime. Well, one change you can make is to make your Bollinger Band perhaps the look back shorter, so that it's more responsive to the volatility. Or another way might be to impose a minimum volatility level for your Bollinger Band instead of just slavishly follow what's the past. You say, if the past has very low volatility, you would not follow it. You would still be, setting it at least at this width. That would be an example of how you would modify your strategy to deal with a particular problem. And of course, after you had this bright idea how to improve that strategy, add some feature or make some modification, you can also we must also backtest this new modification, right? It's not just saying that, I believe that this fix is going to do it. Well, of course, we have to go back and backtest it to see if that modification does improve things. Now, oftentimes what it happens is that it doesn't necessarily improve the return, but it might decrease the risk. And that might be an acceptable improvement. Just lowering the risk is oftentimes a great thing. You don't have to really improve the return.
Sure. Okay. Yeah, that's a really great point. And while we're on the subject of backtesting, I mean, let's just dive into it. So, what are some of the major pitfalls traders can experience when backtesting?
Well, one of the major pitfalls is data snooping bias, as we ourselves have experienced in the early days many times. The model is just simply too complicated, and so it just fit the historical data very well, but it has no predictive power. That's usually the main problem with backtesting. And the cure for that is typically to make sure that the model is simple enough and it actually sensible, not just produce good result, but sometimes you have to make sure that it's sensible. It is capturing certain market phenomenon that is perhaps well discussed elsewhere, so that it sort of increase the confidence that the model is picking up the signal, not the noise.
Yeah, and I mean, I guess that kind of comes back to what we hit on a little bit earlier about how it's important to have an understanding of how the market operates, as well as the programming knowledge. So, let me ask you, to what extent can a backtest tell you the likelihood of a strategy producing similar results in the future? Like, how much do you rely on a backtest?
Well, we really regard a backtest as some sort of a rejection of a null hypothesis in statistical testing. In other words, we want the backtest to at least not produce negative results, because if it produces negative result, we pretty much reject the strategy. We don't have to spend further time and money on it. But if the strategy has produce a decent Sharpe ratio, and Sharpe ratio itself is pretty much a significance test. The higher the Sharpe ratio, the more statistical significance the strategy is. So if a strategy has a high positive Sharpe ratio, it really means that we are much more confident in that backtest. Doesn't mean that it will also work in live testing, but a high Sharpe ratio backtest enables us to find out if it is overfitted very quickly in live trading. Because if you have a strategy that, for example, has an astronomical Sharpe ratio, 10, let's say, practically, every day, if not, every week, if not every day, it would be profitable. if you have a Sharpe ratio 10, that's pretty much guaranteed that every week you'll be profitable and practically every day you'll be profitable. So if you run the strategy live for just 1 month, you can immediately tell whether your backtest is valid or not. Because the backtest says that practically every day you're going to be profitable, and then you run it for a month and you find that it has a drawdown of 3 weeks. Well, that immediately tells you that your backtest is not completely realistic.
What's your guide for factoring in transaction costs to your backtest? So when I say transaction costs, we're obviously referring to like slippage, commissions, and market impact, that type of thing. How do you factor that into your backtests?
Well, one main source of the transaction cost is the bid-ask spread, and to realistically model that, one need to use high frequency quote data to backtest, and that's explained in one of my blog article also. Why sometimes low frequency strategy backtesting requires high frequency data, because you need the bid-ask spread in order to bid and ask quotes to figure out exactly what price you're going to execute at. Just having trade prices doesn't help that kind of transaction cost model. Beyond that, we have to look at the top of book quote size. A lot of the strategy, particularly high frequency strategy, that look very good on paper and particularly favored by academic researcher, you will find that it doesn't work beyond the top of book, and that because it assumes that if you are trading just 100 shares, this model indeed is very profitable. But once you intend to execute 1,000 shares or 10,000 shares, this strategy will be completely gone. It will completely fall apart, because when you have to take more than the top of book quotes and lose more money to take the deeper into the book, the backtest will show that it won't work. So that's not only do you need the quote price, but you also need to know the quote size in some of these backtests. And then, not to mention, there are even more problematic issues such as market impact. Once you take the top of book liquidity, how fast the liquidity replenishes itself, or if you put out a limit order there that is a substantial size, is it going to affect the order book? These issues are really in the domain of high frequency trading. Even though you may not be a high frequency trader, but if let's say you're a discretionary trader and you intend to hold for at least a couple of hours this position, but if you put a order into the order book that is much larger than the typical order size, quote size, you are going to affect the order book, and you are going to have incurring opportunity cost. You're going to affect things, and that kind of modeling nowadays being conducted a lot of times by high frequency trading research, and there are a lot of very complicated mathematical models coming out to model that kind of process. But but that's what I'm saying. This is the kind of transaction cost that's much more difficult to deal with. Opportunity cost and the effect on the order book because of your limit order. But I don't claim that we have a grasp on it, but I understand that this is a field of active academic research.
Okay, sure. So let's just do a couple more questions, and then we'll probably start to wind things down. What are some of the common misconceptions people may have around quantitative trading?
Misconceptions.
Okay, so here's an example. Let me ask you this: is quantitative trading just for an elite few who are math wizards, or do you honestly believe it's an angle that can be implemented by anyone willing to put in the work?
I do believe that it is suitable for practically anybody who is willing to at least learn how to use an Excel spreadsheet. I have collaborated with some very successful traders before that indeed have no programming skills except programming a Excel spreadsheet. Not naturally, they are not doing high frequency trading. They are doing trading that enter a position once a day, but that doesn't mean it's not quantitative. Quantitative trading could be a very slow trading. Could be holding a position for 1 quarter or 1 year. That could still be quantitative trading. So one does not need to be a math whiz, and certainly does not need to be a programming computer whiz in order to do quantitative trading. All one needs to do is to be able to gather data and backtest it, no matter what tool you use to backtest. Could be as simple as Excel spreadsheet.
Okay, so a trader who wants to get started in quantitative trading or really wants to dive deeper into the subject and, give it a real shot, where should they start?
I would suggest that they should start from trying to backtest some of the simplest strategies that they know about or they read about in any sort of trading magazine or blog or books. And there are many of them. I've seen some that are really simple. I've read a lot of trading books where the strategies are extremely simple. Such as sell on the 1st of May and buy the index, at the end of October. That how can it be simpler than that? But that's a start. And or some strategies such as saying that we should always buy when the price drops below the 10-day moving average and sell when it's above the 10-day moving average, something like that. That can be quite readily backtested in an Excel spreadsheet. And once you gain confidence in your backtest method, you might want to next learn a simple programming language. I even though I said that yes, it's possible to start as a quantitative trader by using Excel only, but that doesn't mean that's the optimal state of affairs. To improve your ability as a quantitative trader to sort of expand the repertoire of your strategies, one should learn a better programming language than Excel, namely, and I always recommend one of 3 languages: Python, R, and MATLAB. So that's the next step. Once you have some confidence in backtesting using Excel, well, start to learn the programming language so that you can backtest a wider variety of strategies, especially intraday strategies.
Okay, yeah, that's a really great answer, Ernie. And just on the languages there, so you mentioned MATLAB, Python, or R. How do you feel about languages such as TradeStation's Easy Language? What's the pros and cons of going in the direction of more of an open source language, even though I know you have to pay for MATLAB to use that, but Python and R are both open source languages. How do you feel about comparing those to more of a, I don't know, you could probably call it a proprietary language like TradeStation's Easy Language? What are the pros and cons there?
Well, the pro of using a language that a brokerage trading platform provide is that it can be very easily turned into a live trading system. So you can backtest and trade live using exactly the same code and just flip a switch and it will generate real-time orders. So that's very convenient. The problem is that if you want to switch brokerage, all the script that you've written before, of course, doesn't work anymore. If you want to switch to interactive brokers, your easy language will have no use and you have to start from scratch. And another problem with those brokerage languages is that they tend to be rather limiting. They are not designed to encompass. So just quick, very extreme example. Let's say you want to build a neural network to generate trading signals. I challenge you to do that with easy language. It's just not possible. I don't believe it's possible because if you want to build a neural network from scratch, it will probably take months. And maybe even months won't do it because there will be many bugs unless you're an expert in building machine learning languages. for a MATLAB trader or a Python trader or a R trader, we would not be building a neural network from scratch. We would be using a neural network library that is ready-made in order to generate training signals. So that shows you the flexibility that is inherent in one of these standard languages. Whereas, if you want to use the same neural network program in easy language, well, you have to wait until TradeStation develop it for easy language, which might be never.
All right, Ernie. Well, thanks for summing that up. Now, you've got 2 published books. One is Quantitative Trading, and the second is called Algorithmic Trading. What can readers expect to learn from reading your 2 books here?
Well, I think these 2, the first book particularly answers some of the questions you raised earlier about how to get started in quantitative trading. As let's say you are a discretionary trader, or maybe you never traded before even. Maybe someone is a new graduate or came from a different business. Let's say they are an accountant and wanted to get into trading as a hobby or as a full-time job. Well, the first book is really geared for that type of people. It really starts from the basics. The second book is more of a more focus and perhaps go into some of the trading strategy in more depth. And some of the techniques are also more complicated. Things like Kalman filter, the vector auto regression, vector error correction models, this sort of stuff, or maybe a bit off-putting to a complete novice in trading, but they would be useful to someone who has traded in a systematic manner for a while, but would like to learn newer techniques. So that's what the second book is about. It's really introducing something a bit more detailed and more focused and more complicated to the traders who already have been doing some quantitative trading already.
Okay, yeah, and I mean, both those books are definitely on my list to read, and I hope to get stuck into those very soon. So I'll link to those in the show notes at chatwithtraders.com. Ernie, where can listeners go to find out more about you, and where can they connect with you?
Well, I run a blog, epchen.blogspot.com, and it's open to comments. Anybody can comment on it, and I try to answer them very rapidly to any questions. I have also I have been used to updating the blog with new articles more frequently than now, but now I'm writing a new book, so I don't have much time to update it. So, but despite not having a new article published every month, it doesn't mean that I don't answer the comments that readers might want to post on the blog. So that's certainly a great venue. The other one is that on my website, epchen.com, I listed my email, and a lot of readers are communicate with me just by emailing me. So that's sometimes when a reader asks me questions that are generic, I would direct them to the blog because I like to answer a question so that many people can benefit at the same time. But other times, if they just want to ask for advice on a particular situation that they have, certainly feel free to email me directly. And and then also, of course, I run courses online and off, and some of the people who have read my blog and books would come to these seminars, and we could have a real-time conversation as well.
Excellent. Yeah, well, I'll link to both your blog and your website in the show notes also. I definitely encourage listeners to head on over and check out those links. Really great resources there. And Ernie, you're also on Twitter, I believe.
Oh yes.
What's your handle?
That's right. In my blog, I oftentimes include my Twitter feed, and I don't tweet very often. I don't want to, burden our followers with too many irrelevant information. But I do tweet once in a while when I see some interesting information out there. Feel free to follow.
Okay, and what's your Twitter handle?
Chan EP, CHANEP.
Okay, good one. And you mentioned you've got a new book coming out. When can we expect that?
Well, that should be out. Well, it usually take a year to write a book, and I just started very recently. So, and then it will go through editing and reviewing, and then production and the marketing. So, we probably should see it in the first quarter of 2017.
Very cool. And what's it about? Is it a carry on from your last two?
Yes, the topics will be largely different from before. It will, following the second book, it will go into techniques that I have not discussed before. For example, machine learning techniques. For example, options techniques, trading options, which I have not touched on before, and so forth. So it will be, a bit more advanced techniques than what I've discussed before. And also, however, I will just sort of look back into some of the strategies that I've discussed in the first two books and see how they did, post-mortem in some sense for some of the strategy who died, what caused death. And hopefully we'll find some that didn't die either.
Yeah, that sounds really good, and I'm sure many people are eager to get their hands on that. So, Ernie, thank you very much for doing this. I really appreciate you taking the time. It was a lot of fun speaking with you, and I mean, I sure learned a lot. I'm sure the listeners did too. So, yeah, big thanks for doing this, and let's speak again soon.
Great. I enjoy talking to you too. So, have a good night.
All right, awesome. Thank you, Ernie.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way.